down. And if they are stuck down, will a lot of the tariffs which the US has collected have to be refunded? What is the size, scope of refunds, etc.? We'll have to wait and watch. This is extremely important for the rates market and equities, but more rates because, the Trump, for example, has said that they're going to take in $600 billion worth of tariff revenue. All of that has gone into calculation about US fiscal health and fiscal situation. So if some of this money has to go out, I mean, I think it can put, meaningful upward pressure on yields. We'll have to see how this goes. But Friday is essentially the date, and we'll talk more about this. Markets, of course, sold off yesterday. The Nifty, day before yesterday, it was just the Nifty. Broader market looked healthy. Yesterday, everything rolled over. The Nifty was down, but broader markets also favored a pressure. But Reliance, of course, single-handedly responsible for the 100-odd point cut that we saw on the index. I'll just leave you with the 20-day, and the strange, ironic thing is that the market with every passing day has been coming closer and closer to the 20. So 26,024 as of yesterday's close on the Nifty, 59,335 on the Nifty Bank. I think the GIFT Nifty is indicating another 60-80 point lower start, implied open. Bulk of Asia, except I think South Korea, most markets are also sideways to slightly lower, but they've had a decent start to 26. We've not. So that's essentially the conundrum we find ourselves in. How's the F&O numbers looking, the positioning, the data? Nigel has walked across with that. Nigel, over to you.
Well, let's start off with the cash market volumes first. The cash market, we have the institutions that were buyers, and the FI activity is gradually picking up. So good to see at least institutions, they were net buyers. What did the FIs do on index futures? Well, they went ahead. They added 2,000 long contracts. They added close to 2,000 short contracts. But on stock futures, they went ahead and, in fact, added more number of shorts than longs in the ratio of close to 3:1. That could be partly because of an arbitrage as well, but that's in terms of the futures action. Net-net, they're still short on the index futures with close to 87% of their positioning on the short side. It's come down a little bit from that 90% odd. The PCR, we had pointed a couple of trading sessions ago, it had gone to around 1.5, which is the upper end of the range. Now it's cooled off, post yesterday's weekly expiry that played out, and now the PCR has come more or less in line at around that 0.9 or thereabouts, closer to the lower end of the range. That's because call writers are back. 26,200 call, 26,300 call. Aggressive writing is what you've seen on both those two strikes, and the premium as well has come down a little bit. So punching in these premiums that we are seeing and the recent high, well, the recent high of around 26,373, that becomes a bit of a resistance level just in the near term. And that was on 5th of Jan that we saw that high on the Nifty. Support, though, that's closer to around the 20 DMA, which is at around the 26,000 odd mark. And keep in mind that the last couple of trading sessions, the Nifty has been falling because a couple of large heavyweights have been under pressure. Case in point being HDFC Bank as well as Reliance Industries, both of them, they dragged the index down on the last couple of trading sessions. So going by what the GIFT Nifty is suggesting, that we could be starting off on the back foot, I think today is a good chance that we see a recovery if we do get that 70 to around 100-point downtick that the GIFT Nifty is suggesting. So that's going to be important. Moving to the Nifty Bank, well, that will have to do the heavy lifting. 20 DMA is close to around 600 points away from where it closed yesterday. And that yesterday as well was a relative outperformer. It needs to continue its outperforming ways. ICICI Bank, case in point, yesterday did very, very well in trade yesterday. So the heavies, they need to give up the underperformance, HDFC Bank as well as Reliance Industries. And in terms of individual stocks that we're looking at, silver has gone through the roof. So you have, Hindustan Zinc, that's the only pure play on silver. Yes, they've had some part of their quantity, but if you want to play silver, then it's only Hindustan Zinc. And Vedanta is the parent of Hindustan Zinc, and you get exposure to other commodities as well. So I'll continue to keep an eye out on both these two stocks. But the GIFT Nifty, suggesting a bit of a downtick. I think after the last couple of trading sessions downtick that we've seen, put together today's downtick, good chance we see a recovery intraday.
Well, thank you very much for putting that in context, the macros, the F&O, the technical levels. But back to Trump, can't keep him out of the news. In a very interesting move, President Trump has warned Republicans in the United States House of Representatives that if the party, the Republican Party, fails to win a majority in November's midterm elections, he says he will get impeached. Speaking to legislators, he stressed on the importance of keeping control of the chamber where his party has a razor-thin majority. Listen in.
You got to win the midterms, because if we don't win the midterms, it's just going to be, they'll find a reason to impeach me. I'll get impeached. We don't impeach them. You know why? Because they're meaner than we are. We should have impeached Joe Biden for 100 different things. If you have the right president, it's good. You have the wrong president, if you have the wrong president, nothing's good. Tariffs are the least of your problems. We found that out for 4 years. We had the worst president, did the worst job. They had the worst policy. We have to even run against these people. Now, I won't say cancel the election. They should cancel the election because the fake news will say, he wants the elections canceled. He's a dictator. They always call me a dictator.
Well, that is Donald Trump on Venezuela and the high stakes for the midterm elections for him, saying that if his party doesn't get elected, they will find a reason, the Democrats, to impeach him. Jeffrey Dennis, independent emerging markets commentator, is now joining us on the show. Jeffrey, thank you very much for joining in. This is Rima here. Well, first wanted to get your thoughts in on what the White House had to say about Greenland, saying that U.S. acquiring Greenland is now a national security priority. And even the odds now of U.S. controlling a part, of Greenland has risen to 38%, a good 8 percentage points higher than what it was last week. How do you see this play out, and what are the market implications of a second attack after Venezuela?
Well, I think it wouldn't be an attack anyway. I don't think in the conventional sense. I mean, you're not going to see, as far as I can tell anyway, Trump sending in troops and helicopters and planes and capturing the prime minister of Greenland. I still think it's extremely unlikely that this will happen. And the major reason I think that is the case is because if the U.S. tries to take over Greenland, succeeds in taking over Greenland, basically this destroys NATO. And I think that's not something that probably even Trump would want to imagine. Now, I think a more likely scenario is that he's putting Greenland and therefore Denmark under a lot of pressure because he wants some sort of deal which will give the U.S. sole access to all the various minerals, the rare earth minerals in particular, that Greenland has got. And I think he's saber-rattling aggressively here so he gets some sort of mineral deal. I still think the chance of the U.S. trying to take over Greenland in military terms is pretty low, frankly, and much less than 38%.
Jeffrey, hi, morning.
Good morning.
I think 50,000 people live on Greenland, right? You don't need military. You don't need a military intervention. They can just land up as friendlies and plant a flag, and that's it.
Yeah.
I mean,
yes.
I don't know. But, it's the thing is, I was saying earlier, right? They've so far what they've said they will do, they're doing it. And now Greenland, of course, they've said that, well, we need it for our security and things like that. The letter which a bunch of European countries sent last night, I mean, does it have much meaning? Are they really going to stand up? Wouldn't the US be able to push its way through in some shape or form?
I think at the end of the day, the letter does matter. And don't forget, we did invent, or the Financial Times invented, taco last year. Trump always chickens out. I think he is, as I say, I think he's saber-rattling because he wants control of those minerals. And there's no doubt that Greenland is very, very, what should we say, strategically placed geographically between Russia and China, etc. It's going to be a very important part of international sort of international tension, international pressure, if you like, over the next few years. But I just don't see it happening, frankly. It just seems so extreme. And I think at the end of the day, they want the minerals. I don't think they particularly want to go through the risk of, personally, I don't think anyway, to run the risk of effectively tearing NATO up. Now, don't forget, Greenland is not a narco-terrorist state. Yeah, the president of Prime Minister of Greenland is not a narco-terrorist, as he alleges Maduro has been in Venezuela. And we already know that the impact of the U.S. attempting to take over Venezuela and quote-unquote running it, as President Trump says, is going to give potential green light for Putin to do more in Ukraine. And who knows, even China to start invading at some point. 2027 is the year everyone's talking about Taiwan. So I don't think he needs to create even more territorial pressure elsewhere, such as by trying to take over Greenland, because all that would do is empower China and Russia even more. So I'm afraid I don't buy all this time.
Hi, Jeffrey. Good morning and good to see you, Ben. From a humanity perspective, it's debatable with regard to what Trump does. But from a market perspective, what's your take? Case in point being, he's invaded Venezuela. In all probability, there'll be more crude that comes out of there and puts a lid on crude oil prices. In that sense, do you think that inflationary worry goes out of the way? And maybe, in fact, crude oil prices as well stay at depressed levels. What's your take?
I think crude oil prices do stay at depressed levels. I mean, there's a lot of supply in the world, and the global economy has got definitely pockets of weakness, including, of course, the Chinese economy. Although the US economy probably accelerates next year because of the tax cuts that are going to be coming through. The logical sequence of events, as far as I'm concerned, would be when you do something like you take out the president of Venezuela, the oil price should have gone up and should have gone up significantly because it's a big geopolitical event and it increases geopolitical risk around the world. And then logically, when over time the US companies come in there, restructure the industry, repair all the very badly damaged oil infrastructure, you get more oil flowing and therefore oil prices come back down again. I think given the supply situation in the global economy for oil, I think basically the markets are ignoring the first stage of this anyway and saying there's no obvious reason why, despite geopolitical risk, which is not, by the way, focused on the Middle East at this point, which is still where a lot of global oil comes from and from the US itself, I just think this is why you're seeing oil prices staying fairly calm. And logically down the road, unless the global economy starts to really spurt, if Venezuela, if we do get an increase, a sharp increase over the next 5 to 10 years in oil production out of Venezuela, that is going to be a negative factor for the oil price. But that's going to take a fair time, I think it's fair to say. I think oil is going to trade below $60 for Brent before too long again. And I think best bet is the range is somewhere between 50 and 65, taking 2026 as a whole.
For now, the headline is Trump has said that Venezuela will give up to 30 to 50 million barrels of oil to the U.S. We don't know if it's one time, it's going to happen every month. So those details are missing. But the statement goes on to say that money will be controlled by me. So personal discretion of a president.
Arima, interestingly, at the peak, right, early 2000s, Venezuela used to produce, at the peak, 3 million barrels per day. So what he said, I don't know where 30 to 50 million barrels comes from. It's basically between 10 and 20 days worth of oil production at the peak levels. Obviously, this is a very small number. Is this the cost of the operation, for services rendered, quote unquote? I don't know. But, Jeffrey, do you have a view? Why 30 to 50?
I have no idea. It's a small amount. But I think, and I'm glad you've come back to me because I'm going to be careful what I say. After all, I do live in the US and I am a US citizen, although also a UK citizen. But the stuff coming out of Trump's mouth now is getting crazier and crazier, frankly. Even what he's just said about, where you just given us the clip on, if we lose the midterms, he gets impeached. Well, maybe, but that's kind of an odd reason to want to, win the midterms. You want to win the midterms because you want to get your legislation through. So I don't know where this number comes from. All I know is ultimately, given that Venezuela's got these vast oil reserves, the logic is that once you repair the infrastructure, which will take a long time, several years, Venezuela probably goes back to a 3 to 4 million barrels a day. That's what your math told you, of course, by saying 30 million, it's 10 days worth. That's what the goal will be. And that will be important in terms of the overall global output of oil. But right now, I think in the short term, the driver of oil is going to be, do we get further increase in geopolitical tensions? Where does the dollar go? If the dollar goes down further, that'll push the price of oil up. And what will the global economy look like in 2026? And I think the global economy's got some very, very big weak spots in 2026, notably China, to a certain extent Europe, to a certain extent the UK. The US will look better. But right now, I think the markets are correct look through all of this and assume there's not going to be any major moves as far as the oil price is concerned over the near term.
All right. Thank you very much, Jeffrey, for joining in. Always a pleasure to listen in to your views. Let's also tell our viewers what we've lined up on our show today, the interaction. So first up, 8:35, we've got Marco Papik of BCA Research to discuss the global markets and the brewing geopolitical tensions. 9 a.m., we bring you a special chat with the management of Thermax. 9:20, Manishi Ray Chaudhary of Emmer Capital Partners will be the market master for the day. 9:35 a.m., we've got a special discussion lined up around gig workers, the standoff between the gig workers, the union and the companies, and talk more about the draft social security rules. Following that, the management of Capri Global will be joining with us at 9:45. And towards the end of the show, Lata will speak to Sakshi Gupta of HDFC Bank and Upasana Chachra of Morgan Stanley on the advanced estimates of GDP, which will be announced later today.
Well, time to slip into a short break. We've got a lot of stock-specific action to track on the other side of this break. For the time being, I give you a sneak peek into our top 10 list. Titan, Senco, Biocon, Godrej Consumer, Lodha Developers, Devyani, Sapphire Foods, Credit Access, as well as Kalyan Jewellers. All of them will be reacting to positive news flow, but Jubilant Foodworks will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. The earnings season is just getting kick-started. So many pre-quarterly updates to talk about. So let's prep you up for today's trading session with CNBC TV18's list of top stocks for the day. But first up, it's Ekta on Biocon. Hi, guys.
Hi. Biocon will be in focus because they have indicated to the exchanges that they will be introducing plans on 3 new oncology biosimilars at the JPM Health Conference 2026. It takes place every January every year. And they will be introducing 3 oncology products, which include trastuzumab/hyaluronidase, as well as Opdivo, as well as Keytruda. Now, remember that all of these or many of these are blockbuster oncology products. For example, Keytruda is worth around $29.5 billion in terms of market size. Opdivo is $9.3 billion and Herceptin SC is $1.72 billion. Keytruda is one of the most successful blockbuster oncology drugs, so they will be filing the biosimilar for it, and that should be the big news that Biocon should possibly be reacting to. The drugs are among the largest oncology biologics patents which are going off in the next 5 years. Remember, they already have 17 oncology assets. The total oncology opportunity, including undisclosed assets, could be 35% of the global oncology market. Remember that they've just announced plans as of now. They've not detailed or they've not got approval, and hence it could be a sentiment positive as of now for Biocon, because the way they execute these plans will be something that the street will look out for.
Okay, all right. Thanks a lot for that, Ekta. Well, hopping across to Mangalam. Titan, Mangalam, how was that quarterly update?
It's a solid update coming in from Titan. Yes, the gold prices were up 66% year on year, but importantly on that base, Titan's reported a 38% domestic sales growth. Jewelry business of the company has grown by 41%, led by Tanishq Zoya Mia, which is about 40%. Carrot Lane itself has grown 42%. Watches as well, there's a 13% growth, but the internals out there tell you that there is margin accretion because smartwatches, which are low margins, and the category decline has seen a decline of 26%. Analog watches have grown 17%. Other businesses, eye care's up around 16%. Emerging businesses led higher by women's bag as well as fragrances, not particularly so much for Taneira. The important part is the revenue growth, while it's driven by average selling price, the buyer growth has been absolutely flat, which is a positive because, when a 65% gold jump happens, you expect the buyer growth to decline. So that flattishness is positive and ahead of estimates. Gold coins nearly doubled year on year. That was expected. Plain gold category grew well as well. And amidst all of this, studded clocked its best performance in this fiscal so far, grew mid-20s. So all these factors should point northward for Titan. The stock is already at a record high. I see some green on that one.
And what about Godrej Consumer, Jubilant Foodworks, discretionary snacking? Is it in vogue?
Well, Godrej Consumer, a lot better than what we were expecting because the India business has seen better demand conditions. We've seen the business delivering double-digit revenue growth, closer to double-digit underlying volume growth. And that will be music to a lot of the FMCG analysts' ears because near double-digit volume growth is something that we haven't heard in a very long time. Home care segment did well. Personal care also grew in mid-single digit. And EBITDA margins, they say, after many quarters of disruption, will return to normative range. For India, the normative range is between 24 to 28%. So that's a positive. Indonesia, the competitive pricing pressure continues. They believe that they've seen the last of it, and maybe from FY27 there would be improvement. So things are on the mend for them. Consolidated double-digit revenue growth, double-digit EBITDA growth, going with green for Godrej Consumer as well. For Jubilant Foodworks, now, the company has been an outperformer for the last 4 or 5 quarters in an otherwise weakening QSR area. And right now, the high base is, coming to the fore. So their revenue has grown by about 13.5%, standalone revenue up 12%. But the like-for-like growth in India is just 5%, as against, 12.5% that the company reported in the same quarter last year, or the near double-digit volume like-for-like growth that the company has been reporting over the last few quarters. I expect that Jubilant Foodworks will now, going forward, underperform for major reasons, like the others will have a low base to work with, while these guys have a high base to work with. And secondly, the merger of Devyani and Sapphire should increase the competitive intensity in this space. So going with mild red on Jubilant Foodworks.
We await a pizza, a burger, or anything you got to offer, Mangalam. For the time being, we'll take your take on Jubilant Food. Well, let's have across to Sonal, though. Lodha developers in focus, they came up with their quarterly update as well. Sonal, take it away.
Good morning, Nigel. It was a strong set this time. They did see a good growth, best ever quarterly sales, where the sales were up 25% on a YY basis, 23% sequentially. Collections, though, were down 17% on a YY basis. The company says the strong momentum this time came in from sustained sales, basically the existing projects, and they have a significant launch pipeline in Q4 as well. They will achieve their FY26 guidance of 21,000 crore rupees. However, the collections were lower on a YY basis because the base year had one-off extra collections that came by. That's why it looks optically lower. They added 5 projects with a gross development value of 33,800 crore rupees in 3 cities. Now remember, their yearly guidance was 25,000 crore rupees. So in one quarter itself, they've exceeded it. And 9-month business development is around 60,000 crore rupees. So looks like FY27 will see better sales coming in from these projects. Jeffrey says that the large business development raised the medium-term growth visibility, and this will enable management to aim for higher profitability in the upcoming acquisitions. So going with green on Lodha today.
Thank you very much for that. Mangalam, back to you. What were the key takeaways from the Devyani and Sapphire conference call yesterday?
Well, it was all about synergies. It was all about merger. It was all about creating the largest QSR chain. But remember, ever since the deal was announced, post-merger, the post-merger announcement, the stocks have seen a big decline. One could be, sell on news, buy on rumor. And the second part is the street was disappointed that there was no premium for Sapphire as against, what was expected earlier. Key takeaways are, the merger will be completed in the next 13 to 18 months, given all the regulatory approvals that are required. The tech stack for both of them will be common, for which they will have to make a one-time payment of 320 crores to Yum Brands. The capabilities for the full entity, however, will be ready by June itself. 60% of the synergies will be aligned in the first year, 100% by the second year of the merger, and they're under no stress to launch or exacerbate, the expansion of Pizza Hut, because that was the underperformer out there. But they do believe that, despite not expanding much out there, they can achieve low double-digit growth for Pizza Hut, and the contribution margins for Pizza Hut would come closer to KFC. Sapphire Mauritius stake, now this is an important one, will be 25%, will be maintained at that itself, and they can't sell unless they have the nod of Yum Brands, so that immediate sell overhang goes away as well. Because of some clarity emanating from the conference call and the correction that these stocks have seen, I'm going with green.
Okay, all right. Mangalam, thanks very much for that. So that's Devyani and Sapphire in focus. Credit Access Grameen is the next one, and this is perhaps the best run MFI name. Gaurav is here with details. Gaurav, over to you.
Well, as for Credit Access Grameen, Q3 seems to be a turnaround story, and the reason being that if you look at disbursements, that grew almost by 14% on a year-on-year basis, and at the same time, if you look at gross loan portfolio, that increased by 7%. But the story does not end here. Now, what is important to watch is that the asset quality, which is improving, and the disbursements on a month-on-month basis, as per company, they say that in the month of December, they have seen 26% growth on a month-on-month basis in terms of disbursement. When it comes to asset quality also, we saw asset quality improvement across the segments. Specifically, if you look at the X-bucket collection efficiency, now that stands at 99.7%, and at the same time, the key focus area, which was Karnataka, which contributes around 30% of its gross loan portfolio, there we saw improvement in asset quality. So we've got PAR 0 plus, where we saw Karnataka improving almost by 120 basis points. Now a pinch of salt came from Maharashtra and Madhya Pradesh, where we are seeing some increase in this level for the last 2 quarters. But all in all, at least for this quarter, it seems that the focus will be more on the overall collection efficiency improvement, overall asset quality improvement, and the growth which is coming back. And as a result, going with green for Credit Access Grameen today.
Okay, and back to Mangalam. More news on gold. Senco and Kalyan Jewellers, how did their updates look?
Well, if Titan's doing so well at their base, then obviously, the others are also going to do well because of the same big surge that we've seen in gold prices. Senco Gold, the first 2 quarters of this year weren't particularly good. The third quarter more than makes up for that. A 51% revenue growth is what the company has reported because of higher gold prices. And remember, the third quarter also had the festive season and early wedding season. Retail business for them grew 49%, 39% same-store sales growth. Diamond jewelry as well grew by 36% for them. They've opened 4 new stores, and at the same time, now, because of the performance of the third quarter, they're on track to deliver over 25% growth in this financial year. A lot of analysts were concerned about that. Kalyan as well, I'm going with green. Third quarter, India operations saw revenue growth of approximately 42%. Same-store sales growth coming in at 27%. International operations doing well for them as well, up 36% for them. Candere, now for Kalyan Jewellers, the growth driver has been what Carrot Lane was for Titan a few years ago. Candere is their value fashion, segment where the growth is approximately 147% on a small base, and they've launched 21 stores in India, 1 in the United Kingdom, and 14 Candere stores in India as well. So all these factors would make Kalyan Jewellers a positive move today as well.
Thank you very much for that. Here's a quick recap then of the top stocks. Stocks with positive news flow are the gold jewelers, Titan, Senco. You've got strength coming through in Kalyan Jewellers as well. But outside of that, Biocon, Godrej Consumer, Lodha Developers, Devyani International, Sapphire Foods, and Credit Access Grameen. The only stock which could open in the red today on the back of softer growth projections is Jubilant FoodWorks. All right, now let's go across to Manisha now for a roundup of what's happening in the world of commodities. Another day, new high and big gains in silver.
Oh, yes, absolutely. So I'll start with silver, actually, where we are trading at a new record highs of $83.6 an ounce. And we've seen prices gain up by 15% now for this current year as well. So the strong gains just about continue in silver. It's the arithmetics, really, because the markets are looking at structural imbalance between supply and demand. There is rising industrial demand. And then it also is about a very strong investment demand, whether via ETFs or physical buying, that has been supportive for silver. Not just silver, we've seen another all-time high in copper on COMEX, on London Metal Exchange. Copper prices have been gaining on the back of threat of U.S. tariffs on copper. And there also is a statement from China Securities Company saying that the global market will see a shortage of more than 100,000 tons in 2026. That has led to further gains and sentiment positive coming for those prices. But then again, whether it comes to metals, everything seems to be rising up. Tin is trading at a 1-year high. Aluminum is trading at a 3-year high. Nickel is trading at a fresh 15-month high. So the fund allocations and the rebalancing, as we see, of money for 2026 clearly seems to be coming a lot in metals.
All right. Manager, thank you very much for that. Well, it's everything rally across the board, right? I mean, metals not to be left behind. We'll take a quick commercial break here. Marco Papik of BCA Research joins in on what else but geopolitics and everything which has been happening to kick off 2026. Stay tuned. Coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, as promised, let's get straight to Devin Choksi, Managing Director at DR Choksi FinServ, who joins us on the show. Hi, Devin. Good morning. Good to see you, Ben. Devin, I wanted to ask you about some of these quarterly updates that did come about, and they're looking quite good. Whether you look at Titan, Kalyan, Senco. First, let's get your view on Titan, because that's the big name. Your view on it?
Nigel, good morning. Both, I think, the domestic operations as well as the international operations, the growth that they have reported in third quarter is probably outstanding. Maybe I think in the recent quarters, I think this kind of growth has never been seen. So certainly one can argue that there is a good amount of buying power following the gold price rally, whatever you call it as. But I think there is a good amount of buying which is happening in the economy. That's how I think you can summarize, I think, this particular business. In my viewpoint, I think everything is good at a price. Probably, I think everything is now priced in as far as I think the business is concerned for most of these companies which you mentioned, including Titan. So I guess I think while the business continues to offer promises, but I think the valuations are steep in my viewpoint. From investment perspective, if one is invested, one stays on. If fresh investment, definitely I think better opportunity to wait for.
What about Senco or a Kalyan? I mean, they're outpacing, of course, smaller size, but their growth is higher than that of Titan now for many quarters. Would you look at Senco, Kalyan?
Yeah, both are looking equally interesting, I think, from a growth perspective. But again, I think one would like to look at the valuations for all these companies. I don't think that I think the valuation comfort comes easily. In past also, we have seen that whenever the valuations they ran ahead of the expectations, probably on because of expectations. And I think without, I think, the substantial business growth, probably I think those valuations have not sustained. So in my viewpoint, today's growth is well priced into these stocks. And as a result of which, one would not be very aggressive in venturing into them for buying purpose.
IEX is the other one, Devin. I mean, it was like a crazy move in the last hour as the hearing started. The next hearing is on Friday. Any thoughts at all on this one?
I don't know, Prashant. I think would love to, wait for the complete hearing to get over and then possibly, look at it. Maybe the market has in anticipation given a sharp jump of around 10, 11%, yesterday. But would love to, see how exactly the decoupling means and what exactly it can make the difference in the business of the company. No view immediately. I think would wait for some more study on the subject.
So wait on IEX, wait for the verdict on Friday. You don't like gold jewelry companies because they're expensive. So in the quarterly updates that we've had since the beginning of this week, any particular stock that stood out which makes a good investment case to buy?
Well, I continue to like, the consumer lending companies, NBFC companies, which have been expanding their book size in a systematic manner. Discretionary, non-discretionary, both consumption states are showing higher amount of growth. And these lending companies like Bajaj Finance, Bajaj Housing Finance, I think they are probably among those who are actually capturing the larger pie of the market growth. If the market is growing in a single digit or maybe slightly higher double digit, I think they are basically growing about 20% rate of growth. So yes, I think that is something which I would continue to like because of the integration of the technology that they have done in form of capturing the newer customers, expanding the loan portfolio books, and processing the loan at the same time at a efficient rate. So all in all, along with the growth, the profits also is being seen and with the lowest amount of the NPS. So we like, these companies from investment point of view.
Devin, thoughts on Reliance, which of course was down 5%, 4.5% by close. So that is one. And Trent was down sharply, right? Down 9% after revenue deceleration continued in the third quarter. Your thoughts?
Particularly Trent, I think the valuation has caused, this kind of injury, I would call it as, because I think the valuations have remained very steep. And we have in past also talked about this subject. I think there is no scope for any kind of error if the valuation remains higher. Business generally don't move as per the analyst expectations always. So from a perspective of looking at the company, nothing wrong with the company. However, I think the correction in the price is largely due to valuations. Reliance to me, appears to be a beneficiary of the entire saga which is going on. Assuming that the Venezuela crude is available at $8 to $10 discount compared to Brent crude, Reliance's refinery is a capable refinery to process this heavy crude, and that's where probably I think this company should be in a better position going forward. Maybe market reacted on yesterday's news of Russian crude oil import, etc. But that could possibly, once the company has clarified, in my viewpoint, I think that will go out of the way. One will have to look at how exactly they absorb the cheaper food, heavier food, which basically gives them the power to generate higher amount of GRMs as well.
I'll say this, right, Devin, and you've tracked Reliance for a long time, much longer than I have. Back in the day, I remember Reliance single-handedly used to be the biggest buyer for Venezuelan crude. It's one of the few very large refineries in the world which can process very heavy sour crude, which is exactly what Venezuela produces. As more oil starts to flow out of Venezuela, actually at the margin, it benefits a very large refiner like Reliance, which can handle that kind of crude, not the light sweet crude, which most refineries in the US can. So it'll be interesting to see what this would mean for the company, but it'll take time because underinvestment in oil infrastructure in Venezuela, etc., all of that we'll have to take note of. What else is on your radar, Devin, in terms of single stocks?
Well, I think we continue to believe that auto and auto ancillary space will offer bigger opportunities from an investment point of view. Ancillaries, which are catering largely and making a good shift towards EV, are the ones who are likely to be the bigger beneficiaries in the coming years as well. So we continue to like, some of the auto ancillaries, the likes of Minda Corp, Minda, those companies which are well positioned, back-ended with the proper R&D, which provides to their customers, the complete system in place. We believe that I think such companies are relatively, I think, better positions to take the advantage. We also like, I think, the metal commodity as a direction, particularly the copper. We believe that I think, given the kind of thrust that we are experiencing and will continue to experience in the data center space, I believe that I think the requirement of the copper, be it the cable as well as I think the other infrastructure which is required to be set up, I believe that I think it's going to be the prime requirement. So from commodity perspective, the copper commodity looks relatively, I think, much stable to us. Maybe I think the Reliance, which we mentioned, that also remains, I think, a good convincing story because they are creating a complete circular economy. On one side, I think having the solar power converting into the green hydrogen into, I think, used in the different activities like data center as well as in refinery. My belief is that I think they are going to be structurally bringing down the cost in their operations and in turn can generate significantly large amount of profits through this circular economy operations that they are creating through renewables. So we love, I think, such kind of propositions from investment perspective.
Thank you, Deven, for joining us this Wednesday morning. For now, we need to slip into a very short break. On the other side, we'll connect with Sudarshan Sukhani and Mitesh Thakkar to get in a few technical trading ideas. Stay tuned. Welcome back. Asia, by the way, is softer today. So after 2 days of gains, there is a bit of a pullback. Profit booking visible in the Nikkei, which is down close to about half odd percent. Hang Seng has extended the loss to nearly 1%. There's one market which stands out, and that's the Korean market. Kospi is up over 1%, and that is led by Hyundai Motors, which has soared over 10%, extending gains for the 6th straight session, where the company announced that they plan to deploy humanoid robos at the US factories from 2028. So the street seems to like that announcement, and we'll wait by to see if there is any rub-off impact on India. We're talking about Kospi, where Hyundai Motors has rallied close to about 10-11%. But back to our own markets and the big movers yesterday. Hormis is now joining in with the big delivery stocks. Hormis?
Good morning, Rima. And some divergent moves that were seen in the index heavyweights yesterday. HDFC Bank continued to decline for the second day running, but ICICI Bank was up for the third straight day. And it was ICICI Bank that ensured that A, the Nifty losses were kept in check, and B, the Nifty Bank outperformed. Take a look at the volumes as well. HDFC Bank, over 3 crore shares were traded. For ICICI Bank, close to 2 crore shares were traded. Out of those 3 crore shares, over 2.25 crore shares were marked for delivery on HDFC Bank. For ICICI Bank too, well over 1 crore shares were bid for delivery. The delivery-based selling worth over 2,000 crore rupees for HDFC Bank, and for ICICI Bank there was buying worth close to 1,700 crore rupees in yesterday's trading session. For Mahanagar Gas was another underperformer yesterday. The second straight day of losses. The stock has ended at the lowest level in 2 years. The second highest volumes that the stock saw in the last 3 months in yesterday's trading session. Close to 8 lakh shares were traded. The 20-day average of just over 2 lakh shares. And out of those 8 lakh shares, over 50% or close to 4.5 lakh shares were marked for delivery. Here the 20-day average is less than a lakh, with almost 95,000 shares. So significantly higher delivery-based selling as well in Mahanagar Gas. And the stock over the last 12 months has declined almost 15%. And lastly, Vari Energies, ever since the stock has made its entry into the F&O segment, it has been seeing consistent selling pressure. 9th straight day of losses yesterday for the stock. It declined around 15-18% in these 9 sessions. The volumes were the highest in the last 3 months in yesterday's trading session. 28 lakh shares traded. The 20-day average is close to around 8 lakh shares. And out of those 28 lakh shares, close to 8 lakh shares were marked for delivery as well, compared to a 20-day average of less than 3 lakh shares. And from the recent 52-week high levels, which are close to 4,000 rupees, the stock is down over 30%.
Okay, all right. Thanks a lot for that, Hormuz. Hopping across to Sudarshan, gone through a lot of brokerage calls of the day. Tell us, Sud, what's on your radar?
So 2 stocks where brokerages have initiated coverage. First one is Nomura has initiated coverage on IDFC First Bank with a buy call, and target here is 105 rupees per share. It says bank has entered a phase of sustained and broad-based profitability and transitioning from multi-year investment and balance sheet cleanup cycle. So strong growth visibility with loan to deposit CAGR of 20% and 22% that Nomura sees over FY26 to 28, and superior fee income profile at more than 2% of average assets, and that is much ahead of the peers. It expects EPS CAGR of 67% over FY26-28. That will be amongst the best in the sector. Next one, Nuvama has initiated coverage on Oswald Pumps with a buy call, and target here is 720 rupees per share. It says companies poised to capitalize on growing integration of agricultural and solar energy, and some of the catalysts. First one, it has strong expertise in pump technology and has in-house solar module. Also, significant benefits might come from the government and farmers over life cycle, and should report revenue, EBITDA, profit CAGR of 21%, 13% and 11% respectively over FY26-28.
Thank you very much for that. Getting back to another important story, sources tell CNBC-TV18 CCI probes complaints of cartelization by steel companies. But at this stage, no orders or ruling has been passed by the CCI. Parikshit joins in with the details. Parikshit. Parikshit, can you hear us?
Yeah. So this probe had been initiated by the Competition Commission of India a few years ago at the behest of the High Court. The High Court had given an order. Now the DG investigation within the CCI, which probes complaints that the Competition Commission receives, they have come to the conclusion that close to 35 entities, including some of the biggest steel firms in the company, the biggest listed firms, small steel firms, and even individuals, top executives of these steel firms, were involved in cartelization. So this is a prima facie finding that has been arrived at. It is not a ruling. No penalties have been recommended at this stage. What will now happen is that the CCI will fix a date for hearing where all the parties will be heard, and following that, the CCI will give its ruling on whether there has been a contravention of antitrust rules, whether the CCI believes there has been cartelization, and the next order will be on the penalties. Why is this significant? The penalties could be 10% of the total turnover of these companies. So that could be a big hit on the balance sheet as well. Having said that, in this interim period, now the DG investigations report has been sent to all the parties concerned. Their replies are being sought. Their financial reports are also being sought. Their audited accounts have been asked for. All of this will be examined. Their replies will be looked at. They will be given a hearing, following which an order will be delivered. Even the individuals could be liable because the Competition Commission has invoked Section 48 of the antitrust rules, which means that if held guilty, the top executives could be penalized to somewhere around 10% of their total income as well. So let's see which way this case goes, but we probably would have a ruling in the next few months.
Okay, all right, Parishad, thanks a lot for joining in and giving us that quick update. Well, I'm just putting out some quick thoughts on the CCI probe into steel companies. First point is, this appears more like a preemptive move to prevent any kind of unreasonable price hikes. Remember, the government recently levied safeguard duty to protect the industry. Also, last evening, I understand that Steelmint has reported that primary mills, they have gone ahead and hiked rebar prices by around 3,000 rupees in early January 2026. So that's clearly telling you it appears more like a preemptive move. Additionally, proving a steel cartel is not going to be easy. It could be a bit of a challenge, in fact. Steel prices is more globally driven, and they've also named a PSU like sale. So how does that work? So proving that is going to be a difficulty. Appears this is heading into a legal matter, if you look at everything. Steel companies will contest this in the courtrooms, similar to what happened when cement prices did close to around a decade ago, and that's still in the courtrooms. More importantly, the financial impact could be minimal, but at worst, the penalty will be recognized as a contingent liability and will not affect the cash flows. And also the feedback that I've heard from most sell-side analysts is that any kind of significant stock price correction could actually be a buying opportunity. So in yesterday's trading session, after these, these reports did come out, we did see the stocks did give up. Today, in fact, I think going by the price hike that we saw last evening, I won't be surprised if all these steel companies actually pull back and they look through this entire cartelization claim. Well, that's about steel. For the time being, we slip in a short break. Come back, we'll get you pre-opening rates, and also we get you an exclusive conversation with Ashish Bhandari of Thermax. We'll also get connected with our technical experts. Don't go anywhere.
Okay, welcome back. There's 4 minutes to go for the pre-open session. Let's count down to it. We have our technical experts with us to run us through what they'd want you to do as far as trades are concerned. And there is enough and more action, specific stock action. Sudarshan and Mitesh are with us. Gentlemen, good morning. Great to have both of you here. Thanks very much for joining us. Sudarshan, what's the trade for today? I mean, we've been inching lower. Asia this morning is down. GIFT Nifty is indicating an open, slightly lower open. Another day of drift, you think, at least at the index level?
Yeah, good morning. Well, yesterday was the disappointment because our levels were 26,150 and below that we would close our long positions. That was triggered early in the morning. So essentially, long position should not be maintained while the Nifty is up below 26,150. Today we are seeing another downtick in a market which has bullish signals all around it. So there is really no trade in the Nifty. I don't think we can go and buy this market. And short selling is usually a difficult task. So the Nifty is a complete avoid. There are no levels also. The Nifty has to stabilize before we start thinking of doing some activity on the long side. So just stay away.
Okay, Nifty in a no-trade zone. Mitesh, what's your read of the Nifty and the way it's performed over the last 2 days?
Good morning. So I think yesterday, what was slightly negative was a close below 26,200, which was the immediate pivot. While the structure is in negative, I think it's the bullish possibility is kind of diminished. I think as Sudarshan rightly pointed out, market could yet be, in the sideways range, despite the fact that we made a fresh all-time high 2-3 days back. And therefore, till, 26,400, 2430 is being broken, I would not be very aggressive on the long side. Or, you get to pull back to about 26,000, 25,950 zones. That is where you can explore some long positions.
All right. Well, let's focus on individual stocks then, gentlemen. Mitesh, you go first. What's on your radar?
So on the stock side, Nigel, I have a mix of buys and sells. On the buying side is DV's Lab with a stop at 65.80. Buy for targets of 67.65. FMCG pack is looking good, and Britannia is a buy. Keep a stop below 60.89. Look for targets of 62.20. I also have a buy on Asian Paints with a stop at about 28.20 for targets of 2,900, and one sell call, that's Gas Authority. Keep a stop at about 171.5. Look for targets of 162.
Sudarshan, your stock calls?
Well, it's a mix of buys and sells. Oro Pharma is a buy with a stop under 12.10. Crompton is a buying opportunity with a stop under 255. There are two intraday shorts, M&M Finance, stop above 380, and IRCTC with a stop above 685. Actually, the anchors have to explain. It seems to me that the FIIs are angry with India.
All right, got that view. Gentlemen, we'll come back to you for some 9-10 calls. For now, we've got an important conversation, a corporate conversation. Now, Thermax is celebrating its 60th anniversary this year. Now, this is a company which started off as a boiler maker way back in 1966. And it's undergoing a significant strategic shift to become a leading new energy solutions provider. My colleague Vinny Motiwala traveled to meet up the MD and CEO Ashish Bhandari, and she began the conversation by asking him about the next phase of growth and more. Listen in to a slice of that conversation.
Where we stand today, I look at the next phase of our evolution as perhaps one of our most exciting times forward. Okay. And that is because, A, the world is changing. Yeah, energy transition is a big, big topic. We are all looking at what we are doing to the climate. And any company that has the capability to make a difference, and Thermax does, this is an exciting time. Second, equally important, India too is at a very specific juncture of its own. Yeah, to get to Viksit Bharat, Indian companies have to think in a very different way, much bolder than what we have done ever before. And with that view and that look is how Thermax is looking at the future. There's a lot that we have achieved, but our journey in many ways is just beginning.
What about the overall Capex cycle? When I spoke to a few people, they highlighted that maybe private Capex is there, that we're seeing a comeback. I want to know about both, the Capex cycle overall. Are we seeing an increase in private Capex, public Capex? What's the story right now? Thermax
has never been directly driven as much by government Capex. We are more of a private Capex driven company. I would say post-elections, there was a bit of a slowdown. And especially for Thermax, there was the whole ethanol industry, which after India hit E20 came through a bit of a slowdown. So that affected. But I would say the last few months have been good. And as I look at the next coming period, in India, we have got many new industries, electronics, manufacturing, semiconductors, solar modules and cells progressing, and then of course data centers. So you see a new wave of companies coming in, which were not part of our ecosystem even until 2 years ago. So there's a shift of where Capex is coming from in India. And given the overall demand strength as we are seeing, I expect the coming period to be of a much stronger, larger revival in private Capex all across India.
Okay, so you are expecting a revival there. You know, you touched upon all these data centers or the systems that were not there in place for India so far. Is that something that you all are working on? Right now we're standing at a plant which is the cooling system plant. So when I came in, I was like, oh, will this also help in data center? Is that something that you all are
Very
working
much so. In the last quarter itself, we had two of our biggest wins in data centers. I'm very proud and happy to share that we had a big breakthrough in the US to export for one of the largest data centers, which will ultimately be providing storage and cloud storage for one of the largest companies in the world. We'll be providing 23 absorption chillers, which will be coming out of this plant, and which is just the first phase and the first entry for us. But given it is going for a marquee client in the US, we expect this to be first of very many. Then in India, we have with our latest products, which are called the hybrid closed loop cooling towers, hybrid CLCTs. We just closed a major order for a major data center in India as well. So two very different products, both cooling related, one in the US, one in India. So for Thermax as well, the entry into data centers is now very real and now.
Ashish, you know, in the recent times, or 2025, we could say, there was those FGD issues, and just for our viewers, FGD is fuel gas desulfuration. Now, obviously, there were some norms that came in, then there was a change in that. What is the current status, just to get an update
So
on
for
that?
the last 3 years, we have been saying that we don't expect any future FGD orders, and that's our current stance. We are executing the old set of orders. Our order book also went through what seemed like a dip, because all of these kinds of orders we said we don't expect in the future. And as I look at the future as well, I don't expect too many central government's actions towards pushing FGDs.
So, and when will all these orders be completed for the
So
company?
the orders between this year and next year, all of our FGD backlog would be done in
So by
over with.
FY27, you all will be done with
We'll
that,
be
and
done
not
with
much of an
FY20.
expectation of anything more. coming
Anything
in.
beyond that.
You all have also interestingly, you know, focused on lowering those low margin businesses, right? So are all those executed, or that will also be done by FY27?
So between this year and next year, and FGD projects are one such set of projects. There's one other very specific project which also will be done. Finally, the other segment which continues to remain is like this bio-CNG space, where we have done these 14 plants. But doing that has been technically challenging, not just for us, for the entire industry. But this space I'm still hopeful for, because it makes a lot of sense for the country to grow this space. Done well, bio-CNG should be India's next ethanol sector.
Okay, and where do you see any specific pockets now that are showing great green shoot for growth, maybe for Thermax, maybe for industry?
So one we already talked about, the entire this new group of industries, data centers, electronic manufacturing, semiconductors, solar cells, all of these are suddenly creating a big book of business, which is newer for Thermax and newer for the space at large. That is one. Two, overall, clean water and the water space is very interesting. Third, I would say international. Yeah, international, Thermax has been investing in growing our presence globally. That is now starting to show up. From India, exporting out to the world, I think you will see Thermax becoming a lot more of an exporter than we were
So from
previously.
that 14%, where is it going to go in terms of export then?
At least double that would be the expectation.
By when?
By, look, over the next 3 years even.
Wow,
So we
that's
would
gonna
like
be
to do that.
Ashish, we were talking about exports. We ended at exports growing, but where will it grow? Which countries? Where are we seeing the development now?
Right now, the geographies that are growing the fastest for Thermax is the Middle East, Sub-Saharan Africa, Southeast Asia. US, which was surprisingly, you would think would be an area where, especially with some of what is happening geopolitically, would be slow. In the last few months, after some period of slowdown, has picked up substantially, driven by some of these newer segments like data centers that we were speaking about.
Okay, all right. That's an interesting conversation, and we can catch the entire thing a little later during the day. And of course, go to our YouTube page to watch that. So that's Thermax Management. 9:10 calls. Mitesh is with us. Mitesh, what do you have?
I'll go with a buy on DV's lab for targets of 6765.
Okay. Sudarshan, what about you?
Oro Pharma, buy Oro Pharma with a stop under 1210.
Okay, both pharma names. But let's talk about Lodha developers. Gentlemen, thank you very much for those 9-10 calls. Sonal, the quarterly update looked very good, a 25% top-line growth.
It's not the top line growth, it's the pre-sales growth that has come by for Lodha. Basically, the bookings that the company has done, it's a multi-quarter high, record high actually, at 5,620 crore rupees. Even on a sequential basis, it is up 23%. Collections, however, are down on a 17% on a YOY basis. The company says a lot of this sales came from sustenance sales, that is the existing projects, and they do have a strong lineup in Q4 as well. They will achieve the FY26 guidance of 21,000 crore rupees. The collections look lower on a YOY basis. That is because the base quarter had inflows from a large land and office sales deal, and that's why they look optically lower. But they did add 5 projects with gross development value of 33,800 crore rupees in MMR, NCR and Bengaluru. Remember, their entire target for the year was 25,000 crore rupees, and they've done more than 33,000 crore rupees in just one quarter. 9-month business development, around 58,800 crore rupees. It has, of course, surpassed the guidance by a big margin. Jeffrey says that the business development is something very positive because it gives visibility of future growth, and this will enable management to aim for higher profitability in upcoming acquisitions. So a good update coming in from Lodha after some quarters of weakness that we saw.
Thank you very much for that. Titan could be the big mover. In fact, all the jewelry companies. Manglam, take us through this behemoth first.
A sparkling quarter for Titan this time around. A near 40% domestic sales growth coming in. 41% for their jewelry business, led by around 40% for Tanishq, Zoya, Mia, the mainstays of the company. CaratLane also grew 42%. That's a growth driver. So growth has returned to that as well. While a large part of that is on account of higher gold prices, which were over 60% this time around. The company said that there has been offsetting, buyer growth. So the buyer growth this time around has been absolutely flat. This is a positive because, the street was anticipating that there could be a decline in buyer growth because of the big surge that we've seen in gold prices. Other verticals of the company, watches, eye care, emerging businesses, all of them have done well as well. And on the back of that, brokerages are fairly happy. Goldman Sachs has, upped its target to around 48.50. Remember, the stock is already at record high. They have a buy ratings, sharp revenue acceleration. They believe that margins are likely to moderate, but on an absolute basis, EBIT growth will be extremely strong. Nomura too has a buy call target at 4,500 rupees. Strong performance, and the consolidated sales of around 40% is well above their expectations and that of the street. So good move coming in on Titan, settled about 3% higher in pre-open.
All right, and Godrej Consumer looking good?
Godrej Consumer looking good as well because, the company said that for their India business, this is a near double-digit revenue growth, rather double-digit revenue growth led by near double-digit volume growth. And that's something which will be music to the ears. Home care is what led growth. Personal care has also done fairly well with mid-single-digit sort of growth coming in out there. But importantly, margins for the India business have returned to normative range. Remember, they were under severe pressure for the last 2 or 3 quarters, so that's a positive turn. Even for Indonesia, the business out there, while it continues to reel under competitive pressures, the management sees some early signs of stability, and they do believe that maybe FY27 is where they will return to growth when it comes to revenue and profitability. So overall, consolidated revenue of nearly double digits with margins a little better than the revenue growth would mean that the stock should be in positive today.
Okay, thank you very much for that. In pre-open, it looks like it's going to be a flattish kind of a trading session, maybe mildly lower on the way down. HDFC Bank appears to be struggling for the third day. Let's just do a quick recap of the top stocks that we've covered earlier in the morning and see if you've got pre-opening rates. Senco Gold, Biocon, Devyani. Senco seems to be the big mover. That's the gold jewelry company, dominant in the east. And I think it trades at lower valuations compared to, say, a Titan, which of course is the behemoth, and Kalyan Jewelers, which is the national challenger. Sapphire Foods and Devyani International will held their conference call yesterday. They spoke about the synergies. Sapphire flat. Credit Access Grameen came out with the Q3 updates. Jubilant Foodworks has had a softish December quarter, but the stock in pre-open is on the flatter side. Godrej Consumer, Titan, Lodha Developers are some of the others. But clearly, I think as Mangalam said, it's going to be a sparkling day for all the gold jewelry companies.
Well, indeed, that's going to be, the focal point in today's trading session. Let's just keep an eye out on some of the steel companies as well. Because of what happened late in trade yesterday, all the steel stocks, they sold off because of those reports that suggested that, in fact, there's a CCI probe that's underway. So let's keep an eye out on them. All of them, they fell off close to around 1% to around 2.5%. Case in point being a sale that was under pressure. Not Jindal Stainless, but the steel companies are the ones that we'll be looking at. Mitesh is still with us. Mitesh, what's your take on a company like SAIL? It's had a very good run in the last 1 month. Yesterday, it cooled off, I think, 2% in the final hour of trade. How's it looking at the charts?
I think the ferrous companies have done very well, and we've had some buys on SAIL and Tata Steel. But I think after run-up, pullback to savages is what is playing out. SAIL, I think, if you get it close to about 142, 141 after the market opens and stabilize around those levels, I think I would be keen to look at buying that stock.
Trend, maybe we should focus on that as well. Right now only pre-open, but once it opens up, because after the large 8.5% fall, the street will watch by to see if there is any sort of a recovery. The other one is Reliance Industries. You should keep that on your radar. It was a 4.5% fall. Very large delivery volume seen on that, more than 2,000 crore yesterday. And again, there is no big recovery, at least, that's visible in pre-opening. And the other one is HDFC Bank, which has been struggling now for the last two trading sessions. And combined in those two sessions, stock has fallen 4.5%. I think close to about 4.5%. And both days, on Monday and Tuesday, the stock saw delivery-based selling of more than 2,000 crore rupees. So these are some stocks you should keep on your radar. Mitesh, you want to comment technically on any of these gold jewelry companies like a Titan, Senco, Kalyan? If they open higher, can you chase any? Is there a trade?
Yeah, I think, Titan is something which has obviously been making fresh highs and continues to do very well. Slightly overbought, but I think the stock, if somebody is holding the stock, not an entry point, but playing a stock to 40.
All right, first trade's coming up right now. 26,130 is where the Nifty is starting. 60,000 and 60,001 blinking red and green, basically nothing at all. So just about trying to find its footing. About a 0.25% lower on the Nifty. The Nifty Bank is down about 0.15, 0.2. The mid-cap index is absolutely flat, 34 points lower. And I think the small-cap index, which is coming up on your screen also, which is down about a 0.25% or so. So it's uniformly down about a quarter. Mid-cap, though, the mid-cap index has just about come back into the green. 61,160 is where the mid-cap index is at. 750 stocks are higher, 740 stocks are lower. So, I think it's absolutely evenly balanced. But it's all about single stocks. Senco at the bottom of the screen and a bunch more we'll get to. Titan, of course, is the other one. That's the Nifty heat map. Titan is on the one end of the spectrum after that very strong third quarter update. There is Infi, HCL Tech. So I think I can see some positive color on IT services names, at least two large caps there. Cipla, HDFC Bank and Tata Motors Passenger Vehicles is lower. But more down than up, some 30, 33, 32 names which are lower and the rest which are higher. 60 points down, about a 0.25% is what that translates into. But it is single stocks in action. Rima.
Particularly the gold jewelry companies. Look at Senco, 10% up on that. Kalyan Jewelers up 1.5%. And of course, then the giant Titan, which on a very large base has seen the top line compound or grow at 41%. Titan sees buying, stock is up 3.5%. Interglobe Aviation also up in the green. IT, the Nifty IT index has a positive start with names like HCL Tech, Infosys, Wipro opening up in the green. ITC is another mover, and M&M, which launched a new variant of their XUV 700 at a price point of about 13-14 lakh, has opened up in the grain. On the way down, some softness visible in pharma names. Pharma was the biggest sectoral winner yesterday, but today profit booking visible in Cipla. Is there some news in Cipla? Stock is down 2%, so it's not just a mild cut. But Cipla is down. You've got a mild red coming through on some other names like Sun Pharma, Dr. Reddy's. Tata Motors Passenger Vehicles under pressure for the second day in a row on the back of the disappointing auto sales numbers. And HDFC Bank, that continues to be the problem. Third day in a row, HDFC Bank opens with a cut of 1%. Now in 3 days, the stock is down nearly 5%. Outside of that, Shriram Finance, Maruti, Bajaj Finserv. The two stocks we should pull up are Trend, because it was down 8.5% yesterday. And the other one is Reliance Industries, the big contributor to the fall. Trend opens flat. Reliance sees a mild gain, up 0.5%. So some signs of life now in Reliance.
Well, that's right. Good to see the big boy fight back in today's trading session. Yesterday, maybe in fact, it ended towards the low point of the day. So important to track that one. Jefferies, for one, they continue to maintain their positive outlook on Reliance Industries. Moving to other stocks in focus, though. Bliss GVS Pharma. Nimesh had mentioned yesterday the street is sniffing maybe a possible M&A opportunity out there. And yesterday the stock perked up. It was already up 10% when Nimesh spoke about it. It had perked up, I think, to around 18-19%. And today it's building onto some gains. So stock up close to around 4% in the initial few minutes. Cupid has been all over the place. Volume's massive today, but that stock's up close to around 4.5%. A few other notable names. IRB Infra, positive news flow coming in there. Stock up close to around 2%. Nalco cooled off yesterday towards the end of trade, but today, in fact, it's popped up close to around 2%. So telling you that aluminium rally still continues out there in line with what we're seeing in terms of global prices, maybe getting a little bit tricky in comparison to a month or so ago, but that stock continues to build onto gains. Welspun Corp, there's an order win out there. The quantum, though, is something that we are still checking. But the order inflow has been very, very strong, and it's giving them good visibility for the next few years. So that stock is well up and about in today's trading session. What's down? Meesho. Keep an eye on that stock. Massive volumes. Stock down close to around 5%, so it's falling on rather large volumes. Ola Electric, in the last month or so, the stock has done a quick fire. 32 to 42 rupees on the stock. But that one, in fact, in today's trading session, it's come in for a tinge of profit taking down as we speak. So that's about some of the top movers in today's trading session. Midcap index outperforming, headline index down only around 50 points. Prashant?
Well, I think, some stabilization perhaps as we go along. Bliss has seen a 1.2% equity which has changed hands. And as Nigel pointed out, it was part of our D-Street chatter yesterday. Okay, there's more up than down for now. 1,400 stocks are higher and about 1,000 stocks are lower. Bunch of these silver ETFs, silver Bs, and there is HDFC Silver and Tata SBI. I mean, these are all the entire silver instruments are up between 3 and 4% once again. So it's a massive move which continues across these products into 2026 after a phenomenal 2025. No stopping for now. Tata Technologies is up about 3.25% or so. I think there's an upgrade on auto ER&D companies. There's, I think, Tata Tech is mentioned, I think maybe signed, etc. But 3%, I think on the back of that, one of the, I think JP Morgan, I believe, will try and check and put that out. But I think it's on the back of some upgrades which have been put out. On the downside, we've already highlighted Meesho, and I think Dixon we've highlighted. Indian Hotels, that downgrade from Morgan Stanley.
They've downgraded it to an equal weight from an overweight. The new target price, the lower target price stands 780, so still higher than current market price. And the key argument is valuations. Adequately captures all the risk reward.
Just one more point. Meesho, since we just spoke about it, the lock-in ended. That explains why that stock is under intense pressure in today's trading session. And also keep an eye out on InfoEdge. The job index data should be flashing for you on the screen. That is just out. So that's the stock that we're looking at. For the time being, it's perked up close to around 2.5%. It's seen a bit of a leg up, I think, in a minute or so. So just keep an eye out on that one. We'll get those details up for you on the screen.
Absolutely. And important one, which we will continue to track. So more on individual names, but the Nifty is now down 20 points, which means we've seen about a 60-odd point recovery, 50-point recovery from the day's low, the starting low in that sense. Manishi Chaudhary is with us. He's Chief Executive Officer, Emmer Capital Partners. Manishi, good to have you here. Thanks very much. I have a slightly macro-ish question. because micros we can get to in just a bit, that tobacco tax increase by the government that we saw, you know, revenue collection for the government is under pressure. I mean, I think we can all agree to that because of the numbers that we get. Do you think we will see more attempts at shoring up revenue? Some believe perhaps the focus will be sin goods, liquor, etc. I mean, it's not as if state finances, some of the state finances are also extremely stretched. What's your sense, Manishi? Is that a signal? I mean, you can also take that argument to oil, an excise increase. We don't know if it will happen, but it sure is chatter. Go on.
Right. Thank you very much, Prashant. Good morning to you and a Happy New Year to you.
Happy 2026.
Absolutely. Thank you. Right. So, I think government revenue, and consequently the fiscal deficit, the potential for the fiscal deficit to increase is a real challenge. It's a real concern. And that is something we have to look forward to in this budget as well. And what you pointed to, that is increase in taxes in certain consumption segments, that is a very real possibility. I would be happier, and this is something I would be looking at keenly as far as this budget is concerned, if there are, kind of non-tariff or non-tax revenue sources that can be tapped by the government, maybe monetization of more government assets, maybe a few more privatizations. If the resources are raised through those non-tariff, non-tax sources, obviously that's the best outcome. But otherwise, it's a very, I would look at it very keenly, that how the government plans to, kind of close the potential fiscal gap going forward.
Manishi, since you have this entire emerging market bias, based on what we've seen geopolitically, are there any implications for your, for any of the emerging markets? For instance, you're overweight Hong Kong, China. You sort of increased your weightage on India. Any thoughts on how this impacts the way you thought about emerging markets, the development?
Right. So, what we've seen over the last few days underscores one clear driver of 2025 that's going to continue in 2026, and that's geopolitical tensions. It's a new normal that we have to live with, that geopolitical tensions are here, and consequently, we're going to see increasing defense expenditure. There are plays on that in India. There are possibly larger plays on that in Korea, and those are something that we are banking on. We're also going to see the impact of that in commodity prices. We already saw the so-called safe haven trade or the debasement trade in terms of gold and cryptocurrency in 2025. We are going to see more of that in 2026. And even in some of the base metals, that is likely to seep through. We are possibly entering a kind of a commodity super cycle. I mean, I kind of hate to use that word super cycle, but a strong commodity cycle going forward. While we have seen that in precious metals, we are going to see that, and we have partly already seen that in 2025 in the base metals and possibly at a later date in the ferrous metals also. So those are some of the important themes, debasement trade, geopolitical tensions and defense expenditure, and commodity prices going up that we have to focus on in 2026.
Okay, all right. Manishi, just hold on to that thought. InfoEdge, the December IT sector hiring is up by close to around 8%. Explains why that stock, in fact, has perked up today. And in fact, the insurance sector recorded a 34% overall increase. So just pull up the intraday chart. The stock is unmoved for the last month or so, but in today's trading session, it's perked up. And just one more sector of stocks that we're looking at. We had mentioned just before market opening that yesterday the street was a little bit troubled about the CCI probe with regard to steel companies. But in today's trading session, these stocks actually have bounced back up because it will be very difficult to prove the legalities with regard to that. Tata Steel is holding more or less flattish. SAIL has pulled back some of the losses that we saw yesterday. And JSW Steel as well, the last time I checked. That stock as well, after starting off in the red, it had moved into the green, as is the case with Jindal Steel. So all these stocks, they're pulling back a little bit from the lows. Hi, Manishi. Good to see you, Ben. The next few days, the tech numbers start pouring in. Tech and real estate, the two worst sectoral indices of 2025. Would you bet on them in 2026?
Now, tech is something I'm still keeping away from. Indian tech is a classic AI loser, and I had used this phrase earlier on your channel also, and I'm sticking to that point of view. At some point, as a consequence of these AI investments, the IT services would also have to pitch in to, kind of coordinate and link all this massive investment that's going on. But that time is not now. At least in the near to medium term, over the next 6 months to 1 year, we will possibly see the threat of AI replacing the coders of the Indian IT companies. That concern would possibly be stronger than the potential benefits to the IT companies that could come later. Real estate is something different. I would be selectively positive over there. There are various ways to play that. One could even play the real estate positive sentiment through some of the banks in India. But it did well between 20 to 24. Then 25 was not quite a good year. But I think some of these laggards of 2025 could bounce back selectively in this year.
You spoke about commodities being in a super cycle, and already last year we've seen some big gains. At what point will the inflation start hurting automobile companies in India, or even the renewables play? For instance, you need a silver, copper, etc. in solar panels, inverters, etc. I mean, what are your thoughts on the adverse impact of this commodity super cycle? And to play the commodity super cycle, do you have a view on Indian metals?
Right. So we are, I'll answer your second question first, because that's a lot easier. We are playing the commodities super cycle theme through copper and aluminum. Not so much through the Indian companies in our model portfolio. We have more exposure, larger exposure in China. The likes of Zijin Mining or China Hongqiao, which are into copper, aluminum, also some of the gold plays in that market. These are not only companies with stronger growth forecasts in terms of earnings growth, but also a lot cheaper, than the Indian counterparts. Now, having said that, I think in terms of when we have a situation of a super cycle, pretty much every boat tends to be lifted up. And we would see somewhat some part of that in Indian companies also. Your first question is a bit more complicated, and it's not easy to take that call right now. Certainly, there would be an impact on the margins of the commodity users. So we have to look for those companies which are in a position to pass on their cost increases to the consumers. So we would, in all these consumer discretionary, automobiles, these sectors, we would have to look for the market leaders who have the necessary pricing power to pass on their cost increases to the consumers.
Okay, all right. Manish, what about this FI holding year in India? 2025, all through the year, we kept saying that their holding is declining. It's declining even more. And towards the end of the year, ended at the lowest we've seen in multiple years, more than a decade. Yeah. What's your view with regard to the kind of interest that we're seeing in the Indian markets? Valuations are not cheap, but it's never been the case. We underperformed the MSCI emerging market, by the highest margin all the way since 1994. And their holding is at, very low levels. Growth should come back. Earnings growth should come back. Do you think we welcome back some FI flows in 2026?
Right. So, you're, again, coming back to your original question, what is the reason behind this, the lack of enthusiasm on the part of the FIIs? Equity markets are driven by three basic factors. Their earnings, their interest rates, and currency. In the emerging market context, currency is also an important variable. Now, in case of India, it's only one of these factors which are possibly right now on a positive note, where you have earnings estimates or where you have interest rates declining and possibly likely to decline even more in a benign inflation scenario. But the other two factors, the currency and earnings, they have not been in India's favor. And we think that they will, and on the other hand, we're seeing earnings estimates reviving in North Asia. Asia, Japan itself, the consensus EPS estimate has moved up about 4 to 5%, driven largely by North Asia, China, Korea, Taiwan, etc. So for FII interest to come back on a sustainable basis, those variables will have to be stabilized. Earnings estimates will have to revive. The currency will have to stabilize. There are several factors that could drive these. We have seen part of that in 2025 with a lot of fiscal stimulus being thrown in India. The currency, well, no one knows when the trade deal, the US-India trade deal would finally be signed. That could be a trigger. So many of these building blocks would have to fall in place before sustainable FII interest comes back.
One final question, it'll lead into the next discussion that we're having. Do you own any of these quick commerce, Eternal, Swiggy, a pre-placement perhaps in Zepto? Because there is this standoff between the company, the platforms and the union. There was this large strike which took place on the busiest day ever on 31st of December. And the union is demanding social security, higher wages. If that comes, maybe not to the extent the union is asking, but even if there is any increase in the costs for these platform companies, it questions the profitabilities, it'll hurt. I mean, is that a big risk for platform, the shareholders of people who own a Zomato and a Swiggy? How are you reading it, the developments?
So, in our model portfolio, we don't own any of these, the Swiggies and Eternals of the world. And, I think the manpower-related concerns that you point out, they could hurt these companies, but I think it would be a short-term impact. The bigger story for these companies is the long runway, the long pathway of market penetration that they have still ahead of themselves. In the process, if we have a degree of valuation correction, I think that would actually provide a buying opportunity for investors who don't own many of these companies.
What's the extent of a correction that would interest you, make you buy a Zomato or a Swiggy? A 10%, 20% lower?
I would say it's possibly closer to 20% than 10%.
Got that.
By the way, markets are still treading water, right? 40 odd points lower, sideways, and just about sort of going around. It's not decisive, let's just put it this way. One other name, right? We're talking about Senco and Kalyan and Titan. The smallest of the lot is Tribhuvan Das Zaveri. That is 10% higher, TBZ. So every few years, TBZ wakes up and makes a big, massive move and then sort of, goes right back to sleep. I'm not sure if that is what is happening here. But yeah, I mean, I think that perhaps would be close to an accurate description of what the stock does. MCX is up 3%. So 23.10 after it underwent that split. Stock set basically pretty much highs on MCX. Precision Wire, lots of names. I mean, Natco is up about 3%. I think we highlighted MV, which is the Jefferies had initiated coverage yesterday, day before yesterday, 6.5% again this morning. GM Breweries results reaction, it's up about 3% or so. So it's not a bad-looking broader market screen. Yesterday, of course, was a bit of an aberration where the headline frontline indices were sulking, but broader markets also sulked, which wasn't the case the day before. Thank you very much, Manish, for joining us. It's always a pleasure having you with us here. And once again, wishing you all the best for 26.
Thank you. Thank you very much.
Okay, well, let's just talk about the hot story, which is the unit economics of quick commerce companies. It's a raging debate. Mangalam is here with the math of it, how it works out. Mangalam, over to you.
Well, we'll keep it very simple. For a 600 rupee average order value that you make on a quick commerce app, which is pretty close to what both, Eternal and Blinkit reported in the second quarter, what is it that the platform gets? What is it that the platform spends? And more importantly, how much do gig workers get? And how does this scenario play out? So if you look at a 600 rupee order, the take rate or the gross margin is the important thing that the platform gets out here. At 15%, it's about 90 rupees. And then there is brand commission, all the advertisement that happens on these apps. So, 3% of that would amount to 18 rupees. And then there are delivery and other charges which are paid for by the customer, that's you and I, which is about 12, though increasingly companies are waiving this off to boost consumption on these apps. So, that's about 120 rupees that they make. Where is it that they spend their money? Dark store operations and dark store rent account for nearly 11%. So 42 and 24 rupees out there. Rider payout on an average is about 50 rupees per order. And then you have shrinkage and other expenses. So all in all, if you look at just the unit economics of this business, at an average order value of 600 rupees, the revenue that the company makes is 120, fulfillment cost is about 132, and contribution loss is about 12, which means that the contribution margin is a negative 2%. As average order values increase, that's the important parameter to track here for contribution margins to improve. Now, from a gig worker standpoint, quick commerce delivery gives them about 40 to 50 rupees per order. Food delivery gives them about 50 to 70 rupees per order. But remember, food deliveries travel longer distances. So the key metric to track here is earnings per hour. And on an average, that normalizes to anywhere between 90 to 130 rupees on a gross basis. And take those expenses out, it's about 70 to 120. What are the revenue drivers? Average order value. The higher they go, the better it is for operating performance out there. Or you can have a higher gross margin or a higher take rate depending on the product mix that you have, the assortment. What are the key drags here? Rider payout. If the rider payout increases, then that, as we'll see, impacts the business a lot more. Dark store inefficiencies are the others. The important thing that I'll be tracking as we move along are free deliveries and discounting as competition heats up. But that's something that we will track only once, we do see that happening on the ground. So let's talk about the rider payout. That is an important fixed cost. If you look at the average order values of 400, 500, 600, at any rider payouts, obviously all of them are contribution loss making. But I did a stress test and looked at it at upwards of 600 and upwards of 700. The model currently makes more sense at 700 to 750 rupees as order value. And as the next plate comes up for you, currently the rider payout is 50 rupees. So, you just about break even at 700, 750, make a little bit positive, contribution margin at 800 and about 2% at 1,000. But if this 50 rupees goes to about 60 rupees, then your average order value for break-even increases from 750 to about 850. And a further 10 rupee increase to about 70 rupees boosts your contribution or puts further your contribution profitability by another 100 rupees. So for you to make profit as a quick commerce player, the sensitivity to rider payout is extremely high. Currently, the model makes sense at 750 rupees or 700 to 750 rupees. If the rider payout increases by 10 rupees per order, the AOV has to go up by 850 rupees. And if it increases further by another 10 rupees, then the AOV for contribution profitability increases by another 100. So maybe you'd be making profit only at 1,000 rupees.
Very well explained. Thank you very much for that. And to take this forward, we have with us Sarvanan CR, COO of Updata Services. We also have Ramni Datti, CFO of Team Lease Services. And just to take our viewers through the timeline of the conundrum and, why this quick commerce gig workers payout, the rider payout is in question. Because the standoff between the union workers and these platform companies escalated rapidly towards the end of 2025 in the holiday season. The gig union workers submitted a formal list of 15 demands to the Labour Minister, including a 40,000 minimum monthly wage and a ban on 10-minute delivery, citing safety concerns. On 31st of December in the evening, there was a nationwide strike which began, and the unions claim over 2 lakh workers participated. Dipinder Goyal labelled the strike and the organisers as miscreants. But on 1st of January, these platform companies reported record volumes, saying the strike had limited impact. Politicians also stepped in. Raghav Chadha criticised the 10-minute model as inhuman, but Dipinder Goyal defended the model, citing and explaining the monthly services. But the standoff as of now continues. And as Mangalam was pointing out, the operating model, how much the riders need to be paid, decides the entire profitability of this platform. Thank you very much, both of you, for joining in. Ramni, the first question is, do you think the government needs to intervene or leave it to the market forces? And can the gig model survive in its current form if there is an increase in the monthly wages, or if there is a change in the 10-minute model, or if, as Mangalam was saying, right, the current payout is at 40, 50 rupees. If it goes up to 70, 80, how does it change the dynamics, economics?
Hi, Rima. Good morning. So since we are in the business of staffing and hiring these people for the quick commerce companies, as of now, we are not seeing any challenge with the rider payout, which is 50 rupees standard kind of 50 rupees per delivery. But the bigger issue is in terms of job security or social security benefits. So while a majority of these riders are doing it purely as a gig model, there is a percentage, at least 20% of these riders are doing it like a full-time employment. And this is the percentage where there is a higher demand in terms of social security benefits. Fortunately, in the new labor codes, there is a broad mention about the fact that even the gig workers, because now almost close to 1 crore employees are working, not employees. There are people working in gig format, close to about 1 crore currently. And even the labor codes have mentioned about there should be some sort of social security, but unfortunately they haven't mentioned on like how exactly these social securities would be distributed, because many of these gig workers are working for multiple platforms. It's not like they are working exclusively only with Zomato or only with Swiggy or any other platform. So then how can you define that this is the particular platform that it's their employer? So there are challenges like that. But one thing which we are seeing on ground right now from these platforms is that they are slowly moving a certain percentage of these gig jobs to a full-time contract model. So almost all the back-end logistics and a work which is typically an 8-hour work for the day, those profiles, they're slowly moving to a full-time contract model. So that's a trend that we've been seeing.
Ramani, just to recap the numbers, how many partners are working either part-time or full-time, via the gig economy or for these platform companies? And what percentage, you said, would be doing it full-time, where the social security rules would be applicable?
About 10 to 15% looks like they're working for almost 8 to 10 hours full-time per day. And that's about 10-15% as of now. And during certain peak time, it goes to 20%. But majority, like 80% of these workers are working like a pure gig and working across multiple platforms, not exclusively for a single platform.
So what is the solution for that? As you said, most of them are working for multiple platforms. So the question is, who will bear the cost of the social security? Mr. Saravanan, do you want to come in? I mean, what is the solution to this? If you want to provide safety, you want to provide social security, what's the best way to go about it?
Yeah, good morning. See, as Ramani explained very clearly, the gig workers are inclined towards this, and the potential ability for them to work on their flexible working hours is that something which they are all enjoying it. And with this latest intervention of the central government to have this wage code implemented, the social security part of it is going to play a major role in the overall numbers. If you already look at the numbers, it is not even breaking even at 600 rupees, at even at 50 rupees per rider payout. In these situations, if you are going to increase the social security, especially with the challenge what Ramani posted in terms of people working with multiple platforms, this is obviously going to increase the cost of overall this e-commerce. And at the end of the day, it is going to be the end users like us who are going to pay the cost. But on the flip side of it, people, employees, associates who are working in these e-commerce platforms are willing to continue because it gives them a lot of flexibility. But again, it depends on how much of it can be used for them for the longer run. But I can see a lot of people are slowly moving towards a permanent employment because of the social benefits, because of the long-term benefits which they are getting in. Because now that the payout is also very minimal, and people are slowly intending towards a permanent employment more than a gig workers. But obviously, the payout will make a big difference for the whole engagement.
It's a question which is not knowable at this point, but let me ask it anyway. Prashant here. Good morning. Ramani, do you think this issue will remain a sort of, it'll keep coming up as a political hot potato? I mean, it's not going to go anywhere, right? I mean, somebody or other will keep raising it, because there are arguments to be made on both sides, and strong ones.
I can't comment on the political angle to this, but definitely, since this is a sizable chunk of people who are involved, close to 1 crore cumulative all put together, and this has really been taken up even at the state government's level and local government level. and lack of even basic security like insurance, because the insurance that the platforms that are providing are purely for the job related insurance, not any ESIC or any other medical insurance, just like how any other employee or a full-time contract employee would get. So that is the primary demand, and which is actually a genuine ask. And how this cost will be borne by these platforms is a question, but to be very honest, there is no other choice other than passing it on to the end users and end customers. And while some platforms have already started shifting some of these jobs and converting them to an employment model, it's not like they're making them or paying them anything higher. So typically an average rider, purely in a gig format, if that person is making about 21,000 per month, even after converting that person to a FTC, it's the same cost that the platforms are bearing, more or less. In fact, the take home is going below 21,000 because a percentage of that number has to go into PF contribution, ESIC contribution, gratuity, and others. So this is the main reason why even a large chunk of workers are still preferring the gig model rather than switching to a contract or a full-time employment model. So it's also a choice of the worker here, not just the platforms.
Just to that point about it being a political hot potato and this issue, constantly coming up, being a sort of a Damocles sword, the union claimed that more than 2 lakh people participated in the strike that took place on 31st of December. And yet on 1st of January, when these companies reported orders, it was at a record high. So it's even if some people do participate in the strike, the number of people who are willing to do this, either as a flexi or permanent, is just so much that I guess there is demand at every price point and every.
Shilpa was telling us that the union itself is not. I mean, it's very unorganized. It's split across so many platforms, across states, etc. So the union may call for something, but it's not as if. I mean, it's very difficult to tell how many will participate, not participate, adhere to it or not.
And it's not at a nationwide scale also. It was just, a few union workers. So, Ramani, is there any, other issue that you see to the gig model? And give us the growth projections also. I mean, what you've seen at TeamLease, because in the past, you've spoken about how this is the single biggest engine of growth for you now.
Yeah, this is one of the largest growth engines for us. In fact, over the last 2 years, it has been consistently giving us the highest number of open positions, even though we are catering only to the FTC model, not much on the gig model. And we believe that this model will continue to grow because now this is spreading across tier 2, tier 3 cities as well. So far, majority of the hiring that we are doing are largely in tier 1 cities and metros, but now even tier 2, tier 3 are catching up in terms of overall hiring.
Can you share some numbers for you at TeamLease? What percentage, what has been the growth last year? What are the open positions right now?
Yeah. So overall, out of the total headcount of TeamLease, currently we have about 6% of the total base with quick commerce and e-commerce related profile. And out of this, if I take only annual growth, out of that, close to 20 to 25% growth is coming from retail, quick commerce / e-commerce, this segment.
Okay. And is it possible to break up quick commerce and e-commerce? Because e-commerce has been there for a while. It's only quick commerce which has now come up in a big way.
Yeah. No, currently it's mainly quick commerce because e-commerce has been steady and the numbers could be about 10-20%, but majority is right now what we are seeing as new open positions, majority are with quick commerce companies. And in any given month, currently we are doing about 3,000 to 4,000 numbers purely for quick commerce related profiles.
Okay, Mr. Saravanan, Ramani, thank you very much for joining us on this discussion. We're out of time. Great to have you both share your insights. Get into a break. On the other side, we'll get the management of Senco Gold and Diamonds to talk about the Q3 business update and the outlook going ahead. Stay tuned for that discussion.
Welcome back. Gold continues to shine, and in that context, we have Senco Gold. That's actually buzzing in trade after reporting a strong set of numbers in its Q3 business update. The growth is led by higher gold prices as well as the festive season. To discuss this and what's the outlook for 2026, we're joined by Mr. Suvankar Sen, the MD and CEO of Senco Gold and Diamonds. Hi, Suvankar. First of all, wishing you, family, as well as the entire team a rocking 2026. It's been glittering in 2025 for you. Well, let's see how things pan out for this year. Give us a couple of details with regard to your quarterly update first up. What was the growth, the buyer growth that we saw, the volume terms, if you could help us out with that?
Yeah, thank you very much, and wishing all of you a very happy new year as well. In terms of what we saw, the Q3 results, the growth has been phenomenal. It has been a 51% growth Q3 versus the Q3 of the previous year. And if we look at the YTD numbers, we are growing at approximately 30% plus year on year. One of the major reasons why we have seen this kind of very strong growth is, if you look at and remember that Q2 was a muted Q2, the weather, overall people and the gold prices going up, consumers were procrastinating and delaying their buying decision. And what all got shifted into Q3 along with the wedding season and gold prices also moving up. All in all, I think that finally, with the increase in gold price, consumers thought that this was the best time to buy. And another thing that as a company we have done is that, keeping the higher gold prices in mind, our effort and endeavor was to create new designs and new collections that would fit into the budget of the consumer. Because if you see that while value-wise we have seen a growth, if you look at in terms of volume, like today, YTD, if we are up by 34-35%, but in terms of volume, we are down by 12%, which means that consumers are looking to buy higher and higher, budget in terms of maybe up by 20% budget, 25% budget. But in terms of volume, it has to go, the jewelry has to be made lighter. So this is how it has been. The good thing, another one, is that the diamond sales, we have seen that in diamonds and in silver.
Sorry, apologies. Let me just come in on gold. Let me just finish that loop on gold. Sorry, just the numbers. What is the tonnage growth? I mean, the volume growth in the third quarter?
The volume growth in the third quarter is it's minus 7 to 8%.
Okay, and value growth is
51%.
It's like on both ends of the spectrum, right?
Yes.
So it's largely pricing led.
It is.
Yeah.
Yes.
And this is only gold, right? We're talking about, or total?
This is only gold. If you look at diamonds, we have seen that there is a 39% growth in diamond volume and value. So around 35% in volume and 39% in value. If you look at silver also has seen a volume and a value growth. It is gold which is largely led by the value growth, and the volumes are under pressure by minus 7-8% because of this higher gold price.
So YTD, that is April to December, could you give us the same number? So for the 9-month period, value and volume on gold?
The 9-month period volume degrowth is around 12%. That's the kind of volume degrowth we have seen. And if you see the value growth, it is up by 31-32%. So that's the kind of 9-month figure that we're looking at.
If I'm not talking about whether gold prices come off, but say gold prices stay here. I mean, actually, generally, expectation is it'll do even better. So if it goes up or stays at this level, how long can this kind of this divergence continue, Suvankar, on gold specifically?
Well, I think that it will take some time for the consumers to get used to the gold price. What we see at the ground level, the reality is that consumers are buying jewelry. There is a lot of old gold exchange that is also happening. So around 40% of the business is led by old gold exchange that the consumers are doing. And with this increase in gold price, I can see that the consumers are trying their level best to match up and, be it for their own personal usage or weddings, trying to buy as much. But obviously, there are restrictions in terms of how much they can buy. And we have to make jewelry lighter. We have to look at 18-karat jewelry. We are also introducing 9-karat jewelry. So in terms of pieces, in terms of volume, you will see that yes, with the lower caratage and lower lighter weight jewelry, volumes are going to take a hit. So that's the reality, and we just have to fit into the budget of the consumer, and that is what will lead to our success.
Okay. Two-part question. Subankar, hi, Rima here. One, 9-month growth is 31-32% value. That's higher than the 18-20% that you were guiding for. So what happens to your FY26 top-line growth guidance? And how is Q4 likely to be in terms of the wedding season? Q4 vis-a-vis Q3, Q2. Give us a sense.
So, looking at the 31% growth that we see right now, I can, guide that our whole year's growth should be around 24 to 25% in a very conservative way. I've always been saying that till we have what we see, what happens in Q3, it is not right on our part to increase the guidance of 18 to 20%. But now that we have crossed Q3 and we are very much into Q4, and the wedding season is going to start from 15th of Jan once again, we'll have our Valentine's Day, Women's Day, and all the other various continuous weddings right up to March and April. I think that it is right to guide on a 24 to 25% growth for the whole year right now.
Okay, all right.
And, as you questioned on looking ahead, what we see on the financial year and the calendar year of what's happening in 2026, as a team, as a company, we will continue to target and look at 18 to 20% growth for the upcoming year as well.
All right, Subankar, a couple of more questions then. What is the studded ratio in Q3? And by the end of this year, what are the total number of stores you're looking to add?
So the studded ratio, we've been strategically looking at ensuring that how we can increase the studded ratio. It is around 12.5% right now. And what has happened and helped is that with the increase in gold price, especially for gift items, for lower ticket size items, be it earrings or pendants or rings, I think that for the consumer, it is fitting into their budget to buy diamond jewelry or platinum jewelry. And you must also take note that the way gold prices have gone up, the platinum prices have also been on a very strong upward trend. But all in all, I think we are at about 12.5%, and our efforts have always been to take it closer towards 13.5%, 14%, and towards 15%. And in terms of the store openings, we've opened around 4 stores in Q3. There are about 3 to 4 stores in the pipeline for Q4 as well. And we've always been focusing on opening 18 to 20 stores year on year. And I think that that's how we will always look at, and we'll achieve the similar numbers this year. And we'll aim about the same kind of numbers for the next year as well.
And studded ratio of 14 to 15% is in the coming fiscal? That's FY27?
Not 14 to 15%, no. What is
studded ratio
in terms of the number of stores, 3 to 4 stores that will open, and about in the coming fiscal we'll again aim to open 18 to 20 stores as far as the new stores.
No, you also mentioned that the studded ratio is at around 12.5%, and that's likely to perk up, right? So that goes to what level in FY27 is my question.
Okay. So the FY20 from a 12.5%, it will move to about 13.5%, and over the coming 3 years, we will take it towards 15%. I think that's the kind of a plan with which we are working.
Subankar, did we get the inventory gains?
No.
So you want to just close that with the inventory gains on gold in the quarter?
Yes. So our hedging ratio is around 50 to 60%. So we will be able to see some amount of inventory gains as well, because there is about close to 3 tons of inventory lying across all the various stores. So with around a 50 to 60% hedging ratio, I think we should be able to see some amount of gain from the inventory as well.
Okay.
How much? Can you give us a number in the ballpark?
Again, giving an exact number will be difficult, but from a guidance perspective, we've always been guiding that we will be doing an EBITDA of about 7% plus. So with what we see and with the results, with the performance of Q3, I think that about a 7.2 or a 7.3% EBITDA or upwards by a few bits will be possible. So it's a positive situation. Hoping that this momentum and this journey with a positive approach continues to happen in the coming quarters as well.
A quick comment before we let you go on Titan's entry into the lab-grown space.
Well, I think that's a very good sign. We've been believing in the fact that with the increase in gold price, consumers will look at various kinds of options that will fit into their budget for the occasions. And with Titan coming in, I think it's only going to make the whole industry more organized, especially the lab-grown diamond industry. And there will be more seriousness, more awareness. Consumer awareness will go up, and I think overall the market will be also becoming bigger and bigger as well.
Thank you very much for that, Mr. Sen. Look forward to chatting with you when your Q3 numbers are out. Well, for now, let's get back to the markets and address the market technicals. Siddharth Rai Mangla, Senior Research Analyst at Stockbox Technologies, is here with us on the show. Siddharth, your thoughts on the first hour of trade and what would be the stock calls?
Hi, Rima. Good morning and thank you for having me on the show. See, Rima, if we talk about Nifty, a very small range seems to be playing out very strongly on the index today, probably also yesterday. When we look at the options data, Rima, 26,100 on the downside, which is exactly where Nifty made its low today, is a very important support. And on the upside, 26,200 is a very important resistance for the index, which is what the options data is telling us. So this doesn't seem to be a very good time to be taking aggressive positions in the index itself right now, because somewhere Nifty seems to be in a waiting mode, probably because the heavyweight results are just about to begin. So it's not a good idea to be taking a fresh long or short positions on either direction in the index. It's much better to wait for the index to move out of this range, and it will be better to keep a stock specific approach as long as we are in this no trade zone in the index itself.
Okay, so let's get to the picks then, Sid.
Yeah, sure. Hi, Nigel. See, two stocks. The first one is Tata Technologies, which is one of the highest top gainers today. In fact, it is a very strong move. I think this is a sign of a very strong turnaround in this counter, which is why Tata Tech can be bought right now. Right now, the spot is trading around 680, 681. It can be bought here. The stop loss will be at 665, and our targets being the first target 710 and the second target 725. The second stock is Aurobindo Pharma. See, after a long time, the stock has probably given a breakout of 6-7 months, a big resistance of 6-7 months. So a fresh momentum is beginning in this counter also. So Aurobindo Pharma can also be bought. Right now, the spot is trading around 1257, 1258. We can buy it here. The stop loss will be at 1240, and our targets being the first target 1295 and the second target 1310.
Thanks very much for that, Siddharth. Appreciate it. And we'll speak again soon. Well, 26 points lower on the Nifty is what we have, 26,150. We'll take a quick commercial break here. We're going to come back. Commodities in focus. Manisha will be with us on the other side. Stay tuned. Welcome back. 40 points lower on the Nifty, 26,140 is where we're at. Well, Cipla is the top loser on the Nifty. Ekta is here to tell us why. What's happening? Ekta, morning.
Morning. Well, Cipla is in focus because what has taken place is that their manufacturing partner, which is basically a company called Pharma International and has a manufacturing facility in Greece, which manufactures the drug lanreotide, which is used for certain tumors for Cipla, is under the scanner for the US FDA. So what took place is that in the month of November, the US FDA did look at their particular facility. This is Parmethian's facility in Greece, and issued 9 observations to that facility. So what has come to light is the 9 observations which were issued to that particular facility in Greece, which is Cipla's manufacturing partner for lanreotide. So now the street is fearing that those 9 observations are going to be difficult for them to solve, and there could be some kind of escalation. And if in case there is some kind of escalation, then that means that the lanreotide manufacturing could possibly be impacted going forward. Now, we still haven't heard from Cipla. This is a Nuvama note which is circulating at this point in time. We still haven't heard from the Cipla management in terms of, whether they've had a word with the manufacturing partner, what their response would possibly be to those 9 observations, because one would then realize what the costs would be going forward and whether or not they do have any kind of alternate manufacturing plans for lanreotide. So that's the reason the stock is down around 1.8%, but it's recovered from the day's low.
1.75% lower on Cipla as things stand right now. Well, Manisha is now with us. We're shifting focus to what's happening in the commodity space. Gold, silver, copper, aluminum, you name it. Manisha, what are you focusing on?
Oh, they're all trading at multi-year and record highs as well. But I want to talk about silver right now because we've seen a new all-time high come in for this one. So this time around, 83.82 has been taken over on the higher side. And with that, in the last 1 week, we've seen 15% of gains come in. It's 40% up in the last 1 month. When you look at the gains overall, we are up 13% for this year. And this is after 148% of gains in the previous year as well. So, well, silver absolutely continues to shine bright there. I also want to tell you that between 2020 to 2024, silver kept trading between $20 to $30 an ounce. It was in 2025 that we saw that $30 an ounce of a range break, and then 40, 50, 60, 70 is what we saw. All of that coming in the year 2025 itself. I also want to talk about the gold-silver ratio. Last year, 2025, in the month of January, the ratio stood at around 104. We have seen the ratio come down to 59 right now, and it has been a great last 12 months that we've seen in case of silver. The last times when the silver prices actually rallied was in 1980 and 2011 when it hit all-time highs. And during those periods, the gold-silver ratio stood much lower at 14 and 32. So lower the gold-silver ratio, the higher the chances that you would be looking at silver prices going higher is what the study suggests. Why is silver holding even at these higher levels, even as we've seen so many gains continuing to the market? That is because there is a structural imbalance between supply and demand. We are looking at a deficit for a 6th straight year in 2026. There have been years of underinvestment rather, in case of mining, and is the reason the mining has not been able to react to the kind of gains that we've seen coming for the silver prices. Not just mining, when you look at the inventories, well, they are at a multi-decade low, supporting silver prices therein. It also has to do with very strong industrial demand. Almost 50 to 60% of all the silver available right now is going into industrial demand, supporting prices therein. And then there is strong investment buying as well, whether it is by the way of physical or ETFs. And then the refined availability also is becoming a concern. Remember, China has only allowed 44 companies, and that also is a restricted export starting from 1st of January, supporting silver prices yet again. I just want to take you through very interesting data right now, which is about industrial demand when it comes to silver. So whether it's about photovoltaic cells, high efficiency, power electronics, interconnects, all of that is where silver is used right now. So when you look at solar panels, 2 square meters of solar panel uses 20 grams of silver. And we do understand the kilometers and kilometers and miles of solar panels that are being constructed right now. And then the smartphones that all of us carry has 0.3 grams of silver into that. Is the reason the recycle, the scratching of silver from phones has been quite a narrative in the last 1 year. And then you also have TVs, desktops, laptops. They all have 1 to 2 grams of silver in each of them. And when you look at the battery EV, well, it has 25 to 50 grams of silver, and the number of this automotive continues to increase as well. Electronic industry overall switches, that is, motherboards, circuits, all of that uses 220 tons of silver per annum, which is only growing every year. So the markets are looking at much more higher gains from here on in case of silver. Interestingly, there was a Bank of America report which says the way the prices are and the way you're looking at demand and supply mismatch, prices can go to $135 an ounce. I mean, this is the highest still time that we've heard in sense of silver price forecast. BofA also says that $300 an ounce also is not ruled out, but their first case scenario is $135 an ounce. So, well, yes, much more bullishness from here.
Manisha, thanks very much for that. That's commodity price action for you, and it's largely everything up, except, of course, oil, which was down about 2% last night. We'll take a quick break. Lata in conversation with Sakshi Gupta of HDFC Bank and Upasana Chachra of Morgan Stanley on the advanced estimates of GDP to be announced later today. Coming up.
Fly Emirates, fly better.
Welcome to It's the Economy. The Ministry of Statistics, or MOSPI, will announce the first advance estimates of this year's GDP. A CNBC-TV18 poll expects the MOSPI to announce a 7.5% real GDP growth for the current year, and more importantly, only an 8.3% growth in nominal GDP, that is GDP unadjusted for price rise. This nominal GDP number will become the base for the February 1st budget. To get more on what to glean from the GDP numbers, today I have with me two top economists, Upasana Chachra, Chief India Economist at Morgan Stanley, and Sakshi Gupta, Vice President and Senior Economist at HDFC Bank. Ladies, thank you very much indeed for your time. Upasana, first, will nominal GDP the most important number to watch out for, and what are your expectations?
Hi, Lata. So for nominal GDP for fiscal 26, we are at 8.4%, so not very different from your poll. And on real GDP, we are a little bit higher at 7.6 for fiscal 26.
Okay. Would that be the most important thing to watch out for, nominal GDP?
Yes, I think in this environment of low inflation that we have seen, especially in the last 3 quarters, where the nominal growth has been moderating while real growth has been showing a robust trend, the nominal growth will be an important key takeaway that we will have. Also in context of, other derivatives that come through it in terms of fiscal deficit and implications for that with the upcoming budget as well, in terms of, how large is the base for the nominal growth that we can assume for the next year.
Okay. Sakshi, good morning and welcome to you as well. What would you watch out for in today's numbers?
Good morning, Lata. Happy New Year. Yeah, I mean, as you rightly said, look, these the numbers that we will have today. This is the advanced release. This is basically an extrapolation of the trends that we have seen in data up till November, right? In terms of drawing broader conclusions, especially at the sectoral level for FY26, I think this number will essentially tell us what was happening in the economy up till November, right? And we know that a lot of the high frequency indicators till then, because of this, festive season demand, etc., were kind of holding up.
Yep.
Our estimates for real GDP growth is 7.4, but honestly, the risk to this forecast for me is clearly on the upside. So I won't be surprised if the number is much higher than this. As you rightly said, I mean, the most important relevance for these estimates is actually its implications for the fiscal calculation and the upcoming budget, estimates. On the nominal front, we are estimating, a number close to what your poll showed up, 8.3% growth in nominal numbers. I don't think that, if we get a number close to this, figure, that it really upsets the fiscal math for this year. I think what will be interesting to watch out for, and this will have implications for next year's estimates, what is the government going to assume, in terms of nominal growth for FY27, we are expecting 10.1, right? And that has implications for what they assume on tax collections, on debt to GDP, etc. So I think the most important figure in this release, as you rightly pointed out, is really the nominal growth assumptions that the budget will work with.
Okay. Well, Upasana, we've got some advance data over the past 4 months or 3 months. We just had a note from Elara, which is speaking about very strong auto growth in the September-December 4 months, that is post GST cuts, compared to the previous 4 months and the year ago 4 months. I mean, very strong auto sales data, and that's usually a very good lead indicator. So should we be prepared for even bigger upsides than 7.6? By the way, Upasana, at 7.6, you're among the highest.
You're very right, Lata. The high frequency data that we've got in the last couple of months, and especially I think, sectors which have got positively impacted with the GST tax cuts, has been very strong. So auto sales across passenger or two-wheeler sales have held up in the double digit, almost 20% plus sort of a growth rate if you were to average the last 3 to 4 months. That is very strong numbers. And I think if we were to further dissect it, like, festive to festive, which was very strong at 25% plus, but post-festive also these numbers are holding up, which is an important indicator to see whether this growth trend can actually continue to maintain its pace, or whether it sort of starts to fade out. So that is good news, because data up until December is holding up. And
Upasana, 1 minute. While, I picked up the best fruit I could get, which was the auto sales number. But if you look at power consumption, that's been pathetic. Real estate sales, I saw some number of minus 17% for certain regions. Therefore, can Q3 be, still be a kind of dicey quarter to predict, and more so Q4? Are you reasonably convinced that the GST sales consumption, GST cut boosted sales will continue in Q4 as well? Are you getting that sense about consumption?
Right. So I think for Q3 or December quarter, I think over there is less of a risk of any, the numbers being lower than anticipated because of the GST impact. And you're right, power demand, there are certain pockets which have not done as well. But again, if you look at even power, that is now improving. So December is a plus 6% growth versus, yes, last few months, which were weak. Credit growth is picking up quite nicely. And so are, things like credit card spends as well. So there are certain broader indicators which are showing signs of strength. Q4 or March quarter, we would expect a deceleration, but that is linked to the base effect. And that would start to play out. So in our assumption, Q4 numbers would be lower than 7%. We are at about 6.8 on this base of GDP right now.
Okay. Anything else we should watch out for, Sakshi? Don't we often look for the private final consumption expenditure and the gross fixed capital formation numbers? Our poll threw up a number of 7.5% for consumption. You think that's a fair assumption, or would it be better?
Right. So a couple of points, Lata. So first, I mean, to your question on consumption and investment, I mean, look, we've had very strong numbers in H1, right? Both for investment and consumption. So, for the whole year, I think that given the recent momentum from high frequency indicators, I do anticipate that both for consumption and investment for the whole year, you should end up with a 7+ number. So for investment, for instance, we are projecting 7.5% for FY26, and for consumption, we are close to 7.2. But a lot of this is being driven by, on the investment side, because you had a lot of front loading of expenditure by the government in H1, so numbers were very strong. And then for consumption, I think the GST cuts, low inflation, etc., all these factors are playing out. Just one point I want to make to your earlier question, on the fact that some of the data, while yes, on the consumption side, things seem to be picking up and the momentum is holding on, but all the macro data that you look, everything is not positive, right? And one of the things that I am closely watching or concerned about is the impact from government spending, right? So as we move into Q4, if the government has to kind of meet its FY26, fiscal targets, I do expect some amount of expenditure rationalization to happen. And I think some amount of that will actually fall in the fourth quarter. So, I would be a little, I'm not completely, overtly optimistic about Q4 numbers where, there's still some amount of uncertainty as to how much the growth momentum is going to be.
You want to add to that, Upasana? I think in your note, you also point out that we may have lower public expenditure because, for the second half, the base also becomes high. And there was a lot of front loading of both government capex and exports. So possible downside surprises?
So, I think as I mentioned, the Q4 number will see a moderation because of base effect. So we are building that part in. From a government spending perspective, this year is exactly like the opposite of last year, where the first up to November spending, especially Capex, was so weak. And then there was a big sharp pickup in the last 4-5 months. And this year, as Sakshi has also pointed out, we are of the same view that it's not an easy year to meet fiscal deficit target as well, like we've been used to in the last few years because of tax buoyancy. So tax collections are running short of budgeted estimates. And in our view, the government will meet 4.4% of GDP, the fiscal deficit target. And therefore, to meet that, there will be a need to rationalize expenditure. So the impulse from public spending will be weaker, and especially, I think, in the last quarter. But some of it is getting built in these numbers, which are reflecting a moderation from December to March.
Okay, last 1 minute. So please, each of you take only half a minute for this question. Sakshi, how important is this very poor nominal GDP that we are seeing? Can we assume a better nominal GDP for next year? Or, will it be low nominal and therefore low tax collections?
So you're absolutely right. I think nominal GDP growth numbers very important. Below 9% nominal GDP growth doesn't bode well for a lot of indicators, including things like credit growth. I think for next year, what might work well for us that even with, a real GDP growth between 6.5% to 7%, inflation will start picking up because there is, a very low base. So we are expecting nominal GDP growth to be somewhere around 10.1.
Oh, okay, that's positive. Upasana, your nominal GDP expectation and worries?
So numbers similar to Sakshi, we do expect nominal GDP in fiscal 27 to revert to the 10% mark. I think, though, to your question, it's a very important indicator from a corporate revenue and corporate earnings perspective. We do think this low inflation environment will start turning. Probably December quarter should mark the trough from a nominal growth perspective, and the next 4 quarters should start showing mild recovery.
Okay. Well, I did want to ask you all about how all these numbers will pale into insignificance on February 28 when we get a new series. Okay, very quickly, I believe we have time. Sakshi, you think all these numbers will look very, very different on Feb 28? or will they look better?
Right. I mean, honestly, it's speculation at this stage. But yes, of course, as I initially said, I reserve my, drawing broader conclusions from this data right now because we are waiting because there's a series change, there are changes in methodology.
Will it be better or worse? What's your sense?
Well, I hope it's going to be better, but this is
hope is not a data point.
Yes.
Upasana, expect it to be better when the new series comes?
I think if we go with the last pace revision, where we saw massive upward surprises in the new GDP series, just anchored on that, I think it could be better.
Okay. But you know what? It gave us a very poor FY14 number. It was a 5.3 or something. Yes. So it can cut both ways. Thank you very much, Upasana and Sakshi, for telling us what we should watch out for this evening when the numbers come. Well, that's it on this edition of It's the Economy. Time for a break. Chartbusters up next.
Titan shines bright. The stock is the top gainer on the Nifty, hits a record high after a stellar third quarter business update, where sales rise nearly 40% year on year. Buyer count also remains steady even as gold prices surge.
Titan's smaller peers also deliver strong growth. Senco Gold surges close to around 10% on a 50% revenue growth, although the management does highlight a drop in volume. Kalyan Jewellers is also up close to 6% after the third quarter sees revenue grow over 40%.
IEX's rally continues on optimism over the market coupling case, which will be heard on Friday. The stock surged 10% in the last hour of trade yesterday, up another 3% today.
Morgan Stanley downgrades Indian hotels to equal weight and cuts its target to around 780 rupees from around 811 rupees earlier. They're expecting limited upside surprises to the revenue matrix. The stock is down 2%.
Shares of Meesho locked in 5% lower circuit after the IPO shareholder lock-in period ends. This is for the anchor investors, and as a result of which, the stock now down 30% from its post-listing high.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. Markets a little bit sideways with a bit of a negative bias, but the broader markets, there are plenty of stocks that are doing well. Explains why the Midcap index continues to hold in the green, and the sector that Mangalam tracks very, very closely, gold. Well, that's really glittering, Mangalam.
Gold is the one that's glittering. You know, it's in this very interesting Goldilocks phase where if the prices are high, these guys get value growth. If the prices are low, then people run to buy these products because they believe that maybe at some point prices will keep going higher. And were nothing to happen, then what would happen? People would buy jewelry for adornment instead of value. So that means studded shares will improve for all of them. That's positive for margin. So it's in this wonderfully Goldilocks sort of scenario right now. The only fly in the ointment that is expensive. You know, the valuations for Titan at 70 times. It's expensive, but then you're getting precious metals at precious prices.
Well, that's right, Mangalam. You know, bang on in terms of that. You know, also I'll be looking at the lenders, you know, because stocks like Muthoot, Manappuram Finance, IFL Finance, you know, they all have a good amount of their exposure to gold. And, you know, you'll have a twin benefit here because if inflation is going to stay subdued, if crude is going to stay subdued, then it gives central banks across the globe that kind of liberty to go ahead and, you know, lower rates. And that will help in terms of cost of borrowing, while they also benefit in terms of the higher gold prices. So I think that's another segment to track. Again, not cheap, stocks like Muthoot after the kind of run, but gold and gold finances will continue to remain on our radar.
All right, but then let's talk about the market and, you know, how that is likely to move on, given the sort of consolidation near record highs that we've seen over the last couple of trading sessions. Chandan Taparia of Motilal Oswal Financial Services joins in for a quick check. Chandan.
Good morning, Mangalam and Nigel. Thanks for having me. So Nifty witnessed some profit booking in last three trading sessions after hitting an all-time high of 26,373. However, the measured trend is positive to range bound, but due to the weakness in two heavyweights market, failed to cheer the new all-time high, got stuck. But the good part is higher base is being created with the support of rising trend line. So I believe 26,000 could act as an immediate support, and with that support, it can remain range bound between 26,000 to 26,300. So we have to be with positive to range bound or buy on decline stance in the market. India VIX is below 10. So because of that, we are not expecting major swing in the market. Only good part is FIs, which were earlier selling in the big number, is now somehow neutral from last 2 days, which might provide some support with buying to the index. Now looking at the Bank Nifty index, it has been consolidating from last 3 days. Recently, it made all-time high at 60,437. But now consolidation is clearly visible. I believe 59,500 could act as a major support to get again swing towards 60,437. So both the indices witnessed profit booking in last 2 days, and now buy on decline with key support could give some swing to the broader indices. Now talking about the stock specific ideas, first is buy on Lupin. So after a long time, Nifty Pharma and IT indices are witnessing buying interest, and here we are recommending to buy on Lupin. This stock has given a consolidation breakout on the monthly chart after almost 10 to 11 months. We have seen a massive breakout with surge in open interest and delivery volume, which indicate more momentum could be there. In fact, most of the pharma counter are doing well, including Lupin, Glenmark and all. So recommending to buy with support of 2180 for an upside target was 2310. Second trading idea, that is buy on MCX. We are positive on capital market theme, and mainly MCX is doing well due to the strong momentum in participation in silver and gold. And I believe M6 could continue its positive stance with support of 2240. It can head towards 2380 kind of level. Last trading area, there is buy from Nifty IT Pack, buy on Wipro. It has seen a consolidation at lower zone. Now supports are intact, support is buying. With some put writing indicate up move can be seen in the counter. So one can buy with support of 261 for an upside target towards 284.
Okay, all right. Got that, Chandan. Thanks a lot for giving us those inputs. Wishing you a good day ahead. Well, time to slip into a short break. On the other side, we'll be joined by the management of Capri Global. We'll discuss what's the outlook for 2026. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. As promised, we have Mr. Rajesh Sharma, the Managing Director at Capri Global, who joins us on the show. Hi, Mr. Sharma. Good morning. Good to see you again. Well, before we come to you, we're just highlighting a few points that we're looking at. What's the outlook on gold loan disbursements? The ROA, it's targeted to improve to around 4% or thereabouts. And what's the update with regard to the 40% AUM growth guidance for FY26? Well, Mr. Sharma, good to have you on the show, and thanks a lot for joining in. A quick question before we get to these top points. What is the kind of gold loan business you do at a branch level? And how do you see that number, move up? Because if I look at a gold finance competitor, like say a Muthoot, they do 20-25 crores or thereabouts. So where are you? And do you believe that that number can head towards that level?
Yes, good morning. Thank you. So as we all know, gold loan prices in last 6 months have run up almost 30% plus, and that given a very positive outlook and the growth. So gold loan is doing very well in terms of margin, in terms of growth. At the same time, at Capri, we have added more branches. So I think from 835 branches, another 165 branches will complete addition by end of Jan. So end of Jan, we intend to operate by 1,000 branches of gold loan alone. And that addition will further help us to grow our overall portfolio as well as the gold loan AUM. That will also enhance the overall contribution and the improvement in the spread, because gold loan are relatively at a higher prices.
Yes.
Having said that, this year we are on course to achieve a 40% AUM growth on back of strong demand in the rural and semi-urban in MSME affordable housing on back of Pradhan Mantri Credit.
Got it. All right.
linked
Mr.
subsidy
Sharma,
scheme.
Mr.
Yes.
Sharma, just to come in there, so you have cleared out a couple of points for us. The gold loan focused branches will go to around 1,000 branches, and you're saying you're maintaining that AUM growth of around 40%. We got that. But getting back to the core question that I'd asked you, the gold loan business per branch, what is that number at? And do you see that number move out? If you could keep your answer a little crisp.
So we will keep that target about 17 crore we are likely to close this March. And next year, we will be in the range of about 20 crore plus per branch AUM. That is what we are targeting.
So this is the gold loan business per branch. Got it. So that will give you some operating leverage. A couple of other factors, the ROA target, do you believe that you can go ahead and, achieve that? And also, since you have a fair bit of your cost, borrowing cost that comes in from branches, how does your borrowing cost pan out and what kind of margin should we look at?
So ROA will be in the range of about 4% because still we are keep adding on the branches. So steady state basis, ROA will be higher, but on a reporting basis, keeping in mind branch expansion going on, ROA will be 4%. And what is your another question is?
With regard to your borrowing costs, sir, you have a fair bit, I think more than 75% of your borrowing comes in from branches. So you'll benefit on the cost of borrowing, right? Because RBI has gone ahead and cut rates. How do you see that pan out?
So there are two aspects of it. Whatever the RBI is cutting the rates, because of the ground reality in competition, that get passed on to the customer. However, in case a rating upgrade happens, or we are able to borrow short-term money through commercial paper or linked to repo rate, or all those borrowing, that cost will come to the P&L. So overall basis, we believe that 20 to 25 basis will be able to save by the right borrowing mix, and because some borrowing will borrow short.
Right. Sir, just one question before we let you go. What about the other verticals? Last quarter was very slow for MSME. What are we expecting in terms of growth for those verticals? And credit cost as well, if you could give us a sense on both of these factors.
So growth of MSME, affordable housing and construction finance will be in the range of about 30%. The more growth will be coming from the gold loan portfolio. And as far as credit cost is concerned, affordable housing, GNP will be in the range of about 2%, MSME in the range of about 3.5%, and construction finance less than 0.5%.
And just before we let you go, what's your current LTV right now?
So LTV in MSME is about 57%, home loan is about 55%, construction finance is about 50%, gold loan we talk about, incremental basis 72%, portfolio basis about 66%.
Okay, all right. And I think we have your PAT guidance of around 850 crores for this year and 1,200 crores for next year. That's correct, right?
So PAT, I think because of various other factors and improvement in our operating cost, I think PAT this year will be in the range of about 900 crore. Next year, we are targeting about 1,300 crore.
Got it. All right, Mr. Sharma, thanks a lot for joining in. I appreciate you giving us that guidance. We'll hold you to this. And just one observation, you have a fair bit of your book that's exposed to gold, but the gold financiers have rallied in the last few months. Your stock, however, hasn't yet participated in that particular rally. So that's some food for thought as well. Thanks a lot for joining in. Well, before we slip into a short break, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Madhuchanda De of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about Coforge that remains a growth leader and continues to surprise positively given its first half earnings report. While the three key markets did well, in terms of industry vertical, the leader was travel, thanks to the stabilization of the mega deal followed by the BFS vertical. Coforge has a very strong executable order book, and with order inflows in excess of 500 million in the past few quarters, the growth visibility remains strong. The cross-selling to Cigniti, the company that it recently acquired, is also picking up pace. The company has a resilient margin which is expected to improve further in the fourth quarter. Coforge has recently announced acquisition of Encora in an all-stock deal. The expertise of this company lies in AI-led engineering, data, and cloud. While the acquisition is prima facie seen as expensive, but there are multiple synergies and the deal is expected to be earnings accretive. This further cements Coforge's position in the new age services, and the current consolidation in the stock provides an opportunity for long-term investors.
Right, thanks a lot for that. With that, let's give you a quick note. All you viewers, get ready for CNBC TV18's all-new lineup. Incisive analysis, sharp commentary with CNBC TV18's brand new offering. Watch our new segment, Cut the BS with Manglam and Sonal. Watch Macro Signal, Ritu Singh, that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. The stock that surged in the final hour of trade yesterday is IEX. And today, it's building on to those gains. Vivek joins us to give us an update on IEX. Vivek?
Well, that's right. First, let's understand what actually transpired. We are talking about the market coupling case. And the news stands that as of yesterday, the next scheduled hearing is on Friday, 9th of January 2026, where we should get some update regarding the implementation of market coupling. Now, today, JM Financial has actually written a note on this particular matter. What they're saying is that in terms of CRC's suo motu instructions to implement market coupling beginning Jan 2026, that particular matter remains sub judice. The counsel for IEX has argued 3 points that JM Financial has actually said are quite important to track. Number one, they say that the order was passed not as a prelude to any regulation, but rather to make an impact and to affect the stock market. The second point that the IEX Council highlighted was that the methodology or the regulations adopted to break IEX monopoly is not accurate. And in fact, they also give an example saying that the US antitrust laws to break corporate monopolies are used in different contexts and not in the context that it has been implemented in the case of IEX. Thirdly, what they say is that the CRC order itself quoted the outcome of a study conducted by Grid India, which concluded that there was negligible impact on price, which is the main objective of coupling. So in order to bring down transaction costs, this particular regulation should have come into effect. But two things are to be noted. Number one, the Grid India consultation paper was not made public. And what IEX Council argues was that the Grid India consultation paper, actually said that there was negligible impact on the price. On the back of that, JM Financial says that they reckon that market coupling is not likely before December 27 in the light of the challenges that implementation may face. It's an important development, and we will keep tracking this particular development. The next hearing is on Friday, like we mentioned.
Take that point. Thanks a lot for that, Vivek. Just look at Trent. Opened mildly in the green after a big gash yesterday, but that up move has been sold into the stock now below that 4,000 rupees a mark as well, currently at the low point. But let's talk about Thermax. Turns 60 years in 2026. A company that started off as a boiler maker is now undergoing strategic shifts to become a new energy leader. Our colleague Vinny spoke to the MD and CEO Ashish Bhandari. Let's listen in to that slice of the conversation as we wrap up on this edition of Chartbusters.
The larger projects in exports are coming from oil and gas and petrochemical and refining. In Q1 of this year, we had a big win for Dangote. Sorry, in Q2 of this year, we had a big win for a major oil and gas company from the Middle East, which was a big breakthrough for Thermax. Okay. Because the first orders are typically marquee orders, which once you qualify for, gives you chance of lot of repeat business. Q2, we had a major win with Dangote, which we had publicly announced. There again, we see more opportunity as Dangote also continues to expand. But as we look at Q3, Q4, and some of the other periods, we see a continued pipeline of international projects, not only from Middle East and Africa, but also from the US.
Ashish, I want to understand, we spoke about a lot of segments that are going to do well. You spoke about the new energy transition side, data centers. Where will those large orders come in from? Are these the sectors maybe which will give y'all the large order books, or will this be the newer ones, so this will be smaller order books?
So in the last 5 years, the portion of Thermax which has grown the most is what we call as the industrial products. Yeah, industrial products doesn't have large orders. It provides products that go into multiple industries, sells through distributors, channel networks across India, and the same model we are driving internationally as well. This is the business which is the most profitable for Thermax and has grown the fastest as well. The kinds of products that you will see here as well. Yeah, they don't make the headlines, but they provide continuous business and repeat business across multiple customers. So that is one area. But if you're asking specifically which are the areas that will provide the large orders numbers for Thermax, refinery, petrochemicals we talked about, steel and cement we talked about. The one segment which is coming back strongly, which was how quickly it has emerged as a surprise, is the whole thermal power sector. Which for India was a sector where for a while there were no new coal plants coming up. But now high efficient coal plants, supercritical or subcritical, but highly efficient plants are now back in discussion. And there again, the order sizes are large.
While we're talking so much about the infra side, I want to also understand the industrial infra side, right? Because that was some bit of a where the company had faced a bit of a pain point or an underperformance versus other segments. How is that performing now, or where is the trajectory of that business moving on, given that it's a major part of the businesses?
Look, I would say of the last few years, the current period that we are in, the last 6 months, and as I look at the outlook for the next couple of years, this is the most optimistic I am and have been for this particular part of the business for two reasons. First, the kinds of wins that I talked about, the international wins, the growth of India's power sector, some of the newer, bigger projects that are coming in internationally and domestically are all of the kind that is very much in the sweet spot of what the industrial infra business excels at. Okay, around our core competency, and we have been underemphasizing projects where there is significant civil construction, long-term risk. Even businesses like FGD, we said for the last 3 years itself, we will execute our current set of projects, but we won't do any more. So our backlog in industrial infra is starting to go up. The quality of that backlog is continuing to go up. And the opportunity set internationally and domestically is improving. So I'm very, very bullish on industrial infra, and with fair amount of visibility, at least for the next couple of years, into the kinds of projects we are undertaking in that business.
17% CAGR growth approximately that one has seen. Is that something that can continue for the company? Or do you think overall the industry could grow faster than that if the push comes in faster?
See, for us to grow faster, there would be other... I am an optimist by nature, yeah? And I believe the next 20, 25 years are India's years, yeah? And this is the period where if India has to build 3 Indias, what we have done in the last 75 years, multiple sectors will have to think very, very differently. Yeah, and a company like Thermax has a big role to play in supporting that growth and also making that growth happen. So I believe, I don't think we should be limited to a particular growth number. Our ambition should be to build products that are revolutionary, to be able to do them in a manner which can stand up. And if we do that, a 15 to 20% growth number should be achievable.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. As always, it's me, Mangalam, with me, Hormaz, as well as Ritu. Looking okay for the market. Yes, we started slightly on the back foot, but from there, we've seen a good recovery. The Nifty now marginally in the red. The reason why the index has recovered is because the IT pack is doing extremely well. The IT index was one of the biggest underperformers of 2025, starts 2026 on a positive note. The index up around 1.5% was higher yesterday as well. And if you look at the mid-cap IT stocks, they're doing a shade better. So all eyes will obviously be on the IT earnings. The big ones come by at the start of next week. Ritu, not looking particularly bad. The mid-cap index actually is outperforming.
The mid-cap index is outperforming. That's looking okay. What is, on the downside is the bank Nifty. After crossing record high levels, a few days back in trade, they're back below the 60,000 level. The key drag on the bank Nifty and for the Nifty in general has been HDFC Bank for the last 3 sessions, now declining in trade. Today, again, it is down by another 1.15% as we speak. IndusInd Bank, another name on the bank Nifty that is down. State Bank of India, AU Bank, all of these names. But bucking the trend, as we've seen for the last couple of days, has been ICICI Bank, again, up more than 1% in trade today. Canara Bank also, doing higher. But market breadth, like you said, we bucked the trend. More stocks are advancing now than declining. Keep an eye on the rupee as well. It has made some gains this morning. Now it is back, below that 90 mark to the dollar, currently trading at 89.97. So that's an important cue. We'll keep our eye out on. But broader markets trading with, shallow cuts. But it is individual stocks, as always, that we'll focus on. And Hormaz, it's over to you for that.
Well, indeed. And that's been the case for the markets, with stock-specific activity taking precedence compared to where the index has been over the last couple of trading sessions. And if you take a look at certain pockets that are shining bright in today's session, can't not talk about the jewelry names. You take a look at Senco, and after Senco's business update, TBZ, Thangamayil, and all of the other smaller jewelry names have also surged in today's session. TBZ is up 10, Thangamayil is up almost 6.5, and Senco too is up over 11%. And if you take a look at the volumes as well on all of these names, they too are significantly higher from where they usually are at this time of the day. Senco has had more than 1 crore shares traded. TBZ has had close to 65 lakh, and all of them are significantly higher than their 20-day average, and all 3 of them have a 20-day average volume of less than 1 lakh shares at this time of the day. The other theme that is shining today is the ER&D names after that upgrade that came in from JP Morgan on Tata Tech and on Tata Elxsi. So both of them are doing well, and KPIT Tech being their biggest overweight, and that too is doing well for itself in today's session. And take a look at the volumes on these names as well. With Tata Elxsi has had over 45 lakh shares traded, 3 lakh shares traded. Tata Tech has had more than 45 lakh shares. KPIT Tech over 6.5 lakh shares traded, and all of them too significantly higher than their 20-day average volumes, anywhere between 55,000 to 1.5 lakh shares. And the last name on the list is Shankara Building Products, and the stock was in the news recently for its demerger, and almost 8% higher in today's trade as well. It's the 3rd straight day of gains for the stock. Today's volumes are nearly 50% of Tuesday's volumes already. We had over 13 lakh shares that have been traded on the stock. The 20-day average volume is just 16,000 shares. The stock has moved above its 50 DMA, which is at 121. The 100 DMA comes at around 167, so still far away from those levels at least. But it has entered the month of January after coming on the back of 5 consecutive months of losses. And in this month, in the first 3 trading sessions of 2026, the stock is up almost 30%. But the stock, despite this outperformance, is almost half from its 52-week high, which is close to 290 rupees.
All right, Hormaz, thanks very much for that. Speaking of stocks that have been outperforming, the big story of the day as well, that's Titan. It is the top Nifty gainer today, up about 4.5% as we speak, also at a record high, and that's because of the good performance that it has reported in the 3rd quarter. Mangalam Malu is joining in again on Titan and the kind of moves we've seen. Mangalam, record high gold prices and people continuing to buy jewelry.
In fact, Ritu, they've bought so much more this time around. If you look at Titan, the total domestic jewelry sales growth has come in at around 41%. Overall sales growth, 38%. And in the jewelry business, there are 3 brands, which is Tanishq, Zoya, Mia, all of them, about 40% in terms of growth. And their growth driver, Carrot Lane has done about 42% as well. And Titan's not only about jewelry. Jewelry is done obviously very well, accounts for most of their revenue and margins. But on the margins, you know, the sidelines, watches, also a 13% growth out there, led by analog watches, which is margin accretive. Eye care grew by about 16%. Emerging businesses up around 14%. And that's not all. On a low base, the international business as well has grown about 79%. And the company said that the revenue growth has been obviously driven by average selling prices, but the buyer growth has been flat, which is a positive. Why is that? Because at such high gold prices, you know, you would assume that people who bought last year would not be the same number this year. That number would decline. But that hasn't been the case. The numbers have stayed steady. And that's not all. Gold coins, they nearly doubled in sales year on year. Plain gold category obviously grew strongly in the late 30s. But as gold prices increased, people started opting for lower caratage, lower value, lighter gold, but higher studded segments as well. And which explains why the studded segment has performed the best that it has for Titan in FY26 so far, grew mid-20s.
Where the leader does well, of course, it rubs off on the others as well. But now that Titan, you spoke about it, what about the others, Senco, Kalyan?
Well, both those stocks are doing extremely well. Let's talk about Senco. You know, the first half of this year was very, very slow growth, meager growth coming in for them. The street was worried about their guidance of around 20% as well. But come the third quarter, most of those purchases were pushed into the third quarter and the revenues grew 51%. And as a result of which, what the company has done is upped their guidance from 20% to 25%. Their retail business grew by 49%. Same-store sales growth up 39%. And diamond jewelry itself came in at around 36%. Management saying that, 50 to 60% of their gold is unhedged, or rather hedged. So on that 40%, they will get better inventory valuations. And that's why the margins would be close to around, 7.5% as well. And this compares to 7%. So at a time in the first half of this year when the street was worried about their guidance, comes the third quarter and the company actually ups the full year guidance as well. Kalyan Jewellers as well. If you look at, the overall India operations, 42% revenue growth out there. There too, same-store sales growth at 27%. International operations up 36%. And just the way Carrot Lane grew for Titan earlier, Kalyan Jewellers has its offering Candier. That too has seen a nearly 147% growth on a low base. So Titan on that base is growing. The others are growing faster. And looking at all these players, look at the other names. We have TBZ, which is up 11%. They haven't even reported their update. Thangamel Jewelry up 6%. We have PC Jewelers as well. These stocks are, not as favored, barring Thangamel, by investors as say the others. But, we've seen a big move, big bid ups on these stocks already.
And that's how it has been for all of these names, on very strong volumes as well, more importantly. The other one, we're coming back to Titan actually. Yeah. Just before they came out with their business update, a few days earlier, they announced a lab-grown foray. What do you make of that? What the management makes of it?
After they came out with their update, they also held a conference call, and that was specifically for their lab-grown business. And important key takeaways that have come in. The company said that their objective is to differentiate in this commoditized market. They do not expect cannibalization. Most on the street were worried that, okay, if Titan gets into lab-grown, what happens to natural diamonds? They say that the customer overlap is minimal. The buyers of lab-grown are very different from the buyers of natural. And lab-grown diamonds currently account for only 2 to 3% of the overall studded market. So that's a positive. And Beyond's e-commerce launch is also expected very soon. And here too, they are playing the value equation, not the price thing. So they're saying that they'll, price their diamonds at 22,000 to 23,000 per carat, while the market average itself is around 30,000 per carat, which means that with the brand trust and the pricing of the Tatas, Beyond could actually be a big leader in this market.
Disruption coming into this space as well, with the leader entering this market. But now that you've summarized all of this for us, what lies ahead? The triggers, the valuations and so on.
Let's look at the triggers. The biggest one, will higher gold prices impact demand in non-seasonal period? The third quarter, great, because you had Diwali, Dhanteras, everything happening out there, the early wedding season as well. But now with gold prices still higher, will that impact demand in the non-seasonal period? That's point number one. Secondly, if gold prices decline, will buyer growth return? Because as of now, buyer growth is flat or declining. In Senco's case, volumes were down 12%. So if gold prices come down, will volumes return or not? Or people will wait for the prices to fall further? Typically, higher gold prices means people rush to buy because they believe that the prices will go higher. And if gold prices fall, they do not rush to buy because they believe that it will fall further. So that cuts both ways. Second part, low price, semi-precious jewelry, will that be the next growth driver? We've been talking about this Zudioization of jewelry, Beyondization for Titan, Gingerization for Indian hotels. Will that happen for jewelry as well? What could be the impact of Titan's lab-grown diamond foray on the industry at large? You know, Titan's been known to disrupt the industry. Will they continue to do so for the lab-grown diamond as well? And finally, impact impact on margins for the sector, because as gold prices rise, gold is a very low margin product. You won't sell gold for much higher than what the value of that gold is, barring the making charges. On that as well, there would be a lot of competitive factors that will come in. And then you have the studded jewelry, you have all those factors where lower caratage, etc. comes in. So should margins be revised downwards for the industry or not is the big question. You spoke about valuations. Titan, always at a premium to the sector, continues to be so as well. 70x. Kalyan Jewellers at one point came very close to Titan's valuation. Thereafter, we saw a big gash on that stock, currently trading at 33x. So pull up the valuation chart once again. So Titan is at 70x, Kalyan is at 33x, and Senco, obviously, much lower player, regional player as well, trading at around 18x. So those are the valuations. Titan, 70 times price to earnings, Kalyan, 33 times, Senco, 18 times. As their pecking order is their size as well. So which is why you can't say that one is more expensive than the other.
Indeed.
All right, jewelry stocks continue to shine. Mangalam, thanks very much for taking us through that, our big story for the day. We have to slip into a short break, but before we do that, just a quick heads up for our viewers, because if you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026, is where that conversation will begin. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on the 13th of January, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18. All right, we'll take a break, like I said, but up next, Manisha will continue to join us, as she always does, to talk to us about the bond markets.
Fly Emirates, fly better.
And India Bonds presents Bond Street.
Welcome to Bond Street, and what we are looking at is a decline when it comes to bond prices therein for the 6.33 2035 bond, 2035 bond rather, and this is happening due to the disappointment because there's a lack of 6.33 2035 bond at the RBI OMO, which has been announced for the day of Monday therein. Well, RBI did say that the 9 states will have been able to raise 301 billion rupees at bond auction for Tuesday, which was yesterday. Remember, this was the first round of the agreed bond calendar of around 5 trillion rupees between January to March. So the first round where 9 states were trying to raise 301 billion. We did understand that the first half of the day was kind of mixed because of the prices therein. But RBI did say yesterday evening that all of the money and the 9 states have been able to raise that money. Well, yesterday also 6.33 2035 was the biggest gainer, ending at around 6.60. Not the case right now. But what the markets are looking at right now for bonds is, of course, the focus is on FPIs and banks' demand going forward. Apart from that, it also is about India perhaps joining the Bloomberg Global Aggregate Index. That announcement could come in as early as next week, and that clearly has been supportive for the markets as well. The third thing really is about the Indian rupee, which has seen an appreciation. We are trading on the right side of 90, and that in turn also has been supportive. The other thing that the street will watch for is the first advance estimates of the GDP for FY26. Well, that's due today. As of now, the street is anticipating a number of 7.5% for FY26. Having said that, when you look at the domestic institutions, well, that really dominated the debt deal making in 2025, and the statement coming in that 2026 could be slightly lower than what we saw in 2025. The year saw very strong gains. We saw 5% increase on an year-on-year basis to the tune of total deals in 2025 coming in at 135 lakh rupees. Well, what the street is looking at also is the major leads there. Axis Bank, HDFC Bank, ICICI Bank led as managers in the debt capital market. They were the top 3 there. Of course, the list goes on and is quite long. But the arrangers in the debt market will also watch out for the corporate bond issuances. There are 2 factors impacting that. One is the reduction in repo rate. That should impact in sense of buying. But the other thing is, because of reduction in repo rate and the way the bank loans are working right now, the rising bond yields perhaps will make the market borrowing less attractive versus the bank loans. But that is something we'll have to watch out for in sense of numbers. The first week or 10 days of Jan do show us that we are looking at slightly mixed bond numbers that are coming through in the international markets there. And with that, let's go for a short break. When we come back, we'll talk market technicals with Mehul Kothari, Deputy Vice Chairman, or rather President, Technical Research from Anand Rathi.
CNBC-TV18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're watching Trading Hour. The markets continuing to extend their losses. The broader indices now down almost 30 points. The bank Nifty, though it is down, it is now back above that 60,000 mark. Keep an eye out on that. Midcap, though, bucking the trend, now up about 186 points. So that's where the market stands. But let's bring in Mehul Kothari, the Deputy Vice President of Technical Research from Anand Rathi Shares and Stockbrokers, joining us for a quick check, technical check of the market. Mehul, thanks very much for being here. Just give us, to begin with, your targets for the Nifty in the near and longer term and your top stock picks for the day.
Very good morning. First of all, thanks for having me on the show. Well, Nifty initially witnessed a breakout about 26,200 level and moved up towards 26,350. So post that move, the index has seen a healthy pullback and has retraced towards 26,100 as of now, which coincides with the 61.8% retracement of the rally, which started from 25,900. Now, so as long as 26,100, 26,050 support zone is held, we expect the upside momentum to resume. That said, Nifty continues to remain largely range bound, spending time in consolidation rather than showing decisive directional movement. So on the upside, we feel that 26,400 to 500 could be the cap as of now for short term. Overall, 27,000 could be the targets for a couple of months if we say. But meanwhile, the real action is clearly visible in broader markets. Mid-cap stocks are outperforming the benchmark indices and are displaying better relative strength. So as of now, we feel that a key index to track rather than Nifty is Nifty Midcap 150. The index is once again on the verge of a major breakout near its all-time high. A weekly close about 22,600. As of now, it is trading near this level only. So would be a crucial confirmation for broader market strength. If this breakout materializes, we feel that we could see an upside of 5 to 6% in this index, that is Midcap 150 index, which could be highly supportive for midcap stocks from here on.
In that light, Mehul, what are those recommendations that you have this morning?
Thomas, we feel that pharma sector can do really well from here on. One of our pick from that is Syngene International. Syngene International is looking promising at this stage. It is stabilizing near key support level. So a sustained hold above 660 to 670 zone, which is the current level, could lead to a move towards 730, which is the target. So one can buy the stock near this level. Stop loss will be 635 and upside target is 730.
Right. Do you have a call on the mid-cap IT space that's actually outperforming in today's session? Most on the street believe that maybe, it is not a consensus call, but a bold bet if one had to take on IT after the underperformance. Chartically, is there something happening there?
Still, the entire pack is, I feel, range bound. If we talk about mid-cap IT, then I feel Infosys and Mastech are looking good. But other than that, I feel consolidation will continue in IT. And Pharma might outperform in comparison to IT.
All right, take that point. Thanks a lot for joining in and giving us your views. Wish you good luck. Let's talk about Godrej Consumer. Now, stock is absolutely flat, marginally in the red, but no real worries when it comes to their third quarter update. Why is that? Because they said that the Indian business for them have actually, demand has seen progressive improvement. Business will deliver double-digit revenue growth in India and near double-digit volume growth. Now, this is something that was missing from the FMCG pack, near double-digit volume growth or double-digit volume growth that we've been used to seeing during the good times. And over the last many quarters, it's been mid-single or maybe low single-digit sort of volume growth. This time, it's led by home care segment, which saw double-digit value growth. Also, the personal care segment saw mid-single-digit value growth. Importantly, the standalone EBITDA margin for Godrej will revert to normative range. Normative range for the India business is between 24 to 28%, and that hasn't been the case for the last many quarters because of higher input prices or GST-related disruptions, etc. All these factors meant that this is a good update coming in, whichever way you cut it, for the India business. Now, the problem for them was the Indonesian business, which saw many quarters of weakness because competitive pricing pressure persisted. But here too, the light at the end of the tunnel is they're saying they're seeing early signs of resolution or stabilization. Improvement is expected from FY27 on revenue and profitability. So all these factors mean that on a consolidated basis, the revenues will grow near double digit and EBITDA will also grow that much. Good double-digit revenue growth, good margin growth, as a result of which the stock, should do well. But as of now, maybe the street wants to take a look at the actual numbers before taking a call on how the stock moves from here.
Indeed, and it's not done much in the last 12 months either, as Godrej Consumer is up only 8% over the last 12 months. By the way, some losers in the broader markets as of now. M&M Financial is now at the lowest point of the day, 4% lower now on the stock. Remember, the stock has had a very sharp run up in the last couple of months. So that stock is witnessing some profit booking from higher levels. Cipla has moved to the lows of the day now, 3.5% lower there as well. And Ola Electric, of course, after that 3-day up move when the stock went up almost 20-odd%, the stock was down in yesterday's trade, down in today's trade as well. So another 3% shaved off on Ola Electric. On the flip side, though, Midcap IT continues to do well. Sonata Software has now moved to the highs of the day, almost 5% higher on that stock. Intellect Design Arena is doing well, as is Birla Soft, as is Persistent Systems. So the entire Midcap IT basket doing very well for itself in today's session. Take a short break, come back with more on the markets on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350. Welcome back. Still stuck in a very narrow range is the index, finding support at 26,100, but also struggling to cross that 26,200 mark on the upside. Every dip getting bought into, a recovery getting sold into. So that's been the story of the day, just narrowed down to just 80 points on the index. But one stock that took away all the limelight in the second half of trade yesterday was IEX. The stock ended almost, 8.5% higher. Slightly off the highs of the day, but still holding on to gains of around 2%. Vivek is here with the latest ahead of that all-important hearing on Friday. Vivek.
Well, that's right. The first thing that we need to understand is, as far as IEX is concerned, with regards to the market coupling case, the final or the next hearing rather is on Friday, 9 January 2026. So still the outcome of all of the hearings is still pending and the judgment is not yet been passed. Now, today there has been a note written by Jio Financial based on yesterday's court hearings. What they're saying is that, number one, the matter of CERC's suo motu instructions to implement market coupling beginning January 2026 now remains sub judice. They say that the Council of IEX has argued three main points on which they have taken a view. The first point of argument, of course, is that they say that the market coupling order was passed not as a prelude to any regulation, but rather to make an impact and to affect the stock market. Along with that, what they're saying is that the methodology and regulations adopted to break IEX's monopoly is not correct. And in fact, they say that US antitrust laws to break corporate monopolies are actually used in different contexts and not in the context that it has been used in the case of IEX and market coupling. Lastly, the third point is that the IEX Council argued is that they say the CERC order itself quoted the outcome of a study conducted by Grid India, which concluded a negligible impact on price, which is the objective of coupling. Also important to note that the market coupling or the Grid India report was not made public, another important development that was highlighted. So JM Financial concludes saying that they reckon that the coupling is not likely before December 2027 in light of the implementation challenges that it could face.
All right, Vivek, thanks very much for joining in with that. Friday is the next day to watch out for the hearing to continue on that market coupling case. But another stock that is in focus today is Cipla. It is the top loser on the Nifty today after the US FDA disclosed some observations on one of its key partners. Ekta joins in with more. Ekta.
Well, yes, Cipla is in focus because a Greece-based contract manufacturing company, Pharma, has received a Form 483, which is basically observations for its Rhodope unit, which is based in Greece. They've received 9 observations for this unit. Now, why exactly is Cipla connected to this is because Pharma is Cipla's CMO partner for a drug called lanreotide, which is basically used to treat tumors. And the reason for that is that lanreotide is being manufactured by the CMO for Cipla. Lanreotide is expected to be one of Cipla's most successful, most important drugs in their portfolio. So now the street is worried that if in case they have received 9 observations for this particular unit, then there could be some amount of manufacturing delay, maybe some amount of roadblocks for Cipla in terms of manufacturing lanreotide. As of now, we do not know whether Cipla does have any kind of alternate manufacturing for this particular product. We have reached out to the management. We're still waiting to hear. But the 9 observations seem to be a little concerning, according to analysts, because it does have issues such as microbiological contamination. One of the observations also has been linked to data integrity, according to analysts, and hence they are worried that there could be some amount of delay in terms of resolution of these observations, which in turn could delay the manufacturing of lanreotide for Cipla. But does Cipla have any other plans, any other alternative? That'll be key to know.
Take that point. Stock at the low point right now, down about 4.5%. The street clearly worried about the number of observations and the nature of them. Obviously, we'll monitor remediation soon on Cipla too. But IHCL, Indian Hotels, is another stock which is a rare decliner in today's trading session, and that's largely because there has again been a rare downgrade coming in on Indian hotels. Remember, the hotel sector has been on a structural tailwind, and the stock has seen a big rally all the way up from around 200 rupees thereabouts to about 700 rupees in the last few years. But Morgan Stanley, after this big move, has downgraded the stock to equal weight from overweight. They're saying that, while the company is leveraging the Taj brand and has created a good hospitality ecosystem, the industry revenue per available room, or, the RevPAR as they call it, while it is strong, there may be limited upside surprises now. Back in the day, Street was surprised by these numbers quarter after quarter, but now it may seem to get into more predictable and perhaps priced in zone as well, because the stock is trading at what? Nearly 28 times FY27 EV to EBITDA, which is pretty much, in the price, captures all the risk reward for them. And the only risk from here on is reduction in their return ratios because of the big surge that we'll see in the middle of the road Ginger properties, because Taj continues to do well, but you can't price hotels further than what they are right now. Whereas now the next leg of growth may not come from the upper end of the market, but the lower end of the market, and the upper end may perhaps have been captured already in the price and the run-up that the stock has seen. That explains why the stock is lower.
As you mentioned, the gingerization of the hotels for Indian hotels. But yes, 2.5% lower on the stock, rare downgrade, as Manglam was highlighting as well. Of course, down around 20% in the last 12 months. But Morgan Stanley still believes that most of the positives are in the price. Now, earlier on the channel, Sunil Singhania, the founder at Abacus Asset Managers, told CNBC-TV18 that India's journey from a $4 trillion to a $8 trillion economy will be aided by new age companies. Now, he also remains bullish on the financial space and metal stocks. Listen into what he had to say.
We are not saying that everything which is new age or new economy is bad, but, I think there also one will have to distinguish. And we are very clear that we would want to give capital to companies which will use that to grow, not to burn. And therefore, perennially loss-making or cash flow burning companies are something which we should avoid. The other thing is it is very difficult to value these companies. And, more often than not, one gets sucked into a momentum kind of a thing. So I think that is where I would say that we have to basically be a little bit careful. When we grew from $0 to $1 trillion in terms of economy, that was contributed maybe jute and cotton and, textiles and some utilities, some steel. 1 trillion to 4 trillion, the path in terms of the economy, I think the contribution came from private sector banks, IT services, pharma, a lot of consumption-oriented sectors. And it is very clear that when we move from 4 to 8 trillion, I think a lot of these new age businesses will contribute a lot to that journey of 4 trillion to 8 trillion. So you can't write them off. We were positive on 3 sectors and we continue to be positive. 2 of them have worked out well. So all kinds of financials, including some NBFCs, non-fund-based financials, predominantly asset wealth management companies, insurance companies, I think they have done very well. Banks also have been doing reasonably well. Growth rate obviously have slowed down to maybe, low double digits, but very good asset quality. Metals have done phenomenally well for us, and to some extent we were lucky because it got helped by what is happening globally in terms of metal prices. Pharma is one sector where we are positive, which has not worked out in the way we would have liked to, but I think there is a lot of moat there, both domestic pharma, global pharma. I think there's a little bit of overhang of any negative news which can come in from the US front. But Indian pharma has a lot of moat. So I think pharma is one sector where we would like to stick our necks out and be a little bit more overweight.
Right. Metals and pharma, 2 of the indices that are in the green and trade today, and financials, of course, dragged down by HDFC Bank. We'll slip into a short break, but up next, we're going to get you more on the markets. So stay tuned. Welcome back to Trading Hour. We'll continue to focus on the markets, and as promised, let's bring you the latest trends from the F&O space. Manglam Malu standing by to bring us those. Manglam.
Well, if you look at the Nifty, it's consolidating. It's led higher by the Nifty IT index. We're seeing some contribution coming from the Pharma index yesterday, but right now as well, it's marginally in the green. The Nifty Bank is the one which is underperforming. If you look at the mid-cap IT stocks, they're doing extremely well. We have KPIT Tech, Tata Elxsi, Birla Soft, all of them outperforming the large-cap IT names, which will report their numbers coming next week. As far as the frontline index levels are concerned, because of these negating factors of IT and the Nifty Bank, you will see, the market be in this range. 26,100 put writers, fairly active, premium of 65 rupees, telling you that around 26,050 there would be support. But on the way up, 26,200 call writers, equally active as well. Out there, the premium is around 93 rupees, telling you again that 26,300 would be a resistance. So the range that you're looking for today would be around 26,050 to 26,300. Not just today, but these are the options that expire on next Tuesday, that's the 13th. Let's talk about individual stocks. Titan stock is, the top Nifty gainer at a record high, the stock of the day. And as we speak, it's curtailed around that 4,300 rupees, because 4,300 and 4,400 calls have maximum open interest and a lot of activity taking place out there. So this would be a very stiff resistance to congestion zone to cross for Titan. And if it does fall, then 4,000 put, that's where the maximum open interest is. So a lot of support at the 4,000 mark for Titan as well. A lot of long positions that we're seeing on Kalyan Jewellers and Indian Hotels. We spoke about, the Morgan Stanley downgrade that has come by. A lot of short positions accumulated on Indian Hotels. The stock holding around that 700 mark.
Holding around that 700 mark is Indian Hotels. So doing, well, finding some support at those levels. Manglam, thank you for summarizing that for us. Pull-up Meesho continues to remain locked in a 5% lower circuit. The lock-in period ended in today's session. Of course, that's the 1-month shareholder lock-in, and only 2% of the outstanding equity became eligible to be traded. The other stock whose lock-in period ended today was Tata Capital, and that stock is also seeing a minor downtick in today's session, around about 1.5%. Remember, Tata Capital continued to remain in a very narrow range from its IPO price, saw that big up move last Friday, and since then has been around those levels of around 360. But Thermax is celebrating its 60th anniversary this year, and who started off as a boiler maker in 1966, is now undergoing a significant strategic shift to become a leading new energy solutions provider. My colleague Vinny Motiwala caught up with its MD and CEO Ashish Bhandari, where he shares his views on the performance of the subsidiaries and the chemicals business. Listen into a slice of that conversation.
As we continue to look to the future, many of our businesses we are incubating. Yeah, hydrogen is a great example where over the last year and over the next 3 years, we will be investing more than 100 crores in just establishing a hydrogen business. And we know for the next couple of years, substantial revenues won't show up. Yeah, but we know they are the right investments to make as we look at energy transition and as we look at Thermax of the future. Bio-CNG is also one such example of where we have made significant investments. TOSL is the place where we provide green energy, which is steam or power, to our customers on a build-own-operate basis. It's a fantastic story where we have now done more than 50 plants in India for our customers. And one of the best examples that I can share with you is one of the biggest names in F&B for their noodle plant in Gujarat, which was coming up. They shifted from using coal or fossil fuels to using biomass-based steam, because to make noodles, you need a lot of steam. And Thermax built that plant for them on a build-own-operate basis, using local agro waste which comes from that local geography, groundnut shells, whatever else was available, converting that into steam to the customer on a guaranteed basis. So the customer is guaranteed a plant uptime, availability of steam, and all things considered. The customer has liked the model so much that on multiple plants across India, they are moving completely to this plant. So that is what TOSL can do. Yeah, last FEPL, which is our foray into renewable energy and renewable power, that business we have invested in and we continue to grow. Our plan is that we will grow it to 1 gigawatts for our customers, and at that point we will bring a suitable partner in to scale that business up as we look forward.
Okay, suitable. Once you'll reach that scale, when the new partner will come?
Which should be within the next couple of years.
Okay, within the next couple of years. Ashish, what about order book, order growth that you're seeing? Because I think you all had mentioned 20%, more than 20% growth for FY26 in terms of orders. Given, how things are going or how we are talking about things moving, what is the growth that one could expect in terms of order book now?
Because we have just closed the quarter, it would be wrong for me to share specifics, but I am consistent.
On a long-term basis?
On a long-term basis, at least for the period that I have visibility into right now, the messaging that I had shared, that this should be a good year for Thermax overall on the orders side. Across all our business verticals, I stand by that. Yeah, industrial infra, where we are starting to share visibility on bigger projects, the numbers are there to see. Industrial products also, we will have good visibility. Businesses like cooling, which we are here today, have got good tailwinds with some of the newer sectors looking at. Some of the other businesses like chemicals, where we have invested heavily, we would like to see that growth come through. It hasn't come so far to the extent that we would like, but we have invested in new plants, new capabilities, and I'm confident that growth will come through. For Thermax, driven by India's largest story around development, a growth of 7% that India is going through, a strong international capability that we have, emergence of newer sectors that I talked about, and re-emergence of old sectors like thermal power, which have now come back in a strong way, give me ample confidence that the coming period, Thermax will show the growth that I would like to see the company is capable of.
So good growth like what we're seeing right now, or better? Or is what one could see?
What one could see.
The exclusive conversation with the management of Thermax, the company celebrating its 60th year in 2026. But it's time for CNBC-TV18's new offering, the Macro Signal, which the aim is to isolate the macro forces that matter for the day and explain how it translates into market moves. And Ritu, as always, is going to break this down for us. And today's focus is on the first advance estimates of the GDP for FY26, Ritu.
Yes, Hormaz, that is very much the big focus area for today, because the Ministry of Statistics is going to release this estimate later this evening. And with that, we'll get the first official snapshot of just how fast the Indian economy grew in FY26. Now, keep in mind, this is still an estimate at best. So it's based on partial data and all kinds of extrapolations that are made. So it is bound to be revised later. And also the fact that, all the assumptions will have to be changed once we shift to this revised series with the 2022-23 as the base year. So the number matters. It is subject to revisions. So, we still have to look at it because it forms the base of all the budget math. Now, let's look at where the expectations are. The CNBC-TV18 Outlook poll we presented, which Lata did, pegs the FY26 real GDP growth at 7.5% and the nominal GDP growth a tad lower. 8.3% is the expectation. Now, RBI's own projection is also slightly lower than 7.5% at about 7.3% for FY26 in real terms. Now, so far, we've already got an average growth of 8% for the year, so a 7% plus number does not look unreal. Now, last year's budget had pegged the nominal GDP growth for FY26 at a little over 10%, but the actual FY25 GDP size was also larger than what the budget had estimated. So overall, these changes should not affect the budget math too much. Now, why is this number important? Because this is the starting point for all of the budget calculations that will happen. You take this advance estimate for FY26 GDP, then the government is going to assume a certain growth rate and come up with the estimates for FY27 and then anchor all the budget math around that. Now, these assumed FY27 numbers will, with the FY26 base, will drive all your tax buoyancy assumptions, the fiscal deficit projections, and the denominator that will be used to calculate the deficit ratios as well. So even small changes in this assumption can materially impact things like government borrowing, your capital expenditure allocations, etc. And this is also where nominal GDP becomes the more important hidden driver, because the budget math is not done on the real GDP numbers. It is linked to the nominal GDP, and nominal GDP growth for FY26 will be the starting point for the revenue projections for FY27 and determine the fiscal space that is available. Now, a lower growth will mean weaker revenue buoyancy and tighter budget math going into next year, and a stronger number, on the other hand, will give us more fiscal headroom and more flexibility on government spending and the deficit targets as well. So that's the reason you should keep this number on your radar for today. But on that note, we're going to slip into a short break. Up next, we'll get you an exclusive chat with the Deputy Chief Minister of Maharashtra, Eknath Shinde, on a whole host of civic issues.
Welcome back. Now in an exclusive chat with CNBC-TV18 ahead of the BMC elections, Deputy Chief Minister Eknath Shinde says that there won't be any dug-up roads in Mumbai by next year and that Mumbai will be pothole-free by the end of the year. Listen into a slice of that conversation.
देखिए अभी मुंबई में जितने कंस्ट्रक्शन के काम शुरू है उनको एक रूल्स के मुताबिक काम करना पड़ता है, पूरा कर्टन से उसको ढकना पड़ता है, उसको स्प्रिंकलर लगाना पड़ता है क्योंकि मिट्टी धूल ना उड़े, लोगों को तकलीफ ना हो।
पर उसके लिए बॉम्बे हाई कोर्ट ने कहा कि जब उनके पैनल ने चेक किया तो ये सब कुछ फॉलो नहीं करवाया था
नहीं फॉलो नहीं कराया तो फॉलो बिल्कुल करना चाहिए और बिल्कुल करेंगे। अभी देखो AQI अभी मुंबई का बाकी शहरों से कम है। हम डीप क्लीन ड्राइव करवाया था जब रोड को पूरी तरह चकाचक करके, वही मैन पावर थी, वही मशीनरी थी, वो चकाचक करके मिट्टी निकाल के पानी से उसको धोने का काम खुद मुख्यमंत्री में था, खुद रास्ते सड़क पे मैं जाता था, तब भी लोग मुझ पर टीका करते थे कि क्या मुख्यमंत्री का है, तो क्या मुख्यमंत्री का काम पोल्यूशन कम करना, लोगों को मदद करना नहीं है? क्या घर में बैठने का मुख्यमंत्री का काम होता है?
नहीं, बिल्कुल सर। तो मुंबईकरों को अब इन सब चीजों से मतलब ये जो सड़कें कंस्ट्रक्शन की वजह से खुदी हुई हैं, पूरी तरीके से रास्ते बंद हो जाते हैं, ट्रैफिक, इससे कम निजात मिलेगी?
थोड़ा अभी
कुछ थोड़ा टाइमलाइन मालूम पड़ जाए सर?
नहीं, अगले 1 साल तक खत्म हो जाएगा सब, क्योंकि देखो कुछ अभी पाने के लिए थोड़ा तो सहन करना पड़ता है। अभी
सर ये थोड़ा बहुत ज्यादा हो गया मुंबई में।
अभी आप जब मुंबई में पूरे कॉन्क्रीटाइजेशन हो जाएगा तो ये तकलीफ ही नहीं होगी, क्योंकि फिर बाद में रास्ता खोदना तो बिल्कुल बंद ही हो जाएगा।
मुंबई की अगर हम बात करें या मुंबई मेट्रोपॉलिटन रीजन की भी हम बात करें, ग्लोबल एक स्टेटस है मुंबई का, उसके बावजूद चाहे वो सड़कों की हालत हो, चाहे वो हर साल की बारिश की वाटर लॉगिंग हो, चाहे अब वो पुअर एयर क्वालिटी हो, ये सारी चीज़ें मुंबई करों को इस चीज़ से कब निजात मिलने वाली है? आपकी अगर मैं ट्रैक की बात करूं तो जब शिवसेना टूटी नहीं थी उससे पहले की बात करें, 25 साल तक करीब शिवसेना ने बीएमसी पे राज करा है, स्टैंडिंग कमेटी चेयरपर्सन उनके, मेयर उनके रहे, मतलब उस वक्त तो आप भी शिवसेना के साथ थे, तो तब ये चीजें क्यों नहीं हो पाई और आज तक मुंबईकर इस बातों, इन सारी चीजों से क्यों परेशान?
तब मैं मुख्यमंत्री नहीं था,
लेकिन आप काफी
जब मैं मुख्यमंत्री बना तब मैं आपको बताता हूं कि पहले हमने काम हाथ में लिया पूरी मुंबई का कंक्रीटाइजेशन करना, डांबर के रोड को खत्म करना। ये 25-30-40 साल तक अभी कोई गड्ढा नहीं होगा। पॉट होल फ्री मुंबई करना हमारा मकसद है।
सर लेकिन मुंबई पॉट होल फ्री हुई नहीं है अभी।
कर रहे हैं ना, आप देखिए ना, आपके लोगों को भेजिए। ये
सर मैं खुद ट्रैवल करती हूँ।
हाँ,
2022 में जब आप मुख्यमंत्री बने थे, आपने कहा था कि 2024 तक, हाँ आपने कहा था कि 2024 तक पॉट होल फ्री कर देंगे।
ऐसा नहीं, देखिए मैं कभी भी जो कहता हूँ करता हूँ। अभी अगले 1 साल में आप लगभग ये मई में एक बड़ा पोर्शन कंप्लीट हो जाएगा, मई में, उसके दिसंबर तक पूरा कंप्लीट हो जाएगा। तो ये 1 साल के भीतर में मुंबई में आपको गड्ढा नहीं दिखेगा, ये मेरा वादा है। एसटीपी नहीं थे, सीवरेज ट्रीटमेंट प्लांट नहीं थे इतने 20 साल में, सब पोल्यूटेड पानी सब ऐसे ही समुद्र में जाता था, समुद्र के बाजू से जाओ तो बहुत गंदा आ जाती थी, काला पानी दिखता था। आज सीवरेज ट्रीटमेंट प्लांट हुए हैं, 7 जगह पर काम चालू है, 1-1.5 साल में कंप्लीट हो जाएंगे। तो जो सब पानी जो समुद्र में जाता है वो ट्रीटमेंट हुआ पानी जाएगा, ये काला पानी गायब, नीला पानी वहाँ दिखेगा। तो ये क्यों नहीं किया? ये भी तो करना चाहिए था।
करेक्ट, आप ही 2022 तक वो आप ही लोगों के साथ ही थे सर। 2022 में आप मुख्यमंत्री बने थे, आपने कहा था कि 2024 तक सारी सड़कें जो हैं मुंबई की गड्ढा मुक्त हो जाएंगी।
नहीं, देखिए कैसे एक ही साथ मुंबई को हम पूरी तरह, मुंबई के सभी रास्ते शुरू नहीं कर सकते हैं ट्रैफिक की वजह से, तो फेज वाइज हम कर रहे हैं। लेकिन हमने पूरी मुंबई के सड़कें जो है कंक्रीटाइज करने का निर्णय लिया है, उसका काम शुरू हो चुका है और वो लगभग काम कंप्लीट हो जाएगा। जो हम बोलते हैं वो करते हैं, ऐसे नहीं हम जो नहीं होने वाला नहीं बोलते हैं।
Well, let's hope we finally get to see a pothole-free Mumbai in 2026. On that note, we're going to wrap up this edition of Trading Hour. But stay with us. Halftime report is going to take all the market action forward.
Markets trade off opening lows. IT, consumer durables, capital market stocks do well. PSUs and the auto pack take a breather. Asian markets trade sideways after a good run over the last few days.
Jewelry stocks trade higher after strong Q3 updates. The leader Titan is up 4% today after its consumer business revenue growth accelerated to 40% in Q3 after a 20% growth in Q2. Kalyan Jewellers posts a 42% growth in its India revenues. The Senco stock is up over 10% after the East India focused company posted an over 50% revenue growth in Q2.
Sources tell CNBC-TV18 that a probe by the Competition Commission of India shows that approximately 35 steel companies have prima facie indulged in cartelization. However, the CCI has not yet passed any order on the matter. It has asked responses from all the steel companies on the findings from its investigation and is set to fix a date for the hearing of the matter.
Overnight, US President Trump delivered a wide-ranging 90-minute address to House Republicans at their annual retreat in Washington. Trump gave a blunt warning that his presidency depends on Republicans holding the House and Senate this November in the midterm elections.
The government is set to announce the first advanced estimates of GDP for FY 25-26 at 4 p.m. this evening. This is the first formal step to making the budget. A CNBC-TV18 poll pegs FY 26 real GDP at 7.5% and RBI sees growth at 7.3%.
Hello, good afternoon. You've tuned into Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me my colleague Sonal Butra as well as Ekta Batra. Hi ladies, good afternoon. One more day that we're holding on to 26,100, but the third day that we're still seeing a decline in terms of the market. And broader end of the market though today is managing to hold on to that some bit of a gain. Advance decline ratio still a bit more in the favor of declines today versus advances. And in terms of sectors that are managing to hold on to good gains, metals continues to shine. We're seeing realty that is holding on to good gains as well. FMCG, that's not that great in the trading session as well.
But the updates that have come by, at least from the jewelry companies, they speak otherwise. Of course, we'll discuss that in greater detail, but we are very close to starting the earnings season. We already kicked it off with a mid-cap company reporting numbers yesterday, but other than that, watching out for all the big ones. For today, Nifty IT is batting it for the bulls, but we are seeing some losses coming in from the CPSE index, so the PSU basket not doing so well. We also have some of these names in the auto pack, the infra pack, which are seeing some profit booking. So all in all, third consecutive day of losses on the Nifty, but we continue to stay above the 26,100 mark, but the advance decline ratio in favor of the declines. Market breadth hasn't been so much in favor of the advances in a long time.
Yes, absolutely. So the advanced declines are definitely on the declining side, and sub 26,200 currently for the Nifty. What we are also seeing is that the mid-caps have given up their gains from the top. So it's just about flattened out for the mid-cap index. So that should come up for you just about 100 points higher currently for the mid-caps. So let's see whether they manage to hold their head above the water, but as of now, looking a bit tentative. But nonetheless, underneath the surface, we do have a lot of stocks which are moving. So we're going to kick off the show with our movers and shakers segment, where we track a whole host of stocks which are buzzing in trade. And let's start with what's shining and sparkling in today's trading session. Manglam is here to tell us more about Titan. Manglam, please tell us who is buying and who is affording all of this jewelry, considering where gold and silver prices are.
Indeed, it's a sparkling quarterly update that has come in from Titan. And on that base, a 38% jump in their consumer business, led by 40% plus jump in their jewelry business, around 40% for some of their big brands like, Tanishq, Zoya and Maya. And their growth brand, which is CaratLane, also saw a 42% jump. Now, it's led largely by higher gold prices. Remember, in the third quarter, year-on-year, gold prices were up for over 60%. But despite such high gold prices, there were a lot of people which bought these, ornaments, because they're saying that, number of buyers was absolutely flat. The street was worried about a decline in the number of buyers because of the big jump in gold prices. That wasn't the case to be. Even the smaller businesses, the other businesses have done well. International foray was a big one for the company, 79% jump out there on a small base. Even if you look at the watches business or, you know, the eyewear business or the other businesses, we had watches which showed a 13% growth, but that was largely led by analog watches, which is margin accretive for the company. And we saw a decent performance come by for their fragrances business and women's handbag business too. Studded segment, that's the one that clocked the best performance in FY26 so far, growing mid-20s. And at the same time, gold jewelry grew mid-30s. We also saw plain gold, or rather gold coins, see doubling of sales year on year. So all these factors working well for Titan. And alongside all of this, now the launch of Beyond, which is their LGD or lab-grown diamond segment, will provide to be another trigger as well. Brokerages are fairly happy. The stock, which has already been a big wealth creator, continues to do well at a record high at 70 times. Pricey, but at this growth, no one's complaining.
Oh, yes, 5% higher on that one, top Nifty gainer. But that's about the big boy. We saw similar numbers coming in from Senco and Kalyan Jewellers as well, Mangla?
Yes, on that base, if Titan's growing, it's only fair to assume that, you know, smaller players on a lower base will grow much faster. And that's exactly the case for something like a Kalyan and Senco. We'll start with Senco. The first half of this year, sales were so meager that the street was wondering whether the company will go ahead and cross their annual guidance of 20% growth or not. Come the third quarter, festive season demand as well as the sales which were postponed to the third quarter led to the revenue growth of 51% in the third quarter, and the company has upped their guidance from 20% to 25% plus sales growth for the full financial year. Retail business grew by 49%, same-store sales growth also a fair high number, and they are targeting over 25% growth in FY26 as the 9-month revenue has grown over 31%. The important part for Senco, though, is that, you know, they also saw a decent performance in their diamond business, which saw a 36% growth, and their gold, about 50 to 60% is hedged, 40% is unhedged. And on that 40%, they will see a margin improvement as well, which is why the management upped the margin guidance from 7% to 7.3, 7.4% as well. So all those factors taking that stock higher. Kalyan Jewellers out here as well. You know, the India business has done well, 42% growth, same-store sales growth at 27%, international operations 36%, and more importantly, what Carrot Lane is to Titan, Candere is to Kalyan, and at a much lower base, Candere has been a big growth driver for them. 147% growth is what we saw out there too. So all these factors working for Kalyan Jewellers. At one point, it was trading at near par with Titan when it came to valuations. After a big gash that we saw in the middle of last year as the stock was, you know, introduced into FNO, now trading at nearly half the valuations of Titan. So if you look at the valuation pecking order, Titan at 70 times, Kalyan Jewellers at 33 times, and Senco at 18 times. It's not a premium or a discount. It's just telling you where the size of the businesses for each of these companies are.
Absolutely, Mangalam. Thank you so much for that. So that's all about the jewelers and their Q3 update. But we have Cipla and the pharma side that's in focus as well. We're seeing a bit of a pressure coming in. Top Nifty loser. Ekta, there's some concerns that have come in with the firm 483 here.
Well, yes. Now let's just explain what is exactly troubling Cipla in today's trading session. Now, they have one of their key drugs, which is called lanreotide. They have 22% market share in the US in this particular drug, which is basically used for tumors. So now what has taken place is that it is one of their most successful drugs in their US portfolio, but is being manufactured by Pharma, which is basically their contract manufacturer for this particular drug. So they have a partnership with this company which manufactures this drug for them in one of their plants. Now, this particular plant is in Greece. What has taken place is that their Rodopi unit, which is basically Pharma, which is the contract manufacturer for Cipla for lanreotide, has received a Form 483. They've received a Form 483 with 9 observations. Now, what has taken place is that the US FDA inspected the facility in the month of November, slapped them with 9 observations, and now the street is worried that these 9 observations could possibly escalate to the point that it could affect the manufacturing of lanreotide, which is one of Cipla's key drugs. Now, what we don't know is whether Cipla has any kind of alternate arrangement in place. Based on the stock reaction, the street seems to be worried. Also, the fact that we also don't know how exactly Pharma is going to react to these 9 observations. We've many a time seen observations being resolved, quickly enough, or then massive disruptions in terms of existing products not taking place. So hopefully that those could be also scenarios which could play out. But in terms of the observations, what we do know, they range from microbiological contamination, negative bacteria, poor aseptic practice, etc. So what that leaves us with is fear that these 9 observations could then escalate. One also veers towards data integrity, according to analysts. So it's a wait and watch scenario, but as of now, this is what we know. Cipla, we've reached out to the management. We're waiting for them to revert in terms of any kind of comment that they have on this story. But we have Vivek now joining in to take us through all of the stocks that are moving around in trade today. Vivek, tell us.
Well, thank you so much for that. So much action, so much volatility, especially as far as the broader end of the markets are concerned. First on the list, one stock that's dominated the headlines from the second half of yesterday, that is IEX. Today has cooled off a little bit, but remember, the next hearing on market coupling is on Friday. It's going to be a material development, whichever way it goes. And this is something that the street is anticipating. And the street is hoping, based on yesterday's hearing, that there could be some relief that IEX could expect, especially in terms of timelines of implementation of market coupling. The second stock on the radar, the list of stocks, rather, are the IT pack. Most of the names have seen quite a bit of a bounce back, especially mid-cap IT names, Birlasoft, Persistent, even a Sonata Software. All of these names moving sharply higher today. Coforge, LTI, recovering a little bit from the recent lows. Elecon Engineering, one name from the broader end of the markets, one of the top gainers on the NSE 500 index. Good volumes today. And DMart, ever since the quarterly update came about, this particular stock saw significant selling pressure, but today has bounced back quite smartly, almost 4% higher for DMart today. On the other hand, quite a few laggards as well. Indian Hotels, one particular stock, there's been a downgrade coming in from Morgan Stanley. Last couple of trading sessions, this stock has been under quite a bit of pressure. Select hospital stocks under pressure as well. Max Healthcare as well as Fortis seeing quite a bit of selling pressure emerge. And lastly, Kotak Mahindra Bank, for the last 2 to 3 trading sessions, this particular stock has facing quite a bit of selling pressure emerge.
Oh yes, we can see that fall. It is at the day's low. Kotak Mahindra Bank, that is, and Elecon Engineering has numbers tomorrow, so that stock will be on our radar as well. Thank you, Vivek, for joining us. So with those broader market movers and movers from the Nifty pack, we'll step into a short break. When we come back, we'll connect with Arisa John of Nirmal Bang and Sameer Narang of ICICI Bank. We'll talk about Capex announcements in first half. Most importantly, what is the outlook going forward? Stay tuned for that conversation.
Fly Emirates, fly better.
Welcome back. Well, it's a bit sluggish for the markets at this point in time. So let's get in some opinion then. Thermax eyes a stronger revival in private capex going forward. While speaking to CNBC-TV18, Ashish Bhandari, the MD and CEO of Thermax, says that the last few months have seen some green shoots. Also adds new industries like electronics, semiconductors, solar data centers are coming into the ecosystem. Listen in.
Thermax has never been directly driven as much by government capex. We are more of a private capex driven company. I would say post-elections, there was a bit of a slowdown, and especially for Thermax, there was the whole ethanol industry, which after India hit E20 came through a bit of a slowdown, so that affected. But I would say the last few months have been good, and as I look at the next coming period, in India, we have got many new industries, electronics manufacturing, semiconductors, solar modules and cells progressing, and then of course data centers. So you see a new wave of companies coming in which were not part of our ecosystem even until 2 years ago. So there's a shift of where capex is coming from in India, and given the overall demand strength as we are seeing, I expect the coming period to be of a much stronger, larger revival in private capex all across India.
Any short-term plan right now, as well as long-term, you spoke about that is going
Look,
to be.
we will be in an investment cycle. We have been recently. This plant itself is relatively new, but in the last couple of years itself, we invested in a new plant for water. We have invested in a new plant for expansion for chemicals. 2 of our plants where we do boilers will go through capacity upgrades. This plant here will go through a capacity expansion. As I said, we are investing over this period, we'll invest more than 100 crores in hydrogen. We will invest at least 100 crores in many of the new R&D related areas that I was talking about. FEPL will get some amount of investment. So the next period that we are going through, we expect to grow profitably, and we expect to be in an area in a period that we will invest domestically and internationally as well.
And to decode the picture further about the Capex story going forward, given that the budget is just around the corner, we have Teresa John, Deputy Head of Research and Economics at Nirmal Bang, as well as Samir Narang, Head of Economics Research Group at ICICI Bank. Good afternoon, Teresa, as well as Samir. Thank you so much for joining in. Teresa, let me start with you. When you talk about the Capex story, we have seen a bit of a muted flow that's come in terms of the private capex or public capex. And given that the push that's coming from government for the consumption side now with the tax cuts, GST, from the budget side of an expectation, what should one expect from the capex story?
See, we are actually seeing some revival in private capex, but when we compare to the previous cycle, say to 2006 to 2013, the key difference is this is driven by a lot of new sectors. So if you see the top sector that is driving your private capex announcements in the first half of FY26, it is metals. So metals account for around 28% of the overall capex announcements. And then you have sectors like renewables, you have your electronics, PLI, you have chemicals. So you're not seeing a private investment in these large-scale infrastructure projects, UMPPs, etc., which we saw in the previous capex cycle. So which is why probably you're not seeing that big bang recovery, but in select sectors, it is a little bit concentrated, not very broad-based. You are actually seeing private capex recovery. So I think this cycle is going to be very different from what the previous private capex cycles in India has been.
Okay, so Samir, while we are talking about there is some recovery which has come by, a tad bit of that because as Teresa mentioned in the first half, it was down around 5% What are some of the sectors which are leading that? Is it the similar sectors which we saw in first half? And there was a report which I was reading which indicated that maybe the private capex is still lower than what the government was expecting, and that's why they're planning to put in more money. Do you think that is also which is happening?
I think it's very interesting, observation that you laid out. So when you break the data down, particularly from Capex announcements and on the ground, what is happening, what is very clear that within the overall Capex story, manufacturing Capex is showing signs of uptick and revival. Those services Capex is slightly on the lower side, and within that, it's the transportation services which has seen material deceleration in announcements. So that is where a deceleration is visible. But when you see manufacturing Capex, be it chemicals, be it metals, electricity or energy led by renewables, all of those segments are showing an improvement. government. The other part, of course, is the semiconductor and the electronics value chain, where you are seeing a material uptick in Capex. Whether this is up to the mark or up to expectations, we can always, aspire for more. And yes, this is not as much Capex as a percentage of GDP as we had seen in the previous cycle for private sector. And as Teresa mentioned, some of it is because infrastructure investments by private sector are not as high as what we had seen in the in the previous cycle. So the key, filler then becomes the government, and government has any which ways, at least from the center standpoint, has increased its Capex to 3% of GDP from 1.5. So they've doubled it. And it is likely that they'll maintain this run rate going forward as well. So pretty much center's Capex should increase in line with the nominal GDP growth.
Okay, all right. So you're expecting that trend of around 3% of Capex allocation to continue. But Teresa, just wanted your thoughts on, what Thermax in fact indicated while they were talking to us earlier, that there's a new wave of companies, there's a shift of Capex which is really taking place. There's a whole different set of companies where the Capex is really coming in from. May it be data centers, GCCs, whatever it might be. Teresa, in your sense, what is FY 27 looking like when it comes to this new wave of companies? How much do you think you're possibly going to see in terms of private Capex allocation within that?
So see, something like data centers, we've been seeing this trend from around FY21, FY22, and I think this trend will sustain. So if you look at as a percentage of your private Capex investment, data centers are now around 5%. So that's around in the first half of the year, and that trend will be slightly higher, I think, by the time you close the year. So the new sectors driving growth, your semiconductors, etc. This is something that will continue. But I think even going into FY27, metals will be a dominant sector. We are seeing this globally as well. You're seeing metal prices rally. This is driven largely by demand coming from both the AI related demand from EVs, and decades of underinvestment that has happened globally, apart from China. But China is now shutting down some of those capacities. So I think metals could be one sector, and obviously this data centers, your semiconductors, electronics could be key drivers even going forward.
So Samir, just wanted to extend that point, because metals have led, and that's what Teresa is indicating as well. So do you expect that to be the forefront in terms of Capex investments?
I think it'll be a mix of sectors. So metals may not be the only one driving, the Capex cycle. It would be also driven by, as Teresa mentioned, and you spoke about, much higher investments in the electronics value chain, as well as electronics components for which the government has issued a PLI. So there will be new investment themes also emerging, which is seen globally as well. One of them is AI, which is essentially driven by data centers. And you've seen significant amount of data center investments into India by the hyperscalers, which was not the case earlier. And they are driving investments in the US as well. Apart from that, you will have investments announced in the semiconductor space as well. Even in the budget, it is very likely that we may have a semiconductor policy coming up for indigenizing electronic components and the semiconductor infrastructure, where the large part of value capture is yet to be seen from Indian economy's perspective.
Sure. Samir, while obviously we're talking about these new sectors which will get some bit of a Capex or investment there, but what about the road, railway, defense? Where will it come up from? Where will we see a reduction then?
No, I think what the government is clearly indicating is that perhaps railways, modernization, the bullet train, all of that will continue. Perhaps if you see their utilization as of November or December, they're pretty much likely to utilize the entire Capex that was outlaid for them for the year. And you can see an increase in railway Capex. For roads, given the tendering activity as well as the run rate that we are seeing, perhaps you will see probably flattish numbers. And defense, you are also likely to see a higher Capex announcement for new generation, defense capabilities as well. So largely, I would say overall transport will be flat, wherein railways will be higher slightly, and roads could be a little bit flattish, and defense would be slightly higher. So there is wriggle room for government to increase capex by around 8 to 10%. And within that, they can choose which segments they want to give a thrust on. In our opinion, railways and defense will be two segments where the thrust will be much higher.
Okay, all right. That's interesting because we've been seeing a lot of focus on, say, new energy, semiconductors, data centers, and the newer aspects where India has been seeing a lot of investments. An insightful conversation. Teresa and Samir, thank you so much for joining in today with your thoughts on what Capex looked like and whether we would continue that in the coming years, and especially what happens in the budget. With that, we'll slip into a break. Ritesh Mehta of Yes Securities will join in with some trading strategies on the other side. Stay tuned for that. Welcome back. We're very close to breaking that 26,100 mark. 150 points lower on the Nifty. We are at the day's low. And a lot of these stocks which are leading to the fall from the highs of the day. Reliance Industry should come up for you on the screen. That is a big weight and leading losses as we speak. The other one is ITC. ITC has been on our radar since that excise duty hike, and that stock has seen another low for the day as we speak. We do have M&M, Maruti Suzuki, HDFC Bank is the other one. So watch out for what's happening in the Nifty. There is a 75-point fall from the highs of the day. And we do have the Midcap index too, which briefly turned into the green during the show. But then again, there is a fall. The Nifty is down 175 points, apologies. And if we talk about the Midcap index as well, that too has turned into the red as we speak. And it's a sharp fall from the highs. So tracking the moves in the broader markets as well. Let's get in Pritesh Mehta, Executive Vice President, Yes Securities, joining in now. Pritesh, what are you making of the market moves as we speak? It was volatile at the start, but now we are seeing lower lows. 26,100. Do you think we'll defend that today or we'll see further lows?
I think we should not be making too much of this move, especially for today's day, because the last week was that breakout trade that we had. And now what we are witnessing is pause in momentum. In last 2 days, what we have seen is fall of 0.3% each day. And today we are a bit exaggerating on the downside, but the broader trend is still intact. We are talking about range of 25,900 to 26,500. So I think this range is still intact. One interesting thing that I've observed is that there is no deterioration in the customer's breadth. So it is still trading in neutral territory. So in a way, we are not witnessing that kind of sharp cuts, at least as far as stocks are concerned. So I think a market is going to consume time. In this phase of inaction, I think what we need to do is stick with the outperformers and avoid the noise. That's the right way to play this market.
Stick with the outperformers and avoid the noise. Pritesh, hi, welcome to the show. So just give us a sense in terms of how to spot these outperformers. Which are the stocks that you're recommending?
So metals have been the one which have been in our radar for a long time, and they are still doing well. So what we have seen, several stocks in last few weeks have surpassed the peak of 2024, and now they are still showing strength and outperformance. One stock which is yet to do so is NMDC. Now, NMDC is yet to surpass the peak of 2024, but when you look at the overall point figure structure, the stock is witnessing follow through to bullish anchor column. And the way it is shaping up, I won't be surprised the stock rallies above 97, 98 levels also. So this is target 98 for NMDC, and the stop loss will be around 82, 8 would be stop loss. The second stock that we like is Lupin. Now, what we have seen in today's session is plenty of action in small and mid healthcare companies. And Lupin, is outperforming this particular space. On standalone chart, Lupin is now coming off a 10-month-old base. And what we are witnessing is series of double top buys and bullish shutter breakout. So from here on, we can see a rally towards 2500 levels, and stop loss would be around 2100.
Okay, Pritesh, thank you so much for joining in this afternoon, giving us your view on the market as well as individual stock names. On that note, viewers, we're going to step into a very short break. On the other side, we'll have Manisha Gupta, who will be joined with a conversation on the metals pack with Chirag Sheth. Stay tuned in. Welcome back to Halftime Report on CNBC-TV18. Now let's put the spotlight on the commodity space and specifically metals, because they are not losing their sheen. And Manisha Gupta is here to take us through that conversation. Good afternoon, Manisha.
Afternoon, well, yes, if you look at the silver prices, this is the one that I want to focus on, and we've seen an all-time high in the overnight markets yet there. There is, of course, a bit of a profit-taking right now from those newer record highs, but where are the prices headed from here, and what are the trends that we're looking at in India for 2026? For that conversation, let's go to Chirag Sheth of Metal Focus. Chirag, hi, thank you so much for joining in. A new all-time high, and where do you see all this buying coming from to keep the prices continuing to surge?
Well, yes, silver is not disappointing the investors. It's every day is a new day in terms of silver prices. So I think, much of this is purely driven by investment demand and the stories around the new usages of silver. I think if you look at in India, right, we are seeing that probably there is a bit of demand slowdown among categories like jewelry and silverware. However, investment demand has continued to remain robust, and that's why I think India has imported roughly about 7,000 tons of silver in 2025.
You said investment demand continues to be on the stronger side. Would you say much of that is physical, or this is on paper, would you say?
No, I think it's actually both, Manisha. You have seen steady flows into silver ETFs, and I think the industry estimates that silver ETFs holdings are anywhere between 2,500 to 3,000 tons. That said, we've also seen during our discussions with some of the large bullion dealers and investors, we've seen strong offtake of physical silver as well, especially your 15 kg, 30 kg bars, especially bought by the high net worth individuals, the ultra high net worth individuals. So it's been a mix of both. You've seen ETF flow strong, but also strong physical demand.
What's your sense on prices now, Chirag? Because I was reading a Bank of America report which says $135 an ounce of a possibility and a $300 an ounce of a possibility as well going forward in the years to come. So we're trading almost at around 80 and 82 with the kind of upside moves that the street is anticipating. This is again on the back of sentiment, or as in the story that you would be looking at higher demand going forward.
So I think, Manisha, there are a couple of important things to understand. Like as you're aware, we had a bullish view on silver for the last 2 years, but I don't think even we anticipated the kind of price rally that we've seen. Our forecast for 2026 was roughly about $70, which has actually come in 2025. So we are still trying to put our heads on and see, where the prices are going. However, it's important to understand that beyond a certain price point, a lot of silver usages will see thrifting. We've started to see that in last couple of years, especially in contacts, where there has been shift towards copper, nickel. We might see that in solar also, that many solar cell producers or silver powder and paste producers are now looking at probably putting in more of copper. So I think that's very, very important to understand that, the new usages, while they are all fueling the silver rally, it's important at what price point it becomes unsustainable. Second, I think an important point is the US Section 232 and the US tariff rulings, which might come in the first quarter. I think that will to some extent drive the next silver rally. So I think there are still a lot of moving parts. While the silver market continues to remain bullish, one should trade it with caution given the rally that we've seen in last year.
Clearly. Chirag, also, what's your sense on the hallmarking part of it? Because with the way the silver prices have been rising and people are buying physical silver as well, as you said, there have been concerns about silver for a very, very long time, because for silver, it's about jewelry, small pieces of silverware, etc., to, of course, bars coming in as well, and there's no hallmarking.
No, absolutely. I think, look, if you actually look at, likes of piles or silver articles which are sold in India, which is a quite significant market. Usually we've seen that in last 10 years, the purity have increased from 30-40% to 60-70%. However, it is still highly unorganized, and it is high time that, hallmarking gets introduced in silver like we've seen in gold. And given the fact that where silver prices has gone, I would say the government needs to take an initiative over here and introduce compulsory hallmarking like they've done in gold.
Okay. All right. Chirag and Manisha, thank you so much for taking us through that conversation. Who knew the silver coins that we get casually from our elders would mean so much now in terms of pricing. But it was an interesting conversation. But with that, we'll do one thing. Info Edge, by the way, the Q3 update has come by. We've been talking about a lot of Q3 updates so far, Vinny. It's looking like a good set this time. Standalone billings are up 12% on a YY basis. What do you make of the numbers?
Absolutely seems so far, at least it seems good. Recruitment solutions, that also seen a growth coming in. And, you know, just that yesterday we saw that Naukri data that came in as well. Seems like hiring still manages to hold on the double digit even in the last quarter, almost 9-10% growth. And overall, seems like good business coming in specifically for InfoEdge, 99 acres doing well. So all in all, seems decent in terms of the Q3 update so far.
We'll let you pour over the Q3 update and get us more details. As of now, the street likes what it sees on a preliminary basis. InfoEdge, that stock up around 2%. We'll take a short break, but we have an interesting conversation lined up next. S. Ramesh, the MD and CEO at Kotak Investment Bank, will join in to discuss the IPO and the M&A 2025 roundup and what 2026 holds. Stay tuned. Welcome back. You're still tuned into Halftime Report. Well, India's IPO market hit an all-time high in 2025 with 103 main board IPOs raising around 1.75 lakh crore. The total M&A deals also the deal value surged around 91% as well. To discuss the entire IPO setup in 2026 and whether the M&A boom will continue as well, we have with us Mr. S. Ramesh, the MD and CEO at Kotak Investment Banking. Mr. Ramesh, thank you very much for joining in and wishing you a very happy new year. I'm going to start with that. Is it going to be a very happy new year for the investment banking vertical, at least when it comes to the IPO space? There is, it's expected to even surpass what we've seen in 2024 and 2025. There's a strong list of contenders already waiting in line. Just give us a sense in terms of what the pipeline is looking like.
Before I answer the outlook for 2026, both on advisory, M&A and IPOs, we'll just take a quick look at the rear mirror to see what was there in 25. So investment banking activity saw a very robust regime in 2025. But I would say that contrary to popular belief, the M&A space, advisory deals, actually saw a surge. We ended up doing close to about 121 billion deal values announced. The other call out is that many of these transactions involved listed space, and one particular sector saw an advent of a lot of deals, which was the financial sector, the FIG sector. When it comes to M&A, contrary to popular belief, there was actually a marginal decline in the volume in 2025 as compared to 24. Overall fundraising from all formats was around 5 lakh, a little around 5 lakh crore as opposed to 6 lakh crore in calendar 24. And I would just make one special call out that these by itself really place India superbly in the global space on the overall value of deals done. And the call out I would make is that all of this would not have been possible, and this is the feedback we have got from foreign companies and international investors, that the regulatory regime and the Indian regulator of the capital markets has done a fantastic job in nurturing the capital markets, which has encouraged this kind of activity. When it comes to calendar 26, just basis some fine estimates that we made quick and dirty, we think Indian capital markets should go back to roughly the levels of calendar 24 through various formats led by IPOs and the sell down activity. And M&A, we expect the robustness will continue, because if you see the last 6 months of calendar 25 saw deal values of around 70 billion getting announced. The run rate is very healthy, and we expect that that should go to about a 130, 135 billion in calendar 26. The FIG sector stood out in the M&A space as well.
Yes, Mr. Ramesh, actually, when you spoke about talking about 2025, Mr. Sanjeev Prasad from the Kotak Group himself indicated that we've raised over $100 billion, but only 15% has gone to Capex or something that would generate wealth, right? Do you think that could be, of course, fundraise is good, liquidity is there, we are seeing the regulatory regime supporting us as well. But do you think this is something which could be a risk going forward as well? While FII is talking about what the regulator has done really well, but it not going back into the Capex cycle could be a risk going forward to fundraise?
No, I don't believe that is the case, because you have to put this point in perspective. I think if you look at Indian companies, and particularly new age companies and a number of other Indian companies, the last 5 to 8 years, you have seen the advent of many of these corporates taking private capital. So at the risk-taking stage, they have actually been taking private capital. They have fixed their governance models. They have fixed some of the chinks in their business model. And they have now coming to the capital markets at a little more advanced stage. So that's the advent, which is the reason why you're finding that there is more offer for sale in many of these companies as compared to new capital. So it's okay, because in a way it also plays safe for the capital markets. So I wouldn't be unduly concerned about this narrative. In particular, if you look at 2025, new age companies dominated the capital markets. And if you look at the returns they have provided to investors in their IPOs, it's close to 36, 37%, which is significantly higher than the broader average of all IPOs, which is more close to 12%. So therefore, I don't think we should be unduly concerned about this.
Right. Sir, you know, what I also want to know is, we've seen a lot of this PE capital come in as well during this time. How do you see 2026 on that front as well? And how should we watch out for in terms of sectors?
Yeah, so I would say that the trend we are seeing in the end of 24, and particularly we saw that in 25, strategic investors, which is the Indian corporates, foreign multinationals, as well as the PE investors are now broadly competing for investments in the M&A space. So it's a combination of all of them. And the PE investors have continued to be very robust in their investments in the last few years, particularly even taking control deals wherever they need to. So I see that advent continuing, and I mentioned that I expect the overall M&A volumes to go to about 130, 135 billion. We have seen, while FIG was a common sector across the capital markets and M&A, we have seen that India has had diversified sector activity across the capital markets and M&A. I expect that trend to continue. We will see consumer and internet consumer having activity on the M&A space. We do see industrials having space. So it'll, and of course the whole IT and IT related sector. So I see a little bit of a broad diversified set of activity, not a single call out sector that is likely to dominate in 2026.
Actually, that was my next question, Mr. Ramesh, because, you know, we ended 2025 with the two big deals that took place. One was Shriram Finance as well. And the other one was the deal with Coforge and Encore, which took place. You're not expecting it to be sector specific. What is your sense in terms of what we can see in terms of deal activity when it comes to finance as well as tech?
No, we based on conversations with various clients, well, I would not like to predict it only for calendar 26, but if I take a broader landscape, the two sectors that you called out, namely FIG as well as IT and IT related, we are hearing conversations of interest from various strategic buyers, including PE investors. We expect those conversations to continue. We expect, as I mentioned, the industrial sector to have robust activity, manufacturing and industrials. The consumer sector, we are seeing a lot of conversations, both in capital markets and M&A. So these are a few sectors where we are seeing more prominent conversations. But as I reiterated some time back, we expect the broader play to be in the next 12 to 18 months to be more broad-based.
Okay, all right. Always a pleasure speaking with you, Mr. Ramesh. Thank you so much for joining us with your insights and expert comments on what we can expect in 2026. You mentioned 2025 was good, but it did see a decline from 6 lakh crores to 5 lakh crore rupees in 2025 on a YY basis. So we'll keep that in mind and look out for any more deals that take place across the spectrum. That's the word coming in from S. Ramesh from Kotak Investment Banking. With that, we'll slip into a break. Before we do that, just a quick heads up, if you're thinking about where the real opportunities for 2026 lie, Market Forum, the Alpha Generators for 2026 is where that conversation begins. The Alpha Table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on 13 Jan, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18.
Welcome back. Well, subdued for the markets. So the Nifty is just about, and in fact, it's slipped below 26,100 as we speak. So we're down around 90 odd points currently for the Nifty. We have the Midcap index, which is just very precariously poised at this point in time, just about 100 points higher currently for the Midcap index, and the advanced decline ratio, which is just about even keel. On the declining side, you'd have to say. Just watch out for a couple of stocks such as MV, which is done well since yesterday. There was an initiating coverage report by Jefferies with a target price of over 300 odd rupees, 320 odd rupees. So that stock is gaining for the second day in a row. Just watch out for a stock like Wockhardt as well, where they've received approval from, or they've applied for an application for WCK-5222, their key drug in the European markets. So that's the reason why you're seeing that stock higher by around 3 odd %. But on that note, it's a wrap from all of us on Halftime Report. Business Lunch will take all of the action ahead.
The markets are at the lowest point of the day with the Nifty down almost 100 points. The mid-caps hold up in the green though. Realty and oil and gas stocks continue to remain under pressure while consumer durables are some gainers. Jewelry stocks trade higher after strong Q3 updates from Titan, Senco and Kalyan. Titan's up 4% after its consumer business revenue growth accelerated to 40% in the third quarter after a 20% growth in the second. Kalyan Jewelers posted a 42% growth in its India revenue. The Senco Gold stock is up over 12% after the Indian company posted a 50% plus revenue growth in the third quarter. Sources tell CNBC-TV18 that a probe by the Competition Commission of India shows that approximately 35 steel companies have prima facie indulged in cartelization. However, the CCI has not passed any order on the matter yet. It has asked responses from all the steel companies on the findings from its investigation and is set to fix a date for a hearing on the matter. US President Donald Trump delivered a wide-ranging 90-minute address to the House Republicans overnight at their annual retreat in Washington. Trump gave a blunt warning that his presidency depends on Republicans holding the House and Senate this November in the midterm elections. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia, and midweek trading is turning out to be a bit of a sluggish sort of a day, at least for the benchmark index. The bulls fighting tooth and nail to now protect the 26,100 mark. They tried protecting 26,150 on multiple occasions yesterday, managed to do so. Today, not the case. We've broken below 26,150 and now we are at that 26,100 level as we speak. So 26,080 is somewhere the low of the day. Is stuck in a very narrow 100-point range. We're heading into the Sensex weekly expiry tomorrow. And if you look at a similar story playing out on the contribution front though, HDFC Bank continues to drag the index lower, and that loss is offset by ICICI Bank. So it is the third straight day of losses for HDFC Bank, and it is the fourth straight day of gains for ICICI Bank. However, unlike yesterday, ICICI Bank's outperformance is not enough to put the Nifty Bank in the green. It was the case yesterday. Of course, along with that, there was support from other private lenders as well. But today, the Nifty Bank now near the lowest point of the day, despite the outperformance from ICICI Bank. The broader markets, though, are faring a lot better compared to the benchmark index. And even as the Midcap index is off the highs of the day, it is still managing to hold on to the green and still trading with gains of around about 100 points. So broader markets doing fairly okay, even as the Nifty is stuck in a range but at the lower end of the range at that, and there are enough and more stock specific pockets that are doing well. Of course, the jewelry stocks that we'll talk about with Mangalam in just a bit, and the ER&D names, the likes of Tata Elxsi, Tata Technologies, all of those names, and midcap IT in general has done well for itself in today's session. We'll get you all of that as the day goes by. Tata Elxsi now at the highest point of the day, 8% higher on the stock, as is the Nifty IT index, trading with gains of almost 600 points. But we spoke of jewelry stocks. Titan, of course, being the leader in that space. The stock is at a record high today, almost well over 4% higher, nearing levels of 4,300 now in reaction to its business update for the third quarter. Mangalam is here to break that down for us. Mangalam.
It's a sparkling quarterly update that has come in from Titan, and on that base, a 38% jump in their consumer business, led by 40% plus jump in their jewelry business, around 40% for some of their big brands like Tanishq, Zoya, and Maya. And their growth brand, which is CaratLane, also saw a 42% jump. Now, it's led largely by higher gold prices. Remember, in the third quarter, year-on-year, gold prices were up for over 60%. But despite such high gold prices, there were a lot of people which bought these, ornaments, because they're saying that, number of buyers was absolutely flat. The street was worried about a decline in the number of buyers because of the big jump in gold prices. That wasn't the case to be. Even the smaller businesses, the other businesses have done well. International foray was a big one for the company, 79% jump out there on a small base. Even if you look at the watches business or, the eyewear business or the other businesses, we had watches which showed a 13% growth, but that was largely led by analog watches, which is margin accretive for the company. And we saw a decent performance come by for their fragrances business and women's handbag business too. Studded segment, that's the one that clocked the best performance in FY26 so far, growing mid-20s. And at the same time, gold jewelry grew mid-30s. We also saw plain gold, or rather gold coins, see doubling of sales year on year. So all these factors working well for Titan. And alongside all of this, now the launch of Beyond, which is their LGD or lab-grown diamond segment, will provide to be another trigger as well. Brokerages are fairly happy. The stock, which has already been a big wealth creator, continues to do well at a record high at 70 times. Pricey, but at this growth, no one's complaining.
Mangalam, since you're still with us, you spoke about Titan. Also tell us about its peers. Senco, Kalyan, all of them are doing well today, and all of them reported their business updates for the quarter. Tell us more on that.
Yes, on that base, if Titan's growing, it's only fair to assume that, smaller players on a lower base will grow much faster. And that's exactly the case for something like a Kalyan and Senco. We'll start with Senco. The first half of this year, sales were so meager that the street was wondering whether the company will go ahead and cross their annual guidance of 20% growth or not. Come the third quarter, festive season demand as well as the sales which were postponed to the third quarter led to the revenue growth of 51% in the third quarter, and the company has upped their guidance from 20% to 25% plus sales growth for the full financial year. Retail business grew by 49%, same-store sales growth also a fair high number, and they are targeting over 25% growth in FY26 as the 9-month revenue has grown over 31%. The important part for Senco, though, is that they also saw a decent performance in their diamond business, which saw a 36% growth, and their gold, about 50 to 60% is hedged, 40% is unhedged, and on that 40% they will see a margin improvement as well, which is why the management upped the margin guidance from 7% to 7.3, 7.4% as well. So all those factors taking that stock higher. Kalyan Jewelers out here as well. The India business has done well, 42% growth, same-store sales growth at 27%, international operations 36%, and more importantly, what Carrot Lane is to Titan, Candere is to Kalyan, and at a much lower base, Candere has been a big growth driver for them. 147% growth is what we saw out there too. So all these factors working for Kalyan Jewelers. At one point, it was trading at near par with Titan when it came to valuations. After a big gash that we saw in the middle of last year as the stock was introduced into FNO, now trading at nearly half the valuations of Titan. So if you look at the valuation pecking order, Titan at 70 times, Kalyan Jewelers at 33 times, and Senco at 18 times. It's not a premium or a discount. It's just telling you where the size of the businesses for each of these companies are.
Mangalam, thank you for summarizing all of that. Jewelry stocks shining bright in today's session, be it Titan, be it Senco, be it Kalyan, or even the smaller jewelry names like TBZ. All of them are doing very well and on very strong volumes at that. Now, sources tell CNBC-TV18 that the Competition Commission of India is probing complaints of cartelization by steel companies. But at this stage, no order or a ruling has been passed by the CCI. Parikshit is here with more details on this.
Well, this is going to have major ramifications for India's steel sector because the Director General investigation within the Competition Commission of India, after a detailed probe, has prima facie found that at least 35 companies, individuals who are senior executives of these steel firms are responsible for cartelization and contravening antitrust rules of India. Now, why is this serious? Because as a next step, the CCI has now started asking for responses from all the 35 entities. Their financial accounts have also been asked for. These will be examined. A hearing will be fixed by the CCI where all parties will be heard, and following which the CCI will pass an order, first on whether there is a contravention of rules, and number two, what will be the penalty involved. Now, as far as the penalty on companies, it could be to the extent of 10% of the total revenue of the company, because Section 48 of the CCI has also been invoked and individuals have also been probed by the DG investigation. This means that even individuals could be penalized up to 10% of their total income. Moreover, while we cannot speak about the outcome of the ruling and what the CCI will eventually decide as for its recommendations, the fact is, in almost 95% of the antitrust cases, the CCI has gone ahead and endorsed the report of the investigative officer of the CCI. So let's see which way this goes. But this could go into courts. Following the CCI's order, this could be challenged at the level of High Court and then in the Supreme Court. So we're possibly looking at a protracted legal battle.
Parikshit, thank you for that update. That's, of course, one part of the story. How does this impact the sector as a whole? Nigel is here to summarize that for us. Nigel.
Well, putting some quick thoughts on the CCI probe into steel companies. This appears more like a preemptive move to prevent any kind of unreasonable price hikes, as the government recently levied the safeguard duty to actually protect the steel industry. Well, SteelMint also reported last evening that primary mills, well, they have hiked rebar prices by around 3,000 rupees per ton in early January 2026. Additionally, proving a steel cartel could be actually challenging because steel price is more globally driven and a PSU like SAIL is also named. Well, this appears to be heading into a legal matter. As steel companies, well, if there is any kind of penalty, they'll contest it in the courtrooms, similar to what we saw with cement companies a decade or so ago. More importantly, the financial impact is likely to be very minimal. At first, the penalty will be recognized as, say, a contingent liability. It's unlikely to have any kind of big cash flow impact. Feedback that I've also received from most sell-side analysts is that if there's any kind of significant stock price correction because of this particular probe, it could actually prove to be a buying opportunity. So we wait for the outcome of the CCI probe, but for the time being, steel companies, could look ahead, and in fact, the markets could look at buying into these dips.
Nigel, thank you for summarizing that for us, as well as the entire impact of the steel sector as a whole. Take a short break. More news and updates follow on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now the index is now trading, well, what, 70 odd points lower. Where we are trading at is 26,100 is where the index currently lies. So still consolidating in that very narrow range. Now the Reserve Bank of India has issued draft norms to regulate dividends and profit remittances by financial institutions. Ritu is joining in with more details on this. Ritu.
Well, the RBI has proposed to cap the dividend payout by banks at 75% of their net profit, subject to them meeting the eligibility conditions. And this is for all commercial banks, including State Bank of India and also the foreign banks that operate in India through their branches. For regional rural banks and local area banks, the cap is slightly higher at 80%. Now, earlier, the dividend payout by banks was effectively capped at 40%. So this is an easing of that cap, so to speak, but it comes with certain riders. So the 75% cap is tighter for banks that have a lower tier 1 ratio, but liberal for banks with a higher tier 1 capital. Extraordinary or one-off profits also cannot be used to boost dividends. And RBI has also clearly defined that the adjusted PAT that you will use to calculate the dividend payout is going to be the profit of the year minus the net NPAs as of the 31st of March. And when RBI says dividend, it means the equity share dividends, and that includes the interim dividends but excludes the perpetual non-cumulative preference shares. Now, boards are also being asked to look beyond just profits when they're deciding on this. They have to factor in NPA divergences, if any, the auditor's remarks, the capital buffers, and of course, the long-term growth plans before they approve any dividend. For foreign bank branches, there's some relief because if they meet the eligibility norms, they can remit the net profits from their Indian operations without any prior RBI approval. But, if there's any excess remittance that is found after the audit, it'll have to be returned by the head office. Finally, the eligibility is going to be important because the capital must stay above the regulatory minimum even after giving out the dividend, or you cannot, dole it out. Banks must also, of course, be reporting positive profits, and there should be no restrictions from RBI or any other authority. So net, more headroom for dividend payout depending on the capital buffers of the banks. But this is still a draft paper. Comments have been invited by early Feb, and the directions will only become effective from the new financial year, that is FY27.
Ritu, thank you for that update there. Just before we take the break, pull up a couple of auto names which have fallen to the lows of the day. Maruti Suzuki is one such name, down over 3% now as we speak, 3.25%. It's a pretty steep fall, as you've seen, from the day's high in the last few minutes. And Mahindra is the other one. That too is now at the day's low, down around 1.5% as we speak. But Maruti, currently the big talking point, is now extending its losses as we speak, 3.5% lower now on Maruti Suzuki. And we keep an eye out on these names as well. 16,700 is where Maruti currently is. Take a short break, but just before we do that, just a quick heads up. If you are thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026 is where that conversation begins. The alpha table awaits. Join CNBC TV18 as we host the ultimate confluence of India's market movers. Tune in on the 13th of January, Tuesday, 4:30 p.m. onwards, only on CNBC TV18. Welcome back. Let's put the spotlight on Donald Trump now. In his latest announcement with respect to Venezuela, the US president has announced that Venezuela will be turning over 30 to 50 million barrels of sanctioned oil to the US. A part of the post reads, and I quote, "This oil will be sold at its market price and that money will be controlled by me as President of the United States of America to ensure it is used to benefit the people of Venezuela and the United States." End of quote. The statement comes in the aftermath of the toppling of Nicolas Maduro, who was seized from his country by US forces over the weekend. Now, speaking at the House GOP member retreat, President Trump warned Republicans in the United States House of Representatives that if the party fails to win a majority in the November midterm elections, he will get impeached. Speaking to legislators, he stressed on the importance of keeping control of the chamber, where his party has a very razor-thin majority. Listen in.
You got to win the midterms, because if we don't win the midterms, it's just going to be, they'll find a reason to impeach me. I'll get impeached. We don't impeach them. You know why? Because they're meaner than we are. We should have impeached Joe Biden for 100 different things. If you have the right president, it's good. You have the wrong president, if you have the wrong president, nothing's good. Tariffs are the least of your problems. We found that out for 4 years. We had the worst president, did the worst job. They had the worst policy. We have to even run against these people. Now, I won't say cancel the election. They should cancel the election because the fake news will say, he wants the elections canceled. He's a dictator. They always call me a dictator.
Now, the fate of Donald Trump's tariffs could be decided by the US Supreme Court this Friday. Prashant is here and he's going to tell us what could be on the cards. Prashant.
Thanks very much for that. This is the big one, right? This coming Friday brings the much anticipated Supreme Court opinion on the IEEPA tariffs. Now, will we hear a ruling from the court? As per Bloomberg, the courts never say in advance which decisions are ready for release, only that rulings in argued cases are possible. The reason why there is heightened expectation that we will see a decision, that a tariff decision is a possibility, is because the court has expedited the handling in terms of the hearing, etc. It started sometime in September, October, and then it kind of sort of continued. So the court has heard this case very, very fast, and that is why expectation that we will actually get a ruling from the Supreme Court of the United States. Now, what can happen? It is possible that the Supreme Court may opine on the matter. Will an opinion mean a ruling? We don't know. It's also possible, in the range of spectrum of possibilities, that they defer the decision to the lower courts. They send it back to the lower courts and say, well, you guys decide, not me at this point. But for what it's worth, consensus street expectation is that tariffs on Friday by the Supreme Court will be partially struck down. Actually, not on Friday. The bet is on the fact that tariffs will be partially struck down by the Supreme Court whenever that ruling happens. A betting marketplace like Polymarket is indicating that there is 24% odds that the Supreme Court will rule in favor of tariffs, only 24% odds. Now, refunds, right? In case these tariffs are struck down, refunds will be the biggest focus point for markets, for interest rate markets, bond markets, and equity markets as well, but more rates market than the equity market. Remember, markets have been penciling in all this tariff revenue which is coming in. And if these tariffs are deemed illegal, they'll perhaps have to be refunds. So that money is no longer there, which you've already sort of in a way accounted for. There remains uncertainty on the scope and question of refunds, if the refunds are required. Well, it's possible that if these refunds have to be carried out, they could be through treasury cash holdings and or by increasing the size of auctions themselves. So mechanism, it's never been done. It's all unprecedented. But if it comes to that, we'll have to kind of figure that out. But market will be very, very sensitive. Now, countries facing the most punitive IEEPA tariffs stand to benefit. Obviously, if you're hurt most and there's a rollback, you stand to benefit the most. The scope will be critical as IEEPA has been used to implement both reciprocal and fentanyl-related tariffs as well. For example, reciprocal tariff relief would be more beneficial for Vietnam, India, and countries like that versus fentanyl-related tariff relief for countries like China, Canada, Mexico, etc. Now, many trade deal agreements have been established, right? Over the last 1 year or so, and many are presumably near finalizing. it is an open question at this stage what happens to these as well. I'll tell you this, I'll just leave you with what I think. If the court decides to rule, and as consensus expects on Friday, the court says, well, some of this has to be rolled back, the Trump administration is determined, as we've heard from many, including President Trump himself, to stay the course. They'll find other legislative routes to bring these tariffs back. They may be more cumbersome. Some of those sections will be more cumbersome. But, I don't think that if the court says, well, roll it back, this administration is going to just do it and move on. They're going to find a way to get these tariffs back through other legislative means, more cumbersome maybe, but, tariffs nevertheless. I think it's a big one on Friday and will be very, very market moving as well if there is a ruling indeed. Back to you.
Market moving indeed. All eyes on this all-important Supreme Court ruling on Friday to determine the legality of the Trump tariffs. Prashant, thank you for summarizing that for us. The markets have now moved to the lowest point of the day, 26,075. So it's over a 100-point cut now where we have on the Nifty. Maruti has extended its losses down 3.5% now, and as is Mahindra and Mahindra down close to 2%. Take your leave on this edition of Business Lunch from me and the team. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. We are below the 26,100 mark at the day's low. The Midcap index too is lower in trade. Banking index is one of them, which is putting some pressure. Other than that, it's looking like mostly a red screen across the board, with few and far being in the green right now.
That's right. Good afternoon, Sonal. And even as you say, market breadth has considerably weakened, especially over the last half hour of the session. Advanced decline ratio now skewed in favor of the declines. Well, a lot lined up on the show, so let's start off with the top headlines. Market at the day's low with Nifty down over 100 points. Midcaps hold up in the green. Realty and oil and gas under pressure, while IT and consumer durables gain.
Jewelry companies deliver strong growth. Senco Gold surges over 10% on 50% revenue growth, although the management does highlight a drop in volumes. Kalyan Jewellers is also up about 6% after the third quarter sees revenue grow over 40%.
Infosys surges in trade as white-collar hiring surged 13% in the month of December. The company's standalone billings also jumped 11% year-on-year during the October to December quarter.
Morgan Stanley downgrades Indian hotels to an equal weight and cuts its target to 780 from 811 rupees earlier, expecting limited upside surprises to revenue metrics. The stock slips over 2%.
JP Morgan upgrades engineering research and development companies like Tata Technologies, Tata Elxsi to neutral from an underweight stance earlier. The brokerage also says that KPIT Technologies remains their top overweight in the sector. Stocks surge.
Okay, all right. Those are the top headlines that we are tracking. For the markets, as we pointed out, it's below the 26,100 mark, a 100-point downtick as we speak. The mid-caps are down 0.1% right now, are up 0.1% as we speak, though the markets are at the day's low. That continues to be the case, and the advanced decline ratio continues to be in the favor of declines as well. We do have Nifty IT, which is doing well, but the number of sectors in the green, they have considerably reduced, and we just have Pharma is the other sectoral name which is doing well, and look at that. That line has been quite volatile, but now is largely in favor of the declines.
That's right. One particular segment or sector that was offering a lot of support to the market was the auto pack. But today, most of the auto names are seeing profit booking at higher levels. Some of the large cap names like Maruti, these names too, seeing quite a bit of selling pressure. As you can see, the auto index down 1.4% today. But these names and a whole host of other stocks is what Sudarshan has on his radar. This is our special segment, Midcap Movers. Sudarshan is standing by the wall to take us to the midcaps that are moving around in the session.
So in the last few minutes, we have seen a big downtick in auto names, but some of the names that are moving high in the trade are auto ER&D after the positive brokerage note. JP Morgan has upgraded majority of the names, and on the back of that, you can see Tata Elxsi up 8%, KPI Tech, Tata Tech, L&T Tech Services. All these names are trading with healthy gains and even healthy volumes. Jewelry stocks have been in the focus after healthy quarterly updates that we have seen from Senco Gold, Kalyan Jewellers, even Titan has given very good update, and on the back of other jewelry names too are seeing big gains. TBZ, Thangamil Jewelry, both these names are also higher with a gain of 7 to 13%. Some of the other mid-cap gainers, Info Edge on top of the list is up, now currently up more than 1%, and it has given two first Q3 updates in which standalone billing has increased by 11%. Also job index data in which IT, that's the focused index, that also has seen a growth of almost 8% YOY. Avenue Supermart's Q3 update was weak, but now ahead of its earnings, the stock is saying buying, and today it's up almost 5%. MV Photovoltaic, yesterday it was up almost 8%. Today also it's seeing healthy gains, up almost 8%. All the mid-cap pharma names are saying buying, and amongst all, Torrent Pharma is the big gainer, currently up more than 3%. In the mid-cap loser space, PE Fintech continue to move downward. Today also it's down almost 2%. IRDAI, that is the insurance regulator, can come out with a draft regulation norm related to commission charges. Because of that, this stock remains under pressure. Prestige states ahead of quarterly updates. The stock is under pressure, down almost 3%. Ola Electric, Prima Energy and Vard Energy remain under pressure. Today also, these stocks are trading with cuts.
Okay, all right. So some important names there. Thank you so much for joining us and making sense of the moves that we are seeing in the broader markets, in a particular name, Sudarshan. Let's move across and welcome Ajit Mishra from Reliance for a technical check on the markets. Ajit, good afternoon. Thank you so much for joining in. Do you think we'll see further lows towards the end of the trading session?
Yeah, good afternoon, Sonal. Yes, we may continue to see a bit of a profit taking. And basically, if you see since August, that the way we are seeing that markets are not advancing or seeing a decisive momentum. So it's always like after an up move, we are seeing retracement of 50 to 70% kind of that previous rally. And that is what we are experiencing this time around also. So we are very close to the immediate support of 20 EMA. Currently, we are quoting around that area, which is 26,078 levels to be precise on the daily chart. In case if we fail to hold, then the previous swing low close to around 25,800 would be the next target area for the markets.
Okay, Ajit, thank you so much for your view as far as markets are concerned. Ajit, what are your individual trading picks of the day? And also, do you have a view on Maruti? That particular stock down almost 4% today.
Yeah, so Maruti and like other auto majors, after this phenomenal surge, we are seeing very sharp correction today. Especially Maruti, the last 3 days of gain, we have completely engulfed that move. But the good part is that we are still holding the 20 EMA mark, which is close to around 16,600 level. In case if it fails to hold this level, then this profit taking may extend further, and maybe close to around 16,000 is something the stock might test. So for those who are holding long, 16,600 should be their stop. Coming to the stock specific idea, the healthcare pharma basket looks comparatively stronger. It's been almost like 4 months of consolidation, which has finally ended. So we like Divis Lab from the pharma basket, which after almost like a similar kind of a structure that we are seeing in the index is out of the consolidation range. And 7150 is what we are eyeing as an immediate target with stop at 6440. Another space from the healthcare basket, we like Fortis, wherein we have seen decent correction from the record highs. It's a fresh buying pivot formation on the daily chart, followed by this, a decisive outcome outbreak from this consolidation range. 995 is what we are eyeing as the immediate target with stop at 920.
Okay, all right. So those are some picks coming in from Ajit Mishra. Thank you so much, Ajit, for joining in with those names. We'll talk about individual names in just a bit, but we have to slip into a short break. And as we do that, here's some good news for our viewers. India's business news leaders now click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Midcap Radar. Well, we have our research team standing by to discuss buzzing stocks in trade now. First up, we have Rima, who's talking to us about the midcap IT space. Rima, an interesting brokerage note coming in, especially as far as auto ER&D names are concerned.
Indeed. So today, JP Morgan has upgraded a Tata Technology and a Tata Elxsi from a underweight to a neutral. The target price for Tata Tech now stands at 710. For Tata Elxsi, it stands at 4,800. And JP Morgan goes on to say that KPIT Tech is their top overweight. Now, the key reason for the upgrade or turning incrementally bullish on the auto ER&D space is they're saying that they're seeing some improvement in the environment, in the spending environment over the last 3 months. And therefore, many of these auto companies, the OEMs, have kick-started their R&D programs that had been put on hold. But again here, this kickstart is happening on a very gradual basis. So that is the key reason. 2, remember, ER&D companies have been big underperformers. So while the Nifty IT index itself was down more than 10% in the last 1 year, names like a Tata Tech was down more than 25%, a Tata Elxsi, KPIT Tech were down 20%. So these companies, the companies which cater to the automotive, the tech companies which service these auto companies, helping them with their EV, autonomous programs, etc., were ranked underperformers. Now, why do they like KPIT? Why have they singled out KPIT as their top overweight? The reason is that KPIT Tech has 100% exposure to the automotive segment. So if auto is picking up, it's showing signs of life, KPIT Tech will be a big beneficiary, and they're expecting highest growth coming in from KPIT Tech. Also, some other interesting takeaways. They're saying that the big investment is not happening in EV. It's actually happening in hybrid. And geographically, it's EU leading the way, and US is still lagging. So in all the companies, then there are a couple of them which play in this auto tech space. It's KPIT Tech, Tata Elxsi, and Tata Tech. All these three have a higher exposure to EU, which is where we are seeing investments pick up. LTTS has a higher exposure to US, which is why they haven't upgraded LTTS, because in US, at least as of now, there hasn't been a pickup in the automotive tech spends. Back to you.
Okay, all right. But interesting data, more investments going into hybrids and not as much as EV as we've been seeing so far. But let's talk about Indian hotels as well. Manglam, there is another note, but not so positive.
Not so positive. In fact, that's a rarity where you see a downgrade on Indian hotels, because the hotel sector has been in such a structural uptrend, and the street has been so bullish on Indian hotels that the stock now brokerages believe may have run ahead of what the fundamentals are, or perhaps maybe it's paused for a breath. Basically, Morgan Stanley has downgraded the stock from overweight to equal weight, and the target price is cut from what, 811 to 780 rupees. No problems with the company. They have leveraged the Taj brand. They've created a hospitality ecosystem that is extremely well run, and it gives you industry leading return ratios and free cash flow as well. But while the industry RevPAR cycle, or the revenue per available room cycle, is on the way up, there is still very limited scope for upside given the sort of run that we've seen in the stock already. So not much surprises seen. Every quarter we look at Indian hotels numbers and we say that it's a good set which has come in, and now the street has perhaps priced that in as well. FY27 EV to EBITDA at around 28 times adequately captures risk and reward, at least on the higher side of the spectrum. But at the lower side, the street believes that maybe there could be some sort of margin dilution coming in on account of the company looking to, premiumize the lower end of the spectrum with ginger. So let's see how this pans out. But for now, after the stellar rally that we've seen on the stock for the last many years, maybe it's pause for a breath.
Well, pausing for a breath is Indian hotels, but one stock that's seen a bit of a comeback today is InfoEdge. The company has given a couple of important updates to the exchanges. Winnie joins in with more details.
Hi, afternoon. So first update that came in this morning was the Naukri jobs peaks data. That's the hiring trend that we see. And this is for the month of December. The company said that, overall, white collar hiring has seen a 13% growth on a year-on-year basis. October to December quarter, that has also seen a 9% growth. So when you look at this trend, seems like a good growth that has continued in terms of hiring. Now, insurance sector, that has seen a very good growth, specifically with fresh hiring, seeing more than a 50% uptick on a year-on-year basis. Hospitality sector, that's also seen a very good growth, led by maybe the metro cities, whether you look at Mumbai, Delhi, NCR region, that's where good growth is coming. So hiring trend overall, good growth has continued. Apart from that, when you look at the IT sector, growth has been positive even in the December quarter. But the BFSI sector, that's where the hiring trend is again moved on the negative side. And we're seeing a decline in December 2025 as in terms of the numbers that's come in on a year-on-year basis. Now, apart from this data, we have the Q3 updates that have come in. The standalone billings that have come in at around 11%. Recruitment business as well as the business segment as well as the 99 acres business segment has seen an around 11 to 13% growth as well on a year-on-year basis. This is for Q3 FY26 versus Q3 FY25. 9-month basis as a whole also decent numbers have come in on the Q3 update front, standalone billings as well as individual segments. So all in all, decent update that's come in terms of Q3 as well as hiring trends.
Well, thank you so much, Winnie, for joining us and giving us all of the important updates pertaining to Info Edge and also known as Naukri. Well, as we now slip into a short break, here's a quick note for our viewers. Get ready for CNBC-TV18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC-TV18's brand new offerings. First, watch our new segment, Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch Macro Signals with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC-TV18's most trusted in-house technical experts.
Welcome back. Well, let's take a look at the Midcap index. The index is up 150 points as we speak. That's a 0.2% of a gain. Nifty continues to be where it was. So it's been a little volatile even on the mid-caps. The small cap index too has gotten into the green. That one is up around 0.2%. A lot of moving parts actually. So there's some recovery in the broader markets. Watch out for that one. We will continue to track the market moves on the headline index as well as the broader markets. One stock that we have been talking about and tracking closely in last couple of trading sessions has to be IEX. There's been no decision. We are still awaiting that, and it's been happening for years now.
Absolutely right. And the uncertainty regarding the final implementation of market coupling is something that continues to remain an overhang as far as IEX is concerned. First, let's understand what actually transpired yesterday, post which you saw almost a 13% uptick in IEX, and there has been a certain amount of follow-on buying too that's been seen today. So first up, as far as the hearing of IEX is concerned, yesterday the outcome was that there was a fresh date given, and the next hearing is on Friday, that is January 9th. Today, JM Financial has written a very interesting note. What they've done is they've basically gone ahead and analyzed what was the arguments given by the Council of IEX versus CERC in the matter of market coupling. Number one, remember, the matter continues to remain sub judice given the fact that there has not yet been any kind of an outcome or a judgment given. So IEX has argued 3 points. Number one, the order that was passed by CERC was not a prelude to any regulation, but mainly this particular order was given to go ahead and impact the stock market. And we already know that there was a certain case on which SEBI has passed an order as well regarding insider trading allegations. The second part, of course, is that the methodology and the regulations that were adopted to go ahead and mainly break IEX monopoly in the short-term power market is not correct. In fact, they say that the US antitrust laws that were stated to go ahead and break corporate monopolies was actually used in different contexts in the US market and may not be appropriate to be used in the case of IEX. And the third point that they say is that the CERC order itself quoted the outcome of a study conducted by Grid India, which concluded that there was a negligible impact on the price, which was clearly the main objective of market coupling. So the main objective of market coupling, of course, was to bring down or lower the cost of purchase of power in the short-term market, which they believe market coupling does not sufficiently address. But remember, IEX Council also said that there is absolutely no dispute where CERC, of course, is the final authority that decides whether or not to bring market coupling. But JM Financial says a lot of implementation challenges, and they reckon that coupling will not come into effect before December 2027, on the back of which you're seeing a bit of a relief rally on IEX.
It's been going on for a while. How many years now?
2021 is when the first paper started. Wow. 2024 is when they implemented it, and now it may go back.
Wow, so it's been 4 years and there's no finality on what would happen here. IEX, it did see a big rally during COVID, but since then this uncertainty did bring some volatility in the stock price as well. Let's move on. Thermax is the stock on our radar. It eyes a revival and a stronger revival in the private capex going forward. While speaking to CNBC-TV18, Ashish Bhandari, the MD and CEO of the company, says that last few months have seen some green shoots. Also adds that new industries like electronics, semiconductors, solar, data centers, they are coming in the ecosystem. Listen in.
Thermax has never been directly driven as much by government capex. We are more of a private capex driven company. I would say post-elections, there was a bit of a slowdown. And especially for Thermax, there was the whole ethanol industry, which after India hit E20 came through a bit of a slowdown. So that affected. But I would say the last few months have been good. And as I look at the next coming period, in India, we have got many new industries, electronics, manufacturing, semiconductors, solar modules and cells progressing, and then of course data centers. So you see a new wave of companies coming in, which were not part of our ecosystem even until 2 years ago. So there's a shift of where capex is coming from in India. And given the overall demand strength as we are seeing, I expect the coming period to be of a much stronger, larger revival in private capex all across India.
Any short-term plan right now, as well as long-term, you spoke about that is going to be?
Look, we will be in an investment cycle. We have been recently. This plant itself is relatively new, but in the last couple of years itself, we invested in a new plant for water. We have invested in a new plant for expansion for chemicals. 2 of our plants where we do boilers will go through capacity upgrades. This plant here will go through a capacity expansion. As I said, we are investing over this period, we'll invest more than 100 crores in hydrogen. We will invest at least 100 crores in many of the new R&D related areas that I was talking about. FEPL will get some amount of investment. So the next period that we are going through, we expect to grow. We expect to grow profitably. and we expect to be in an area in a period that we will invest domestically and internationally as well.
All right, that's the word coming in from Thermax. By the way, Midcap index continues to outperform as we speak. We do have a lot of these broader markets jewelry companies which are doing well. For instance, TBZ, that stock is up around 14%. Senco, we spoke about it already, 13.5% higher. There was an initiating coverage by Jefferies on MV yesterday. That stock is up another 8%. Elecon Engineering comes out with numbers tomorrow. That stock is surging, trade up 7.5%. So a lot of movers in the broader markets that we shall be tracking. But for now, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Quick look at what the market is doing. Just below 26,100 levels as of now. 26,084 is what the Nifty is trading at. Down almost 92 points in the trading session. 88 points, actually, as of now, in the trading session. Now, let's look at what's managing to hold on to some bit of a gain today, broader end of the market. Nifty Midcap is holding on to 0.2% of gain in the trading session. So yes, the broader end of the market seems to be doing better than what the benchmark indices are doing, right? Though it's also come off the day's highest point, but nonetheless, still, as of now, it's trying to go back up. And Nifty Midcap is still holding on to that green side. We have Nifty Small Cap that's also managing to hold on to gains of 0.5%. So watch out for that one. And advanced decline ratio, let's pull that up. Today has been a bit of an interesting day. We've seen a couple of crisscrosses coming in for the advanced decline ratio. As of now, decline, it's more in favor of declines versus advances, but look at it in the morning also we've seen a couple of crisscross. Now clearly a bit more in the favor of declines versus advances, but seems like again it's going to be crossing. That's something that we will watch out for in the second half of the trading session. But let's move on and bring on board our guests for today who are here to solve all your stock-related queries. We have Richard Jain, Equity Technical Research, Wealth Management, Motilal Oswal Financial Services, as well as Astha Jain, Research Analyst at Hem Securities. Astha, as well as Richard, good afternoon. Thank you so much for joining us on the show. Let's start with the queries for today then. The first query is coming from Anil, who's writing to us from Ahmedabad. He's holding 6,781 shares of LIC. Price is 948 rupees per share, making a loss on this one. He's asking what should he do with this investment? Should he continue to hold it for the long term? Astha, good afternoon. And what's your view on LIC?
So, hi, good afternoon to everyone. View is quite positive and we are recommending a hold on this counter with a price target of more than 930 to 950 odd levels. Talking about LIC's fundamental seems to be okay because what we have seen that this company has posted a strong growth. I mean, VNB growth is very, very strong. And with this GST rate cuts, definitely volume-led growth is highly possible for this company and that will help company in posting a good set of numbers going ahead. So yes, LIC is looking good to us, recommending a hold with a price target of 935 to 950.
Okay, surely 935 to 950 is a target price that you're talking about for LIC as well, and a hold that's coming on the fundamentals front. But on the technicals, Richard, good afternoon, and what should one be doing with LIC?
Yeah, hi, very good afternoon. Well, technically, it seems to be in a consolidation phase. Last 4 months, the stock has traded within this broad range of 820, 830 on the low side and 920 on the higher side. So I think it's more of a time-wise correction which is going on in the stock. But the good thing is that post the recent correction from the highs, the stock is trading quite close to its weekly 200 EMA support. So price-wise downside seems to be limited from here on. Wait for a pullback move towards 920 kind of levels. If you see the stock over there, then take a review over there. But at current levels, I would recommend to hold on the existing positions.
Okay, hold on to that existing position for LIC on the fundamentals and the technical front. Next query for today, let's move on to that. We have Amrit who's writing to us from Chandigarh. He's holding 500 shares of IndusInd Bank and this is at a price of 1,400 rupees per share. Long-term investor wants to know whether to hold or to sell at the current levels. He's got it at 1,400, so he's making a bit of a loss on this one. Astha, your view for IndusInd?
So view here is to stay invested in this counter at least for the cost price because our targets are matching with the cost price. We are giving a target of around 1,040, 1,050 on this counter. So recommending a hold and wait for this investment. Now talking about the fundamentals of this bank, I say fundamentals seems to be okay because what we have seen that there are certain MFI provisions which has created some sort of pressure in the financial performance. But I think going ahead, definitely with the kind of strong capital buffer this company is having, I mean to say this bank is having as of now. So that will really help the bank in posting good set of numbers. This is what we believe. And we also believe that now under the new leadership, definitely this bank will show some good performance going ahead. Maybe not in the short term, but yes, in the long term. So we are really keeping our fingers crossed for all these factors and hence recommending a hold with a price target of 1,035 to 1,050.
Okay, thanks for that level over there. But on the technical front, Ruchit, IndusInd Bank, does it become a bet maybe to average? And what is the target price that you're giving as well?
Well, if you look at the stock and compare it to other private sector banks, it has been a huge underperformer However, off late, we have seen some pullback move over last 2.5 months, and the stock is respecting its 50 DMA in this period. So, which is now around 840. So, 840, 830 remains a very crucial support for the stock. Till this is intact, I would recommend to hold on the existing positions and keep a stop loss below 830 on existing positions, but won't recommend to do any kind of averaging over here. Relatively, if any fresh funds has to be put, then I think there are much better options available in the private sector bank itself, such stocks such as ICICI Bank, where I think post the correction, the stock is now resuming its broader uptrend. So if you have to put any fresh money, then go with ICICI Bank. But in IndusInd Bank, you can wait for a pullback move towards 1,000 rupees.
Okay. We'll wait out for those levels over there for IndusInd Bank. Let's move on to the next query for today. We have Nagraj, who's writing to us from Bangalore. He's holding 9,000 shares of Lemon Tree Hotels. Price is 128 rupees per share, making it a profit on this one. Should he continue to hold this for the long term? Astha, what's your view for Lemon Tree Hotels? Today we had a brokerage note that came in for Indian hotels, which is a bit of a downgrade. But overall, for Lemon Tree Hotels, long-term view is good, or should they switch to some other name?
I think long-term view is also good, so there is no harm in staying invested in this counter. But what I believe is that we have already seen a very, very strong set of numbers from this counter in the quarter gone by, and their revenue, we have seen a very strong jump. And there were certain reasons behind it. But going ahead, what I believe is that we really need to look how this season pan out to be for this hotel company. And hence, our idea here is to stay cautious, just book partial profit, not fully profit. We are fully booking, we are recommending at this point of a time. So just book partial quantity, and then remain invested in the partial quantity with a price target of more than, because right now what we believe that 147 is such a level where the investor is already earning profit. So stay invested in the partial quantity with the price target of 170.
Okay, and Ruchit, what's your view for Lemon Tree Hotels? What are the levels that one should keep an eye out on? Should they continue to hold, and are you expecting some bit of an up move?
So the near-term trend seems more of a consolidation or sideways move only. Hotels is a space, if we can see that last 2-3 months have not participated in this broader market pullback move that we have seen. 140 is the crucial support for Lemon Tree Hotels. If that gets breached, then probably that would change the near short to medium term trend for the stock. So I would advise to keep a strict stop loss below 140. If that gets breached, then take an exit.
Okay. We'll keep an eye out on those levels over there for Lemon Tree. Let's move on. Next query for today is coming from Venkat from Hyderabad, who's saying that he's holding 2,380 shares of IRFC. This is at a price of 161 rupees per share. So they're making a loss on this one. What should he be doing with this? Should they continue to stay invested, average? What's your view, Astha?
I believe that one should stay invested in this counter at this point of the time. So my idea here is to just hold this counter, because we all know that this is a Navratna basically company and CPSC, and it falls under Ministry of Railways. Now, what is major positive about this counter is that we believe that this budget may be it may be prove a positive budget for the railways. Stocks and railways companies, and in turn will definitely be benefiting IRFC. So our idea here is to stay invested in this counter, and let's wait for the budget as well as results. So hold is a strategy which we are recommending for this counter with a price target of 140 to 150 at the initial levels.
Okay, we'll keep an eye out on those levels over there. And Ruchit, your levels that one should keep an eye out on, and near term, will it at least come to the buy price of the year?
I think it makes sense to hold on. We have already seen a significant underperformance in the railway stock. The price-wise as well as time-wise corrective phase has been done. Of late, last 2 or 3 weeks, we have seen a good buying interest in many of the railway names where up moves are supported by good volumes. So this should lead to a pullback move towards 145, 150 range, at least in the short term. So continue to hold your existing positions. I think at current levels, even if you want to average out and buy more, you can add more positions at current levels so that your cost price could come down.
Okay. Surely we'll keep an eye out on that. Could add maybe some bit of a position right now, given that your cost price could come down. Thanks so much for that. But on that note, we're actually going to sip into a very short break. But just a quick heads up for our viewers. If you are thinking about where the real opportunities for 2026 lie, Market Forum, the Alpha Generators for 2026 is where that conversation begins. The Alpha table awaits, and join CNBC TV18 as we host the ultimate confluence of India's market movers. Tune in on the 13th of Jan, Tuesday, 4:30 p.m. onwards, only on CNBC TV18. Welcome back to Your Stocks on CNBC TV18. We still have with us Richard Jain as well as Astha Jain to answer all those stock-related queries. Let's keep it going then. The next query for today is come from Dushyant Patel, who's writing to us from Surat. He's holding 400 shares of NTPC. Price is 328 rupees per share. Right now, making a little bit of profit on this one. He's asking if they should continue to hold this or sell at the current levels with that little profit that they're making. Astha?
So my idea here is to stay invested in this counter for the price target of around 370. Now talking about the NTPC, we believe that whatever management has given in their commentary, I think that is really looking very, very optimistic because they have a vision to become a group capacity of around 244 gigawatt by, I suppose, 2037. So I think that is a strong, strong vision to believe on. And medium-term capacity additions are also there. So with this capacity addition, we believe that NTPC is going to benefit in their financials also in the longer term. So stay invested in the NTPC. Here, short-term price targets can be set at somewhere around 370 odd levels.
Okay, and Richard, your view for NTPC, last 1 month the stock is up almost 7-8%. What should they do now?
It makes sense to hold on. Already the stock has gone through a decent time-wise corrective phase, and now the stock seems to be showing some positive momentum since last few days. The price of moves are supported by rising volumes, so the stock has potential to rally towards 360, 365 or 370 in the near term. So hold on your existing longs. Maybe if it comes around that higher end of the range, you can take a review again over there.
Okay, we'll keep an eye out. Hold on to it right now. That's a word on the technical front. Next query for today, we have Jack Ishan, who's writing to us from Mumbai. Now, he's holding 78 shares of GMM Pfaudler. This is at a price of 1,652 rupees. So they're making a loss right now. Future prospects of GMM Pfaudler. Astha, your view on the fundamentals for this company?
So what we are seeing is that now the financial performance is showing some sort of improvement, and that is basically from the company's non-glass line business. So that is the major highlight of that. Now that segment has started performing very strongly. In fact, their current order book is also very, very strong, and their current order backlog stands somewhere at around 2,146 crore, if I'm right with my figures. So I believe that this counter has started showing some sort of improvement in their financial performance, and as we should give a chance to it. So my idea here is to stay invested in this counter with a price target of 1,200.
Okay, stay invested with a price target of 1,200. Ruchit, what's your view for GMM Pfaudler? Should the viewer continue to hold the stock, average, short-term as well as long-term view? Beg your pardon.
So, well, the near-term trend does not look that positive for the stock. The stock has been into a consolidation phase since long time. It's only the thing is that 1,990 has been a support and the stock is trading quite close to those levels. But on pullback moves, the 200 DMA resistance is immediately around 1160, 1170. So I think the upside seems to be limited. Keep a sell on rise approach, do not average. In case if you see any pullback moves from here on, at high levels, I think one should look to take an exit from this.
Okay. That's a view there on the technicals. Let's move on then. Next query, we have Satish, who's writing to us from Hyderabad. He's holding 1,000 shares of Pricol. He wants to know the future prospects of the company. Pricol, Asta, your view, not a one that we talk regularly about it, but and a query that's coming here from the viewer.
So I think now the management is looking to be very, very optimistic, because what price targets, what revenue targets they have set for this company is around 80 billion of the revenue by FY30. So that seems to be very, very strong. We believe that with such kind of revenue targets and the strong vision, this stock is well poised to move more side from here, and hence recommending a hold with the price target of 720 to 750.
Mm-hmm. And Ruchit, on the technicals?
There's a high top, high bottom structure on the daily chart, which is a good sign. So can hold on existing position, but just because of the overbought setups, a near-term consolidation cannot be ruled out. But the good thing is that on any corrections, the stock is forming a support base around its 50 DEMA, which is now around 610 kind of levels. So till it is above 600, I don't think there is much need to worry. Only on the existing position, only if it breaks 600, then take a review again.
Okay. Only if it breaks 600, then take a review again. That's a view on the technicals. Next query then for today, that's coming from Gopal Krishnan, who's writing to us from Tamil Nadu. He's holding 1,000 shares of Route Mobile. Price is 1,400 rupees per share, so they're making a loss on this one. The other one they're holding is Park Hotels, 3,000 shares there at a price of 170 rupees. Here also they're making a loss. So both of these counters, they're making a loss on this one. Asta, should they continue to hold Route Mobile and Park Hotels, sell, average? What is the option here?
I would like to recommend a hold. Now, talking about the Route Mobile, yes, we know that the financial performance was not very, very excited, because what we have seen is that their financial growth was a decent one with around 8% revenue growth. But now they are focusing more on the strong customer mix, etc. So I think that all will help the company in the future financial performance, maybe 2 to 3 quarters down the line. So that is one of the case that makes this investment a long-term investment rather than a short-term investment. So if anyone has a long-term view on this counter, then one should remain invested. However, here the cost price is very, very high. So my idea here is to just wait for the numbers, at least for the Q3 of FY26, and then make any sort of decision. Right now, hold this counter. Initial price target can be set at somewhere around 750 odd levels.
Mm-hmm. And Park Hotels?
Yeah, Park Hotels is also a hold from our side. So what we recommend on Park Hotel is it is just a hold, because their financial performance was in line with the expectation, and going ahead also their occupancies have rose. So I think that is the major point. And now the management is also aspired to achieve double-digit revenue growth going ahead. So with this kind of confidence, it is a strong hold from our side. Even buy on dip strategy can also be applied to this counter. So for Park Hotel, it is a hold as well as buy on dips with a price target of 150 to 160.
Okay. And Ruchit, your view for both these names. The viewer is making a loss on both these counters. Park Hotels as well as Route Mobile is averaging an option.
Well, both the stocks are in a downtrend, and it's not just the downtrend. They have been showing a significant underperformance to the broader markets. So I think when you see any stocks which are not performing when the markets are going up, better not to do averaging in those stocks. So take pullback moves as an opportunity to exit from these names, but certainly not. It would not be advisable to put any fresh money at current levels also.
Okay. Let's move on then to the next query. We have Ashish Sawant, who's writing to us from Mumbai, wants to know the entry price for Brainbees solution from a valuation perspective as well as a technical perspective. He's a long-term investor. Asta, your view for this one?
So I believe for the Brainbees, here the investor wants to know about the entry price. So I believe right now, from the valuation perspective, it is little bit overpriced. So it's better to enter at the price level of around 250 to 260 odd levels. This is what we believe. This counter is looking strong in the longer term. However, in the short term, because results were not that much excited and valuations are still at this higher level. So I believe if some correction comes, then it's a better entry point. So 250 to 260 are those levels where we are expecting this counter to be a good entry bet.
Okay. Rajat, what's your view for Brainbees, right? Because in the last 1 year, the stock is down 53%. Should one still wait technically? Or can they look at to buy at this level or start adding at this level?
Post-listing, the stock has consistently formed that low top, low bottom structure. I think somewhere in August 2024, the stock listed around 700. And since then, we have not seen any kind of uptrend signs. So I would suggest that rather than looking at what price you should buy, wait for some trend reversal formations or good price volume action happening in the stock where buying interest comes in. Then only look to enter stocks which are showing such huge underperformance. But for now, there are no signs of trend reversal, so better to stay out.
Okay, no signs of trend reversals as of now coming in, so it's better to stay out of Brainbees solutions. So that's a word there on this one. But Ruchit as well as Asta, thank you so much for joining us, as always, helping our viewers answer all those stock-related queries. And viewers, thank you so much for sending us those queries as well. But a quick check in terms of the market, still 26,090 around that level is what the Nifty continues to trade at, down 0.3% in the trading session. Came off the day's high, came off the day's low, slight bit of a recovery from the day's low is what we could say right now. But, where it's going to be headed, that will be important to watch out for. And whether those advanced decline lines actually crisscross again and we see a bit of a change there, that will be something to watch out for. Because today, declines are in the favor of advances as of now. Though that line is nearing, let's watch out for that. Broader end of the market continues to do well. IT, that is also continuing to do well. So yes, important sectors to keep an eye out on, along with the metals pack that continue to shine. But with that, we're absolutely out of time on this edition of Your Stocks. Remember, you can always send us the query on the email address that is there, as well as the phone number that is flashing at the top of the screens for you all as well. That will be there. And you can also send us your mutual fund related queries on this phone number as well. But with that, thank you so much for tuning in. Up next, you have Closing Bell to take you to the last hour of trade.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
And contrary to the handover on Wall Street, it's a fairly subdued picture across the Asia Pacific. Most of the markets trading with losses.
We don't win the midterms. It's just going to be, I mean, they'll find a reason to impeach me.
Equities in the US hit a new record high. The S&P about 0.6 higher. The Nasdaq up about 0.6 as well. All right, first rates coming up right now. 26,130 is where the Nifty is starting.
I think revenue, government revenue, and consequently the fiscal deficit, the potential for the fiscal deficit to increase, is the real challenge.
In terms of what we saw, the Q3 results, the growth has been phenomenal.
I want to talk about silver right now because we've seen a new all-time high come in for this one.
We are talking about the market coupling case, and the news stands that as of yesterday, the next scheduled hearing is on Friday.
In Q2 of this year, we had a big win for a major oil and gas company from the Middle East, which was a big breakthrough for Thermax.
Titan, the total domestic jewelry sales growth has come in at around 41%.
More days that we're holding on to 26,100, but the third day that we're still seeing a decline in terms of the market.
A roundup unit, which is basically Pharma 10, which is the contract manufacturer for Cipla for lanreotide, has received a Form 483.
For the markets, as we pointed out, it's below the 26,100 mark, a 100-point downtick as we speak.
Okay, well, that is the day so far. And once again, it's a sulky-looking market. 85 points lower as far as the Nifty goes. And every day, all this week through, we've come closer and closer to those moving averages. And the 20-day now, I think, is not very far. I think about 70, 80 points away from yesterday's closing level. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, Rima and Nigel. Guys, afternoon.
Hi, 26,024 is the 20-day moving average. So we're exactly 70 points away from that level. The advanced decline ratio has also turned now. We've got more stocks declining compared to stocks which are advancing. Auto has down more than 1%. So you've got weakness coming through. Oil and gas is weak. On the way up, it's the consumer discretionary led by the gold jewelry companies, a couple of FMCG names, and IT. IT is actually doing pretty well. The Nifty IT index, the last time I checked, was up close to about 1.5%. So it was sulking earlier at the start of the week when some downgrades came through, but now it's picked up.
Well, that's right. I think tech as well as the jewelry makers, they are the two pockets of strength in today's trading session. While on the flip side, this market is, preempting various numbers, I think. So case in point being a Maruti Suzuki, suddenly intraday, a bit of a buzz with regard to possibly that the Q3 numbers may not be as good as what the street was expecting. The operating leverage has played out, so we'll have to see whether or not that buzz is anywhere close to that. But otherwise, the stock, after seeing a sharp downtick, I think close to around half an hour or so ago, it's pulled back a little bit, still down close to around 3%, but Cipla and Maruti, top losers on the Nifty itself.
No, absolutely. And, lots of very large single stock moves like these two that Nigel highlighted. We'll talk more, and that's the focus here, because at the index level, there's not very much at all which you can go by. Well, the market's staging a slight recovery. This is what's coming up off the lows, but not by much. Auto, real estate stocks are dragging, while the broader market, of course, is outperforming. Jewelers are shining bright after stellar third quarter updates. Titan is the top gainer of the Nifty. Senco and Kalyan Jewelers are following suit. Cipla, on the other hand, is a top loser on the Nifty after the US FDA released multiple observations for its pharmaceutical unit. JP Morgan has upgraded ER&D companies, and some of these stocks like Tata Tech, Elxsi, KPIT are higher. We'll talk about all of these, and there's a deal story coming up in a little bit as well. So that is the lineup. How should you position yourself in the last hour? Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. Nifty, any trades out there, and what would you do broadly? What should be the approach here?
On the index, Prashant, we've kind of, as I said, yesterday closing below 26,200 meant that we have come back into the range and the chance of a breakout was negated. I think broadly you would now want to see the markets come down to about 25,950 odd levels. That is where you would look for some reversal signs and then look to buy into it. So as of now, there is no sign of a downside break. That's a positive thing. But the upside breakout possibility has been negated. Having said that, on the stock side, I have two calls. The first one is a buy on Alchem Labs. Alchem Labs is a buy with a stop at about 5793. Sorry, 5759 for targets of 5870, and NBCC is a sell with a stop at 118 for targets of 109.
Okay, thank you very much for that. But right on top of the gainers list are all the gold jewelry makers. Titan is the top Nifty gainer at a fresh record high post the Q3 business update. And outside of that, Senco is up nearly about 12%. Kalyan Jewellers too having a strong session, up 4%. Manglam joins in to recap the numbers and the way forward.
Well, it's a good performance coming in from all the jewelry players this time around. The best performance came from gold prices, which itself were up around 60-65% in 2025. And the third quarter seasonally the strongest for all these companies. And in that as well, some of them have reported sparkling numbers. So for Titan on that big base, a 38% revenue growth in their consumer business, led by 41% growth in their jewelry business, which itself was led, by their main brands. We have Tanishq, Zoya, Mia, all of them growing at around 40%, and Carrot Lane growing at 42% as well. All of these things doing well. What is it that the street likes most about Titan's numbers? The fact that, yes, understandably, the revenue grew higher by because of average selling price, but there was no decline in the number of buyers that came in. So it offset flat buyer growth, or rather, higher prices were offsetting the flat buyer growth, and there wasn't any decline. Gold coins obviously doubled year on year, and we saw plain gold category which grew in late 30s as well. Importantly, as prices were higher, people were also looking at jewelry for adornment, the lower price variants, and that improved their studded ratio. So the studded ratio for Titan grew mid-20s. Senco, the first half of this year was so feeble for Senco that the street was worried whether the company will go ahead and cross the 20% revenue growth guidance that they've given. Then comes the third quarter, revenues grow 51%, and so much so that the company goes ahead and increases their guidance from 20% to 25%, led by nearly 39% same-store sales growth in the third quarter, along with 36% jump in jewelry as well. Kalyan Jewellers too, their India operations grew by about 42%, same-store sales growth coming in at 27%, good performance coming in for both the international and West Asia business, and Candier grew by about 147%. So now here's the big trigger that we have to watch out for going forward. One, will higher gold prices impact sales in non-demand season? Because gold prices are so high for players like Titan, Senco, and all of them. The third quarter obviously had the early onset of the wedding season. They had the festive season, etc. Will that buyer growth continue in non-seasonal, quarters as well or not is the big question. Secondly, if gold prices decline, will buyer growth return or not is another thing. Because typically when gold prices are rising, buyers flock to the stores thinking that gold prices will increase tomorrow even more. And similar is the case when it declines. So when it declines, people perhaps postpone their purchases thinking that they will get it at lower prices. And speaking about lower prices, is the next growth driver going to be low price semi-precious jewelry? Just the way we saw in Carrot Lane and, Candier for Kalyan, and now Titan's announcement for Beyond. Will that be the next big trigger for the jewelry industry? And similarly, what could the impact of Titan's LGD foray be on the industry? And finally, we'll look at whether the overall margins of the sector are structurally likely to come down or not, because gold prices have been higher and gold jewelry typically is lower margin than studded, and studded itself will be impacted by these low value, sort of products that have come in only for adornment. Speaking about all of this, valuations, Titan at record high, 70 times valuations. Kalyan Jewellers at one point was perilously close to Titan's multiples, but then thereafter Titan moved higher, Kalyan moved lower, and now trading at 33 times. Senco at around 18 times. But remember, this is not a premium or discount in the sector. They're just given the sort of multiple, given the size and the history that each of these companies have.
Thank you very much for that. Lots of thoughts to think about, as Manglam was pointing out. What happens if gold prices drop? Will buyers return? What would the margins look like if we increasingly start seeing the sales of low-price semi-precious jewelry or the lab-grown diamond foray? Interesting times. Mehraboon Irani is now joining in. Mehraboon, you want to come in and comment on the points that Mangalam laid out and also the valuations from here on, 70 times for Titan.
I would put it this way, that if I look at all the three stocks together, I will give my personal view on all three of them. I'm talking of the stocks. I think, let's be honest, the results were fantastic. The numbers were fantastic. You can give it the credit to the wedding season, you can give the credit to the festival demand, but the main contributor, of course, has been higher gold prices. Now, stating that international business grew up by 79%, I'm talking of Titan right now on a lower base, and eyewear business, watches business, consumer business, and of course the jewelry business, which grew by 40%. On the other end, even Senco and Kalyan are stating that the demand grew by 40%. Great. Now they have upped their guidance, which is the most important thing over here as far as Senco, as far as Kalyan goes. Now the question is the valuations. I think Titan, you said it correctly, 70 times. But Titan is a different animal completely. It's on a different planet. We all know the premiumization. We all know that when we talk of watches, when we talk of jewelry, we always think of Titan first. It's a stock which has always enjoyed a very high valuation. So at 70 times, and whereas these two are going at about 30 times and 20 times respectively, the point is, will I prefer the other two to this? My answer would be no. The reason is very simple. Will this demand continue? Will this demand sustain? I have a big question in my mind. I'm not disputing the fact that people are owning this stock, may continue to own. The numbers were brilliant. I don't have any problem with corporate governance in any of these three companies otherwise. So the point is, do I put in incremental money? So what we have seen possibly, and I hope I'm wrong, could be the best as far as this particular year goes. The first 9 months could have been the best, because as the gold price remains high, the sustenance of demand, see, there is ultimately a limit to affordability. You can't go on buying things at higher and higher prices. So growth rate sustenance remains a big question. There's a certain affordability that comes into place, and my personal feeling is that people will learn to recycle the gold which they have. Like I have certain gold necklaces for my wife or for my mother or for my sister and all. I'm going to go and recycle it. That will lead to a new business channel for these companies. But stating that people will go on buying gold jewelry and higher prices of gold is not going to be very easy. As I said, again, affordability is going to come into play unless gold prices correct by 10-15%, and the pent-up demand which is there in the system, which is not coming out because of higher prices, could come out and bode well for this company. So I would not be a buyer at this valuations for the time being, while stating that I'm pleasantly surprised with the numbers and keeping fingers crossed that this type of demand continues for them and for the shareholders of the company.
Credit, Meherbon, should go to the Indian consumer, right? Buying when the price is so high. More than the company, it's the consumer. But anyway, let's move on and talk about tech. Because, come.
No, I'm just trying to say that gold basically is a thing which is of great importance in the mind, psyche of people as far as Indians go. So when there is a wedding, we want to buy the gold. People are buying it right now, but can the sustenance of demand continue is a big question for me. So if the price is correct, there's a distinct possibility somebody who has seen this price is seeing it down will come out to buy it, possibly looking out for every passing rupee which he has and go and buy gold, because that is the importance of gold in this particular country. So I'm doubting the sustenance of demand. I'm not saying I'm doubting demand. The demand which has grown so fast is mainly because of higher prices, and if the prices remain high, will this type of growth come or not? Because somewhere the market starts valuing the growth which it has seen so far.
Got it. All right, Meherbon, good to hear your thoughts on that. But let's focus on another stock that's down, and then we'll get Meherbon's view on Cipla. It's a top loser on the Nifty. Ekta joins us to fill us in with more details on that. Ekta?
Well, yes, Cipla is in focus, and that is on the back of their drug lanreotide. Now, what exactly has taken place with lanreotide is that it is one of their key drugs in their portfolio, which basically is used to basically treat tumors. They have around 22% market share as of the quarter gone by in the US markets when it comes to this particular drug. Now, what has taken place, and the reason why Cipla is impacted, is because their contract manufacturer, which is called Pharma, has received a Form 483 for its unit in Greece, which is basically their Rhodope unit. This is the company which is apparently manufacturing lanreotide on a contract basis for Cipla. And hence, because they've received 9 observations for their Rodopi unit, the street is now assessing whether or not there will be any kind of disruptions in terms of supply to Cipla for lanreotide, and then hence will it eventually impact sales. Generally what happens, and there are 2 scenarios that can play out, is that if in case the 9 observations are tackled successfully by the company, there would be no disruption in terms of sales, and hence lanreotide would then continue as per normal. But if in case there is an impact of these 9 observations, then Cipla will have to see what to do. Now, the big question is whether or not Cipla has any kind of alternative manufacturing when it comes to lanreotide, or whether the US FDA will allow old production which is going on in the unit to continue, and hence lanreotide sales will not be impacted. These are a couple of questions which need to be answered. We've reached out to the management of Cipla. We're waiting to hear back as well on that. But nonetheless, as of now, the street is fearing that there could be some amount of disruption.
Okay, all right. Thanks a lot for that. Ekta and Ekta, get back to us with Cipla's response as well. Meribun, what do you make of this? Stock is the biggest loser on the Nifty today.
Yeah, Pharma as a pack, I think I have always been stating that I'm not a great fan of it, the valuations it is. Even today, I feel that whatever I understand from friends in the industry is that the pricing pressure remains for quite a few companies like Sun or a Lupin or even a Cipla as far as the US markets goes. So why should one go and buy into them? But the point is, I have bought into certain scripts in the pharma segment, clear disclosure. I have bought into Mankind, I bought into Aurobindo in the recent past, and I also bought into Lupin and Glenmark. The reason for buying it is somewhere you believe, when you see the screen for the last at least 2-3 weeks, that pharma stocks are refusing to fall any further. So there could be a buying opportunity in them. And as far as Cipla goes, this particular US FDA observations which has come, I otherwise like Cipla, but I think I would like to keep away for the time being till we hear a proper clarification from the management on this. But on the whole, pharma as a pack selectively, I have turned positive with Mankind, Aurobindo and Glenmark remaining my top 3 picks, followed by maybe a Lupin.
Okay, let's talk about the ER&D companies. They were, deep underperformers, but they've bounced back today. This is on the back of a JP Morgan upgrade. JP Morgan has upgraded Tata Technology and Tata Elxsi. From an underweight, it's now become neutral. And for both these two, the Tata Group companies, they've also raised the target price. KPIT Tech in the entire automotive ER&D space is their top bet with an overweight rating. Now, why do they like it? They're saying that OEMs, that's the auto companies, auto majors who are involved in EV hybridization, just moving towards autonomous, had paused on their spending on account of uncertainty related to tariffs, etc. So they're saying that finally in the last 3 months, they are seeing these auto companies start spending on technology, which is needed for EV, for the software and just moving towards autonomous. So that is one. But this spending is happening at a very gradual pace. But some R&D projects which were put on hold are now, finally seeing the light of the day. Also, secondly, they're saying ER&D companies were ranked underperformers. So while the Nifty IT index itself was down 10-12% in the last 1 year, some of these companies, like a Tata Tech, was down over 25%, a Tata Elxsi, KPIT Tech, was down 20%. So in relative to an underperforming sector, ER&D underperformed even more. Now, why do they like KPIT Tech? One, they expect the company to grow the fastest, but also because they're bullish on these auto tech spends, KPIT Tech has 100% exposure to this segment. Also, interestingly, they're saying that investments are now not driven more by EV, but more by hybrid vehicles towards hybridization. And amongst geographies, they're seeing EU leading the investments and US is actually lagging. So not so far linked to the calls, but these were the 2 other interesting takeaways. But ER&D, Meribun, in the heydays post-COVID, FY 20 to 23, these were the big, growth stories. They were compounding at 30-35%, and then they went through a sharp period of slowdown. Do you see signs of recovery? What is your own analysis throw up?
I appreciate the way you described everything. I think if you look at the victims right now of high valuations in sectors outside what we are discussing right now, what we are going to discuss right now, there is auto engineering research and development. You look at Keynes, you look at Dixon, you look at PG Electro, you look at quite a few stocks which came off very sharply because of valuations. So when you mentioned right now the way Tata Elxsi came off and Tata Technologies came out, has mainly got to do with valuations, because somewhere along the line, the stock gets priced for much higher growth than what the growth right now is. As far as the JP Morgan report goes, which has led to a big thumbs up for the stocks were lying begging at prices which are much lower than what the market has seen. Now, following this report, they are talking of growth improving as far as auto engineering research and development goes. As far as Tata Elxsi is concerned, true, the growth is improving, but the growth is definitely at this level, not at the rate at which the market has priced it in. So again, this is a stock which, despite the fact that it has come up very sharply from the highs, is not a screaming buy. The point is, demand is definitely driven today by mega trends like digitization, electrification, connectivity, artificial intelligence integration, software-defined vehicles. True. So Tata Elxsi is a good stock, will ultimately go up. But it is not in a great sweet spot, because the demand which is picking up is not the demand which the market is pricing in right now in terms of the valuation. At 45-50p, there is not too much of comfort to put incremental money in. On the other hand, Tata Technologies is an engineering R&D company. It's acquired ES Tech Group in the recent past, named a strategic engineering supplier for Volvo cars, relatively cheaper to Tata Elxsi because it's going at around 37, 38, 39 times PE, but again, not a stock. So if you look at the prices at which they were and look at it today and say, oh, let's go and buy it, so you may get a trade there of 5, 10, 15%, which possibly you are witnessing right now. But putting in incremental money, thinking that the demand is really going to pick up for the way the market has priced it in, I think it would be a little bit too early to do that. So I would not be a buyer in both the stocks right now. But yes, if I was holding the stock and feeling stupid that I did not sell at screaming valuations, at very high valuations, then I would continue to hold on to them. There are no problems with the company otherwise.
Okay, Mehrbon, we leave the conversation here. Thank you very much for joining in. We will slip into a break. On the other side, we'll connect with Alok Agarwal, Alchemy Capital Management. Stay tuned. Welcome back. Still down 80 points on the Nifty, down for the third consecutive day in a row. But let's light up our screen and find out stocks which are making big moves today. Harmis is now joining in.
Yeah, well, a couple of names on this list today are forgotten stories. Actually, not forgotten names, but stocks that we once used to talk about every time when they went upside. Now we talk about them when they move lower. But starting off with a recent outperformer, that's Mahindra Finance, that's M&M Financial. The fourth straight day of losses in today's session. It's down 12% in the last 4 trading sessions. Although today's fall is not on very significant volumes. Now, today's fall has come on volumes that are 45 lakh shares that have been traded today. The 20-day average is 35 lakh shares. So it's marginally higher than its 20-day average. Now, the first important level on the downside is its 50 DMA, which comes up to 351. So it's coming up to those levels on the downside. And it had a fairly decent 2025, gaining around close to 60% in that period. Now, the first name on this forgotten stories list is Tata Elxsi. As the biggest single day gain that the stock has seen since August of 2024, 10% higher on the stock today. It's gained in 3 out of the last 4 sessions. 22 lakh shares have been traded today. The 20-day average is just under 2 lakh shares. So almost 11 times its 20-day average. Its stock has moved above all of its key moving averages. It has begun this year now on a positive note after 2 successive years of losses, in which both of those years the stock was down around 22-23% each. The other one on this list is Avenue Supermarts, and after the fall that it has had from record high levels, it's seeing a bit of a bounce back today. The biggest single day gain since August. Volumes are the highest. That has gained in 3 out of the last 4 sessions as well. The volumes are the highest in the last 3 months. The stock has seen over 12 lakh shares traded. The 20-day average is 3 lakh shares, so 4x its 20-day average. But despite this move, the stock remains below its key moving averages. The next level on the upside is its 50 DMA, which is around 39.36, so still around $100 away from those levels. The 200 DMA comes at around 4100, so it's even further from those levels. And it has entered the new year on the back of 4 consecutive months of losses, has Avenue Supermarts. And lastly, Torrent Pharma is the second straight day of gains today. The stock is at record highs in today's session. We have had 6.5 lakh shares traded on Torrent Pharma. The 20-day average is under 1 lakh, so it's only 85,000 shares, and it has remained above all of its key moving averages for the last 2 months now. And after 3 straight years of positive returns, Torrent Pharma continuing that momentum at a record high today.
All right, Harmis, thanks very much for that. Alok Agarwal is with us, Head of Quant and Fund Manager, Alchemy Capital Management. Alok, good afternoon. Good to have you with us here. And I think first interaction of 26, so wishing you the best for the year. Just a quick word, Alok, if you will, on directionally, is there a bigger kind of move developing here? Because this is almost like a silent sell-off that we're seeing. To some who are losing money, not so silent, but pretty much every day now. So is there a bigger move afoot, you think? You know, as we were closing out last year, general opinion was maybe because usually when you flip on to the next year, you know, people kind of like to see it as a fresh start and not a repeat of what's gone wrong the previous year. So the expectation was it'll be a better one. Not so much, at least at start. What's your sense?
Yeah, hi, good afternoon, Prashant. A very happy new year to you and your viewers. Yes, as rightly pointed, Prashant, at the turn of the year, all expectations were that the growth would start coming back, and especially the impact of that GST rate cut would also start being visible. However, the data that came out in the beginning of this month, that was for the November month's GST activity that got collected in December. The GST collection again came out at just 6% growth. And this was the 7th straight month of single-digit GST collection growth. The GST collection is a very good proxy for nominal GDP. It may not be exactly the same, but it is quite a good proxy. And we are seeing that India's valuations are on a higher side, but our growth rates on a nominal GDP front is actually hovering in the single digit, a higher single digit number. For India's stock markets to do better and for the gains that we all want to see, to all those to come, our growth rates need to pick up. At the same time, the Capex side of the story for the months of October and November, the total Capex for these 2 months combined was around 76,000 crore. And even to meet the budget numbers, the next 4 months, that is from December till March, in the 4 months period, the Capex has to be at the rate of 1.15 lakh crore per month. So, you know, on both sides, on the Capex side and on the economic activity side, there's some slowdown. And we are coming into this quarter with a slightly higher expectation of about 14% in the Nifty earnings growth. Whether those things can come in, can we have more upgrades? That's the kind of a doubt that we're seeing in the markets currently. For us, the growth numbers need to come by, and which looks little tricky given the fact that both Capex is slow and the GST collection is slow.
Alok, hi. Sorry to ask you about stocks, but wanted to get your view on trend because I know you've liked it in the past, but quarter after quarter, as growth moderates, the street is getting disappointed and the stock is getting punished. What does one do?
You got it right, Rima. You know that you chose that correct phrase of the growth rates moderating. With that particular company, it was possibly the torchbearer of the retail sector in India, one of the best performing ones, with the top lines growing in excess of 50-60% for a number of quarters that we saw. But you know, when your numbers are growing at such scorching pace, the valuations also keep expanding, and quite rightly so. But when the growth numbers start moderating, as we have seen in this particular case, from 50 odd percentage points to now teens, the kind of growth numbers that we've seen in the last 2 quarters, the valuations need to adjust accordingly. We do think that the current valuations for the kind of growth is on a higher side. But yes, nevertheless, it's one of the best quality stocks in the sector. Once the growth valuation metric starts looking attractive, the risk reward would turn positive. As of now, it doesn't look too positive on the risk reward metric.
All right. Hi, Alok. Good to see you again. Alok, if I got it right, you all were very positive on Force Motors. Is that correct?
Yeah, we are.
I mean, you all were one of the few on the street, I think, 12 months ago, or even before that, that was positive. And the stock is up, I think, 2.5 times, from there on, or more. You could clarify on that.
Yeah, it's been a multi-bagger for us. And with the kind of prowess that this company had in terms of providing engines to the market companies of the world, as well as their products becoming more and more successful, the risk reward, again, there was pretty attractive. The growth numbers were just turning more explosive. The valuations weren't very high as well. And the overall size of the company was also pretty small. So, for us, it made more sense to be invested in that company.
Okay, all right. But what's the view now after this big run? Because the premiumization theme clearly is playing out. You go to various parts of the country, you'll see the Urbania. I was in Coorg, I saw the Urbania there. I was in Uttar Pradesh, I saw the Urbania there as well. So the numbers are still very small compared to the market size, but penetration appears to be increasing. And we had Mr. Firodia here on CNBC-TV18 as well, one of his rare interactions, where he spoke about various dimensions, defense, you have the Urbania premiumization that's playing out, as well as the core business, which is the machines. At what point of time do you all decide that enough is enough, or do you think the company still has more to go?
We do think the company has more to go, although the low-hanging fruit of a very high disproportionate return may be slightly behind. But the growth numbers ahead of us looks much better than the rest of the pack in the auto sector. Both their skill set on terms of the precision manufacturing of engines, etc., as well as newer products that could come by after the success of Urbania as well. They both look attractive to us. So we do think that it can possibly throw up more growth numbers higher than the sector for the forthcoming 4 quarters as well as few years.
What's the new stock that you all have bought with due disclosures in your portfolio? Something new that you all have got, which is already in your portfolio. It's perfectly in line with the regulations to help us out with that. Like Force was the stock of last year. What's another stock that you're reasonably positive on the prospects from year on, a longer term view?
So actually, as we were just saying that, on the domestic side, a lot of challenges are coming in terms of growth. We would like to have exposure to sectors and stocks where the path of least resistance is on the upside. We are seeing a lot of global phenomena unfolding in the markets, especially on the precious metals as well as on the industrial metals side. And that's an area that we have been increasing our exposures throughout the last year. And as of now, it happens to be the top sectoral bet in the funds. Both on the precious metals side as well as industrial metals, you can guess it. That's to be out on the gold and silver, and then the corresponding plays on the stock side as well. So we have mining companies which have high exposure from this particular silver. Aluminium also has gone into deficit. And the brighter spot this year possibly could be copper. We are seeing huge demand coming for copper as well. And we all know that, from first identification to setting up a mine in copper takes on an average about 17 years. Recently, there was a report by IEA regarding the global critical minerals outlook for the year. And they said that over the next 1 decade, the total current capacities and new capacities may be able to take care of only 70% of the global demand. Those areas are the areas that we are seeing that there has been a massive requirement, massive demand, but supply cannot really be ramped up at the pace at which the demand is coming. So that bucket is that bucket that we have been increasing our exposures to.
So Vedanta is one stock you've spoken about in the past in the metals commodities basket. What else, if you are increasing your exposure to precious metal plays and base metals, what are the stocks that you like right now and you hold in your portfolio?
If you look at silver, the better plays, the direct operational play, of course, is Hindustan Zinc. And because Vedanta holds a part of it's a promoter company for Hindustan Zinc, so Vedanta also benefits. But Vedanta's larger contribution comes from aluminum, which itself is in a deficit segment. So the aluminum prices are also showing the same. For copper, we do have Hindustan Copper as a lead miner, but we also have a company like Hindalco, which benefits both from aluminum and copper side. So all these segments are the beneficiaries of silver, copper, zinc, and aluminum. And then you have the gold plays as well, some of the gold lending companies. And there are certain asset management companies as well, which have a higher exposure to the gold, silver ETFs too.
About these AMCs with a higher exposure to gold and silver ETFs?
Yeah, so the Nippon Asset Management happens to be the largest ETF holder for both the gold as well as silver. So benefiting both from the contributions coming in the segment as well as the pricing.
Okay, Alok, can't hear you very clearly, but I think what he said is in the commodity space, Hindustan Zinc, Vedanta, Hindustan Copper, Hindalco, gold plays include the lending players, and in the asset management companies, Nippon AMC seems to have the highest exposure to gold and silver ETFs. Thank you very much, Alok, for joining in and sharing your views. It's over to Nigel now to get a sense on the F&O trends. Nigel, today is the sandwich session between two weekly expiries. What's happening?
Well, Rima, if you look at it, the last couple of trading sessions, the Nifty has ended at the low point of the day. However, in today's trading session, you're seeing some bit of a fight that's coming at around the 26,050 odd mark. And I think the risk reward should favor the bulls at around this 26,000, 26,050. As we speak, we've got a bit of a recovery that's underway. The PCR, that's cooled back down to around 0.8. You like that? It's close to the lower end of the range. Besides that, the options data, the call writers, they are very, very active. You look at the 26,200 call, the premium out there is down by close to around 40%. Last time I checked, it was around 70 rupees. The 26,100 put, though, that's seeing a lot of open interest build up. And there's a mix of activity out here because the premium's holding at around that 75 rupee odd mark. There was some buying earlier on, but now it appears there is some writing out there. And if there is writing at around the 26,100 put, that's telling you that the bulls believe that they can defend this 26,000 odd mark. So I think that's the important mark. Incidentally, besides the options data, you also have the 20 DMA that's coming in that vicinity. So if we give you a broad range, the recent high is closer to around 26,400. That becomes a bit of a resistance mark. While on the downside, I'm expecting this 26,000 to hold out. Individual stocks, and I mentioned this point earlier this morning, that SAIL as well as the other Ferris names, they are unlikely to see further pressure on the downside because of the CCI probe. Because implementation of that is going to be difficult. SAIL actually is coming for a bit of a short covering bounce. Yes, it ended at the low point of the day. It's seeing a bit of a short covering bounce. Yes, Bank, I don't know what's going on there, but the open interest build-up is massive. Even in the cash market, volumes are very, very high. And I'll keep an eye out on Yes Bank from here on. And one more stock is Manappuram Finance. At the start of this week, I was making this point that gold financiers could be in focus, whether it's Muthoot, Manappuram, or even IIFL Finance. And as we speak, we are seeing some fresh buying on Manappuram Finance. That stock has moved to the high point of the day. The open interest as well is up out there. So these gold financiers, they have a tailwind, higher gold prices, and probably lower cost of borrowing. That's what's helping these stocks climb higher. Back to you.
All right, Nigel, thanks very much for that. Keep an eye out on some of this stuff as we go through the rest of the day. About 25 minutes to go. We take a break. We're back. As always, D Street Chatter. Nimish gets us the picks that sort of populate his list today. And, of course, some trading ideas with our technical experts as well. Coming back.
A bit of a recovery underway as we speak. Infosys has moved to the high point of the day, and that's done bulk of the heavy lifting. And Axis Bank as well. You know, the Nifty Bank is down, but Axis Bank today is the banking name that's outperforming, like what ICICI Bank did in yesterday's trading session, currently at the high point of the day. And as I pointed out earlier, Yes Bank as well is seeing massive volumes, massive open interest out there. So that as well moving higher. But it's that time of the day when Nimesh joins us to tell us what he's picking up in D-Street Chatter. Nimesh.
Hi, Nigel. Recovery from the intraday lows, largely led by the tech names. So it is underowned. There is a bit of shorting as well in tech names, and we've seen a bit of a short covering rally in technology stocks. And that's helping the Nifty also to recover. But again, from a flow perspective, it's a day when there is aggressive selling from the larger FIs. That was the feedback yesterday as well. It didn't show up in the numbers, but largely I'm told there is better, that FIs are still better sellers in both large caps as well as in the broader market names. So that's from a flow perspective. The other sector which has done well is the within the technology names, the ER&D companies. All of them are buzzing in trade and large volumes as well. I guess there was a report from JP Morgan, and also the sense is that maybe they might report good numbers. So there is a bit of upside in those technology names as well. From a technical point of view, I think 26,300 is acting as a very strong resistance on the upside. For a meaningful upside from here on, that level has to now taken out for the bulls to be comfortable. So that's level on the upside to watch out for. But the broad sense is that the selling from the FIs continues both in broader markets as well as in large cap stocks.
Okay, all right. But what about individual stocks, Nimesh? What are you picking up?
Well, the first name is Sun Pharma. The entire pharma basket has done well for the last couple of days, and Sun Pharma stands out today. Good volumes as well. And there is a very strong indication and a buzz that maybe that company is on for an acquisition. So that's something to watch out for as far as Sun Pharma is concerned. The second name is Hindalco. The entire, the commodity space has seen some bit of profit booking today after the recent up move. And Hindalco stands out. It's off days high. There is selling pressure is what I understand. And one leading family office who was very aggressively bullish, they have booked out some profits in Hindalco at current level. So that's the reason why it's down today. The third name is Jio Financials. There was a large block 10 days back. I understand there's going to be a further clean out trade from the similar entity in Jio Financials very soon. So watch out for a large block deal very soon. And the last is Saregama. The stock has recovered from the lows after a large block. Again, I understand there is a clean out trade from a domestic mutual fund who've sold out. So if there are any disclosures, it could be quite interesting in Saregama.
Okay, all right, Nimesh, thanks a lot for that. Well, let's go across to Mitesh. He's here to help us out with a couple of trading calls. Mitesh, we have a bit of a recovery that's underway, actually. And if I look at the breadth of the market as well, I recall Rima saying at the start of the show that the declines had outweighed the advances. That as well has crisscrossed yet again. Number of stocks advancing more than declining. But give us your idea.
I think, as I said, this is not a market which has broken down. It's failed to give a breakout on the upside. So it's just that, back to the range, back to the grind. NMDC is a BTST with a stop at about 85.40 and a target of around 88 is what traders can possibly look for tomorrow. And the other one which I like is Patanjali Foods, BTST here with a stop at 572 for targets of 588.
Mitesh, we asked you about HDFC Bank over the last 2 days, but third day in a row, stock is down and now below 950. I mean, has it broken any key levels? Is there a trade?
Sorry, which one?
HDFC Bank.
Yeah. So HDFC Bank, there's been 2 days of decline. There was a big gap there. But the last key support, we got a weekly closing at 945 on the 26th of September. I think we're back to those levels, 945, 940 zones. So if we break that, I think there will be further declines. The structure is weak, but it may not break immediately. So large cap stocks, typically it will bounce back on the support. And then, you may want to see if it fails to get past 969 to about 975 zones, then I think we'll again see weakness and a fresh low in place.
Thank you very much for that. Well, looking ahead, one of the big triggers the markets will watch is on Friday, where the US Supreme Court will pass a judgment on the legality of Trump's tariff. It's called the Opinion Day. Prashant has now moved over to the big wall to tell us what could be on the cards. Prashant.
Absolutely. And I think, will opinion be a ruling is the big question, right? So it's a much awaited, much anticipated Supreme Court, a day and opinion on the emergency IEEPA tariffs is what is likely to come up. Now, as I said, will it be opinion? Will it be a ruling? Now, Bloomberg says this. They say that the Supreme Court never says in advance which decisions are ready for release, only that rulings in argued cases are possible. So we don't know. I mean, but there is a fair bit of expectation that there is a ruling. And the reason is because the Supreme Court, actually the court system in the US, has expedited the handling of the case so far. They've gone pretty fast. I mean, it started in September, October, all the way now to the Supreme Court now. It is possible that the court may say these are, of course, a range of possibilities that they may opine on the matter or even actually defer the matter to lower courts. It happens all the time. But as I said, consensus is that tariffs will partly be struck down. That's going to be huge if it happens, right? Betting market odds have stabilized. Polymarket, which is a betting marketplace, says that there's only 24% odds that the Supreme Court will rule in favor of tariffs. Now, what happens if they're partly struck down or struck down in such? Refunds. You've collected so much in tariff revenue, and now you've got to pay them back. I mean, refund some of this money. It's never happened before, unprecedented. How will it happen? It'll be a very important thing, especially for interest rate markets, bond markets, because you've accounted for a lot of this money, and suddenly you don't have it because you've got to pay it back. Now, there remains uncertainty on the size, scope, in terms of the question of refunds. And some are saying it's possible, and they may do it through treasury cash holdings and or by increasing the size of T-bill auctions themselves. So how will they come up with the money is the other question. Remember, different countries, of course, are differently affected by tariffs so far. And it's natural countries which are most affected by the punitive IEEPA tariffs stand to benefit the most. Countries like India, for example. And of course, there's also the matter of the scope. So IEEPA has been used to implement both reciprocal tariffs and fentanyl tariffs, right? As an example, India got reciprocal tariffs. Vietnam, for example. So these are more benefited as compared to countries where the US imposed tariffs by accusing them that, a lot of the fentanyl into the US is coming from these countries like China, Mexico, etc. And of course, lastly, there are so many trade agreements which have already been struck. There are others which may be just about to be signed. What happens to all of it if the court steps in such a manner? I'll say this, though, even if, and this is my opinion, but I think general overall opinion as well, even if the courts were to strike tariffs down, expect the Trump administration to come back and find other legislative routes through which to reimpose the tariffs. Because, I mean, it's a very, very central policy of the Trump administration, and it's unlikely they're going to back down. The IEEPA was the easiest and quickest way to do these tariffs. But, there are other legislative routes available. They're more cumbersome. But they're still available. So my sense is it may be a market-moving event. I think it'll be late Friday evening for us when the decision comes. So markets may only react on Monday. But I think if the court moves on this and strikes it down, expect President Trump to go on social media and I would imagine that he'll tell all of us what he intends to do in terms of using this section or that section to stay the course with some of these tariffs. In any case, I think it's going to be an interesting one and perhaps market moving as well. Back to you guys.
All right. Thanks a lot for that, Prashant. Well, keep an eye out on the bottom of your screen. Warburg Pincus is likely to acquire a big stake in Lemon Tree. Initially, the stock did react positively. Then it saw a sharp downtick. And now I think it's still holding well in the green. If I got that correct, there could be also, stock initially spiked up, then it sold off, and now, in fact, it's holding in the green. There could be a preferential offer as well after it picks up a block of close to around 15%. And that, in turn, could trigger an open offer. Keep in mind, in the last 1 year or so, the stock has done absolutely nothing. From the peak, in fact, it's under some pressure. And now let's see whether or not, get further details on this. 12-month stock is unmoved in this sort of a market. But, this is the big deal that's coming out there. Warburg Pincus likely to acquire a meaningful stake in Lemon Tree. We'll get you further details on that front.
Warburg has been an investor in Lemon Tree.
So basically,
in 2006, I think they first invested.
Very meaningful investors in Lemon Tree, as you said, back in the day. And then they exited during the IPO and after the IPO as well. So basically, they sold their entire holding by about 2019. And looks like, they want to come back into Lemon Tree. So some more details. Let's try and keep the flash on, the news flash on, and some more details in terms of how this is going to be done. There's an existing investor who has just under a 15% stake. So there is that stake, that 15% perhaps, which will be bought then there are also, I mean, step 2, step 3, etc. So this looks like it perhaps could be a meaningful transaction in that sense. Yash will be with us to tell us and give us more details on the story in just a bit from now. Mahindra Joshi is with us, Director of Research at Mark Smith, India. Mahindra, good to have you with us here. You know, we'll talk about this story with Yash in just a bit and we'll ask you for a reaction. But this tariff business on Friday, you think it could be market moving? I mean, for countries like India, what else can go wrong? I mean, on the positive side, with regards, if they are struck down, the only thing is that we'll be bombarded by statements and comments by no less than the president himself on how he plans to bring them back. At least that's what I think. What's your sense, Mayuresh?
100%. No, you're bang on the spot, and very well put. The news piece that you've done, Prashant. Having said that, I think if it is struck down and if there are no alternate measures that President Trump probably adopts in the current avatar, the most beaten down sectors as far as the US markets are concerned, whether they're textiles, shrimp makers, a few of the jewelry players exporting to the US markets, I think those 3 sectors will react the most, in my opinion, because these 3 sectors have been the sectors which have got beaten down the most, with the assumptions of Trump tariffs playing advertently in terms of expected revenues going forward. It's anybody's guess what Trump will do, even if they're struck down, as you rightly pointed out. But if they come down and if there is some sort of an arrangement promptly done, I think these 3 sectors might probably remain in focus, which have been the most affected by US tariffs.
You've liked Lemon Tree in the past. Do you still own it as a part of your portfolio, or you've recommended it?
Sorry, Riva, can you repeat it?
Lemon Tree. Is Lemon Tree a part of the stocks that you like? Because we were just flashing news that Warburg could pick up a significant minority stake in Lemon Tree.
So I think as a space, we do like the space. ITC Hotels is something that we continue holding we continue holding both in our domestic and global portfolios. Our sense is that the industry as a whole is poised for superlative growth over the next few years, gaining market share from the unorganized players. They're adopting an asset-light strategy, which clearly is going to be in their favor because it does not increase leverage onto their balance sheets. And therefore, I think the expectations in terms of the key additions at a minimal Capex, that will add to the ROCs of these companies. Let's not forget, I think the GST rationalization for room rate into 7,500 also aids a whole host of these companies to a certain extent. And obviously, I think the F&B revenue, the MICE revenue, a lot of weddings are planned post 14 Jan as well. So I think the wedding season will come back very, very strongly in the first quarter, in the fourth quarter, in the first quarter of this calendar year. And that will again aid earnings going forward. So I think like the space, ITC Hotel is something we continue holding in our local group.
Yeah. Okay, fair enough. Yash is with us. Yash, tell us more. Lemon Tree.
Well, Prashant, the story that we are addressing could mark a significant entry from a large private equity player into Lemon Tree. What we've been given to understand from our sources is that Warburg Pincus is likely to acquire a meaningful stake when it comes to Lemon Tree. As far as this particular transaction on the acquisition itself is concerned, it is expected to happen in 2 tranches. In the first tranche, what we've been given to understand from our sources is that Warburg Pincus may look to acquire APG Strategic Real Estate Pool stake in Lemon Tree. That is going to be the first tranche as per our sources. APG Strategic Real Estate Pool owns about 14.99% stake in Lemon Tree. As far as the second tranche of the transaction itself is concerned, we've been told that Lemon Tree is likely to make a preferential allotment towards Warburg Pincus. As I said, that could be the second tranche of the transaction, and that could bring in growth capital in Lemon Tree. What we've been given to understand is that that is likely to be used towards expansion of one of its brand. What we've been given to understand as of now, the early indication from our sources is that this particular transaction may trigger an open offer as far as Lemon Tree is concerned. We have written to all 3 parties involved in this transaction, Warburg Pincus, APG Real Estate Pool, as well as Lemon Tree. A response from all these parties is still awaited.
Okay, all right. Yash, thanks a lot for that. Big story, big spike up in the stock. Clearly reacting to Yash, his exclusive story out there. Well, moving on then, the Ministry of Statistics will announce its first advance estimates of this year's GDP. The number is key because it will form the basis of all the budget calculations. Lata's with us to to tell us more. Lata?
Yes, this is the first step of the budget because today the MOSPI, that is the Ministry of Statistics and Program Implementation, announces this year's, say, whatever, 356 lakh crore or some number as the GDP, nominal GDP, not real GDP, nominal GDP. Based on that, on February 1st, the budget takes a call on, okay, we put in another 10% or 9% or 8% nominal GDP growth, and then 4.2% or 4.4% of that is the fiscal deficit. So all the other numbers come out of this base and the assumption, which we will know only on February 1st. So what are we expecting today? The CNBC-TV18 poll says that real GDP, now I'm not talking nominal, real GDP that is adjusted to inflation is expected to grow by 7.5%. Very important, not the impressive 8% of the first half, but clearly a slowdown was expected in the third and fourth quarter, and therefore 7.5 is the full year GDP estimate expectation. And nominal is expected to come in at 8.3%. This is lower than the 10.1% which last budget assumed that the GDP would grow by. Now, don't get worried that this will mean that the fiscal deficit will have to be reduced this year, because last year the FY25 GDP was assumed at 324 lakh crores and a 10.1% growth was expected to give a GDP of 356.97 trillion. But the actual 324, when the full numbers came in May, was really 330 trillion. So even if you don't grow at 10.1%, you grew at 8.5%, we will more or less reach this 355 trillion GDP, and therefore the government doesn't really have to cut corners to meet that 4.4% fiscal deficit. So anyway, the point is you have to look very closely at what is the nominal GDP number that they give. Is it 356? Is it 355? What is that number? And then, all the other numbers in terms of what is the growth of consumption, growth of investment, all those assumptions are important. Our poll also said that the upcoming budget will assume a 9.7% growth in nominal GDP. Although this year is only 8.5%, next year is expected to be 9.7 or almost close to 10% because inflation is expected to be higher in the next year. But don't get confused with all the numbers I'm hurling at you. You have to remember these numbers only till February 28. On 28th of February, the MOSPI releases a new GDP series, and therefore then we will start worrying about a different set of numbers.
All right, Lata, thank you very much for that. There's going to be a lot of numbers later today, right? I think.
Large ones.
Large ones. Stay with us for all of that. But that's a little later. We'll take a quick break here. Markets are not doing as bad. About 40 points lower. We'll sort of wrap up things. As I said, just a few minutes to go for close. Mayuresh is still with us. Okay, well, I think we are wrapping up things. 37, 38 points lower on the Nifty, off the lows by about 60 odd points. But not a very enthusiastic day at all. Reliance was the big reason why the market sold off yesterday. Today, of course, it was a bit more distributed in terms of reasons. Reliance on your screen, absolutely flat. But in terms of pressure points, you still had the oil and gas index, which contributed to losses. You had the auto index, which was down about 0.75%. Maruti perhaps is the culprit, which sold off 3%. Maruti also one of the top losers on the Nifty. But you also had the real estate pack, which was around about 0.5% or so. IT services, long list of names there, which did well. I mean, Infosys, Wipro, HCL, the larger ones, Tata Elxsi, Tata Technologies, Persistent, and so on and so forth. And of course, one standout sector in the broader space was the gold jewelers, the Sencos and the Titans and the Tribhuvandas Zaveri, Kalyan Jewelers, PN Gadgil, all up anything between 5 and 15% in some cases. So that was the day in terms of the market action. That's it from all of us here on this edition of Closing Bell. But stay tuned. Mayuresh is still with us, and the team of Markets Forward will pick up on some of the cues in just a bit.
Markets pair losses to end near flat line. The Nifty holds 26,100, closes closer to 26,150. Mid-caps outperform, keeping the market breadth mildly positive, just mildly. IT supports the index, while HDFC Bank and autos drag.
Strong Q3 update lifts jewelry stocks. Titan, Senco Gold, Kalyan Jewellers report revenue growth between 40 to 50%. Titan management says growth was driven by increase in average selling price.
JP Morgan turns positive on ER&D stocks, upgrading Tata Technologies, Tata Elxsi to neutral, while retaining KPIT Technologies as its preferred overweight pick on improving demand trends.
Hello and welcome to Markets Forward on CNBC-TV18, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny Motiwala. With me is my colleague Mangalam Malu. Mangalam, good evening. And it's been a day where we saw a bit of crisscrosses, a bit more than normal and usual for the advance decline ratio. Nonetheless, we did manage to close in the red today as well.
Well, it was one step to the left and one step to the right. Basically, it was a sideways sort of market. Yesterday, we were speaking about the 26,150 to 26,200 range. Today, it only got a little expanded by going to 26,100 to around 26,210 thereabouts. So that was the rough, narrow range that we looked at for the frontline indices. The Nifty Midcap Index, while it moved high by about 0.5%, the broader market told you that there were an equal number of stocks which were in the green and in the red. So about 1,500 is where the number was pegged. Those lines come up for you very close to each other, almost kissing through the course of the day. But let's tell you what we've got for you on the show today. All the big news, key developments on D Street, top corporate voices, more importantly, the events that you need to track ahead of trade tomorrow. First up, let's go across to Vivek, who will tell us about the big movers and shakers. But before we go to Vivek, the biggest movers and shakers today were the jewelry sector space. Because if you had, you saw Titan, you saw Senco, you saw any of those, Kalyan Jewellers as well. All of them reported a good performance, and that's why they were higher. But if you looked at other names as well, TBZ, you had the kinds of Tangamail jewelries and PC jewelers of the world. All of them, they surged too on the back of good performance updates coming in from these players. So here's Titan, 38% domestic sales. You had over 40% sales coming into their jewelry business. Out there as well, the main brands of the company, which are Tanishq, Maya and Zoya, all of them did 40% and 42% growth coming in from CaratLane, which earlier was the growth driver for the company at that segment on a lower base. Importantly, the company said that nearly the entire growth was led by higher average value, because gold prices between last third quarter and this third quarter were up over 60%, and the buyer growth was absolutely flat. Now the street would say, okay, why is it that the buyer growth flat being is a positive thing? Because, well, if the gold prices are higher by 60%, it's good that the number of buyers are the same.
At least it's not decline.
It's not decline. Yeah. So that's a positive. International business has done well for them as well. If Titan on that base can do well, why not Senco and Kalyan? That's exactly what happened. Senco up 51% in their sales. Titan's studded segment did well. Senco's diamond jewelry actually grew by 36%. And add to that, we had Kalyan Jewellers as well, which did almost a 42% domestic jewelry revenue growth. And even there, like Titan has CaratLane, Kalyan has Candier, and out there, Candier grew by about 147%. So all things said and done, it was a sparkling day of trade for all these jewelry players. Titan on their base looking extremely good, stock hit a record high. We saw 51% growth for Senco. At the midway mark, the street was worried about whether Senco will meet their guidance or not. They had a guidance of 20%. Now, the third quarter, 51% growth. What the company's done, it's increased their guidance from 20% to 25%. So that's a positive as well. So all these stocks doing extremely well. So those were the big movers of the day. But for all the other movers, let's go across to Vivek, who joins in. He's mic'd up on the wall. Vivek.
Well, thank you so much for that. A very volatile trading session, but a very sharp recovery is what we saw, especially in the last hour of the trading session, led by quite a few large cap names. In terms of which are the sectors, segments, individual stocks that did very well, have a look at the mid-cap IT space. Today, most of the names, aided by an upgrade coming in from JP Morgan on select auto ER&D names, those stocks did very well. Tata Elxsi, KP IT Tech benefiting from that particular note. And other mid-cap IT stocks too saw quite a bit of a bounce from recent lows. The other stock on the radar, again, IEX. From yesterday's low, this particular stock is up almost 15%, a very sharp up move. Today as well, follow-on buying seen after yesterday's 12 to 13% up move. Remember, the next hearing regarding market coupling is on Friday, and that'll be a key trigger to watch out for. Elecon Engineering, ahead of the results, one of the top gainers on the NSE 500 index, up on strong volumes today. Titan, like you mentioned, strong quarterly update coming in, aiding the up move on that particular name. And DMart, remember, this particular stock saw quite a bit of a sell-off after the quarterly update, but a very sharp recovery is what that particular stock saw in the session today. On the other hand, quite a few laggards as well. Cipla, one particular name, one of the company's key manufacturing partners based out of Greece, saw US FDA concerns on the back of that, that particular stock lower by 4%. Indian hotels, this particular stock on the back of a downgrade by Morgan Stanley, cooled off a little bit in the session today. Auto stocks, especially towards the second half, saw quite a bit of profit booking emerge. Maruti Suzuki dragged significantly, almost 3% lower. And lastly, M&M Fin, again, in the broader end of the markets, one of the key drags today.
Okay, Vivek, thank you so much for listing out all those stocks that were moving around in the trading session. But on that note, let's bring on board our experts for today. We have Mayuresh Joshi of William O'Neill, as well as Shrikant Chauhan of Kotak Securities. Mayuresh, as well as Shrikant, good evening, and thank you so much, as always, for joining in. Mayuresh, we have a lot of stocks today that were moving around. Q3 updates that came in. We had individual other names moving on the back of brokerages. Let's start with those updates which Mangalam was highlighting as well, right? All that glittered was all these jewelry stocks, gold stocks, all of that doing well. Now, apart from metals, these names as well. Your thought on Nifty metals as well as in terms of these jewelry names?
Afternoon, Vinny. No, I think metals have continued their strong show and momentum. After the base metals, what really transpired in terms of the steel anti-dumping duties that the government has imposed, I think that created some element of a positive momentum. However, I think the markets was sideways and there were news in the morning in terms of cartelization, though I think it will not have much of a financial impact. So my own sense is that ferrous stocks selectively should continue doing well with the imposition of the duties coming in. Realization should be a tad bit better. Expectations in terms of operating leverage and utilization should start picking up, aiding EBITDA and EBITDA per ton. And therefore, I think ferrous stocks, in our opinion, should bounce back very, very smartly. As far as the gold jewelry players are concerned, I think the updates have been pretty encouraging as we speak. Again, I think post-Jan 14th, a lot of wedding dates are around the corner. The expectation largely is that volume should sustain in Q4 as well. And therefore, I think how gold prices will probably behave, as Mangalam pointed out, what is going to be the studded share in terms of the overall portfolio, and what happens with the lab-grown diamonds in terms of forays by a few players, including the likes of Titan, is to be seen. So within this space, I think Titan, one of the leadership stocks, if anybody is holding, should continue holding. But the gold financing players, I think, have a better chance of better earning sensitivity because of better LTVs that we'll get with elevated gold prices. And volume should be relatively better, as the point managements have pointed out. So if that probably transpires, that leverage should probably kick in, or the gold financiers even more as we head into Q4.
All right, so gold financiers over gold sellers, gold jewelers, but Titan, if at all you had to look at any of these jewelry companies by its leadership. Mayuresh, thank you for joining in. We also have Shrikant with us. Shrikant, we usually speak about the markets, but the last few trading sessions, it's been so sideways that it's pointless speaking about the very near-term range. So let's pick and choose sectors, right? The sector of the year so far, and by year so far means just a few trading sessions. Yesterday as well, the Nifty Bank was underperforming. The IT index was higher. Today as well, the IT index was higher. All of 2025, this was the only index which was in the red. And now it's got some wind beneath its wings. Do you think the IT sector has in it to outperform in 2026, or would that be, expecting too much?
Yeah, afternoon, Mangalam, afternoon, Vinny and everyone. So for IT, yes, absolutely. This time it is like exhibiting a lot of strength as compared to the start of the previous year. And if we compare their overall performance in terms of the contribution from the stocks that contributes whenever there is a rally in the particular index, this time we are seeing buying interest in TCS as well as Infosys and along with TCS and Infosys, we are witnessing buying interest in Wipro also. So I am of the view that definitely this index is going to do well. The only concerning part, or maybe we can say the watchful level, is close to 40,000. There, the index has spent a lot of time in the past, and crossing this level will give more confidence that we are heading higher, and maybe we may even see the levels of 44,000. So in that case, the appreciation of 10 to 12% is not ruled out. But in case if it fails, if it rejects to cross the level of 40,000, then we may see some more consolidation. But broadly, I am of the view that we need to be more and more stock specific in this particular sector instead of taking any long bet at current level. I'm going to say long bet on the index at current levels. But if it crosses 40,000, then certainly, yes, we should look for adding some more ideas, and we may even take top-down approach on the sector.
Okay, surely we'll keep an eye on those levels for Nifty IT, and more of a stock-specific action is what Srikanth is saying that one should look at in the Nifty IT or the IT sector as a whole. But let's switch gears and now talk about the pharma pack with Cipla. That was among the top Nifty losers today, and this came in after the US FDA administration flagged off some compliance issues at the units, one of its partners' units. Now, what was the impact of this for Cipla? We saw the stock is down. For more details, Ekta is here to take us through that. Ekta?
Well, yes, Cipla is in focus, and that is on the back of their drug lanreotide. Now, what exactly has taken place with lanreotide is that it is one of their key drugs in their portfolio, which basically is used to basically treat tumors. They have around 22% market share as of the quarter gone by in the US markets when it comes to this particular drug. Now, what has taken place, and the reason why Cipla is impacted, is because their contract manufacturer, which is called Pharma, has received a Form 483 for its unit in Greece, which is basically their Rodopi unit. This is the company which is apparently manufacturing lanreotide on a contract basis for Cipla. And hence, because they've received 9 observations for their Rodopi unit, the street is now assessing whether or not there will be any kind of disruptions in terms of supply to Cipla for lanreotide, and then hence will it eventually impact sales. Generally what happens, and there are 2 scenarios that can play out, is that if in case the 9 observations are tackled successfully by the company, there would be no disruption in terms of sales, and hence lanreotide would then continue as per normal. But if in case there is an impact of these 9 observations, then Cipla will have to see what to do. Now, the big question is whether or not Cipla has any kind of alternative manufacturing when it comes to lanreotide, or whether the US FDA will allow old production which is going on in the unit to continue, and hence lanreotide sales will not be impacted. These are a couple of questions which need to be answered. We've reached out to the management of Cipla. We're waiting to hear back as well on that. But nonetheless, as of now, the street is fearing that there could be some amount of disruption.
Among the top losers on the frontline indices today, Ekta, thanks a lot for that. Engineering R&D stocks, however, did extremely well. The IT index, which was doing well, Midcap IT did even better. Tata Tech, Tata Elxsi, KPIT, all of them rallied after a positive note coming in from JP Morgan. And at the same time, we also saw, other stocks like Persistent, etc., spike higher on the back of the rub-off that we saw in all these mid-cap IT names. Rima joins in to tell us the contents of that brokerage. Rima.
Indeed. So today, JP Morgan has upgraded a Tata Technology and a Tata Elxsi from a underweight to a neutral. The target price for Tata Tech now stands at 710. For Tata Elxsi, it stands at 4,800. And JP Morgan goes on to say that KPIT Tech is their top overweight. Now, the key reason for the upgrade or turning incrementally bullish on the auto ER&D space is they're saying that they're seeing some improvement in the environment, in the spending environment over the last 3 months. And therefore, many of these auto companies, the OEMs, have kick-started their R&D programs that had been put on hold. But again here, this kickstart is happening on a very gradual basis. So that is the key reason. Two, remember, ER&D companies have been big underperformers. So while the Nifty IT index itself was down more than 10% in the last 1 year, names like a Tata Tech was down more than 25%, a Tata LXC, KPIT Tech were down 20%. So these companies, the companies which cater to the automotive, the tech companies which service these auto companies, helping them with their EV, autonomous programs, etc., were ranked underperformers. Now, why do they like KPIT? Why have they singled out KPIT as their top overweight? The reason is that KPIT Tech has 100% exposure to the automotive segment. So if auto is picking up, is showing signs of life, KPIT Tech will be a big beneficiary, and they're expecting highest growth coming in from KPIT Tech. Also, some other interesting takeaways. They're saying that the big investment is not happening in EV. It's actually happening in hybrid, and geographically, it's EU leading the way, and US is still lagging. So in all the companies, then there are a couple of them which play in this auto tech space. It's KPIT Tech, Tata LXC, and Tata Tech. All these three have a higher exposure to EU, which is where we are seeing investments pick up. LTTS has a higher exposure to US, which is why they haven't upgraded LTTS, because in US, at least as of now, there hasn't been a pickup in the automotive tech spends. Back to you.
Thanks so much for that, Reema. Mayuresh, your thoughts coming in on all these names, Tata Tech, KPIT Tech, Tata LXC?
ER&D companies, and as Reema pointed out, I think the expectation largely getting built in is that with the advent of newer technologies expected to come through, electric mobility is a reality. And I think more and more investments will happen towards more platforms as we speak. And therefore, I think these players will remain in focus. However, at this juncture, at least as we speak, I think a couple of stocks, as I've always maintained, that we continue holding in our global portfolios is Persistent and Emphasis. Both the stocks have reported a very decent set of numbers. Commentaries have been resilient and strong. Expectations in terms of constant currency growth should be relatively better off as we head to the next financial year with no pricing pressures, making us believe that EBIT margins should largely hold up for midcap IT in general and for these two players in particular. So I think the ratings and rankings probably look very well placed for both Persistent and Emphasis, and we continue holding them in our global portfolios.
Okay, thanks so much for that, Mayuresh. But, just talking about another stock that was in focus today, and that is InfoEdge. Now, a couple of news flows that came in. One was the Naukri job speaks data that came in. Now, overall in that, the trend that we saw, white-collar hiring at the end of December, 13% growth there. For the quarter, October to December as well, they saw a good growth of 9%. So that was consistent in terms of a double-digit growth for the second consecutive month. No complaining on that front. Insurance sector, good growth of 34% on a year-on-year basis. Hospitality sector saw good growth. IT hiring trends managed to see high single-digit growth of 8%. Last quarter, actually, it was around a 14% growth. Before that, we'd seen a bit of a negative growth through 2025. So 8% growth, again, for IT hiring is also something that is decent versus the beginning of the year, that is Jan 2025. Now, BFSI sector, that's where some bit of a pressure seems like that came in terms of hiring trends, because December saw a bit of a negative decline. So that was down by 17%. Apart from this, we also had their Q3 update that came in the afternoon, where the standalone billings for the company stood at around 12% in terms of year-on-year basis growth for quarter 3. Recruitment solutions segment, that saw good growth of around 11%. And that is sustained in terms of double-digit growth. And real estate sector, the 99-acre side where they have exposure, that also saw a good growth of 15%. Even in the last couple of quarters, they managed double-digit growth there. So no complaining there, Mangalam. Overall, InfoEdge, we saw a good move in the
What did you say was the growth in the hospitality segment?
Hospitality sector, I was talking about the hiring trend.
Yes,
that was a double-digit growth.
Double-digit growth. Looks like it may continue to be more than that, because sources tell CNBC-TV18 that Warburg Pincus is likely to acquire a meaningful stake in Lemon Tree Hotels. Yash joins in with more details. Lemon Tree, remember, was a stock of the last hour of trade, saw a big spike as the story flashed on your screen. Yash.
Well, Mangalam, a very interesting development, unfolding as far as the hospitality space itself is concerned. What we've been given to understand is that a large private equity player, that is Warburg Pincus, is likely to acquire a meaningful stake when it comes to Lemon Tree Hotels. What we've been told by our sources that this particular transaction could be executed in 2 tranches. Under the first tranche, Warburg Pincus is likely to acquire APG Strategic Real Estate Pool stake in Lemon Tree Hotels. Remember, APG Strategic Real Estate Pool owns about 14.99% stake in Lemon Tree Hotels. Promoters of Lemon Tree Hotel, they own about 22% stake. Once the first tranche has been executed, according to our sources, would then lead to the second part of the transaction. That will be a preferential issue made by Lemon Tree towards Warburg Pincus. As far as the money raised by the company, that is Lemon Tree Hotel itself, is concerned, sources indicate that money is expected to be used towards expansion of one of its brands. Also, what we've been given to understand is that the total transaction, that is the first tranche and the second tranche, could together lead to an open offer as far as Lemon Tree Hotels is concerned. CNBC-TV18 has written to all three parties involved in this particular deal, that is Warburg Pincus, APG Real Estate, Strategic Real Estate Pool, as well as Lemon Tree Hotels. Response from all of them remains awaited at this point.
All right, Yash, thanks a lot for that. Mayuresh, I'll ask you about Lemon Tree Hotels, and Srikanth, I'll ask you about Indian hotels. Reason why I ask you about Lemon Tree Hotels, obviously, fundamentally, how do you like it? And Indian hotels has done well so far, has been on a phenomenal multi-year bull run. But today there was a brokerage downgrade that came in. So fundamentally, the street believes that maybe a lot of the upside is in the price. I wanted your thoughts chartically on Indian hotels. So let's go to Mayuresh first for Lemon Tree, and then a quick one on Indian hotels by Srikanth. Mayuresh.
I think news announcement has obviously propped up the stock. And obviously, I think if there is an open offer triggered, that will probably aid the kind of downside risk that the stock probably witnessed in terms of supply pressures. Having said that, I think the product mix that Lemon Tree itself has in terms of its premium properties, and I think it's very well spread out. And therefore, I think it is addressing a large part of the value chain from the super hospitality to the entry chain hotels as well. Obviously, I think for the industry as a whole, they're expanding in a very asset-light mode. They're opening their own hotels as well, but the Capex probably is kept to a minimum requirement. With addition of office probably coming in, I think the capital infusion will obviously help and aid the overall numbers. And therefore, I think all three segments of their business, the annuity part, the F&P stroke MICE part, and the expectations in terms of the retail-oriented business, I think should continue doing well. As disclaimer, I think ITC hotels is something that we like from this space now.
Right. And Srikanth, on Indian hotels?
So for Indian hotels, Mangalam, I feel it is into consolidation mode. It is spending some time within the range of 800 and 700. We saw spectacular rally in the stock from the levels of 350 to almost 950. And since last 1 year, it is consolidating. So I'm of the view that it is going to spend some more time, maybe within the range of maybe 700, 675 maximum on the downside. But one thing is very clear that the overall trend for the stock is still very, very strong. And we should look for adding position whenever there is a correction. Even at this level, it's a buy and more on dips. Broadly, I am of the view that after completing the correction, the stock may again start moving towards the next leg of its rally. And in that, I am expecting stock to move towards the levels of 1150 or 1200.
Okay. Surely that's the view there on Indian hotels. But Srikanth as well as Mayuresh, thank you so much for joining us and as always answering all those markets as well as stock related points from our point of view. On that note, we're going to slip into a very short break. On the other side, we'll get into the top market voices as well as the key events to watch out for in tomorrow's trading session. Stay tuned in for that.
All right, we're coming to the close on markets forward, but just before we wrap, let's get you the key events that you need to watch out for in trade tomorrow. Upasna joins us for all of that. Upasna.
Well, first up, let me start with the global economic cues coming to US first. US will be reporting its initial jobless claims, non-farm productivity and trade balance data. Japan will be reporting its consumer confidence data. Now let us look at the key stocks that will be on our radar tomorrow on the back of corporate action. NHPC will be in focus on the back of fundraising plans. The company plans to raise around 2,000 crore via private placement of bonds. Ugrow Capital also in focus as the board meeting is scheduled to review prospectus capital amalgamation and commercial paper limit enhancement. LG Electronics will also be in focus tomorrow as anchor lock-in opens tomorrow. And now let us look at the list of key results that we'll be watching out for tomorrow. Hence, Elcon Engineering and TRIL, that is Transformers and Rectifiers India, both of these counters will be reporting their Q3 numbers. Now, let us look at some of the key important events. Now, India-Europe crucial FTA talks will be scheduled for Jan 8th and 9th in Brussels. And lastly, Fed Vice Chair, that is Michelle Bowman, will be speaking, addressing about the economic outlook and liquidity of the country. So we'll be watching out for that as well. So all in all, looks like quite a power-packed day tomorrow.
Upasna, thank you so much for that. But it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. More news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The market pairs losses ending the day flat in what was a range-bound session. The Nifty holds the 26,100 mark. Mid-caps outperform. IT supports the Nifty while HDFC Bank and autos drag.
I have a very good relationship with him. He's not that happy with me because, you know, they're paying a lot of tariffs now.
President Trump rakes up the India additional tariff issue yet again during a huddle with Republican lawmakers, says Prime Minister Modi is not happy with him, but India has reduced Russian oil imports substantially, also warns that he could get impeached if Republicans lose the midterms. Venezuela relents to pressure from Washington. Trump says the Latin American nation will export up to $2 billion worth of crude oil to the U.S., adds he wants interim President Rodriguez to give U.S. and private companies total access to Venezuela's oil industry. India's competition regulator seeks responses from 35 steel companies on allegations of cartelization after its probe flagged concerns. The matter pertains to the year 2021, when a group of Coimbatore builders moved the Madras High Court accusing 9 companies of forming cartels. RBI releases draft norms proposing high dividend payout by Indian commercial banks, caps it at 75% of net profit for banks meeting eligibility criteria. Well, let's go straight to the big story at this hour. The first advance estimates for FY26 GDP growth. The numbers are out. Lata joins us now with the details. Pretty much in line with our poll, Lata. Nominal growth, though, are lower than year-on-year expectations.
Well, yes, you hit the nail on the head. It's a tad lower than what our estimates said. Our poll threw up a real GDP growth of 7.5%. What the MOSPI is forecasting is a 7.4% growth. So not, very, very different. We must remember that the first half was 8%. Clearly, that was not expected to be repeated in the second half because the base is much higher. For the second half, also, exports had been front-loaded to the United States. Capex of the government was front-loaded in the first 6 months. So some anemia was always expected in the second half. 7.4 would give a number slightly less than 7 for the second half 2 quarters, especially for the fourth quarter. But as you say, the more important number is the nominal GDP number, which has been placed at 8%. Now, the nominal GDP number is important because based on the nominal GDP number, the next year's nominal GDP is taken and the percentage of fiscal deficit is calculated as a percentage of the nominal GDP. So that number is important. Now, the previous budget had estimated that this year's nominal GDP will grow at 10.1. Now the MOSPI is telling us it is only going to grow at 8%. So that makes it substantially lower. But the important point to note is that last year's GDP actually came in higher than what the budget had assumed. So even with 8%, we will reach about 356 lakh crore in terms of a nominal GDP, which is what the budget had assumed. So that 8% nominal GDP per se is not going to create a fiscal deficit problem. The problem it creates is that 8% is very low. Taxes grow at the pace of nominal GDP. Corporate earnings grow as per nominal GDP. So 8% is like a multi-decadal low for us if you don't count the COVID years. Not counting that, we have always produced a double-digit nominal GDP. Therefore, this comes as a bit of a setback. It's because of the very low deflator, very low inflation. The hope is that next year's GDP will come in a bit, towards the double digit, may come in at 10% because of higher inflation. That's the hope. So the key takeaway is the very low nominal GDP number and the assumption of the MOSPI that the second half is going to be slightly sub 7%. That's why you will get a 7.4% GDP for the full year. The lower numbers are primarily for the primary sector, that is agriculture, expected to come in at 3.1 versus last year's 4.6. So that brings in a reasonably big drop. The others, manufacturing actually is quite positive at 7% compared to last year's 4.5%. Likewise, the tertiary sector, especially the big sector, trade, hotels, transport and communication, very, very important from an employment point of view, is expected to grow fairly well at 7.5% compared to 6.1% last year. Finance is expected to do very well, finance, real estate, professional services at 9.9%, and public administration also expected to do very well at 9.9%. I'm still looking for the consumption and gross fixed capital formation. I'll just get to that in a minute. Okay. Private final consumption is expected to grow by 7%, which is a tad lower. So looks like, according to the MOSPI, the GST-related consumption bump is not expected to continue that much into the second half. Their assumption of private final consumption is 7%, whereas it was about 7.4 in the first half. So clearly it is going to be sub 7% in the second half. And the 7% also compares with a higher 7.2 last year. Gross fixed capital formation is the one that really stands out as a very good performer. The expectation is that it will come in at 7.8%. So the country is running on investment more than it is running on consumption, which is a positive. Those are the key takeaways as of now. We will get more details shortly.
Yes, we will come back to you, Lata, with our experts. But many thanks for joining us with the first cut of the advance estimates. Let's bring you the market action. The Lal Street closing flat today with the Nifty holding on to the 26,100 mark. Mid-caps outperformed and the market breadth was in favour of advancing stocks. IT stocks lent some support. HDFC Bank auto stocks were lower today. The Nifty finally closing flat, a 100-point cut there on the Sensex. And 100 points gone on the Nifty Bank. The mid-cap index closing in positive territory. Jewellery stocks rose on the back of strong Q3 updates that came in from those companies. In the bullion market, gold and silver prices softening marginally amidst a wave of profit-taking following their recent rise. Both precious metals surged close to record highs earlier today as geopolitical tensions lifted safe haven demand. The market will now turn its attention to the US payroll data for insights into the Federal Reserve's interest rate policy. But the big global story, from exercising bragging rights to mocking transgender weightlifters to off-teleprompter rants, President Trump laid out the MAGA agenda during his 90-minute speech at the Republican annual conference last night. Speaking at the event, Trump said Indian Prime Minister Narendra Modi is not that happy with him because of the 50% tariffs imposed on India. He, however, added that India had reduced Russian oil imports substantially. Trump also claimed India had raised concerns over delays in receiving US military hardware and said that issue is being addressed. He said India ordered 68 Apache choppers and were waiting for 5 years for the deliveries. Trump also warned Republicans that if the party fails to win a majority in the November's midterm elections, he will get impeached. Trump also stressed on the importance of keeping control of the chamber, urging the grand old party to stay united. It was not all about diplomacy. In a lighter vein, President Trump mocked his French counterpart, Emmanuel Macron. Trump recounted how Macron initially resisted the US demands to raise prescription drug prices by 200%, but ultimately gave in under pressure. He also called himself the king of sales for selling more Boeings than any man on earth. Here's President Trump.
The Apache helicopter. I mean, I had India coming to me, sir, I've been waiting 5 years. We're changing it. We're changing it. India ordered 68 Apaches, and Prime Minister Modi came to see me. Sir, may I see you, please? Yes, I have a very good relationship with him. He's not that happy with me because, you know, they're paying a lot of tariffs now because they're not doing the oil, but they are. They've now reduced it very substantially, as you know, from Russia. You got to win the midterms, because if we don't win the midterms, it's just going to be, I mean, they'll find a reason to impeach me. I'll get impeached. We don't impeach them. You know why? Because they're meaner than we are. We should have impeached Joe Biden for 100 different things.
Well, that's President Trump there. Now, competition watchdog, the CCI, has probed steel giants for alleged cartelization. Sources tell us the Competition Commission has sought responses from steel companies over these concerns. Now, remember, the CCI opened this case after the Coimbatore Contractors Association moved the Tamil Nadu State Court in 2021, so this dates back a few years. The association alleged that steel companies had hiked prices by 55% during a 6-month period. The public prosecutor told the court that the issue was an antitrust matter. The judge then ordered the CCI to take appropriate action. Parikshit joins us now with more details. Parikshit, how many companies have been investigated and what are your sources telling you?
Well, at least 35 companies and entities, even top individuals, CEOs of some of the biggest steel companies in India have been under investigation since 2021, when the Madras High Court delivered its order asking the CCI to probe allegations of cartelization. The allegation was that these steel companies are getting together, acting as a cartel to artificially boost prices by restricting supplies of steel products to builders and consumers. There was a very detailed investigation, following which the Director General of the Investigation Department in the CCI has given a report that prima facie these companies and individuals are guilty of violating the CCI laws they're guilty of cartelization, and they've contravened CCI procedures. As a next step, the CCI has now asked all these companies for their replies. Copies of the report, investigation report, has gone to all these companies and individuals. They will now have to reply. The CCI will hold a hearing where they will give a hearing to all parties and then give an order first to conclude whether all the companies are in contravention of antitrust rules, and secondly, in a subsequent hearing, they will pass the order on penalties. There could be two kinds of penalties here. One would be against the companies itself, which could be to the extent of 10% of the total turnover of these companies. And because Section 48 of the CCI Act has been put into effect, therefore, the CEOs, the individuals, will also be liable to the extent of 10% of their total annual income. So this could be a big setback to the steel sector, to the companies and the individuals involved, subject to what the ruling is. What we can tell our viewers that in the past, in at least 90 to 95% of cases, this is what experts have told us, the CCI has always followed the conclusion, the prima facie conclusions of the DG investigation. But we're possibly looking at challenges to the CCI ruling. This could go to the High Court, even to the level of Supreme Court. So we're looking at a protracted battle over it.
Yes, Parikshit, many thanks for joining us. Now, the RBI has released draft norms proposing higher dividend payout by Indian commercial banks, capping it at 75% of net profit for banks meeting eligibility criteria. The draft rule also says domestic banks must report positive adjusted net profit for the relevant period. Ritu standing by with what the RBI has proposed. Ritu.
Well, the RBI has proposed to cap the dividend payout by banks at 75% of their net profit, subject to them meeting the eligibility conditions. And this is for all commercial banks, including State Bank of India and also the foreign banks that operate in India through their branches. For regional rural banks and local area banks, the cap is slightly higher at 80%. Now, earlier, the dividend payout by banks was effectively capped at 40%. So this is an easing of that cap, so to speak, but it comes with certain riders. So the 75% cap is tighter for banks that have a lower tier 1 ratio, but liberal for banks with a higher tier 1 capital. Extraordinary or one-off profits also cannot be used to boost dividends. And RBI has also clearly defined that the adjusted PAT that you will use to calculate the dividend payout is going to be the profit of the year minus the net NPAs as of the 31st of March. And when RBI says dividend, it means the equity share dividends, and that includes the interim dividends but excludes the perpetual non-cumulative preference shares. Now, boards are also being asked to look beyond just profits when they're deciding on this. They have to factor in NPA divergences, if any, the auditor's remarks, the capital buffers, and of course, the long-term growth plans before they approve any dividend. For foreign bank branches, there's some relief because if they meet the eligibility norms, they can remit the net profits from their Indian operations without any prior RBI approval. But, if there's any excess remittance that is found after the audit, it'll have to be returned by the head office. Finally, the eligibility is going to be important because the capital must stay above the regulatory minimum even after giving out the dividend, or you cannot, dole it out. Banks must also, of course, be reporting positive profits, and there should be no restrictions from RBI or any other authority. So net, more headroom for dividend payout depending on the capital buffers of the banks. But this is still a draft paper. Comments have been invited by early Feb, and the directions will only become effective from the new financial year, that is FY27.
Ritu, many thanks. But up next, government signals a major Capex thrust ahead of the union budget. That and more when we return. With less than a month to go for the union budget, the government has announced the second pipeline of 852 infrastructure projects. Now, these projects will be developed under the public-private partnership model with a combined cost of over 17 lakh crore rupees. Sapna joins us now with more details. Take us through the government's plan and pipeline.
Absolutely. In fact, this probably is a clear signal coming just ahead of the union budget that the Capex push on the part of the centre is expected to continue. Speaking about this pipeline, well, basically around, over 800 odd projects is what have been lined up by the central government mainly, but of course in consultation with the state government. So you have an estimate of around 17 odd lakh crore worth of total project cost over the next 3 odd years, starting from FY26 itself, out of which the centre's share is going to be around 13 lakh odd crore. Having said that, if you look at the top spending ministries, basically, or rather the ministries which will be calling for these kind of investments, of course, the usual ones, railways, ports and shipping, power to an extent, yes, a bit of a surprise there, and of course, roads and highways. Primarily, these are the ministries which will be calling in for these PPPs. So basically, the plan here is, probably the government, the central ministries putting around 20-25 odd %. And also the main, issue here is to attract the private sector investment. So probably around 20-25 odd % coming in from the private sector, players, and the remaining will be done through borrowing by setting up SPVs. Almost all of these projects are going to be done by central sponsoring authorities, central government sponsoring authorities, the central government Capex that we're talking about. Having said that, experts are also of the opinion that, of course, this is being done to attract private sector investment. Around 33 odd % of the GDP is where it seems to be stuck at over the last 2 to 3 odd years. So that push by the central government at least is continuing very clearly. Also, not just that, but also giving the signal about Capex push. So if you look at the overall budget this year, around 31 odd % is going towards total capital expenditure, both by the central government and state governments put together. Of course, centre has the lion's share around 11.21 lakh crore. And let's not be surprised if this number goes up in the coming union budget, because I think, and rather this is what the view of the experts also is, that Capex is going to be a big push for union budget FY27 as well as it has been in the last 2 odd years. So all that talk about, absorptive capacity and, central government not having finances to do the needful, maybe a lakh odd crore or something, but easily those numbers are going to be absorbed by the budget, as is also visible in the nominal GDP numbers which have just been come out by MOSPI.
All right, Sapna, many thanks for joining us. The Capex push to continue, and of course, we'll be tracking the budget action. The Delhi High Court has stayed the centre's direction, asking Vedanta to hand over the Cambay Basin Offshore Block 2 to ONGC. The court has ordered the centre and Vedanta to maintain status quo on the offshore oil block. The High Court said the company's arguments against the rejection of extension of the production sharing contract needs to be considered. Remember, Vedanta was awarded the production sharing contract in 1998 and was due to expire in 2023. President Trump has said that the Venezuelan interim government will turn over 30 million to 50 million barrels of oil to the U.S. He said the oil would be sold at market value and the proceeds controlled by the U.S. in a post on social media. Trump has claimed that the proceeds will be used to benefit the people of Venezuela and the U.S. Crude prices fell following the announcement on fears of excessive supply amidst tepid demand. Meanwhile, External Affairs Minister S. Jaishankar has expressed India's concern over the developments in Venezuela, urging all parties to prioritize the well-being and safety of the Venezuelan people. He also called for dialogue to resolve the crisis peacefully.
Concerned at the developments, but we would really urge all the parties involved to now sit down and come to a position which is in the interest of the well-being and the safety of the people of Venezuela.
Well, that is the External Affairs Minister. The White House has said that using the U.S. Army to take Greenland is always an option. In a statement, the White House said that President Trump and his advisors are discussing a range of options to acquire the Arctic island for national security purposes. This comes after European leaders issued a joint statement rallying behind Denmark, which has been pushing back against Trump's ambitions. Elon Musk's XAI has raised $20 billion in fundraising. This could lift the company's valuation beyond $230 billion. The investors include NVIDIA and Cisco Investment, who work with XAI as vendors and strategic partners. And this comes as the company faces regulatory probes in Europe, India and Malaysia after its Grok chatbot generalized, sexualized and non-consensual images of children and women. President Putin has described his country's invasion of Ukraine as a holy mission to defend Russia in an address marking Orthodox Christmas. This as Ukraine's allies issued a joint declaration that any settlement to end Russia's war will have to be backed by robust security guarantees. Ukrainian President Zelensky, French President Macron, UK's Prime Minister Keir Starmer also signed a separate agreement declaring their intent to deploy forces to support Kyiv's defense if a ceasefire is agreed on.
We discussed these issues in detail today, and so I can say that following a ceasefire, the UK and France will establish military hubs across Ukraine and build protected facilities for weapons and military equipment to support Ukraine's defensive needs. And with our coalition partners, we've also agreed significant further steps.
Well, that UK's Prime Minister Keir Starmer on the possibility of peace in Ukraine and what allies, including the UK and France, are likely to do. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to this special broadcast on the first advanced estimates of India's GDP growth in the current year. the Ministry of Statistics, or the MOSPI as we call it, has pegged the Indian growth, GDP growth, at 7.4% in real terms, and the nominal GDP has been placed at 8%. The 7.4%, a very good number compared to the 6.5% last year, is coming on the back of very strong services and manufacturing sector estimates. How does this compare with our poll? It is slightly lower than our poll. Our poll threw up a real GDP number of 7.5%. The MOSPI is a little more modest at 7.4. The RBI stands at 7.3, by the way. So clearly, these are more modest numbers. Nominal GDP of in the poll came in at 8.3%, with several people at 8.4 and 8.5. But the MOSPI is way more modest at 8%. Nominal GDP is important. This is the actual output in the country this year without adjusting for changes in prices. That is the overall number, GDP number, which we have to take into consideration when we measure fiscal deficit. The nominal GDP is also important, or the pace at which it grows is important for taxes, important for earnings growth. So the nominal GDP coming in at 8% may be seen as a disappointment, because historically India always had a double-digit nominal GDP growth number. In the first decade of the 2000s, we were running at 14 and 15% nominal GDP numbers. But now with the control of inflation, the nominal GDP for the first time is coming in single digits. Well, even last year was a single-digit number, but 8 is a new low if you don't look at the COVID years. That perhaps is one big takeaway. What are the other big takeaways? We have a panel of experts, expert economists, to speak to us and parse this number. We are joined by Kaushik Das, the Chief Economist at Deutsche Bank, Madhvi Arora, the Chief Economist at Emkay Global Services, and Kanika Pasricha, the Chief Economic Advisor at Union Bank of India. Kaushik and ladies, thank you very much for your time. Kaushik, 7.4, is it practically in line with what you thought?
Yeah, I mean, most people were expecting around 7.5. Our own forecast is broadly in line with what people were thinking. But the nominal GDP obviously is lower than what I thought. Our own forecast is 8.3, so 8 is slightly lower than that. And if you see that nominal GDP has come down from 9.8 of previous year to 8, almost 1.8% decline. Yeah. Whereas real GDP has gone up from 6.5 of previous year, supposed to go up to 7.4. So about 90 basis points increase. So it's again a question of which one you should give more importance to, nominal or real. And the question about whether we are managing to calculate the deflator properly or not. If we had a different deflator, the double deflator debate that we have, whether the real GDP would have been lower, whether it would have been consistent with the core inflation, excluding gold being on the lower side, earnings growth, obviously muted because of the low nominal GDP, FI outflows we have seen through last year. So yes, depending on whether you want to see the glass half full or half empty, it depends whether you want to look at the nominal or the real. But overall, I think nobody expected GDP growth to be above 7% this year. So on the surface of it, it looks like it's a stronger number compared to what people thought in the beginning of this year.
Oh, absolutely, absolutely. In the beginning of the year, almost everyone's forecast was sub 6.5%. And the Reserve Bank was seen as aggressive when it came with a 6.7% number. But now, yes, 7.5%, especially after the very strong Q1 and Q2. Just to remind our viewers, Q1, we posted a growth of 8% and 7.8% and Q2 at 8.2%. First half, we average 8%. But since the CSO or the MOSPI is saying that the full year is going to be 7.4%, by arithmetic, they are assuming that the second half we grow only at 6.8%. That's not a bad number, especially because the base is fairly strong in the second half. Madhvi, first thoughts, is this 8% nominal GDP growth a very big disappointment?
Hi, Lata, not really, because, if I look at the government assumption for FY26 nominal GDP, it was also now, while they had taken a higher number during the budget forecast, if I look at the revised number, they were looking at close to around 8% growth. So I think I'm not very disappointed, because we already had built up our expectation the nominal GDP would be close to even sub 8% for that matter. Mm-hmm. That said, of course, this is way below the 10-year average of 10%, way below the 15-20 years average, wherein we were generally seeing a 14-15% nominal GDP. With that, obviously implies that all macro and market variables, be it fiscal deficit to GDP, sovereign debt to GDP, and credit growth, and even corporate earnings, all of that need to be recalibrated accordingly. So obviously, any slippage on nominal GDP growth, I mean, of course, this is again an advanced number.
Madhavi, I'll just rest your worries on that. In the budget, the assumption was that FY25 nominal GDP would be 324 lakh crore.
Yeah.
On top of that, 10.1% would give us 356 lakh crore. But when the May numbers came, last year's number came in at 330 lakh crore, as you know. And therefore, even at 8%, I calculate, it comes at 357.
Exactly.
The nominal GDP is higher than what the budget estimated, even with a lower growth number. So the worries about fiscal deficit.
At the margin, yes. Yeah, we were not expecting that to be a bigger variable for fiscal per se, any which way. So we were expecting it to be in terms of value terms, largely matching the government's forecast on fixed. So I agree with you. There was not much of a disappointment on that front. And obviously, we had already built up a nominal GDP growth, which would be close to around 7.8 to 8%. So pretty much in line with the view that the market is already sort of playing with.
Fair enough. I'll come back to you on nominal GDP, since we will have to worry about what the budget assumes on February 1st. But before that, Kanika, I wanted your all your views on the consumption and the investment numbers. The consumption number is coming, is estimated at only 7% compared to 7.2 last year. What is this telling us? That the GST-related, GST cut-related bump is not expected to continue? Does this look modest to you, 7% consumption?
So, Lata, first of all, Happy New Year.
Oh, thanks.
And what you said is absolutely right, that initially the kind of numbers we had seen in high-frequency indicators for consumption, be it auto sales across indicators, yes, we were looking at a stronger number for GDP growth even for Q3 because of the consumption-led boost. But this data is showing a slightly different picture. So we had thought that even December quarter number will clock above 7%, but a 6.8% average for H2 is somewhere signaling that consumption boost, I would want to say it will not sustain, but it's not as strong as the lead indicators and the initial thought process came across on account of GST-led booster. That said, the boost was much needed. We need consumption as a growth driver in a world where there's so much uncertainty, and Capex growth momentum, in our view, is primarily led by government. Private sector is yet to catch up.
Okay. So, yeah, I mean, Madhuri, to come back to you on consumption, is the MOSPI being very, unambitious or conservative in that 7%? After all, we did see very good auto sales numbers. Even the December numbers were good, year-on-year comparisons. Maybe better when the actual GDP is announced?
The consumption boost that we have seen post GST cut hasn't been broad-based. We've discussed that any which way in the past as well, where it has been very concentrated on sectors like auto. If I look at consumer durables and consumer staples, there hasn't been as much excitement as one would have liked. And beyond the festive season, any which way, the fourth quarter would have seen a little bit of fading. To that extent, then the income effect is still very dominating in the urban sector, which has not seen much of an upside. So I wouldn't be surprised if consumption, while might still do better than investment in the next quarter or even next year, I'm not sure whether that would be a big, exciting variable in terms of really driving the growth story in India per se. Because I think while the tax incidences come down, which obviously at the margin boosts consumption, one, it has not been across the board. Two, the wage impact or the income impact would be still more dominating in that context.
Okay. Kaushik, your thoughts on consumption and also investment. Very strong number at 7.8% compared to only around 7% last year.
So investment is easier to understand because, the government Capex has been stronger than the year of 2024 when because of elections and all, government could not spend in the first half of the fiscal year. So this year, obviously, there was supposed to be a boost. And then second half of the fiscal year, that is supposed to fade out a bit going forward, because the base effect will normalize. So first half was expected that government spending would be higher than on a year-on-year basis. So
yeah, actually, it is higher by 28%. I just calculated,
which is not
surprising. It was because of the low base.
Yeah, because of the low base. So what is important and interesting in this forecast that CSO has given, as you pointed out, that 6.8 for the second half of the year. Then the question is, how much is for October, December? How much is for January, March? We don't know that. But the point is that they're saying that growth will kind of decelerate in the second half as the base effect normalizes. So investment and the private sector obviously is on hold because of the uncertainty and the broad-based Capex recovery that we talk about beginning of each year. That has not taken place. So overall, it's the government push that has helped the investment. And again, we are hoping that this continues in the budget for next year as well. Okay. On the consumption side, we should not forget that in 2024, we were seeing a broad-based, credit growth decline. And RBI had clamped down on, credit, unsecured credit. And, there was this concerted effort to bring credit growth down, which obviously had its impact on 2025. Then beginning of 25, the RBI started reversing all this, tightening measures and started cutting rates, giving liquidity. Now, these things take time to have impact. So despite that, we have managed to grow at 7%. I would say we are doing well. But we have to figure out whether, how much of it is, due to low deflator, how much is the real, consumption taking place, adjusting for the deflator impact. Are we really growing at 7%, 7.5% kind of, private consumption growth, with private consumption being close to 60% of GDP? Yeah. So my guess is it's not as strong as the headline number that is being reflected. And question is, going forward in FY27, should we see a higher growth or should we see a lower growth than 7%? Particularly as the base effect normalizes, as the deflator is corrected, as inflation moves up. So I think overall it's a good number, but if you drill down into some of these intricacies or nuances, you might find a fault here and there.
Yeah, I know the consumption number seems a little disappointing considering that so much was done for consumption. The Reserve Bank went all guns blazing on rates and liquidity. As well, you saw the government both cut income tax and GST rates. So therefore, this 7% comes as a bit of a surprise to me. Maybe the estimate will be bettered when the actual numbers come. We don't know. But the positive is the investment. 7.8% is seeming to assume a private capex growth as well. It can't be a 7.8 only with government capex. Is private capex also picking up? That question after the break to our economists. Welcome back. The MOSPI, or the Ministry of Statistics, has announced its advance estimates of this year's GDP, and it is placing the real GDP growth at 7.4% and the nominal GDP growth, that is growth unadjusted for price rise, at 8%. The 8% is a tad lower than what the budget had assumed of 10.1%, but the 7.4% real growth is better than Reserve Bank's forecast of 7.3%. 7.4% is anyway a growth to kill for. The context is that the first half was 8%, and therefore the MOSPI is assuming a 6.8% growth in the second half, that is Q3 and Q4. I've been speaking with economists Kaushik Das of Deutsche Bank, Madhavi Arora of MK, and Kanika Pasricha of Union Bank. Ladies and Kaushik, thank you very much for your time. I wanted to get this investment argument right. Kanika, the investment growth is seen at 7.8%, very strong number. Does this assume that there is a good private capex pickup also? This can't be only because of government capex, can it?
So, Lata, completely agree with you, but just that, let's understand that this is basically, in my view, led by a few sectors. Because, for first half of the year, the listed corporates, when they came out with their numbers for capex in their balance sheet reporting, it did not show a very strong momentum, which is broadly in line with the kind of environment we are dealing with. But some sectors are really shining. Like renewables continue to shine, data centers is doing well, even iron, steel, healthcare. So some sectors are showing a very strong momentum, but it's not a broad-based story in our view. That's one. Second, so we think that, while yes, private sector capex has shown some signs of recovery, because we cannot have sustained deleveraging in corporates, we cannot have sustained downward momentum in capex as well. However, government capex continues to remain prime driver of overall capex growth of 7.8, with central government reporting 28-29% till November.
Yeah, if they stick to the entire budget, then they would be doing 10% higher than last year. But government capex is still a very small portion of the overall, gross fixed capital formation number. It's a very, very small percent. Therefore, this 7.8 assumes government capex, assumes private capex. Very quickly, Madhavi, are you seeing it? Or will we, when the final numbers come, be disappointed? It may not be 7.8.
Yeah. So, Lata, as you rightly said, the government is only a small player in the overall capex picture. I think informal sector and household participation has been a major driver of investment growth, specifically in the past 3 years. In the first half of this year, we've seen private capex announcement hitting a decadal high of around 15 trillion plus. But at the same time, we have to see how much of that actually sort of converts into actual investment. In the last cycles of capex that we saw FY24 were led by government as well as the real estate cycle. Now, the government cycle also has largely peaked, while we are going to see probably 8 to 10% growth in government capex in the next 2 or 3 years. As a percent of GDP, I think government capex has largely peaked at around 3.1%. At the same time, the real estate cycle is also near its peak. So incrementally, again, I think it'll be very important that the large cap, as well as the the mid companies and households, they continue to participate in the capital formation cycle, which I think at this point in time is still, as Kanika was mentioning, is extremely selective in sectors like EMS, sector like renewable energy, data centers, semicon, auto and EVs. All of these sectors are, the one which are having a concentrated capex at this point in time. The broader listed universe is likely to adopt it in a more gradual fashion. We also have a lot of uncertainty with regard to what is going to happen to India-US trade deal, which could impact, the low end of manufacturing segment in terms of their investment, which is the SMID universe, or the informal universe as far as the investment is concerned. That will be a very big variable. Plus, given the fact that, we are still looking at an excess capacity in the world order, which is somewhere spilling into, the way the reaction functions of private players is also evolving. All of that also will be very important. So I think I would still be a little wary of assuming that we are in for a big investment cycle. The importance of household and the SMID economy has to be taken into account. And the fact that the private capex guys are still a little more cagey with regard to what is happening in the global order, as well as the trade deals that we are negotiating with the US. So I think as of now, the broader listed universe may not necessarily be following suit of certain segments, selective sectors that I mentioned.
Yeah, fair enough. I think earlier today, Knight Frank released its real estate, investments number or sales number. And while office space has grown 20%, that's a very small part. The residential space has degrown, has fallen by 2% year on year. So overall growth is perhaps about 4% if you count office, that is residential and commercial. It's not looking like a very good number, and real estate is a very big driver of investment. It's not looking very bright, but as you say, it could be data centers. But the bigger number that I'm looking for from y'all is next year's nominal GDP assumption. With just 8% this year, Kaushik, what's the best assumption that the government can reasonably go with for next year?
So I think, Lata, they can take 10%, to start off with, because inflation is supposed to go up for CPI. And also remember, all these numbers that we are discussing will probably become redundant by the time we get the new GDP series or in February end. And you know that they will discontinue the current series and they'll just give the new series. And the new series will be for 3 years full data. So as of now, this particular series would be used for calculating your fiscal ratios in the budget, revised estimates, and next year's estimate. But by the time we, go to the end of February, we'll get a new series of data. And based on that, we'll have to see how the numbers are looking like, whether it changes materially from what has been announced today, then whether the next year's numbers will kind of change according to that. So all the fiscal numbers will go for recalculation in April once you get the new series of GDP. So that apart, what I think is that, 9.5%, 10% is a realistic estimate for next year. As long as, if you're changing the way you're calculating the deflator, then probably, you could get, different numbers for next year. I would say the government probably will assume 10% to start off with for the fiscal calculations. Now, whether it ends up being 9.5%, I don't expect, nominal GDP to be lower than 9.5% next year, because I see inflation picking up. And therefore, we could manage, if we even have 6.5% to 7% growth in the next fiscal year, to assume 3.5%, 4% inflation, I think would be okay. And 9.5%, 10% would be my guess. But I think the government would prefer taking at the higher end of 10% and doing the calculation. Later, we'll adjust depending on how the revised estimates also become actual estimates, and all these nuances will come into play.
Okay. Well, at 10%, the GDP will look like 392 trillion or 393 trillion rupees. So at 4.2%, I think the fiscal deficit will work out to 16.5 trillion, which will be fairly modest, actually. If only 70% of that is government borrowing, it looks like a benign number for the bond market. So that nominal GDP number is very important, what they forecast or assume. Ladies and Kaushik, I don't have much time, so a monosyllabic rapid-fire question. Kaushik has said 10%. Nominal GDP, Madhavi? Assumption for next year?
What I would also take. I think they would work with 10% nominal.
Kanika?
In camp, 10.
Oh, very good. There's some consensus here. The other is a more speculative question. Will the February 28th recast make the GDP higher or lower? I just want one number, one word. Kaushik?
Higher.
Higher, good. Madhvi?
I also think a tad higher.
Okay.
May not be very different, but a tad higher.
Kanika?
Higher.
Oh, very good. So I think we're going with optimistic assumptions here, and I think reasonable optimistic assumptions. You all are not kite flying over here, which means that the bond market shouldn't be very unhappy tomorrow with a 10% nominal GDP assumption and the likelihood of it actually being higher when the recast numbers come. It looks like a manageable borrowing program will be in the works. But I'm getting ahead of myself. At the moment, the numbers are very much in line with expectation for the current year. Thank you very much, Kaushik, Madhvi and Kanika for taking us through these numbers. We wrap up on this special broadcast on the state of the economy. Do stay tuned. Lots more lined up for you.
Hello and welcome. You're watching News Center and I'm Parikshit Luthra. The fate of US President Donald Trump's tariffs announced on April 2nd, 2025 may be decided by the Supreme Court on Friday. The court has not indicated which decisions are ready for release, but it merely stated that rulings in argued cases may be issued when the justices take the bench. The expectation is that the legality of tariffs may be taken up. During the arguments on November 5th, several justices signaled doubts about the legal basis for the tariffs under a 1977 emergency powers law. Meanwhile, India continues to face 50% tariffs from the US as negotiations for a trade deal continue. President Donald Trump said that Prime Minister Modi is unhappy with him because of the high tariffs. Speaking at a House GOP members' retreat, Trump also claimed that India has substantially reduced its oil purchases from Russia. Earlier, Trump said that Prime Minister Modi wanted to make him happy and was aware that the US could raise tariffs quickly. According to data from Cipla and other reports, India's Russian oil imports fell to a 3-year low of around 1.2 million barrels per day in December, a 40% drop from the June peak of nearly 2 million barrels per day. In the absence of a trade deal, Indian exporters are bearing the brunt of tariffs. A Bloomberg report warns that exporters risk losing US orders for the crucial summer shopping season if no deal is reached by January. The tariffs have already hurt order volumes during Christmas and New Year, forcing many exporters to cut production. All right, let me go across to the Director General of Federation of Indian Exporters, Ajay Sahai, who is with us right now. Mr. Sahai, could you give us a sense of how the exporters who had somehow been able to absorb the impact of tariffs, how will they fare now, considering we don't have a deal, and if we don't have a deal by January end, what would happen?
No, you are right, because in some of the fashion-led sector, particularly in apparel and footwear, normally the order for the next season should have been finalized. By looking into the good rapport with the Indian exporter have with the US buyer, they have deferred the decision. They are expecting India to have a deal by the end of January. If that happens, probably those orders can be executed by the Indian company, and still be a challenging time. We are also pinning our hope that some intervention is made by the Supreme Court of the US, and if the tariffs can be struck down, that can also provide relief to the Indian industry.
Right. Do you see a substantial impact on certain sectors? What about footwear? What about leather? What about textiles? Are we set to lose volumes, export volumes to US in this quarter?
That will happen because in the tariffs so far, the global companies have not been able to shift their supply chain because they have a high social compliance. But now, since the deal is not there, if that is not happening by January, probably they will be moving to the other destination. And the challenge is when they move to the other destination, bringing them when the PTA is in place will be quite a challenging task for the Indian exporters.
Right. So you expect US companies to start moving to other destinations if we don't have a deal by January end?
That is the feedback which the industry has given to us. In some of the segment where the orders are not seasonal in nature, probably that may not happen. But in respect of footwear and apparel, where the orders are seasonal in nature, this is likely to happen.
Right. Let me go across to Mr. Dua as well. Mr. Dua, we're looking at a difficult situation. All eyes on Friday. But even if the court strikes down Donald Trump's tariff strategy, saying that it has not been endorsed by any US law, it is unconstitutional, can Donald Trump and the White House still find a way to give legal effect to those tariffs?
Thank you for having me in this discussion. The only way possible at that point of time would be for them to appeal to a higher court and bring out more forcefully that the tariffs have been levied for the security of the United States, an argument which probably, if they lose, would mean that they were not able to convince the first trial court. Otherwise, I don't see any other reason, merely because they've had a trade deficit with India or with many other countries, that the United States president can trample over the Congress's powers, the parliamentary powers, and call out everything which he does, as we are finding, that he calls it a security necessity. This argument may not really cut ties either in the first court or even in the appellate court. That's my anticipation.
Right. Let me go across to Deep Pal. Deep, how do you see the situation here onwards? Do you see any kind of reprieve for India, or even if the reprieve comes by way of the Supreme Court order, is it going to be temporary?
Right. I think we need to consider a couple of things there, Parikshit. First of all, thank you for having me. So the first thing is, in the way things are operating right now, if you notice that there has been quite a bit of focus both on the part of the government as well as exporters in India to try and diversify, right? In the last month, we have heard about two trade deals, one with Oman and the other with New Zealand. The Commerce Minister, as we speak, is in EU trying to tie up the EU FTA that has been negotiations on which have been going on for a while. And we are also in conversation with a number of other countries across the globe, including Mexico and elsewhere as well. So I think every time that we hear President Trump talk about tariffs on India, or the possibility of higher tariffs on India, or questions about India buying Russian oil and so on and so forth, I think that just reinforces the need for India to diversify across its export basket across the globe. Now, of course, America is a huge market, and there is no easy way, as every country that sells its goods and services to America has found out, there is no easy way, obviously, to find an alternative, right? So that notwithstanding, I think moving forward, what we will see happening, what we are seeing happening already, is an attempt to find other markets where India can sell its goods and services. Now, while that is happening, we also need to remember that there are, while on the trade front things haven't been very good going for the last year or so, there are other areas where India continues to have a cooperative relationship with the United States, whether that is on defense collaboration, on technology, and so on and so forth, through the Trust Initiative. So that will continue, and there is this hope, or there is this attempt to ensure that the benefits of cooperation on various other aspects do accrue as far as trade is concerned. So that will obviously be something that India will continue to hope. But at the same time, I think, as the other speakers have also mentioned, there will be an attempt to tie up a trade deal at the earliest possible. There will obviously be also expectation that if the 25% tariffs that have the additional 25% of tariffs which have to do with purchase of Russian oil, if they can be gotten rid of, which is something that the Indian government has been talking about, has been trying to for quite a while. We have noticed that RIL has recently come out with a statement saying that they have not been buying Russian oil for the last 2 weeks of December, and they don't intend to buy any for the rest of this month. So there will be an attempt to try and see if these 25% of the tariffs can be removed, and that would obviously bring some amount of respite to Indian exporters, and then take it from there.
Right. Mr. Sai, you've been in so many meetings with the government. Is there any kind of clarity on whether this 25% oil tariff will go away, considering we've substantially reduced purchases of Russian oil?
Definitely, if you look into the data, our import from Russia is going down. On the contrary, our imports from US is improving. So we are definitely giving a very clear signal, and I don't think any of the private sector industry or even the Indian bank will try to buy Russian oil from a sanctioned entity and sell this to sanctioned entity, a conflict on major flow of oil to India. It is likely to come down. But whether that satisfies the US government or not is also a $1 million question.
Right. The other question, Mr. Dua, that I'd like to ask you, look at the kind of statements that are coming from the Trump administration right now. And does that put India in a difficult position? He's saying that Prime Minister Modi is not happy with me. He's not that happy because of the steep tariffs. He also said that India was concerned, the Prime Minister was concerned about the 5-year delay in delivery of Apache helicopters. And he's saying that India came to him, requesting him for the release of these helicopters. And now they're not buying Russian oil anymore. He's making these kind of statements about the government, about the Prime Minister. Do you think it makes it very difficult for the Indian government, for even the Indian trade negotiators, to work with the US on this front? In this kind of an atmosphere,
Can a trade deal happen?
Anticipating what President Trump says or what President Trump does is certainly an extremely difficult exercise, which I think even as Indian astrologers, known otherwise for their competence, can also probably not predict. The fact of the matter is we do want the trade deal. Let our trade negotiators not be overtly concerned by what President Trump says or his officials say. That is more on whether the penalties would be removed or not, the 25% additional levy would go or not. If it goes, then we are well off with the new rates of duty, which we all expect under the trade deal to be much lower than the existing 25%. But in any case, that even the 25%, if it is kept, it is better than the double which we are paying. And we need to be worried about also the fact that losing the markets of the US is a matter of concern for us, because once they switch to some other supply chain gets altered, it will be difficult for us to intervene there, get in and get the US market back. So I'm really concerned.
Right. Mr. Dua.
Yeah.
Yeah, Mr. Dua, you're rightly saying that we are very concerned. In fact, almost all diplomats have said that, and even the likes of Mr. Surjit Bhalla have gone on to say that we definitely need an India-US trade deal if we want to become a Viksit Bharat by 2047. That is integral to India's growth story. Having said that, do you think the kind of comments that President Trump is making, does this mean that the US is now putting more items on the table for India to include even after the negotiation was closed? In fact, let's not forget, Jamieson Greer last year, several weeks ago, had said before the US lawmakers that India has given them the best ever proposal that the US has ever got from a country.
You know, what you're saying, Parikshit, is absolutely right. But Mr. James Green isn't the final authority, as we know, in the US. In the current milieu, in President Trump's second term, everything gets called out by him. He can turn down all the months of negotiations, the results, anything his officials say, and his stance seems to have become a little more firmer after what he's been able to achieve in the Latin America in his kind of actions in Venezuela. Correct. So these comments which came from him about Russia, Indian oil, somebody saying it should be 50% levy, etc., where, if you would recall, the timing was coinciding with his success, inverted commas, in Venezuela.
Absolutely. And that's what he is using, that muscular diplomacy and trade strategy to send that word. We'll take a short break at this point, but we'll request all our guests to stay with us. We'll be right back.
Welcome back to News Center. Ajay Dua, former Secretary, Ministry of Commerce, Deep Pal, Director, Geopolitics and Policy, Coon Advisory Group, and Ajay Sahai, Director General and CEO, Federation of Indian Exporters, are still with us. Mr. Sahai, what constructive or clever diplomacy do we now need to do with the United States? What has been your recommendation? What concessions should we give to quickly clinch a trade deal?
I think we have already given whatever concession India could have given, and it's a call which they have to take from the negotiator side. I think they have given a very good offer to the US to work on, but now we are not waiting for that to happen. We have already started our work, and in many of the sectors, companies are looking into the alternative market. In some of the sectors, for example, in marine sector, we have already compensated the loss which has happened into the US with a new market in Europe, Russia, and China, and probably, as told by the previous speaker, we are looking at the diversification, de-risking. I think that's the positive fallout of the tariff war, that Indian companies are now looking into the new market and probably forming up in those markets, moving away from the US. But at the same time, we do agree that US is a very good market, probably a market which provides for the volumes, and therefore, at any given point of time, once the BTA happens, they will be very keen to work in the market. The only challenge is that once you lose the buyer, how you will be getting the buyer back is an issue for the Indian exporter. That's why still we are hoping that if something happens by the 31st of January, whatever little losses Indian companies have undertaken in the hope that BTA will be in place, probably that will work to the advantage of India.
Right. Also, Mr. Sai, what do you think we will possibly see, and are there these developments already happening? Are some of the Indian companies, in order to continue catering to US clients, are they considering or have they started moving some parts of manufacturing to other jurisdictions in Southeast Asia?
But definitely in some of the sector, they are doing part manufacturing in India, part manufacturing they are doing in other countries where they're meeting the rules of origin and getting their product in the US market at lesser duty. Is not circumvention. Probably they are doing the adequate manufacturing in those geographies so that they can retain the buyer. So whatever is possible within the rules, Indian companies are doing it. Some of them are also looking into the first sale rule, where they are moving the goods to the first seller at a price, and then from the first seller, they are sending it to the US market, getting the duty advantage, which is right now imposed on the first seller rule. So whatever is possible within the rules of the game, definitely Indian companies will be doing it, because they would like to retain the US market to the extent possible.
Right. Deep, do you believe that India must now possibly stop giving concessions, more concessions to the US, do not comment about US policy in any way, but start locking in our gains? Because whatever we are giving to the United States in terms of concessions, we've done literally everything that they wanted us to, but it's still outside the trade deal. Do you feel that any further concessions or policy changes must be contingent on some trade deal actually being reached?
Right. So, Parikshit, if I can connect that to an earlier question that you were asking about, the kind of comments that President Trump seems to be making about India, and whether that affects the trade deal negotiations. Now, there's something that we need to understand about the people on both sides of the table, both the people at the USTR's office as well as the people on the Indian side of the negotiating table from the Ministry of Commerce. Now, these are all professional bureaucrats who have worked on issues such as these, on trade negotiations in multiple occasions across their careers, right? So I don't think a comment from the president or from any other side of the US establishment really moves them to an extent where they are not able to negotiate depending on what the remit that they have been given, what they have been asked to do. So that's something very crucial to understand and remember. Now, having said that, if the question that we are asking is what is it that we can do further, or why is it that retail is still not coming about, it's also important to understand that, all the comments that we hear either President Trump making or other people in the Trump administration making, it's useful to remember here that not all of them are necessarily meant for us or for India or for the Indian establishment or for Indian citizens' consumption. There is a large domestic constituency, there is a large political base that all of these people also have to keep in mind. So a lot of these comments that they make are meant for the consumption of their own supporters back home. So that's one useful part to remember. Now, as far as what else can we give or what other kind of concessions can we talk about, I think the red lines for India have been drawn very, very clearly. Now, what will take is a great deal of sitting across the table and negotiating, which has been happening, as we know, both virtually as well as through the teams traveling to the two countries, which is also an indication that both sides are still keen that they find a way out of this. Right now, how long that will take, exactly when they will manage to seal some kind of a deal is something that only they can answer. But I think what is most important in this is to keep your red lines clear and can continue the conversation, which is what we see happening right now.
All right. Mr. Dua, what do you think is the best way forward for exporters, Indian trade negotiators? Should we now just bide our time?
Not really. I think we would need to prepare for the eventuality that the trade deal gets delayed beyond January. There has been...
may not happen also?
One doesn't rule it out. If President Trump is under pressure, whether it's a constituency pressure because he has the midterm elections later in the year and the Midwest, which supported him, is really the agricultural belt of the US, and he wants to do something for them. China has been obstinate in that matter. It's now agreed to a certain quota, but that's not good enough of soya being imported by them. He wants India to also open up. So there are a host of considerations which could work either way. Saying Mr. Trump says no, unless the red lines of yours, which are your red lines, are kind of withdrawn or diluted, I'm not going to be approving the deal, but irrespective of what has been negotiated or what comes up to his table. Similarly, what India could perhaps, I'm just going back to the question which you asked the earlier speaker, Deep. IPR is one issue which the USA has been worried about for a long time, over 20 years, ever since we came in with the new act in 2004. Earlier it was the provisions which we thought are meant to check evergreening of basically pharmaceuticals in the US. But the US widens it to say that even if for a moment we accept your argument that your IPR law is in line with the WTO provisions, something which doesn't bother US actually, what WTO says any longer. But they've been saying its enforcement is extremely poor in India. And that whether certainly patents, but they also have been giving examples of trademarks as well as copyrights, which they say Indian people are prone to copy, many Indians, and that India just doesn't have a proficient machinery. You still ask a policeman to go and register a case or go and detect a violation under the IPR. There is no other machinery on the ground till the matter comes up to a much higher level. So that is something which we might like to look at and concede. In addition, I think it may not be something devastating if we were to allow a certain degree of soya to come into India, but only for use as ethanol. Yes, the Indian farmer will get hurt to some extent, but ethanol, the proportion of ethanol in our Indian petrol can increase tremendously. Now, it can go up from the existing about 10 to 11% to 20 to 25%. The technology in Brazil has been showing that for a long time, way ahead of others. And that it would probably serve one of the constituencies or one of the things which have been bothering Mr. Trump about doing something for the US.
All right. Thank you very much, Mr. Dua, for joining us with those very important remarks on what could be more concessions that we could we give the United States. Deep Pal from the Cone Advisory Group and Ajay Sahai of FIO for joining us with their very important views after Donald Trump's remarks last evening. With that, it's a wrap on this edition of News Center. Thank you for watching. Goodbye.
Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. Gold, silver, copper, aluminum. Now, when we investors think about our portfolio, we rarely think about metals as a real asset class. At best, most of us have some exposure to gold, and many a times, even that is not a scientific, well thought out portfolio allocation. It's something that we perhaps have at home, or some jewelry that we add on here or there, or maybe an ETF that we invest in. But now, having seen a 60% run in the price of gold in the last 1 year, a near 150% surge in silver, and over 50% rally in copper in just the last 1 year, many investors are suffering from FOMO, the fear of missing out. But FOMO investing is not a strategy, which is why this week we are going to do a full classroom on the metals melt-up. Yes, that's what I call it, the metals melt-up of 2025, which is still continuing, by the way, in 2026. So what is driving this massive price spiral? What is the outlook on gold, silver, and other industrial metals in the coming months and years? And then we ask the experts if there is still some merit in investing in these metals as an asset class. Joining me on the show are Peter Mungwaya, CEO of Trading.com, Mrin Agrawal, who's a financial educator and director of FinSafe India, and Kunal Shah, Vice President, Head of Commodities Research at Nirmal Bang. Thank you so much, ladies and gentlemen, for joining in. As you heard in my opening remarks, this is a classroom because this is for the actual retail level investors out there who are watching all these headlines and wondering what happened. Gold and silver have moved like small cap stocks, right? And so here we are. So first of all, thank you very much for joining in. Maybe I can get opening thoughts, Peter, from you first, and then let's hear from Kunal in terms of what really has happened. 50% to 150% price rise. Peter?
Absolutely, Surubi. Pleasure to join you. And I tell you what, if you would have rolled this show back 12 months and we were sitting here, no one would have believed what you have just said as far as that intro. I don't think Jim Rogers wouldn't have believed it.
Yeah.
Because every market analyst was saying possibly you might get 3,500 out of gold. You may touch 3,750 as a long shot. And silver, yeah, all right, let's go to $40. Well, we've touched $84 for silver, as we know. They're the numbers on the chart. I mean, it's just extraordinary. And the overall momentum and appetite, I think, from retail traders, central banks, and the paper market has just been absolutely game on. So I feel as though that will continue very much into 2026, Surubi, and I'm not expecting any of that heat to come out of the market anytime soon. So that's my observations, and I think strap yourself in. It's going to be one wild year.
All right. So, it's going to be interesting. It has been interesting, probably will be. But Kunal, your thoughts? The thing is, now we all know, that silver has wide uses as an industrial metal. It's used in data centers. It's used in, electronics. It's used in electric vehicles. That all is known. It's been known for years. So what changed in the last few months?
Okay, it's a very good question, and I just like to. It all started last year with one fact that people realize that with every year going by, US is going to find very difficult to service its debt, because at the start of the year, the US interest rate stood at 4.5%, and their total debt was standing at $37 trillion. So they had to service this debt with the 4.5% interest rate. So that was never going to be possible every year whenever they have to service this debt at a higher interest rate. So the main reason, the main ground for this rally was the rising debt of US at an alarming pace. So the way US debt from 2021, the way it has been every year, $1.5–2 trillion, $1.5–2 trillion, that was absolutely unsustainable. Second, fear of crash of US dollar because of the rising debt level. The way their debt was soaring, so everyone was fearful. What if dollar, loses its value by 10–15% going forward? Or what if the dollar crashes, So that was the starting point, when people started to buy commodities. Third thing, most important, we are living in a multipolar world. We are no longer in a globalization economy. Earlier, in globalization economy, there was a transfer of goods and services to all economies. Now, we are going back towards the protectionism. So everyone is bothering about securing their own supply, okay? Because of the tariff era, which was started by Mr. Donald Trump. So now everyone wants to have a hard asset in their portfolio because the paper currencies are seen losing its value. And when the paper currency are seen losing its value, and that is dollar, in fact, everyone wanted to be in commodities. So that's where the bull run started in 2025. So post-COVID, the fourth reason, there was no incremental growth in the supply of any of these commodities, what we are talking about. May it be copper, may it be silver, may it be gold. So the supply side was weak from last 4 years. There was no major supply side growth which has come in. All of these metals, the price of which have rallied, okay? And now we are talking about the new age demand, which was not there 5 years back, which is the data center demand, battery storage, electronic vehicle, the way the transitions of EV taking place. So it all combined and led to this humongous rally in a price of all these commodities. So you take precious metals, you take base metals, you take even for that metal, even in last 2 months, even the ferrous metals have started to catch up,
Yep.
So all commodities have been moving up, not because the demand was so strong or the supply, but because everyone wanted to be in commodities because of the hard asset. Everyone wanted to own
own something tangible,
because,
something that can be an alternate to the dollar, like you're saying. So it really started from there.
And if you see what has been going on from last 4 days, what we are seeing from the Fed chairman, from the Walmart, from everyone now is accepting crypto, and crypto is now becoming a reality, where the Fed is saying that we are going to regulate this. This is going to stay. This is alternative payment system. This is a simultaneous monetary system. So they know eventually there is going to be a collapse in the dollar. The debt level every year, if it is rising at $1.5–2 trillion, dollar is going to collapse one fine day.
So Kunal, for the sake of financial market stability worldwide, let's hope we don't get to that point, the collapse of the dollar, because that will be like Armageddon. But I take your point. I mean, largely there's a lot of fear about what's happening with the US policy, and the way these US tariffs also shaped up over the course of the year. So that's led to heightened interest. Mrin, I want to come to you, and we'll go through each of these metals one by one in a minute. But Mrin, I'm sure over the last couple of months, the last year, you work with investors widely. I'm sure you got a lot of these questions thrown at you. Should I buy crypto? Should I buy gold, silver? Anything beyond Indian equities? Because Indian equities, anyway, were among the worst performers of the last year.
Yes, absolutely. And I think, there's been a lot of trend chasing. And in fact, even now, there are so many investors after the 150% return. The most common question right now is that should one buy silver, or, should one get into copper right now? And of course, we know that it's not easy to get into copper investments in India, right? So, but there's a lot of interest from investors. But I would still say, Surabhi, that a lot of it is driven by FOMO, and a lot of people are really trying to play the catch up, having missed out the rally probably last year.
And that is why this conversation is extremely important, because obviously we here and viewers of this show, Let's Talk Money, would know that FOMO is not a strategy. We never believe in it. None of our experts ever advise it. It needs to be far more scientific. So Mrin, bear with us. I'm going to ask the commodity experts to go through each of these metals one by one, and then we'll come back to the investing strategy in a minute. But let's take it from the top, gentlemen. So let's talk about gold. So the triggers have been, sort of captured by Kunal earlier, the fear around US policy, what's happening with US interest rates. The question is, can gold still keep rising despite a 60% rally last year? Peter, why do you think so?
Yes, I do believe so. Building on, and Surabhi, building on what Kunal mentioned, I mean, you could discuss this all day as far as the framework, what are the key drivers and the metrics associated. I do believe, if you're looking at far as central bank buying, appetite as far as retail traders, paper market and physical acquisition, yes, I do believe that gold is in its early stages of a bull market. And when I say that, it's not unusual when you see these hyperdrive events that they take a long protracted time to grow. And the overall theme at the moment, I think, is certainly bullish, and that will continue. I look into 26 as a year that you would have to think very closely. If you don't have it in a portfolio or you don't have physical, now's the time to probably say, yes, I want to be a part of it, because the momentum and I think the attraction will be fairly solid going into the first half of the year. I'm tipping by the end of this month around about 47,500, so up about $300 from where it is at the moment. And there is no way that it is not Main Street news, because people are talking about it from 15 years of age all the way through to 90. Male and female, everyone is talking about it globally, and I think that that's very much on everyone's radar.
Okay, so that's a full thumbs up to gold from Peter. Kunal, come in on this. A lot of the targets that I saw, like I said, I think UBS, JP Morgan, Bank of America, a lot of these big global banks, they are calling for 5,000, which is actually not too far away from where we are. But what is your own call? Can one still get onto the gold bandwagon despite the rally?
See, the fundamental of gold is bullish, and a lot of these fundamentals are already priced in. So after the 65–70% rally, what we've seen in gold futures, I think a lot of fundamentals are in the price right now. So I believe that going forward into 2026, we are expecting that gold will continue to remain bullish, but the incremental return will be very less as compared to what we saw during the year 2025. So I'm expecting a conservative 15 to 18% upside in gold futures. So if they are trading at 4,400, 4,700 to 4,750 would be my conservative upside target for gold futures. So it can come the way it is rallying these days. It can come in a matter of 3 months or 6 months also. But I would not believe that one should not aggressively go long at gold, assuming that we are not going to get gold and the way things are going to unfold, because you have to also remember what is in the price. So like the word you mentioned at the start of the show. So now there is a FOMO. Everyone is like, nobody wanted to buy silver at $40 and entire world want to buy silver at $80.
At $80. That's my question, Kunal, really. Between gold and silver, and again, I'm not talking about a speculative trade here, a couple of days. I'm talking about people taking exposure from an investment point of view. Between gold and silver, what looks better?
Anytime gold at these levels. I would not recommend silver to go long at silver aggressively at this level. So gold has more value right now. If you look at the gold-silver ratio, that has come down from 105 to 55. So the possibility of this ratio going down to 40 or 35 is very less. And I believe that from here, there can be a possible reversal in the ratio where gold again starts outperforming. So looking at the current landscape, looking at the way there is a fear of the dollar crash going forward, the way cryptos have been accepted in the world. So the entire West, US is after crypto. And if you look at the BRICS, they are after gold and silver. So in this battle of crypto and gold, gold will still be a winner with a moderate gains because it is already outperformed. So gold
Peter,
is my favorite pick.
Gold is your favorite bet. Got that. Peter, gold versus silver. Where would you put your money this year?
I'm erring with silver. And the reason for it is data centers, electric vehicles, and the overall shortage as far as investment over the last few decades has been immense. And so that means that I think the upside for silver is going to keep this momentum going forward. I'm not expecting 150% up from here, but I'm certainly expecting it to be over $100 in the probably 3 to 4 month time frame. And we were at $84 last week. So the horsepower that's being created across the silver market, I think is going to actually outgrow gold from a percentage terms leading into 26, Surabhi.
Okay. All right, gentlemen. So that gives us a view on both gold and silver. And as we can see in the house, we've got a gold bull and a silver bull, which explains why both of these commodities continue to shoot higher and higher. We need to take a very quick break. But remember, this metals rally is not just about precious metals. Look at what's happening in the industrial space. Look at what's happening with copper, with aluminum. Again, the same question. As investors, should we take a considered view or leave this to the traders? Back with that after the break.
Let's talk money. talk money.
Welcome back. You're with us on Let's Talk Money. And this week on Let's Talk Money, we're not talking plain vanilla mutual funds or fixed deposits or insurance. We're talking metals, because that metals melt up is making investors around the world and here in India sit up and take notice. The question is this just a FOMO trade that we should be away from, or do we need to evolve ourselves in our portfolios and take some exposure? Well, we have three experts with us, Mrin, Agrawal, Kunal and Peter, of course, are with us on the commodities front as well. We've discussed gold and silver. Gentlemen, now I want to understand what's with copper, or even aluminum for that matter, these other industrial metals which are also shooting higher. Now, Kunal, with gold and silver, we understand they're a store of value, there's industrial use, there's a whole dollar and Fed element, etc. But copper, is it how much of it is actual genuine shortage in the market, supply issues, and how much again is just becoming excessive speculation? Where is that line? And what's your view?
Well, we have come up with a report 2 months back that copper will be the new gold for the year 2026. And we believe that that's going to be the case. The concentrate side of the copper have been weak from last 3 years. And the quality ores have been completely missing from the market. Now, the refined copper, the smelting capacity in China is going to go down. China is following involution policy because of the tariff trade war going on. China doesn't need excess capacity. So they are going to cut down the capacity in copper smelter. So all the copper production in China, the refined output is going to go down. The concentrate output was already going down, and the demand is rising at a rapid pace from the AI, from the data center, power consumption, from the electronic vehicle point of view. So all this new demand is coming and the supply is shrinking. The demand is growing at a double-digit growth in countries like India. So where is the supply? Today, India copper is trading at 10% premium than the LME prices. So in my 20 years of career, I have never seen such phenomenon when Indian prices of copper is trading at a premium of 10% the price of LME. So this is a clear-cut scenario that the shortages are clearly visible, and going forward it is going to get worse. So I believe that the likelihood of copper still doing well, there will be bouts of correction here and there. There will be profit taking, there will be dips, but the underlying strength of copper makes me believe that I will not be surprised to see LME copper at 15,000, 15,500 6 months down the line. So I'm very bullish on copper in particular, then followed by aluminum and zinc and other metals.
So Kunal,
copper, very bullish.
Kunal, if a friend or a family member asks you, and again, I use that analogy because we're not talking to the savvy traders here. We're talking to people who are trying to take considered investment calls in their portfolios, which otherwise only perhaps had fixed income or equity. So for such a person, what are the options? What is the realistic upside you'd see, say, over the next 1 year? And in India, I don't know if multi-asset funds have enough exposure to copper. Is there any other way? If you're so convinced that copper fundamentally is looking good, then how can one take exposure?
So either you create a long position in the MCX future, number one. Number two, you invest in a multi-asset fund. Like there are funds like ICICI Prudential multi-asset fund, which do actively invest in all of the commodity futures, including copper, including silver, gold. So those kind of funds where they are taking exposure in, so that will give a good exposure towards this metal. We don't have copper ETF in India, so that remains out of question. And as far as the copper producing stocks, that can be an attractive option also going forward. So these are some active
options
and passive ways to invest in copper.
Got it.
And I think the best one is to go long in the M6 futures.
Okay, all right. Mrin has been listening to the commodity experts very, very patiently. And Mrin, I think, you got to feel a bit convinced, right? I know when we started the conversation, Mrin was like, look, don't get into this FOMO. It's probably FOMO. But the gentlemen here have outlined a lot of fundamental reasons, and both are convinced that these metals are going higher. So now I ask the portfolio question. Should one be taking gradual baby steps? If yes, how much? How do you ensure that you don't get burnt?
Yes, and I think that's the whole point that, while everybody's talking about this, the fact that we could see some really good numbers and we could see some really good returns from all of these metals. But I would still say that, I think it's important that any investor understands that do we want to add this to the portfolio as a part of our core allocation that we're going to hold for the long term? Or do you want to do it as a tactical allocation, right? And I think that's very, very important. And, from whatever I heard from Peter and Kunal, again, as a financial planner, I would still say that this is more of a tactical allocation. Second, while there were some great return predictions that have come, I think, again, which we see, Surabhi, across the markets, whether, whatever the asset class is, that whenever a particular asset class does well, a lot of people just jump into it thinking that they're going to make similar returns. And I think they did, kind of point out that, of course, you can't expect 150%.
The same returns, yeah.
Which Peter pointed out, but he did mention that you can expect good returns, but I think it's always good to go with the average returns in the long term. So whatever asset class you get into, let's say you're thinking of getting into silver, for example. Again, be mindful that after 150% increase, you could get some corrections. That's the first point. The second thing is that in case if there is a correction, do you actually have the ability to hold on? Because this is what we typically see, right? That people get in and then there's a correction and they feel upset and then they get out. And the correction, nobody knows, right? I mean, you could correction for some period of time with the way things are changing in this world. Nobody
Mrin, that's a great point you brought up. Let me actually take that back to the experts, and unfortunately we're running out of time. But Mrin brought up a great point. While the projections are still, northwards of whatever levels, current levels on these metals, Peter, last word with you. Are you expecting sharp corrections given the rally anywhere? And among all of these metals, silver, gold, aluminum, copper, which would you still be most bullish on? And what is the downside risk? What is that drawdown that investors better be prepared for if they're entering now?
Surabhi, in commodity markets, it's not unusual to see washouts. We could see 10 or 15%, 20% be stripped out very, very quickly. That's not unusual. But the overall theme moving forward, I think, is going to be a very solid year for the industrial metals, precious metals, and some of them could rally 40%, 30%. Others might rally 60 or 70%. So not the rising tide doesn't lift all boats at the same time at the moment, because some of those markets have performed incredibly well. But there are sleepers out there, the likes of aluminium, the likes of zinc, that will probably have better upside, possibly in the second half of 26 versus the first half.
Okay, that's interesting. I think the takeaway from this conversation is that it's going to be a roller coaster ride. There could be potential upsides, but you need to judge your own risk appetite and your holding capacity. Are you willing to ride that roller coaster without getting burnt out? I think that's the takeaway. Bryn, finally, if someone wants to get into commodities, into metals, would multi-asset funds be the best way forward for you, or would you recommend something else?
Well, of course, you have gold and silver ETFs that are available. But over the ETFs, actually, I would recommend the fund of funds because, we're seeing that the ETFs are trading at a premium. And so, I would just say do the fund of funds. And, it depends on what your allocation is. As such, I'm not really a big votary of the multi-asset fund. So I always prefer if you take the exposure separately. And it's, of course, based on the existing exposure that you have right now in the portfolio.
Okay, all right. Thank you so much, Mrin, Preet, Peter, and Kunal. This has been a very, very helpful conversation at a time when you feel almost dizzy, given the heights at which these metals are trading. But it sets us up with more perspective for, of course, the ride ahead, which promises to be a pretty interesting one, as you've all pointed out. Thank you so much for joining in, and we look forward to more such conversations during the course of 2026. Thank you for watching.
Let's talk money.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The market pairs losses ending the day flat in what was a range-bound session. The Nifty holds the 26,100 mark. Midcaps outperform. IT supports the Nifty while HDFC Bank and autos drag.
I have a very good relationship with him. He's not that happy with me because, you know, they're paying a lot of tariffs now.
President Trump rakes up the India additional tariff issue yet again during a huddle with Republican lawmakers. Says Prime Minister Modi is not happy with him, but India has reduced Russian oil imports substantially. Also warns that he could get impeached if Republicans lose the midterms. Venezuela relents to pressure from Washington. Trump says the Latin American nation will export up to $2 billion worth of crude oil to the U.S. Adds he wants interim President Rodriguez to give U.S. and private companies total access to Venezuela's oil industry. India's competition regulator seeks responses from 35 steel companies on allegations of cartelization after its probe flagged concerns. The matter pertains to the year 2021, when a group of Coimbatore builders moved the Madras High Court accusing 9 companies of forming cartels. RBI releases draft norms proposing higher dividend payout by Indian commercial banks, caps it at 75% of net profit for banks meeting eligibility criteria. Well, let's go straight to the big story at this hour. The first advance estimates for FY26 GDP growth. The numbers are out. Lata joins us now with the details. Pretty much in line with our poll. Lata, nominal growth, though, are lower than year-on-year expectations.
Well, yes, you hit the nail on the head. It's a tad lower than what our estimates said. Our poll threw up a real GDP growth of 7.5%. What the MOSPI is forecasting is a 7.4% growth. So not, very, very different. We must remember that the first half was 8%. Clearly, that was not expected to be repeated in the second half because the base is much higher. For the second half, also, exports had been front-loaded to the United States. Capex of the government was front-loaded in the first 6 months. So some anemia was always expected in the second half. 7.4 would give a number slightly less than 7 for the second half 2 quarters, especially for the fourth quarter. But as you say, the more important number is the nominal GDP number, which has been placed at 8%. Now, the nominal GDP number is important because based on the nominal GDP number, the next year's nominal GDP is taken and the percentage of fiscal deficit is calculated as a percentage of the nominal GDP. So that number is important. Now, the previous budget had estimated that this year's nominal GDP will grow at 10.1. Now the MOSPI is telling us it is only going to grow at 8%. So that makes it substantially lower. But the important point to note is that last year's GDP actually came in higher than what the budget had assumed. So even with 8%, we will reach about 356 lakh crore in terms of a nominal GDP, which is what the budget had assumed. So that 8% nominal GDP per se is not going to create a fiscal deficit problem. The problem it creates is that 8% is very low. Taxes grow at the pace of nominal GDP. Corporate earnings grow as per nominal GDP. So 8% is like a multi-decadal low for us if you don't count the COVID years. Not counting that, we have always produced a double-digit nominal GDP. Therefore, this comes as a bit of a setback. It's because of the very low deflator, very low inflation. The hope is that next year's GDP will come in a bit, towards the double digit, may come in at 10% because of higher inflation. That's the hope. So the key takeaway is the very low nominal GDP number and the assumption of the MOSPI that the second half is going to be slightly sub 7%. That's why you will get a 7.4% GDP for the full year. The lower numbers are primarily for the primary sector, that is agriculture, expected to come in at 3.1 versus last year's 4.6. So that brings in a reasonably big drop. The others, manufacturing actually is quite positive at 7% compared to last year's 4.5%. Likewise, the tertiary sector, especially the big sector, trade, hotels, transport and communication, very, very important from an employment point of view, is expected to grow fairly well at 7.5% compared to 6.1% last year. Finance is expected to do very well, finance, real estate, professional services at 9.9%, and public administration also expected to do very well at 9.9%. I'm still looking for the consumption and gross fixed capital formation. I'll just get to that in a minute. Okay, private final consumption is expected to grow by 7%, which is a tad lower. So looks like, according to the MOSPI, the GST-related consumption bump is not expected to continue that much into the second half. Their assumption of private final consumption is 7%, whereas it was about 7.4 in the first half. So clearly it is going to be sub 7% in the second half. And the 7% also compares with a higher 7.2 last year. Gross fixed capital formation is the one that really stands out as a very good performer. The expectation is that it will come in at 7.8%. So the country is running on investment more than it is running on consumption, which is a positive. Those are the key takeaways as of now. We will get more details shortly.
Yes, we will come back to you, Lata, with our experts. But many thanks for joining us with the first cut of the advance estimates. Let's bring you the market action. The Lal Street closing flat today with the Nifty holding on to the 26,100 mark. Mid-caps outperformed and the market breadth was in favour of advancing stocks. IT stocks lent some support. HDFC Bank auto stocks were lower today. The Nifty finally closing flat, 100-point cut there on the Sensex. And 100 points gone on the Nifty Bank. The Midcap index closing in positive territory. Jewellery stocks rose on the back of strong Q3 updates that came in from those companies. In the bullion market, gold and silver prices softening marginally amidst a wave of profit-taking following their recent rise. Both precious metals surged close to record highs earlier today as geopolitical tensions lifted safe haven demand. The market will now turn its attention to the US payroll data for insights into the Federal Reserve's interest rate policy. But the big global story, from exercising bragging rights to mocking transgender weightlifters to off-teleprompter rants, President Trump laid out the MAGA agenda during his 90-minute speech at the Republican annual conference last night. Speaking at the event, Trump said Indian Prime Minister Narendra Modi is not that happy with him because of the 50% tariffs imposed on India. He, however, added that India had reduced Russian oil imports substantially. Trump also claimed India had raised concerns over delays in receiving US military hardware and said that issue is being addressed. He said India ordered 68 Apache choppers and were waiting for 5 years for the deliveries. Trump also warned Republicans that if the party fails to win a majority in the November's midterm elections, he will get impeached. Trump also stressed on the importance of keeping control of the chamber, urging the grand old party to stay united. It was not all about diplomacy. In a lighter vein, President Trump mocked his French counterpart, Emmanuel Macron. Trump recounted how Macron initially resisted the US demands to raise prescription drug prices by 200%, but ultimately gave in under pressure. He also called himself the king of sales for selling more Boeings than any man on earth. Here's President Trump.
The Apache helicopter. I mean, I had India coming to me, sir, I've been waiting 5 years. We're changing it. We're changing it. India ordered 68 Apaches, and Prime Minister Modi came to see me. Sir, may I see you, please? Yes, I have a very good relationship with him. He's not that happy with me because, you know, they're paying a lot of tariffs now because they're not doing the oil, but they are. They've now reduced it very substantially, as you know, from Russia. You got to win the midterms, because if we don't win the midterms, it's just going to be, I mean, they'll find a reason to impeach me. I'll get impeached. We don't impeach them. You know why? Because they're meaner than we are. We should have impeached Joe Biden for 100 different things.
Well, that's President Trump there. Now, competition watchdog, the CCI, has probed steel giants for alleged cartelization. Sources tell us the Competition Commission has sought responses from steel companies over these concerns. Now, remember, the CCI opened this case after the Coimbatore Contractors Association moved the Tamil Nadu State Court in 2021, so this dates back a few years. The association alleged that steel companies had hiked prices by 55% during a 6-month period. The public prosecutor told the court that the issue was an antitrust matter. The judge then ordered the CCI to take appropriate action. Parikshit joins us now with more details. Parikshit, how many companies have been investigated and what are your sources telling you?
Well, at least 35 companies and entities, even top individuals, CEOs of some of the biggest steel companies in India have been under investigation since 2021, when the Madras High Court delivered its order asking the CCI to probe allegations of cartelization. The allegation was that these steel companies are getting together, acting as a cartel to artificially boost prices by restricting supplies of steel products to builders and consumers. There was a very detailed investigation, following which the Director General of the Investigation Department in the CCI has given a report that prima facie these companies and individuals are guilty of violating the CCI laws. They're guilty of cartelization and they've contravened CCI procedures. As a next step, the CCI has now asked all these companies for their replies. Copies of the report, investigation report, has gone to all these companies and individuals. They will now have to reply. The CCI will hold a hearing where they will give a hearing to all parties and then give an order first to conclude whether all the companies are in contravention of antitrust rules. And secondly, in a subsequent hearing, they will pass the order on penalties. There could be two kinds of penalties here. One would be against the companies itself, which could be to the extent of 10% of the total turnover of these companies. And because Section 48 of the CCI Act has been put into effect, therefore, the CEOs, the individuals, will also be liable to the extent of 10% of their total annual income. So this could be a big setback to the steel sector, to the companies and the individuals involved, subject to what the ruling is. What we can tell our viewers that in the past, in at least 90 to 95% of cases, this is what experts have told us, the CCI has always followed the conclusion, the prima facie conclusions of the DG investigation. But we're possibly looking at challenges to the CCI ruling. This could go to the High Court, even to the level of Supreme Court. So we're looking at a protracted battle over it.
Yes, Parikshit, many thanks for joining us. Now, the RBI has released draft norms proposing higher dividend payout by Indian commercial banks, capping it at 75% of net profit for banks meeting eligibility criteria. The draft rule also says domestic banks must report positive adjusted net profit for the relevant period. Ritu standing by with what the RBI has proposed. Ritu.
Well, the RBI has proposed to cap the dividend payout by banks at 75% of their net profit, subject to them meeting the eligibility conditions. And this is for all commercial banks, including State Bank of India and also the foreign banks that operate in India through their branches. For regional rural banks and local area banks, the cap is slightly higher at 80%. Now, earlier, the dividend payout by banks was effectively capped at 40%. So this is an easing of that cap, so to speak, but it comes with certain riders. So the 75% cap is tighter for banks that have a lower tier 1 ratio, but liberal for banks with a higher tier 1 capital. Extraordinary or one-off profits also cannot be used to boost dividends. And RBI has also clearly defined that the adjusted PAT that you will use to calculate the dividend payout is going to be the profit of the year minus the net NPAs as of the 31st of March. And when RBI says dividend, it means the equity share dividends, and that includes the interim dividends but excludes the perpetual non-cumulative preference shares. Now, boards are also being asked to look beyond just profits when they're deciding on this. They have to factor in NPA divergences, if any, the auditor's remarks, the capital buffers, and of course, the long-term growth plans before they approve any dividend. For foreign bank branches, there's some relief because if they meet the eligibility norms, they can remit the net profits from their Indian operations without any prior RBI approval. But, if there's any excess remittance that is found after the audit, it'll have to be returned by the head office. Finally, the eligibility is going to be important because the capital must stay above the regulatory minimum even after giving out the dividend, or you cannot, dole it out. Banks must also, of course, be reporting positive profits, and there should be no restrictions from RBI or any other authority. So net, more headroom for dividend payout depending on the capital buffers of the banks. But this is still a draft paper. Comments have been invited by early Feb, and the directions will only become effective from the new financial year, that is FY27.
Ritu, many thanks. But up next, government signals a major Capex thrust ahead of the union budget. That and more when we return. With less than a month to go for the union budget, the government has announced the second pipeline of 852 infrastructure projects. Now, these projects will be developed under the public-private partnership model with a combined cost of over 17 lakh crore rupees. Sapna joins us now with more details. Take us through the government's plan and pipeline.
Absolutely. In fact, this probably is a clear signal coming just ahead of the union budget that the Capex push on the part of the centre is expected to continue. Speaking about this pipeline, well, basically around, over 800 odd projects is what have been lined up by the central government mainly, but of course in consultation with the state government. So you have an estimate of around 17 odd lakh crore worth of total project cost over the next 3 odd years, starting from FY26 itself, out of which the centre's share is going to be around 13 lakh odd crore. Having said that, if you look at the top spending ministries, basically, or rather the ministries which will be calling for these kind of investments, of course, the usual ones, railways, ports and shipping, power to an extent, yes, a bit of a surprise there, and of course, roads and highways. Primarily, these are the ministries which will be calling in for these PPPs. So basically, the plan here is, probably the government, the central ministries putting around 20-25 odd %. And also the main, issue here is to attract the private sector investment. So probably around 20-25 odd % coming in from the private sector, players, and the remaining will be done through borrowing by setting up SPVs. Almost all of these projects are going to be done by central sponsoring authorities, central government sponsoring authorities, the central government Capex that we're talking about. Having said that, experts are also of the opinion that, of course, this is being done to attract private sector investment. Around 33 odd % of the GDP is where it seems to be stuck at over the last 2 to 3 odd years. So that push by the central government at least is continuing very clearly. Also, not just that, but also giving the signal about Capex push. So if you look at the overall budget this year, around 31 odd % is going towards total capital expenditure, both by the central government and state governments put together. Of course, centre has the lion's share around 11.21 lakh crore. And let's not be surprised if this number goes up in the coming union budget, because I think, and rather this is what the view of the experts also is, that Capex is going to be a big push for union budget FY27 as well as it has been in the last 2 odd years. So all that talk about, absorptive capacity and, central government not having finances to do the needful, maybe a lakh odd crore or something, but easily those numbers are going to be absorbed by the budget, as is also visible in the nominal GDP numbers which have just been come out by MOSPI.
All right, Sapna, many thanks for joining us. The Capex push to continue, and of course, we'll be tracking the budget action. The Delhi High Court has stayed the centre's direction, asking Vedanta to hand over the Cambay Basin Offshore Block 2 to ONGC. The court has ordered the centre and Vedanta to maintain status quo on the offshore oil block. The High Court said the company's arguments against the rejection of extension of the production sharing contract needs to be considered. Remember, Vedanta was awarded the production sharing contract in 1998 and was due to expire in 2023. President Trump has said that the Venezuelan interim government will turn over 30 million to 50 million barrels of oil to the U.S. He said the oil would be sold at market value and the proceeds controlled by the U.S. in a post on social media. Trump has claimed that the proceeds will be used to benefit the people of Venezuela and the U.S. Crude prices fell following the announcement on fears of excessive supply amidst tepid demand. Meanwhile, External Affairs Minister S. Jaishankar has expressed India's concern over the developments in Venezuela, urging all parties to prioritize the well-being and safety of the Venezuelan people. He also called for dialogue to resolve the crisis peacefully.
Concerned at the developments, but we would really urge all the parties involved to now sit down and come to a position which is in the interest of the well-being and the safety of the people of Venezuela.
Well, that is the External Affairs Minister. The White House has said that using the U.S. Army to take Greenland is always an option. In a statement, the White House said that President Trump and his advisors are discussing a range of options to acquire the Arctic island for national security purposes. This comes after European leaders issued a joint statement rallying behind Denmark, which has been pushing back against Trump's ambitions. Elon Musk's XAI has raised $20 billion in fundraising. This could lift the company's valuation beyond $230 billion. The investors include NVIDIA and Cisco Investment, who work with XAI as vendors and strategic partners. And this comes as the company faces regulatory probes in Europe, India and Malaysia after its Grok chatbot generalized, sexualized and non-consensual images of children and women. President Putin has described his country's invasion of Ukraine as a holy mission to defend Russia in an address marking Orthodox Christmas. This as Ukraine's allies issued a joint declaration that any settlement to end Russia's war will have to be backed by robust security guarantees. Ukrainian President Zelensky, French President Macron and UK's Prime Minister Keir Starmer also signed a separate agreement declaring their intent to deploy forces to support Kyiv's defense if a ceasefire is agreed on.
We discussed these issues in detail today, and so I can say that following a ceasefire, the UK and France will establish military hubs across Ukraine and build protected facilities for weapons and military equipment to support Ukraine's defensive needs. And with our coalition partners, we've also agreed significant further steps.
Well, that UK's Prime Minister Keir Starmer on the possibility of peace in Ukraine and what allies, including the UK and France, are likely to do. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Scientific skincare brand B Clinical raises 6 crore rupees in a seed funding round led by V3 Ventures with participation from Kunal Behel and Rohit Bansal of Titan Capital. Funds will be used to boost R&D capabilities to enhance in-house formulations, conduct clinical testing and develop targeted solutions for aging concerns. Beauty brand Antinorm raises 28 crore rupees in a seed funding round led by Fireside Ventures. Existing investors V3 Ventures and Rucum Capital reinvest in the company. Funds will accelerate platform expansion, talent hiring and working capital. Renting platform Flint raises 21 crore rupees in a pre-Series A round led by Incubate Fund Asia. Funding to comprise 17 crore rupees in equity and 4 crore rupees in debt. Funds will be used to scale the company's team and expand footprint beyond Bengaluru. Bengaluru-based voice AI startup Arrowhead raises 27 crore rupees in its seed funding round led by VC firm Stellaris Venture Partners. Funding round also sees participation from Cred's founder Kunal Shah. Capital to be used for hiring and technology development. Elon Musk's XAI bags $20 billion in a funding round with the potential to lift the company's valuation to beyond $230 billion. Lead investors include NVIDIA and Cisco Investment. Digital healthcare platform Practo expands its footprint in the American market after a strong debut in UAE, launches its care navigation platform in the US. Since entering the US market, Practo has listed more than 2 lakh doctors on its platform, with its annual GMV run rate crossing over $75 million. Well, those were the headlines we've been tracking for you this evening. On What's Brewing Today, ID Fresh Food, the clean label foods brand and category creator in branded idli dosa batter and ready-to-cook Indian foods, has secured a strategic investment from Apex Funds, advised by global private equity advisory firm Apex Partners. The deal marks Apex's first consumer brand investment in India, with the firm acquiring a significant minority stake as ID scales its presence across India and the Gulf while continuing to deliver profitable growth. What does this partnership mean for ID's next phase of expansion, innovation, and its long-term IPO ambitions? Joining me now is PC Mustafa, the chairman and global CEO of ID Fresh Food. PC, welcome back to Startup Street. ID Fresh, like I mentioned, has secured a strategic investment from Apex, with Premji Invest and TPG Newquest partially exiting but staying invested. Now, Apex is taking a significant minority stake. Can you give us the number? And as I mentioned, this is Apex's first consumer brand investment in India. How hands-on will they be in decisions around distribution, branding, and category building? How transformational is this partnership for a business built on daily freshness?
Thank you, Shruti, for inviting me here. Since the numbers are highly confidential, I'll probably pass that question.
Okay.
Coming to the strategic partnership with Apex, it's a defining moment for ID. It's another turning point in the history of ID. We had excellent partners, and they continue to be on our cap table going forward as well. They want to be part of our growth journey going forward. Apex decided to invest their first consumer brand in ID.
Yes.
Because they believe in the story of freshness, story of a clean label food. And we were able to lead that effort in India. So there's an opportunity for us to take this in international market as well. And that's the reason they decided to partner with us.
And what does Apex really bring to the table, PC?
I think a strong network in international business. And they're, especially in their consumer brands across the globe. And maybe some M&A opportunities as well.
All right.
Growth perspective.
We'll delve deeper into that. But ID today commands a 50 to 60% share in its core categories and operates across 50 plus cities. What has worked consistently in building scale while staying profitable in a low shelf life fresh food business? And how do you plan to continue outpacing competition as the clean label space gets more crowded?
I think we've stayed true to a promise from day one, and that's a strength. Many things have changed in ID, but one thing has never changed, which is a strong commitment to the value system. We will never take shortcuts. We will never add chemicals and preservatives in the food. We will never compromise on values. And that's a brand ID.
Okay.
That's the only reason that we have grown to this level. Going forward, we will continue to do the same thing that we have done so far, right? Which is expanding to newer markets, looking at newer products, adjacent categories, as well as category creation exercise. To answer your question with respect to the competition,
yes,
I think it all depends on how you look at the competition. When you have a 60%, 70% category shareholder, looking at competition from other local brands is not the right approach. You got to create a category. You got to expand the pie. And we don't look at the local competition as a competitor, because all of them put together will probably have around 30-35% market share.
Okay.
We look at the category, the homemade batter category as the opportunity. In fact, I keep telling my team that never look at other packaged batter as a category, a competition for you. Look at the grinders at home as the competition.
All right. On that note, your daily direct-to-retailer cold chain model is often cited as your moat. How difficult is this to replicate, and does it still give you an edge at a larger scale? And you mentioned M&A. Will we see ID do that this year?
Yes. So many people think that ID is a batter company, but we are probably one of the best fresh food distributors in the world. We know how to make fresh food every day, go to every store every day with fresh products, replenish stock on a daily basis, and make money out of it. And that is not that easy to replicate. Of course, anybody can create. There is nothing called a moat as it is. But then, we have created a network which will help us, scale this business to the next level. By the time somebody copies it, we will have to upgrade ourselves.
Innovation clearly has been central to ID's story, from batters to flatbreads to accompaniments. How do you institutionalize innovation without diluting the core promise of fresh and honest food? And which adjacent categories excite you the most right now? And where will ID not play, even if the opportunity looks big?
Yeah, there are a lot of adjacent categories that we looked at. Chutney, for example, is a large category for us. We have launched chutney around a year ago, and it is doing very well already. Then we have sambar we just launched, which will do very well according to me. We will actually look at all the categories where there is a clean label take on it. If there is a fresh clean label take on it, that's a category that we will look at. One thing that we will never do is to get into products with chemicals and preservatives. That is not ID.
Okay.
Because at ID, we believe growth at any cost is not the philosophy of ID. Growth at any cost is the philosophy of a cancer cell.
All right. Okay. You operate across India and the Gulf, PC. What kind of growth are you seeing in international markets? And can you walk us through your revenue and growth targets for the year ahead?
Yeah, so we are planning to close 1,000 crore plus next year. 1,100 is what we're looking at in the total market, in the global market, with close to 20% EBITDA is the broad guideline we had agreed with internally. Let's see where we reach. Maybe even with some dilution in EBITDA, we should be still able to deliver the overall numbers. Our plan is to do an IPO next year. By delivering the FY21 numbers, we plan to do IPO in October 27.
Okay. So October 27 is when you're looking at an IPO.
Yes.
So how does the strategic investment from Apex align with your journey towards this public listing? Is this because of Apex coming on board?
No, this was the plan earlier as well. My existing shareholders itself were a great asset on the cap table. Now, Apex, a global partner coming in, will really help us in our IPO journey. It's a great brand to be on the cap table. We had a lot of interest this time when we were looking for a funding. This is mostly secondary funding, as you know. But then, we decided to go with Apex because they will play a key role in our IPO journey.
All right, one final question, if you could quickly answer that. You've grown 25% annually with double-digit EBITDA margins. Where does the next leg of growth, PC, come from? Will it be newer cities with newer products, or will it be an increase in consumption per household?
I wish more people start eating idli every day so that consumption becomes easier thing. But if I look at, I think I would look at 4 or 5 things. One, adjacent categories like sambar, chutney, those categories that we've really built. Category conversion from a homemade batter to ready-made batter, or a homemade parathas to ready-made paratha, and homemade chapati to ready-made chapati is what we look at. Third would be expansion to newer markets. When I say newer markets, today we are there in around 200 cities in India. We plan to add another 100 cities this year, right? So that's the geographical expansion we look at. Next one would be, international expansion with Capex coming on board. That would really help us because they have a strong connect in the global market. That will help us in our international expansion journey. And the fifth one would be looking at some inorganic opportunities like M&A, as I discussed earlier.
Okay, all right. We'll surely keep a track of all of this on Startup Street. PC Mustafa, many thanks for joining us today on Startup Street. Appreciate your time.
Thank you. God bless you all. Jai Hind.
All right. Moving on, India's gig economy is under renewed scrutiny with founders, policymakers and workers locked in a debate over pay, protections and dignity of work. But beyond delivery apps and ride-hailing platforms lies a much larger workforce powering India's economy. Today, we turn the spotlight on that reality. Work India, a blue and grey collar job platform, has raised 97 crore rupees in a Series B round. Avishkar Capital led the round with 75 crore rupees, while existing investor B Next Capital invested 22 crore rupees. To talk to us about the fundraise, the future of work, worker trust and livelihoods at scale, joining me now is Nilesh Dungarwal, the co-founder and CEO of Work India. Nilesh, welcome to Startup Street. Now, before we get to Work India, India's gig economy is facing intense scrutiny. From where you sit, is the debate too narrowly focused on delivery and ride-hailing apps? Are we missing the larger story of India's blue and grey collar workforce? What is your viewpoint on the whole debate?
Thank you, Shruti, for having me on the show. So it is very narrowly focused at this moment. It is much broader. India has 23.7 crore blue-collar workers, and we are just talking about a very small fraction of people right now, right? And according to us, the core issues are like fraud jobs, right, which people get. So if you just move out and talk to like 10 people in this blue-collar workforce, you will find like every one of them would have basically faced this fraudulent job issue, right? People don't get salaries on time, right? People don't get salaries on time. People are not getting even salaries once they work for 30 days in the month, right? So those are the core issues that still persist, and it's our mission to basically work on that and solve it.
Sure.
Yeah.
Nilesh, if India gets the gig worker framework wrong, what's the biggest risk that we'll see? And as the gig and blue collar debate intensifies, what is the one policy change you would like to see that could immediately improve the lives of India's workers?
See, the words like policy, framework, right, are basically more for like you and me who are sitting in a AC room and working, right? What we essentially feel is that getting transparent onto the money that they will be making, right? These people are working for money, working for dignity, right? And if you are able to make that transparent, for example, when there's any gig company want to scale up, they would basically give very high incentives or very high salaries to these gig workers, right? And when the profitability comes in, it becomes they make it very complicated, the way they will be getting money, because these are not like fixed jobs. These are like per delivery jobs or per ride jobs, right? So how can we bring transparency onto that?
Okay.
I think that's very important. Second point is, a lot of salaries are still given in cash. So one of the policy change, if we can enable, is can all the salaries be given digitally?
Sure.
Because once that is done, all of these people will start getting access to loans, at a lower interest rate versus now they get it like 3-4% outside, right? So these are very small things that we need to work on to basically make sure that it does the job.
All right, coming to Work India, which sits right at the heart of this workforce. You've just raised 97 crore rupees in a Series B round led by Avishkar Capital. Now, even as the company is profitable, so what was the objective of this raise and where will the capital be deployed?
Our purpose is to provide meaningful livelihood to 23.7 crore blue collar of India. And we have raised this money not for survival, but to scale the impact, right? For example, in last 12 months, 1 crore candidates have used Work India for hiring, right? In last 12 months, more than 10 lakh companies have come to our platform and looked for jobs, provided jobs to these candidates. We employ close to 3 lakh candidates every month onto our platform. Now we want to get this number to 23.7 crore blue collar workers and 73 lakh companies, right, which are there onto this in India, right? So that's the whole objective why we've raised this money for.
Okay, you operate across 50+ job categories, Nilesh, from delivery to warehouse jobs. Which categories are seeing the fastest growth right now and what's driving that demand?
So because of the quick commerce, we're already seeing like a 70% year-on-year growth in delivery jobs. I think that's very paramount, right? We're also seeing 42% growth in domestic work that we are seeing. We have seen 40%, because it's Make in India campaign, we have seen 40% growth in manufacturing. So these are the top 3 categories where we see immense growth today. Whereas other categories have also grown by 25-30%, but these are top 3 categories which really outshines the entire.
Sure. You know, MSMEs are central to your platform, Nilesh. How does technology help eliminate fraud and improve trust for both workers and small businesses? Also, with this fresh capital, what are the growth targets that you've set for yourself for the future in terms of scale, revenue, or livelihoods transformed?
So, first, like talking about fraud, right? So we have a fraudulent job engine which just makes sure that no fraud jobs stay on Work India, right? So today, if you see, there are no fraud jobs because of our engine, right? It's a 3-step process. Second, we use a lot of rules below that fraud engine to make sure that the job doesn't pass through. And third, we also have AI bots that we have recently implemented to make sure that it becomes very seamless to remove these fraud jobs onto our platform.
Okay.
So, and we have like close to 9.8 million data points across the country. In fact, we would have the highest number of fraud jobs that have come to our platform and we have not allowed them to come listed on the platform, right? And whereas it comes to the growth targets, again, our growth target is very, very simple. How can we quickly reach to 23.7 crore blue collar of India to give them jobs transparently, 100% genuine, and also provide dignity to them.
Sure.
That's our whole objective.
All right. One final question, and if you could answer that quickly. Do you see Work India evolving from a recruitment platform into a broader ecosystem for workers, you know, spanning skilling, credit, or social security?
Yes. See, our purpose is to provide meaningful livelihoods, and jobs is just one part of it. Because when we did our research, we understood that jobs is the first essential thing that the candidate requires, right? And post that, everything comes like insurance, loans, and you would soon see us moving in that direction as well. Once we get to a significant scale with providing jobs.
All right. On that note, it's time for me to wrap up our conversation. Nilesh, many thanks for joining us on Startup Street today and wish you the very best with all your growth plans.
Thank you. Thank you, Shruti.
With that, it's time for us to head into a short break. But coming up, two-wheeler startup Simple Energy launches its Gen 2 scooter lineup. A special report when we return. Welcome back to Startup Street. Bengaluru-based electric two-wheeler firm Simple Energy has unveiled its Gen 2 scooter lineup. Prices begin at 1.39 lakh rupees. The lineup is headlined by the Simple Ultra, which the company claims is the first scooter offering a range of up to 400 kilometers on a single charge. Speaking to CNBC-TV18's Meghna Sen at the launch event in Bengaluru, founder and CEO Suhas Rajkumar said the company is confident on the pricing with no need for early buyer discounts. He also expects the firm to turn EBITDA positive in 2 quarters. Listen in.
So there's no concept of early buyers as of today for us because everyone is purchased for the older generation. This generation goes on sales from today, and I think on the price side, I think we have very well priced it. Given how the competitors are today, I think we have done a lot of work on our BOM cost and everything else. At 1.39 starting introductory price, I think that's very well justified and placed for Gen 2. I think you've seen all the features and everything that we have added in this. I think we are fairly priced there, and I think consumers don't mind purchasing a scooter which offers safety features, and apart from everything else, the range and the tech that goes into the scooters.
Talking about your order book, how does your order book look right now? And as we're heading into the next financial year, so you compete with already established players like Ola Electric, Ather Energy. So what is the market share growth that you're targeting for?
I think over the last year we have grown about 300% in revenue. We have grown from 10 stores to approx about, it was mentioned 71, we are 80 almost, 150 by March. So I think as a market share, we are growing rapidly. We should be about 0.5, 0.6% today. By March, it should be about 1.5%. But I don't think there's a quantifiable order book because now we're in sales, so we don't have pre-booking systems with us. It's all you go to the store, buy it from day one, right? So we have launched it today, the Ultra or be it any other model. It's available right on the menu. You just have to go there, order it, and you can enjoy the ride.
Got that. So are there any plans to venture into electric motorcycles? And if yes, will that be a mass market product?
No, not really. I think we are very well, stationed ourselves in EV two-wheelers of scooters. Bike market, there's a lot of questions that come in when we make a business model for it. Even on the innovation scale, we don't see much of things moving there. Of course, we keep our doors open, but I don't know if we have any plans in the near future. As of now, no. And scooter market is something that is growing, and we always want to hit the markets which consumers really buy and matter to, right? And I think we are very well placed here. And I think next should be four-wheelers rather than two-wheelers.
So what are Simple Energy's plans for international expansion? Like outside India, are you targeting any specific geography?
Maybe next 4 to 5 quarters, but not now.
So any like country, any specific countries?
It'll be for South Asian countries or Southeast. I think apart from that, we don't see anything else in our immediate plans. But today we are fine with this.
So moving on to domestic manufacturing, you are about to set up, looking to set up a manufacturing plant. So any like progress on that?
We have a manufacturing plant in Hosur, which is 2 lakh square feet, which is one of the largest EV manufacturing hubs today. And apart from that, as we grow, maybe in a few quarters, we shall look at a new plant. I think our chief guest today also mentioned the same plans that we will be expanding soon. I think this will, come into play maybe 2-3 quarters down the line, not now.
This is a sort of a capital-intensive business, right? So looking ahead, when do you expect Simple Energy to turn EBITDA positive?
We're looking at about maybe 2 quarters from here, yeah.
So you have also indicated IPO plans going ahead. So any updated timeline on that? And if yes, how much are you planning, targeting to raise, and also where will you deploy the IPO proceeds?
I think about 3,000 crores is what we initially mentioned, and we'll stick to that. But on the timelines, we're looking at 27, 28. 27 is our target, maybe a quarter here and there. But I think we are well versed with the market conditions, and our plan is on the track. And I think as we are progressing, we are going ahead strongly.
Well, shifting focus from electric two-wheelers to electric toothbrushes. At CES 2026, Y-Brush introduced a toothbrush that can detect more than 300 health conditions, including early-stage diabetes, by analyzing the user's breath. Aishwarya Anand has more on this AI-enabled toothbrush. Take a look.
Brushing isn't about dental hygiene anymore. It is also about health monitoring. Now, Halo has built-in sensors called Smart Nose. It detects biomarkers in your breath, basically chemical signals your body gives off. Now, these biomarkers can be early indicators of issues such as gum disease, metabolic stress, or conditions linked to diabetes and liver health. Well, your mouth is one of the fastest places where health changes show up. That's why researchers increasingly see oral health as window into overall health. Brush is trying to turn a daily habit into passive health. No extra steps required. Now they're also showcasing Duo Brush connects, this connects via Wi-Fi and Bluetooth and shares brushing data securely with dentists and insurers. Now in the US, this includes Medicare and Medicaid, meaning oral care data can now be part of preventive healthcare. Brush is now part of Biotech Dental, a European dental tech group and partner of Henry Schein, the world's largest dental distributor. That's why this launch is happening here at CES, where consumer tech meets healthcare and AI. Over 90% of adults say they know oral health impacts overall health. Now the tech world is now finally asking, can your toothbrush help spot problems early? From faster brushing to AI-powered health signals, this is oral care going digital. And CES 2026 is where it's making that case.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Hello and welcome to our special broadcast. I'm Timsi Jaipuria. With less than a month to go for the union budget, corporate India and tax experts have laid out its wish list. The industry has called for simplification, more relief for the middle class, and reduction in criminal provisions. Remember, last year's budget focused on relaxing tax slabs under the new tax regime. The finance minister also announced tax exemptions for those earning up to 12 lakh rupees per annum. So what can the industry expect this year? We are now joined by Charanjot Singh Nanda, president of the Institute of Chartered Accountants, Amit Maheshwari, tax partner, AKM Global. Also with us, Akhilesh Ranjan, former member at Central Board of Direct Taxes. Gentlemen, thank you for joining us on this program. Let me come straight to Mr. Nanda first. As President ICAI, I'm sure you must have submitted your suggestions to the government as to what can be done in this upcoming budget. What tops your wish list when it comes to especially the middle class, the corporates, because that has been the focus of the government?
Madam, it is customary for the Institute of Chartered Accountants of India to present a pre-budget memorandum to the Finance Minister, taking into consideration certain issues. So 2 issues which have been making a great mark. First is joint taxation system of married couples. We have asked for that aligning both the exemption schemes. You are aware that there is a tendency to transfer the income or asset to a non-earning spouse. So we want a straightforward system whereby we have said that the standard deduction can be doubled from 75,000 to 1,50,000. The exemption limit basic of 4 lakh can be 8 lakhs. And then the slabs can also be accordingly taken care of. More so, we have requested them that the surcharge, which is above 50 lakhs, can be increased above 1.5 lakh. It is not double because earlier the proposal was that it will be increased from 50 lakh to 75 lakhs. So taking that into account, we have proposed that if we could ultimately ask for the surcharge above 1.5 crore rupees. So this will equate the entire system. You are aware that a lady who is in home, who's a home lady, she also works and the income of the husband is used for the homely purposes. So parity and equality, it would be better if the joint taxation system of married couples be made. The non-earning...
What about corporates?
Madam, about corporates is separate. We have made a suggestion. We have made a suggestion for tax-neutral business reorganization in LLPs. We are asking that LLPs be made, but the tax rate of companies is 30%, while it is for corporates it is 22%. So we are calling for a special tax regime in companies under section 115BAA. The tax rate is 22%. So we propose for companies, for LLPs also, it should be 22%. Secondly, a very important thing, with respect to amalgamation, when transfer of capital asset is made in corporates, there is no capital gain tax while it exists in LLPs. So if we want LLPs to come and have the ease of doing business, we have to very, very clearly indicate that there shall be no capital gain tax if a capital asset is transferred.
Coming to Mr. Ranjan now, how do you see these suggestions? Do you think there is enough merit in these suggestions, the 2 suggestions that Mr. Nanda has said, that which tops the list when it comes to the personal income tax and especially for the middle class, and secondly for the corporates? Do you think government can consider them? Does the government really have the room to actually accommodate, plus the surcharge, what he has been suggesting, that it should be hiked, the limit of levying a surcharge should be beyond 50 lakhs, it should be 1.5 crores. Do you think government has that much of room to accommodate all these suggestions?
Yes, thank you, Timsi, and thank you for having me here. There are countries which do follow the family system, where a married couple can return their income together. And I'm not so sure whether the government here will think about that. Firstly, what do we hope to achieve? Mr. Nanda has mentioning maybe double the exemption limits, have more relief for the family. I think the government has done quite a bit on the personal income tax rates. Last year that you just mentioned, and there was a whole lot of relief, the 30% slab kicking in only at 24 lakhs, which is a huge thing. 12 lakhs being the minimum threshold. I don't think that the government really thinks that the personal income tax is heavy for the individual. So that's one reason why I don't think that they will want to consider any such change. Of course, we must remember that it should not make a change just for the sake of making a change. The idea is to what is to be rectified, and that's the thing to be thought about. So
So what is to be rectified according to you?
Well, actually, it's nothing. When I say rectified, I mean what next? Now, we have already done a lot in personal income tax and in corporate tax. A lot of changes have been made. What India now needs is essentially three things, according to me. One, stability and predictability of the tax system. There should not be frequent annual changes. We have seen changes in the personal income tax structure for each of the last 3 years. People are now so confused as to know which rate really applies. I think it is very important to have a stable tax system, first of all. Secondly, we need to have simplification. Now, simplification doesn't mean rewriting the Income Tax Act in simple language. That's only making it easier to read. Simplification means simplifying the tax structure. So, for example, why do we have things like a new regime and an old regime for personal income tax? Why don't we have just one regime and have calibrated and selected exemptions and incentives out there? Thirdly, we need to build trust between the government and the taxpayers. That's the most important step that the government has to see now. And that can be brought about by things like decriminalizing the tax defaults, by introducing measures of accountability, by making people aware that, look, the government is actually appreciating your tax contribution. So those are the three main areas, according to me, which need to be addressed. There's of course things like disputes and tax certainty, which is a part of trust.
I'll come to the dispute part a bit later. Coming to Amit Maheshwari, how do you see these suggestions, and especially when it comes to the corporate side, because you handle a lot of corporate clients also, and what's on your wish list? Do you think can the government consider some more cuts?
Yeah, so good evening, Timsi. Good evening to the channel viewers. So I just wanted to highlight a few points which probably are very practical, and I would tend to agree with Mr. Nanda. The Institute has made some very valid suggestions. So this joint married couple taxation, which is treated as one wholesome unit, I think it has a lot of merit. There are a couple of advantages. So one biggest thing is that in terms of succession planning, most of your wealth advisors tend to tell you that please have assets in joint names, and that is something which I think everyone should follow. And typically we have seen clubbing of income provisions getting triggered. We see it in a lot of property transactions, though that is outside the clubbing provisions, but we see that the properties are in joint names. But even for financial instruments, that is required. So that is one biggest advantage, which makes inheritance and succession plannings a lot simpler. The other thing is that you have cases where one individual, even though they might be earning, they might have losses, and the other, the husband might have profits, and the wife might have losses. So those can be clubbed, and a lot of tax optimization and efficiency can be brought in. I think the overarching principle is that you should try to avoid unnecessary planning mechanisms or these complexities where the unit can be treated as a whole. And the same thing applies even for, there was a demand of the industry for group tax consolidation, where you have different entities which can be consolidated and a group tax return could be filed. So I think just akin to that concept, I think this concept has merit. Obviously, whether that will the government would agree to that or not, but I think it is a very valid suggestion. And yes, obviously, consequently, the slab rates, exemption limits all need to be increased to do that. But I think it can be as an optional regime. It's not necessary that you impose it on everyone. It can be an optional regime. But I would probably agree with Mr. Nanda and the Institute of Chartered Accountants, which has it's a pretty valid suggestion. On the corporate side, and I think on the individual side,
on the corporate side.
Yeah, okay. So on the corporate side, I think like Mr. Ranjan said, I think that's definitely there, that the need of the hour is to build more trust. And the government has certainly done its bit. And there's few changes which have come in, which might be very progressive. And the new Income Tax Act, even though it does not have very fundamental changes, but they have tried to simplify the act. So we believe that the LLP tax neutrality is definitely, the reorganization is definitely required. Like Mr. Nanda said, there are a lot of provisions under the Income Tax Act wherein the LLPs are not treated at par with the Companies Act. So they have tried to give more and more benefits to the companies, like, for example, startups, when they carry forward their losses under erstwhile Section 79, that has not been extended to LLPs. You don't have the presumptive taxation. So, I mean, there are certain things which probably, apart from even the tax rate, where they need to bring parity and make LLPs more lucrative, because it is an excellent vehicle. Right now, especially for foreign investors, it does not work because the profits of LLPs tend to be exempt, and they are not able to get a credit which they are able to get when it is a company dividend. So I think there is definitely merit in those suggestions as well. And yeah,
I'll stop you, Amit, over there. Time for a short break, but don't go anywhere. The discussion continues on the other side. Stay tuned, especially when it comes to the dispute resolution mechanism, which has been much awaited. And as both Charanjot Singh Nanda and Amit were saying on LLPs, we'll be back shortly. Welcome back. You are watching our special broadcast. We still have with us Charanjot Singh Nanda, the president of the Institute of Chartered Accountants, Amit Maheshwari, tax partner at AKM Global, and Akhilesh Ranjan, former member at Central Board of Direct Taxes. Gentlemen, thank you for staying with us on this program. As we say, ye dil always mange more cuts, and that's what they are looking for be it for corporates or for the middle class. Mr. Ranjan, do you still think, as you said, that a lot has been done on the personal income tax side? We saw the government going the extra mile to make the new regime even more lucrative. Do you think that when it comes to the corporate side, when it comes to the points that both the CAs were making, that LLPs are not treated equally, corporates get a much better rate to file their returns. Do you think there is still merit on that side? And also, on the dispute resolution, an ask which has been there pending for quite some time now, that almost every industry association has been talking about, that there needs to be a more robust and a better dispute resolution mechanism that needs to be seen into the picture. We've seen in the past few dispute resolution schemes, but they did not actually excite the corporate sector to end the legacy disputes, which helps both the governments and the industry.
Right, that's right. So, well, it's true that even after carrying out a number of reforms on the corporate tax side, there are still certain areas, certain anomalies which need to be rectified or clarified. I think the things like the treatment of LLPs is one thing. Of course, an LLP is a partnership ultimately, and in Indian law treats partnerships very differently from corporate entities. So while there is some merit in saying that we have created something called a limited liability partnership, which should have more of corporate tax features, I think there is also a need to ensure that there is a distinction between the two types of entities. Corporate entity is a juridical entity and holding property in its own right. So, but then yes, there is merit in trying to align these systems. Similarly, on things like demergers, there are some gray areas, some areas which need to be smoothed out. So there are these areas in corporate tax which need to be addressed, and I think these issues are all known to the government, and let's hope it's a matter of time that they come up with clarifications. On the dispute resolution, now that's a big one.
Yes.
That's, as you said very rightly. Every industry chamber is talking about it. Every corporate is talking about it, because people are quite really fed up of the amount of litigation out here and the years it takes, the period it takes to resolve an issue. So, and the government has also been trying. There have been so many dispute resolution schemes in the recent past. I think it's high time now that the government shifted its focus from dispute resolution to dispute prevention. That's the theme that I think is catching on globally. There are already systems in place in many countries where one can resolve or come to an understanding on a tax dispute before it reaches the courts. I think India needs to think about a proper system of prevention of disputes. We have mechanisms like the Advanced Pricing Agreement (APA), which is doing extremely well. All corporates are vying to or trying to get.
Still, I'll pause you there, because still there's a hefty amount that is logged when it comes to both the government's due or the benefit that the industry can get in the dispute mechanism that is there at CIT appeal, at various levels, and the amount is so big that every year it just keep on accruing with interest and penalty, which no one likes, be it the government or the industry, be it the taxpayer or the taxman. So there has to be a solution to it, which, as you rightly said, that these matters are before the government and it is very well known to the government. So what is holding the government back from coming up with the actual new revised, say, earlier we saw Vivad Se Vishwas. It was a scheme which did decent, to be precise. How do you think can this be reshaped and given it as a boost, be it to the tax collections or to the taxpayers?
Now, that's a very difficult question, and I'm sure neither anyone in the government nor anyone here would be able to give a good answer as to what sort of scheme should the government come out with. We have had the Kar Vivad Samadhan scheme, we have had the dispute resolution scheme of 2016, we have had the Vivad Se Vishwas scheme. All these schemes have made a dent. They have resolved a certain number of disputes. They have brought in some revenue for the government. But you know, the problem really is that the tax law is always a law which gives rise to disputes. Unless we can control the generation of disputes, there is not much hope of trying to address it only by thinking of resolution. The resolution, of course, we can have more and more schemes, but you know, there is a limit to what sort of schemes one can have. I mean, what can one expect the government to say? That all right, we will not go against the ruling of any court. I mean, that they already said that the monetary limits have been enhanced to a very high level now. You don't go to the Supreme Court unless there is a 5 crore tax effect out there.
Yes,
That's
yes, yes.
a huge thing.
So
the
there are limitations, as you are saying.
So the government has done its bit and said that, okay, we will not appeal, we will not do litigation. But then the law is that the taxpayer also cannot stop from carrying out litigation. So I think we have to somehow...
Coming to Mr. Nanda on that, sir. Sir, coming to Mr. Nanda on that, as you said that the government has done its bit by not appealing in many cases. Sir, what more is on the wish list, apart from the much talked about dispute resolution, the equal treatment for LLPs, or for the middle class joint filing for the married couples? What else is on your wish list?
Madam, on the principle of equity, we would suggest that decriminalization of certain prosecution provisions be undertaken. I would give an example. For example, if TDS is not paid, that ultimately tends to be a prosecution issue. We should stop that. In case, if there is a failure to produce books and documents as per notice served on direction issued to the assessing by assessing officer, that is precisely under 268(5). So that should not be, we have to be very equitable when a prosecution has to happen. So we suggest that in these two provisions, we have suggested that to the government in pre-budget memorandum, that it should be waived. Now coming on to the removal of dual penalty for the same default and bringing down the quantum of penalty in line with the nature and extent of default is very important. I'll give an example. For example, a person is misreporting the income. It attracts a penalty of 200% of tax payable, which is correct. But apart from that, you have two more penalties. Now, if a wrong entry has been recorded in the books of account, 100% of that entry has to be taxed. That will be part of the taxable tax. And other than that, if it is an international taxation transaction which has not been reported, then 2% of the transaction value has to be taxed. So it results into dual penalty for an offense which has been conducted once. So we propose that all these things need be rationalized.
Yes. Mr. Nanda, a point very well taken that decriminalization should be on the government's top list. Coming to Amit Maheshwari, give me in a very crisp and short answer, what could be your two best suggestions that government can actually act on? What could be the two best suggestions that you would like to put forward, which you think government can easily do them? I think you're on mute.
I'm sorry. I think coming to what Mr. Ranjan was saying, it's very difficult to say what the government can do. But one thing is for sure, that prevention is the answer. And I think the more accountable you make the officers, the less disputes will arise. A lot of times taxpayers have very good success obviously in appeals and the tribunals. So I think the prevention of disputes should start at making the officers a lot more accountable. I think that's the number one thing which the government can do and they should do. Even in this right now, in this what we are seeing in the current cycle, there are hundreds and thousands of show cause notices being issued with very short time periods. Orders are coming in where the assessees, taxpayers, submissions have not been taken care of. So I think the disputes start at the assessing officer level. So that should stop at least. If some accountability can happen, that is very important. And I think a couple of other points which was shares like the APA, I think it obviously helped in bringing the transfer pricing disputes dramatically. But I think having them more time bound, that's very critical. I have seen cases in black money when you have FAIU notices where it could eventually lead to prosecution under the Black Money Act. You have thousands of taxpayers lying in the lurch who do not know whether their submissions, their investigation have been closed or not. I think,
Amit, I'm on a very short deadline, so I'll come for a closing remark from Mr. Akhilesh Ranjan. Since he has been a taxman, probably he could give a closing remark as to what can be expected from the upcoming budget.
Right. So as far as direct tax concerned, as I said earlier, I think The minister has already been talking about simplification. Minister has been talking about predictability and stability. I think the government is on that path already, but it's just that some further actions have to be taken. So we have now rewritten the law. I think what is required is a simplification of the system as such, as is what I was saying. And most importantly, for building trust, Amit has just mentioned about some measures like accountability. I'm all for that. I think that is something that the government should look at. We have a citizens' charter. It's there in the statute, but there is no way of enforcing that. There has to be some way in which accountability can be introduced by making that charter more effective. If we can build that trust with the taxpayer and show the willingness of the government to come forward, I think a lot of compliance improvement can be seen, and that's what the government really needs now. With a very moderate tax structure.
So definitely the ask is for further simplification, equal treatments where entities are equal, and yes, most importantly, if more cuts can be given, then it should be for the middle class. And with that, it's a wrap on this special broadcast. Thank you for watching and stay tuned. More is being lined up on the other side.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3.
Hello and welcome to Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3, a platform where influential leaders come together to examine the ideas shaping India's economic and institutional future. Today's conversation centers on India's next phase of growth, competitive manufacturing, greater participation of women in leadership, and family businesses anchored in strong governance and succession. Joining us today is Ms. Mallika Srinivasan, Chairman and Managing Director of TAFE, one of India's most respected manufacturing leaders. Under her stewardship, TAFE has emerged as a global force in farm mechanization, combining scale, innovation, and a strong commitment to inclusive and sustainable growth. Her perspective offers a rare view into how Indian manufacturing can compete globally while remaining deeply rooted in national priorities. Alongside her is Mr. Cyril Shroff, Managing Partner at Cyril Amarchand Mangaldas, a leading voice in corporate law and governance. Through his work with businesses, boards, and policymakers, he has played a pivotal role in shaping the legal and governance frameworks that underpin India's economic transformation. Together, they explore how India can strengthen its manufacturing base, expand women's participation in the workforce and leadership, and ensure that family enterprises evolve with strong governance, clear succession, and enduring values. Ms. Srinivasan, Mr. Shroff, as always, thank you very much for being part of this program. Let's kick this off. And I want to sort of start, Ms. Srinivasan, with you. At a recent interview, you spoke about precision agriculture, automation, AI, and IoT as key to the future of farming, and TAFE targeting around 2 lakh tractors annually with strong export growth. I mean, if you had to write a so-called manufacturing manifesto for India 2030, from your vantage point of farm equipment, what would be your 3 non-negotiables on policy, infrastructure, and talent, ma'am?
We are the world's largest market for tractors, and in this segment is the largest volume segment in the world as well. Our products and our technology, we have demonstrated quality and innovation at an international scale. And so we genuinely believe that we have an opportunity for a global play. The first, I think it was Asian players, including us from India, who formed the first wave of disruption in our industry. And the next and most imminent wave of disruption is coming from precision ag, automation, precision ag tech. So if you talk about the policy in this context, I think the one policy initiative that we would expect would be for support of innovation, support of R&D. And I'll give an example. We were at a show, the world's largest show for farm equipment was Agritechnica, that was recently held. And all the startups there, you see, they had funding from the EU. EU-funded, EU-backed startups. And of course, we know what it is with China. And with the EV advantage that China has, we expect that tech advantage to spill over into other areas as well. So I think that is the first policy initiative. The second, in terms of infrastructure that you referred to, would be for our own agriculture, for our agri sector to benefit, would be the availability and offering of very accurate positioning services, pre-positioning services. This is the whole foundation on which automation rests. And with all its benefit, what we have today in the country, which is offered by the Survey of India, it doesn't have quite the required level of accuracy and is charged. And financing support, of course, would be another policy initiative that one could touch upon, perhaps shifting the emphasis from the support that we receive today for mechanization to a support for new ag tech solutions for small farmers of our country. And finally, I think in terms of talent, I think our focus needs to be, so far it has been on agronomy. We'd like to see a shift from that to agronomy with technology.
That's very, very comprehensive, very, very well laid out in that sense, ma'am. Mr. Shroff, what do you see as the biggest legal or regulatory sort of bottleneck to manufacturing and making in India?
So let me build upon what Malika ji has said and add to it a kind of a layer of policy and regulation. I think for investment to happen and growth to happen, capital needs to feel secure, whether it's Indian capital or foreign capital. And so long as it doesn't feel secure, you always have this struggle of underinvestment. So when does capital feel secure? I think it feels secure when there is regulatory certainty, there is certainty of contract enforcement and dispute resolution, and there are clear sectoral policies. And, India has changed from the time when everything was relationship-based and, whose telephone number you have on speed dial, to now, which is a much more rule-based system. And the rules need to be clear, because what is worse is neither being relationship nor rule-based, and somewhere in the middle with gray rules as well. So clarity of rules, I think, is the most important thing. So, and India has now changed, evolved a lot from being a rule taker of what happens in the West. We are now rule makers. India has a lot of self-respect in terms of its policy making agenda and what it does, and you've seen that across many sectors. So I think there is a great opportunity for Indian rule making to become clearer, and which will facilitate how capital feels secure and businesses are finally commercial enterprise needs to be profitable.
Mr. Srinivasan, if I can come to you, I mean, TAFE, as I said earlier as well, I mean, is built for global markets, right? I mean, it's moved away from India's India first kind of approach. What are the 2 or 3 most critical policy or structural changes India needs to implement to make its manufacturing sector consistently competitive on the global stage, especially in high-tech and value-added areas?
I know much has been said about the ease of doing business, and I think Stroff also perhaps alluded to that in his comment. But I'll talk on just 2 other points, perhaps. One is, if you look at our cost structure, it is in the larger ecosystem, a critical point has been traditionally, we've been talking about our infrastructure cost in manufacturing. Our costs have been high. But this is one area where I think we have good tidings. We've seen some very good progress in this area. Government has invested very significantly in the infrastructure sector. With our road network has grown very fast. Our investment in the railways is perhaps 9 times what it was a decade ago. We've seen many more airports and metros come up. So all of this, we see a significant impact in terms of a heartening trend. And we are expecting logistics expenses to come to a more competitive 9% of GDP. But what we still find a little short is our warehousing. In terms of the infrastructure, warehousing availability, if you look last year, I think the demand was greater than, the supply was very short. We had 1.4:1 in terms of demand is to supply. And our PPP models with respect to developing infrastructure have also had only very limited success, maybe because of the risk sharing and also due to access to financing for the private sector. So we still have some concerns in that area, but we're making some really good progress. But the one area that I think I would like to touch upon, which completely corporates can do, is the need for investing in R&D. Be globally competitive, and you mentioned high-tech areas, and I include both traditional areas as well as high-tech areas. To be there, it is surely India's decade. The coming decade is surely India's one. But for us to make those strides in line with our national ambitions, R&D becomes a very important area. Undoubtedly, our R&D has almost doubled over the last decade to 1.27 crores. But most of the R&D is restricted to the public sector. Only 35% of our R&D is coming from the private sector, much lower than what you see in other innovative innovation-led economies, be it the US or China. So therefore, I think whether it's traditional industry or you're going for new sectors in biotech or advanced manufacturing or AI, the creation of IP is going to be most critical for our growth.
On that note, we'll take a quick commercial break. When we return, Mallika Srinivasan and Cyril Shroff will continue this conversation looking at leadership, governance, and the future of Indian enterprise.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3. Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3.
Welcome back. You're watching Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3. We're in conversation with Mallika Srinivasan and Cyril Shroff discussing how India can build competitive manufacturing, unlock women's leadership potential and strengthen family businesses through values-led governance. Mr. Srinivasan and Mr. Shroff, let's move on to one other element which doesn't get discussed as often, but I think is an important element when we talk about how to increase productivity, output, etc. in India. I mean, more manufacturing here in India, which is, of course, female participation in the workforce. Ms. Srinivasan, you've been passionate about this. At IIM Lucknow, you contrasted India's roughly 35% female workforce participation with 73% in Kenya, 61% in China, over 50% in Malaysia and Indonesia, and pointed out how few women still make it to CEO and board chair roles in India, here in India. Now, if we wanted to move that 35% meaningfully upwards in the next 10 years, what are the social transformations required to increase the pipeline of women in the workforce and to make sure that the pipeline is not leaky and women make it to the top?
Well, can I start with a good example? Because just to illustrate the point, I think Tamil Nadu, and I'm proud of our home state, Tamil Nadu is really leading the pack when it comes to women's participation in the workforce. We have the largest, I think over 43% of women in manufacturing are in the country are in Tamil Nadu. So we have very high enrollment rates in education, etc. But this is not just a coincidence, because it is for decades of inclusive policies, inclusion, and consciously building that social mindset and that social consciousness. And I'm glad you used the word social transformation. And I think it's actually indeed social transformation. Even states like Tamil Nadu are going with very iconic programs now. And let's see, there's a new recently launched program called the Tamil Nadu We Safe. And how it attacks this issue, despite being ahead of other states, is to look at it very holistically. It is to look at it from all angles. It's multi-sectoral, it's multi-organizational, government, private, NGOs, all coming together. And it's backed by World Bank funding against targeted outcomes. Covers everything. Covers from safety to childcare to supporting entrepreneurship to building a social consciousness to building awareness. I think it needs to be, the social transformation is at the heart of the problem. And while we have a lot of discussion around what are the root causes, if you really look at the root causes, it can be because the decision makers, most women need someone else to take a decision about whether they can work. And while people understand the importance for women to work, most people prefer that they take a part-time or a small business or a part-time role or a small business, and very few use childcare. So I think there is a social transformation that needs to start at home with equal access to resources, from nutrition to education to finance, and then go through into our education system where it is not just taught but demonstrated. And the concept of workload sharing, for example, needs to become a social norm. It's going to be a slow progress, but perhaps it will take us a generation to make a complete transformation, but we need to start.
No, absolutely. And so important, that some of what you said does take place and happen. Mr. Shroff, you've been closely involved with corporate governance reforms and discussions on gender diverse boards in the country, including the push for women directors and better governance scorecards. Why are we still stuck in are we stuck in the tick box mode on gender? And what would a genuinely outcomes focused governance framework for women's participation look like? I mean, if you could sort of give us the example from law firms and the legal world, including your own firm, sir.
I think firstly, we have to recognize that gender equity is an economic issue and not just a social issue. I think you need to sort of play at both levels. And outcomes actually start improving only when you treat it with that level of seriousness as an economic issue as well. So I think the IMF has commented that if there was even a 50-50 workforce between male and female, India's GDP would increase by almost 36% and global GDP would increase by about 25% from what its levels are. So it is not insignificant at all. And it cuts across different sectors, different industries. law firms you mentioned, they have traditionally been quite gender inclusive. You take my own firm, we're over 60% women, including at senior leadership level as well. And I think, it's almost the opposite of what we see around us. And it has worked very well for us. And this is a movement that is happening actually starting from law colleges and universities as well, where the graduate class that comes out is to start with itself, very female heavy, and then they continue. I think the interesting thing also is that in modern law firm careers, it is possible to continue the journey through, and not just after 4 or 5 years there is a tendency of a drastic fall. That has not yet happened, and that is one of the reasons why even in our firm we have seen this do very well. Now, speaking of corporate governance on a more India Inc. kind of perspective, I think the problem is that it is still seen as a bit of a tick the box. And I think the problem starts with how promoter families quite often are structured. There are progressive families where women are treated equally and have equal opportunity. One of them is on the screen with us just now. But on a more general basis, I think the fact is that successful women are sometimes seen as an exception. It should in fact be treated as a norm. And I think the way in which this issue should be, leadership issue should be approached, should be gender neutral, the best person for the job. Because you should realize that businesses are essentially capitalist structures, whereas families are more socialist structures. It is important that in a capitalist vocabulary, that the best person for the job should win. So therefore, in families itself, where 70% of corporate India is still founder run and for the promoter families, I think the change needs to start there. And when you start seeing the change emanate from there, you will see it flowing into mainstream India Inc. as well, particularly in older businesses. So I think that it's a more complex issue, which impacts families, it impacts succession, and it impacts really how modern India is to be built.
That's well put, Mr. Shroff. Ms. Srinivasan, let's move on to one other topic, one other issue, which I think our viewers would love to hear from you. This is family businesses, the question of succession, and really values-based governance, which many of the old family sort of led businesses have displayed, like yours. You've often said that ethics, quality, and human values are the bedrock of TAFE's culture, and that values form the core of a successful work environment. Mr. Shroff has often argued that India's corporate governance must reflect Indian values and family realities, and not just imported, sort of, to use that word again, checklists. Where do you see Indian family businesses getting this values governance balance right, and where can we improve?
I think values drives the governance. So if you can instill values and imbibe them, and then they dictate a kind of behavior pattern, and everyone knows what's acceptable. I agree. A large percentage of India's businesses are family-owned, promoter-led businesses, and therefore the succession planning models, the governance related to succession planning models, cannot be a cut and paste from Western models, and we'll have to evolve them for ourselves. But nevertheless, that having been said, articulation of governance standards and adherence to these with a strict audit as well is certainly important and protects the investors. Where can we improve? I think once we need to look at the governance need, the family leadership needs to take these principles, internalize it completely, and make sure that the reverse also happens, that the governance that you want to see is put into and institutionalized into the value system of the company. We can perhaps do better on that.
Mr. Srinivasan, you've publicly backed robust succession planning and spoken of grooming Dr. Lakshmi Venu into the leadership at TAFE. But this is a broader question, but your perspective is important here. What needs to change broadly, as you see in Indian sort of industry and other groups, in shareholding structures, role design, family governance, if we want to see more women from promoter families to be serious contenders for CEO and not just sort of, shareholders and other roles for the CEO position? What needs to change, ma'am?
I think if you want family women in the family, and if they're ambitious and they want to be in the business, I think the journey needs to start fairly early on in their lives. It starts with education and equipping them with the necessary skill sets that will give them a good chance for success. That having been said, I think every family is different, the culture is different, the business is different. So as you plan your succession, one needs to think carefully with respect to how do you bring them into the business? Where can they add value? What is the individual's personal strengths and weaknesses? And I think what we should do, perhaps we don't do well enough, is a formal system of periodic review, interaction, feedback, because that hones perceptions, that hones expectations, and makes the whole journey smoother, and you can put down a development goal and take it forward. I know you would think that I'm saying something that's very similar to what we would do with a professionally run company or a combination of professional and family company, and why would it be different for a family member? It is different because it needs to be more sensitive. There are also a lot of family dynamics that come into play, and therefore this requires a little bit more nurturing and careful handling.
Well put, ma'am. Mr. Shroff, you've had a sort of ringside view to many of these things across many large business families. You've sort of been involved in drafting family constitutions, succession frameworks. You've written about power structures inside family businesses. I mean, so same question to you, sir. What needs to change in this regard?
I think two things. Firstly, succession is not an event. It's a multi-decade journey. I think you have to recognize that it is actually a whole process that has to be carefully navigated, and actually you have to run the process very carefully. That's point number one. Secondly, I think probably because of the hierarchical structure of families, not enough open conversations take place. I think the manner in which you handle the complex succession of a family-run business is that there needs to be a lot of open conversations, and it is ideally done at a time when the kind of patriarch or matriarch are in charge. It is a very difficult conversation later on when it is a conversation amongst peers rather than in a kind of a conversation where there is a kind of a senior voice that is involved. It is just from a technicality point of view, it's not the toolkit is fairly simple. It's the manner in which you handle the sensitivities about it, the fairness and the transparency that is brought to it that makes the difference between a successful succession and an unsuccessful one.
Brilliantly put, Mr. Shroff. So much to talk about, but I think such an insightful conversation. I really enjoyed it, and I hope our viewers did as well. That's all for this edition of the Thought League. A big thank you to you, ma'am, Mallika Srinivasan, and of course, Cyril Shroff, for sharing your insights on manufacturing, women's leadership, and the governance frameworks that will shape India's economic future. Thank you for watching. Stay tuned to CNBC-TV18.
Cyril Amarchand Mangaldas presents CNBC-TV18, The Thought League Season 3,